supporting the markets. Having said that, the Saudi Arabia also said yesterday they are pushing for increase in production and could penalize the members producing more than the quota. So that is something that will keep the prices in cap there. Having said that, the precious metal prices have seen some profit taking. Gold prices have seen a decline. The positive about gold, though, is that every time you see a decline coming in for gold, there is a buying opportunity as investors see it. So when you look at the gold ETF, it's recording net inflows for 115 tons in the month of April. The global gold ETF holdings are the largest in over 3 years. Some bit of a profit taking, though, is what we've seen in case of metal prices. Copper did gain 1% overnight and silver did gain 2% overnight. But in the Asian markets right now, it's stabilizing a bit. What has seen stronger gains, though, has been the sugar prices trading at a 1-month highs and the rubber prices as well trading at a 5-week highs. So many of these industrial agriculture commodities seem to be doing quite well.
Manisha, thanks a lot for that update. We'll keep an eye out on all of these commodities as well. With that, we call time on this edition of Power Breakfast. From me and the team that put this show together, thank you so much for watching. Bazaar Morning Call sets you up for the day's trade.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant with you, my colleagues Nigel and Surabhi. Guys, good morning.
Hi. Good morning, folks. So middle of the week. Yep. Kind of muddling along right now because Monday was great. Yesterday was a pause. We have lots of global news to discuss as well.
Well, that's right, Prashant. So let's get straight to the action.
The S&P is, by the way, in the black for the year.
Yes.
After being down 17% earlier this year.
I mean, it's just what, May, right? And already we've had up and down and down and up. So it's just an absolutely crazy year so far. But let's take it from the top. I mean, what really happened? As I said, the S&P 500 took out 5,900, 5,900 as a level intraday, and we ended at about 58.86. But we've now reversed all of the losses of 2025 so far. Black for the year. That's quite something. Now, the final close, S&P about 0.75% higher. Nasdaq was up about 1.6%. The inflation numbers were softer than expected. So this is the thing, right? Despite all the tariffs and all the front loading, and I mean, of course, this agreement, US-China agreement, just happened now. The data does not reflect this agreement because this is past data, but it was softer than expectations. But look at the market reaction. That was not, I mean, yields were down 1 basis points after the big 12% move the day before. It's about 4.5% of the 10-year. Dollar, though, I think came off more sharply, about 0.75% lower on the dollar index, almost 101 or so by the US market close time. Oil prices, and I've been saying this, oil's kind of felt out of sync with what's happening with equities because it's largely risk on. I mean, if it is financial flows, it kind of goes into everything. And oil is another commodity, and financial flows have been going into equities, and oil's still down quite a bit. So maybe there is a bit more catch up here in that sense. I'm not talking about fundamentals in terms of more supply in the market or anything of that sort, but keep an eye. Now, President Trump is, of course, in the Middle East, and he said he'll lift all sanctions on Syria. That is one. He also, by the way, said that the Saudis are going to invest $1 trillion. And this is, this trip largely is to kind of show deal wins and investment wins, etc. On the other side, NVIDIA is going to sort of, work with Saudi public sector company. NVIDIA, by the way, was up about 5-6% yesterday. So more on this later. Goldman Sachs, I put this out yesterday, Goldman Sachs has upped their forecast for GDP in the US to 1%. Now they've also raised GDP forecast for China. So it's 4.6% compared to 4% earlier. This is for this year, that is 2025. And I mean, if you are somebody who follows flows and kind of, regional flows, etc. I mean, China certainly after this deal, it's getting more and more, the view is getting more and more entrenched that they've gotten a lot without giving in too much. So they've been unambiguously the clear winners, at least as far as round one is concerned, between the US and China, Trump and China, rather, I should say. Now, just to tie in the levels, Nifty yesterday, of course, gave back about 40% of Monday's big gains. The immediate support, I mean, is the 40 hourly moving average, which is 24,485. It's about 100 points out from where we left off yesterday. That should hold. I mean, if this is a tactically risk-on kind of a market, I mean, hourly average on the hourly chart should not break. So I'd watch out for that. And of course, I mean, the recent highs, etc., are a reference point on the way up. Nifty Bank, the support here is the 20-day moving average, which is 54,504. Again, I mean, it's less than 1% away from where we left off yesterday. And of course, here as well, the 550 was the high that we saw yesterday. And I think you need to see a break above that. I mean, the big cut, of course, was in the Nifty stocks, not so much in the Nifty Bank. And of course, the broader markets actually, if anything, ended higher. They were actually up on the day, even on a day like yesterday. GIFT Nifty will give you a quick sense of how we are starting. It's a 90-point higher start. Surbhi.
It's looking actually quite impressive because not all markets in Asia are showing this kind of enthusiasm today. The picture's getting a little more mixed because that big event has played out on Monday. The question is what happens from here on. So let's talk about, how some of the Asian markets are poised. The Hang Seng is doing well. Taiwan's doing well. The mainland Chinese market is absolutely flat. There's some profit taking in Japan. So you're seeing a mix of green and red across the Asian screens. That's point number one. Chip stocks have been higher because of this deal that was announced in Saudi Arabia with NVIDIA looking all set to sell a lot of its powerful chips to a Saudi company. This is 18,000 GB300. These are their most powerful Blackwell chips. They are selling these to a Saudi company called Humain. And because of this large order, the stock was up about 6%. And a lot of that enthusiasm has now spread across to chip-making stocks in Asia as well. This will be used for large data centers, etc., by the Saudi company. The S&P, of course, has turned positive for the year. So the positivity and the follow-through from that US-China trade deal was still very much evident in US stocks. The question is how much of it continues in Asia. And for us, I mean, really where things stand. By the way, crude gained 3%. A lot of markets are pulling back. So crude gained 3%. That was the, that continuing reaction to the US-China trade deal. But since this morning it's cooled off, for us, it's important to note that crude has snapped back to about 66 from falling below 60 a couple of days back. So keep that in mind as well. Now for the Indian market, we've had the reaction to two mega events. This cessation of hostilities between India and Pak and the global, event, which is the US-China trade deal. The two events are over. What now? And the market is in a bit of a what now situation. Now, the what now is not being answered too positively or too emphatically by FPIs, because if you're looking for very large FPI flows coming back in, it hasn't happened yet. Could it start, in the coming days? Who knows? But let's get the flows picture. Yesterday, they were, in fact, on the sell side. Sold off cash market stocks worth about 470 odd crores. Domestic institutions were buyers, so no problems there. About 4,300 crores of buying coming in from the DII fraternity. But that FPI number has been a little confusing. 1 or 2 days of selling when the escalation was really on. Then 1 day of pause. Yesterday was a sell. So let's see. The FPI trend's not very clear. There is macro cheer, however, in India, and that's inflation. Guess what? CPI inflation falling to an almost 6-year low. This is the lowest print that we've seen since July of 2019, so looking very good. And the deceleration is being led by food prices, by vegetable prices, because there the fall in prices is very, very severe. Vegetable inflation is at a minus 11% versus a minus 7% month on month. So it's looking good on the CPI inflation front. Obviously, the expectations from the RBI, therefore, perhaps go up a notch. Lots of stocks and news. It's the fag end of earnings season. Some big numbers have come through. Tata Motors is actually not looking too bad. Their profit is above estimate. And more importantly, they've managed to meet the lower end of their margin guidance for JLR. But the commentary is cautious, given what's happening in the global backdrop. Bharti Airtel, again, steady numbers coming in. ARPU has, if you look at it year on year, it's a massive surge, 245. But of course, quarter on quarter, that ARPU is flat. But otherwise, the numbers are more or less ahead of estimates. And watch out for defense stocks, right? They rallied yesterday as well because the mood is still very much in their favor. The numbers have to add up as well. And for Garden, they're actually adding up. The numbers came in and they're looking very, very good. So we'll watch out for this. Leave you with today's results tally. Some interesting names today as well. There's Eicher Motors, Lupin, Shree Cement. There's HAL, Hindustan Aeronautics, and Jubilant Foods. So I think a lot of those earnings will keep us busy today. Nigel.
Well, that's right. And it looks like the Nifty could see a little bit of a consolidation in the near term, but it's heartening to see that we have the broader markets that are outperforming, because that's what makes your portfolio look quite good. Let's take the top cues then. Yesterday's trading session saw the premium on the Nifty. In fact, that contracted. You were wondering whether or not there was unwinding of positions or there were shots that were getting added. I'll tell you what, there was a bit of both, because there was unwinding of positions for the Nifty as well as the Nifty Bank. If you look at the total open interest, it was low in yesterday's trading session. So that's the market on the whole. And from the FI basket, well, they added short positions. I was mentioning this a couple of trading sessions ago. You want some shorts into the system, and it seems my wish at least has been granted, because you had some long unwinding in trade yesterday, and you had some shorts that did get added. And now if you look at the net short positions, well, it's moved to around 35,000 contracts on from the FIs on index futures. So this is the highest that we've seen in the last 20 days or so. Even if you look at the stock futures, well, they added some shorts yesterday, but that could be a bit of an arbitrage that's playing out. So there was some kind of, unwinding that we saw on the stock futures. We just get to that in a bit. The clients, what did they do? Well, the clients have been getting this correct, and they were net short on the index. Now they've done a bit of a U-turn. So they've gone net long. So this actually is a good combination for the markets to trend up. The FI is short, the clients long, because they have been getting it correct. But as I said, what do the FIs do, on stock futures? That comes up for you. Some long unwinding as well as short addition. There could be an element of arbitrage out here. Moving to the options data then. Yesterday, we had made this point that the PCR was moving towards the higher end of the range. So it had moved to around 1.3. The higher end of the range was around 1.5, 1.6. But that's cooled off. How did that happen? A lot of those puts that were written, they came in for unwinding in yesterday's trading session. And on the call side, you had a mix of activity that was seen out there. The call writers, in fact, came back into play. The 24,600 call had a good amount of open interest built up out there, premium at around 128 rupees or thereabouts. And the 24,800 call as well, there was a mix of activity that we saw out here. Which brings us to the levels. Going by the options data, going by the recent resistance level, on the way up, the 24,500 was a bit of a hurdle. So that becomes the near-term support. This is the broad range you're looking at for the day. But you'll have to say the trend is still up till the 20 DMA is protected on the Nifty. And the Nifty Bank as well, that will become the first reference point for today's trading session, which is just 1% or so away. We should get the 20 DMA up for you on the screen. Stocks that I'm looking at, well, I'm looking at Z. That's one of the biggest underperformers over the last few years. But the stock actually has perked up, and yesterday it moved on very, very high volumes as well. They say that the promoter knows what's the asset value, and the promoter holding in this company is very, very low. But it was reported on the exchanges that 2 sessions ago, the promoter entity went ahead and chipped in some shares. So I'll keep an eye out on Z, because the commentary has been good, and now the promoter is sneaking in there and, in fact, buying some shares.
Okay, all right, got that. Thanks, Nigel, very much for that. So let's see whether the bulls can actually build on the momentum. Yesterday was a pause day. Will they come back or not? That's the question. Like we've been telling you, one good news that's come in is on the macro front here in India. because we're looking at CPI inflation really behaving itself. The question is whether it will continue. A lot of, the guests that we've been speaking to kind of indicate that. With the monsoons expected to be bountiful, perhaps this ugly monster of food inflation, perhaps it's, well and truly behind us. I think we'll have Lata join in just a second to talk about this. Yeah, I think we have Lata. Lata, good morning. So good news coming in on inflation.
Oh, yes. And it's important that it's repeating, month after month. At the moment, this, of course, for breaking records, 6-year low at 3.16. The last we saw it was in mid-July. And largely dragged down by food. Food is at 1.78% inflation. And that is, again, a 42-month low, which is what? 3.5-year low. And the components, cereal, vegetables are down even month on month. Cereals usually fall April over March, but vegetables start inching up because it is summer. This time we've seen vegetables fall 7% month on month. And of course, they are down a good 10-11% compared to year-ago levels. And mind you, this is food inflation is lower in spite of milk prices having been raised in April. So this is very good numbers. And I just want to point out a data detail. This is the 4th month that inflation is surprising our poll. It's from January, we have seen the numbers coming below our poll. This time the poll was 3.2. It's coming at 3.16, not much lower, but still importantly lower. Now, core inflation is another number I should mention. At it's actually at 4.1. But if you take away gold and silver, then it falls to 3.4. So there are really no complaints even about the components. If you're getting a sub 4% number all through, it looks like it's going to be surprising below economists' expectations for the rest of the year as well. For instance, in April, May, June, the Reserve Bank's forecast is 3.6. Now, first month, you have got April 3.16. The current one, May, is also expected to come in at 3.16. In fact, Goldman Sachs tells us that their number is 2.9 for the current month, May. Almost all economists believe that the Reserve Bank 3.6 will not be met at all. It will be a good 40-50 basis points lower, the average for April, May, June. So what does that mean? Everyone is going to lower their full year forecast, and many of them already have. Kotak and ICRA, for instance, have cut their full year CPI to 3.5. Earlier number was 4%. Reserve Bank's number is also 4%. MK and HDFC Bank, other economists we spoke to, are poised to cut it to 3.7. So all this means where will the repo rate stop? Of course, a cut is there on June 6th, but there are small noises that it could be a double cut. Then there are noises that it need not be just 2 cuts. You don't have to go to 5.5. If inflation is going down to 3.5, then you normally keep 1.5% plus. So 3.5 plus 1.5, the Reserve Bank can go all the way to 5. Kotak is saying that they're expecting 4 more cuts. So the point is the market is expecting a lot of help from the Reserve Bank, not just liquidity, but also rate cuts. The US CPI has also come in slightly softer than expected. So even from the global front, there isn't much of a challenge. We should expect a dovish RBI.
Lata, thank you very much for that. Guys, by the way, when Tata talked about food prices, have you checked on mango prices?
It doesn't show. Every time I open my quick commerce apps.
No, don't go to quick commerce. I'm talking about you got to go to the market.
The real market. Okay, fine, yeah.
Which one are you talking about now? 1600 for what? Which variety?
No,
you got to be specific.
No, I get
because they're all there now in the market.
I mean,
Apus, Safeda, there's Alfonso, of course.
I only stick to people who bring gifts home. When it comes to me too, they bring. I don't try to buy.
I'm looking, ma'am, for a gift.
All right. Well, it's really a bountiful season. It's a good harvest this time, and unlike the last year, actually, as far as mangoes go. Let's talk about the global stuff. Back to the global stuff. Paul Grunwald is global chief economist at S&P Global Ratings. He's with us. Paul, great to have you with us here on the program. Thank you for your time. Suddenly this cloud of global growth getting hit very severely because of US-China trade war is lifted a little bit. Have you made any estimate changes? I was looking at sell-side brokers like Goldman Sachs. They've lifted the China GDP forecast. They've lifted the US GDP forecast. We actually had the Goldman Sachs guest with us yesterday. Any changes you've made at S&P? Paul, are you there?
Sure. Yes.
Go on, please. Go on.
Yeah. So we had a forecast March, and then we had to revise that because of the tariff escalation on U.S.-China, and we put out another one on May 1st. Now that the tariffs have mostly rolled back and we're on pause, we're probably back to that March forecast where we've got China's growth around 4% this year, and the U.S. probably still closer to 2 on an average basis. But you are correct. I think this pause and reduction in U.S.-China tariffs gives a little bit of tailwinds to growth, at least over the next 90 days. We'll have to see how that pans out.
Yeah. Got it. We'll have to see how that pans out. Just one point, Paul, if you will, and this is with regards to India, right? India was looking like it'll be the first in line to get a trade deal. Yesterday, we got news that India is gone to the WTO and proposed retaliatory tariffs on US aluminum, steel, etc. You know, there's some chatter here, and maybe it's an unfair question to you, but that it's kind of is showing unhappiness with what the US is really doing on the some of the statements which have come with regards to India, Pakistan, and the conflict here. So that, leave that as it may, but what is your own sense on this issue here, India and India and the US and a trade deal and a potential trade deal?
Yeah, so we've only had 2 trade deals so far, and both of them have been provisional, right? We had one with the UK that was announced last week, and then we had the one with China over the weekend. We don't know whether those are templates for other deals, so it's hard to say what's going to happen to India. In the news reports here in New York, they are, of course, reporting that the U.S. is talking with many countries, including India. The pattern seems to be, for now, that the 10% that was announced on Liberation Day is a floor, and that so-called reciprocal tariff on top of that is up for negotiation. So again, that hasn't been declared as a template, but that seems to be the model the U.S. is using. I'm not sure China would be kind of a prototype, because that's a special, relationship with the U.S. and China. India might be with sort of another group, but remains to be seen what the actual negotiating space is. But that 10% does appear to be a floor for most of these negotiations.
Sure. Paul, on US-China, so it's a big climb down, right? From 145% to now they're at 30%. It's massive. Now, we don't know where it finally ends once this 90-day window is over. What's your best case sense? And more importantly, I think most are predicting a recession in the second half in the US right now. Do you think that can be averted? Or even if the US does go into a recession at some point this year, will it be a very shallow and fleeting one?
Yeah, let me take the second question first. We actually do not have a recession in our U.S. baseline, but we do have a very steep slowdown in growth. So let's remember the U.S. has been growing almost 3% the last couple of years. So we came into 2025 growing almost 3%. We think that's going to end up between 0 and 1. So we have a pretty big deceleration, but it's not actually a technical recession. And again, developments over the weekend with U.S.-China suggest the recession probability probably went down a bit. We're sitting at around 35% right now, but we'll be revising that in the coming weeks. Where US-China lands, that's really anybody's guess. I think we're all pretty confident saying that the triple-digit tariffs on both sides were not sustainable. That actually ground trade to a halt, as we know. But now we're at 10 on one side and about 30 on the other side for Chinese.
Yeah. I think we've just lost that line with Paul.
Like 6, one really knows.
Right. Paul, just one last question. If it looks like, the US has really, in a way, blinked first, and China's kind of sort of given in very little to get these tariffs down to this. And now, of course, there'll be further negotiations, which means US, this entire thesis that, US will collect so much in tariffs that they'll be able to lower taxes for Americans. And then there'll be a boost on that front. All that on the corporate tax front, etc. Does all that look a little shaky now, Paul?
Well, to be honest, we were never really true believers in that. Tariffs look like they're going to bring in something like $8 billion per year, which is not nearly enough to cover U.S. Income tax payments. And we were also a little bit that we're going to bring manufacturing back to the U.S. Our view is that there's no winners from the trade war, and the tariffs are actually a tax that's mostly paid by U.S. consumers. So we're pretty heartened to see the tariffs rolled back, and hopefully we can get them as low as possible. That's going to help growth and everything else, help central banks, et cetera. It's going to keep inflation lower. So we'll have to see how all of this develops. You know, Trump's style is very unorthodox, as we've seen so far, and we've had very volatile trade policy from the U.S., and we'll just have to see how that develops in the coming quarters.
All right, Paul, good conversation. Thank you very much. Appreciate you joining us here
My pleasure.
on CNBC-TV18. Well, let's just quickly run you through what's lined up here over the next 2 hours or so. So, 8:35, the management of Sirma will be with us on the fourth quarter earnings. 9 o'clock, you'll have the Gaurav Malhotra of Axis Capital to talk about the earnings from Bharti. And earnings are strong. 9:20, Krishna Sangvi of Mahindra Manulife Investment Management will be with us on markets. 9:30, PG Electroplus, another EMS company, on their fourth quarter numbers. Siva Chittur of Sai Life Sciences will be speaking with us at 9:40 on their earnings. Towards the end of the show, it's a special segment. It's the economy, and Lata will be in conversation with S&P Global Ratings and Neeraj Gambhir of Axis Bank on the impact of US-China trade deal on Asia and, specifically, India.
Time to slip into a short break. Got a lot of stock specific to track for you. Well, we are just going to run you through the top 10 list. Tata Motors, Bharti Airtel, Bharti Hexacom, Max Financial, Honeywell Automation. All of them will be reacting to positive news flow. Add to the list Garden Reach Shipbuilders, Coromandel International, Nykaa. While we have Siemens who will be reacting to the negative set of numbers, and crude sensitives as well. Expect a reaction out there. Stay with us.
Welcome back. So as we've been telling you, the cues across Asia are a little mixed. The implied open, however, has been telling us that we'll start strong, almost 80 points higher. So in sync with some of the markets like Hang Seng. Look at that, almost 90 points higher now. What about individual stocks? Lots of companies to look at, lots of earnings to go over. So let's straight away get to it. Our team is standing by with the CNBC-TV18 list of top stocks to watch. Guys, morning to all of you. Sudarshan, Tata Motors, it's all about these trade issues that are going on. But anyway, how's the company shaped up in Q4?
I'm going with mild green for Tata Motors due to two main reasons. First, Q4 earnings were largely ahead of expectations and outlook remains supportive. Now, talking about the earnings were ahead of estimates, but outlook remains cautious. And the guidance, if you talk about for Tata Motors, company will give guidance on June 9, that is Investor Day. And for JLR, the guidance will be given on June 16, that is Investor Day for JLR. Now, coming to the headline numbers for Tata Motors, both EBITDA and margin were flat if you compare YY, but it's higher against our estimates. For JLR 2, EBITDA margin was flat at 15.3%, but almost 100 basis points higher against our estimate. And for JLR, EBIT margin of FY25, company has reported 8.5%, which is almost in the line of the guided range that company had given. Now, going forward, what would be in the focus for JLR? First is the tariff increase. For the exports from UK plant, tariff increase is of 300%, that is to 10% from 2.5%. And for exports to US from EU plant, tariff increase would be 1,000%. So that would be in focus. For commercial vehicle, both trucks and buses segments have registered double-digit growth. But in the near term, company cost will increase because company has to transition truck business to AC. Now for passenger, both SUV and CNG segment continue to do well, but hatches segments remains under pressure. But going forward, company believes that new launches that company is going to take in FY26 will support the growth.
Okay, all right. Thanks a lot for that, Sid. Well, let's hop across to Rima, who's tracking Bharti Airtel and Bharti Hexacom. Welcome back, Rima. Fit and fine. Go for it. How are the numbers?
So pretty good for both Bharti and Bharti Hexacom. So first for Bharti, remember the numbers are impacted because of a full quarter consolidation of Industars versus only 43 days in the prior quarter. That's Q3. We're looking at the numbers on a quarter-on-quarter basis. So that explains the big improvement seen in the consolidated numbers. So revenues have gone up 6%. EBITDA is up nearly 10% on a sequential basis. The bottom line is a lot of exceptionals. But if you strip that out, analysts say that the numbers are largely steady. The company continues to execute very well on the India mobile front. Revenues have gone up 1.3%. Their margins have expanded further to 59.2%. That's the India mobile EBITDA, 59.2%. ARPUs are steady. That's the average revenue per user at 245. Subscriber addition healthy at 5 million in the current quarter. So all in all, good set of numbers. Africa led to the beat, but Africa numbers were known. India numbers are pretty much in line with expectation. Conference call today at 2:30 p.m. Hexacom has reported a beat. Top line growth 1.7%, margins 53.3%, and the bottom line has been boosted by an exceptional gain of 82 crore rupees. Back to you.
All right, Rima, thank you very much for that. That's Bharti and Bharti Hexacom, and you'll hear from an analyst at 9 o'clock on these as well. Max Financial Services reported numbers. The insurer, Yash, is here with details. Yash, morning.
Well, morning, Prashant. So it's a double positive as far as Max Financial Services is concerned. I'll speak about the first one. Here, the numbers for the quarter have been very, very strong. A beat on all counts, if I may say so. Total AP that has come in at about 3,339 crore rupees versus CNBC-TV18 poll of 3,039 crore rupees. Retail AP is bang in line with what CNBC-TV18 had estimated. Value of new business, that's where operationally strong performance is coming. A strong beat and a growth of about 8%. Margins, again, on a year-on-year basis, they're up 45 basis points, but again, a very strong beat at 29.02% versus poll of just 26.06%. This is the first positive, and the companies ended the year FY25 on a very strong note, but the month of April has again been very, very strong over a strong base which the company had. So, of course, ending the year on a very strong note, starting the next financial year again on a very strong note.
Okay, all right. So looking good for Max Financial Services. Thanks for that, Yash. Let's get to Pasna now. Siemens and Honeywell Automation, two numbers from the capital goods and industrial space. Pasna, morning. How are they looking?
Good morning. First up, let me start with Siemens. Now, overall revenue was in line with Nomura estimate with a growth uptick of 3% on a one-year basis. Company's EBITDA, EBITDA margin and net profit, all three missed estimates. Now, it is also important to note that the demerger of the energy business is effective from 25th of March 2025 onwards. Now, coming to the company's overall EBITDA, it stood at 467 crores with a downtick of 27%. Company's EBITDA margin stood at 11% versus 15.3%, downtick of 436 basis points. Company's PAT stood at 408 crore with a downtick of 37%. Now, company's PAT declined mainly due to under absorption of fixed cost and higher cost of material in the digital industries business. It is also important to note that PAT was also impacted by an extraordinary gain of 192 crore from the sale of property in Q2 SY24 and demerger expenses of 63 crore in the current quarter. Now, next up is Honeywell Automation. After the last few quarters, company missing consensus estimate. After several quarters, company has reported revenue, gross margin and EBITDA above estimates. Now, revenue saw an uptick of 17% on a one-year basis, 3% higher than the Bloomberg estimates. EBITDA stood at 159 crore, down 6%. EBITDA margin saw a downtick of 357 basis points, which was largely in line with the estimates, and company's net profit missed estimates due to higher effective tax. The number as 140 crore in terms of PAT with a downtick of 6%, 9% lower than the Bloomberg estimates.
Going with red, right, on Honeywell as well.
Green, I expect, and Siemens, I'm going with red.
Siemens is red, all right. Got the head of us, and thanks very much. So mixed numbers from the industrial stocks. Let's talk about defense names. Tall expectations here because the stocks have been going through the roof. Ria is joining in. Ria, Garden Reach Shipbuilders, at least optically those numbers were looking good. Tell us more.
Well, yes, good morning. Garden Reach Shipbuilders has reported quite a good set of numbers in this quarter. The revenue has gone up around 62% on a year-on-year basis. Even the EBITDA and net profit have jumped up by 144% and 119% respectively over the previous year. EBITDA margins have also seen an expansion of around 454 basis points, coming in at 13.5% in this quarter versus about 8.9% in Q4 of last year. For the full year FY25 as well, we've seen good growth on all fronts. The net profit margin has also been above the guidance of the company of over 8%. The order book details haven't been disclosed yet, but as per the Q3 earnings call, the company had said that the order book is expected to come down to around 22,000 odd crores at the end of FY25 as execution is picking up, and the order book at the end of Q3 stood at around 23,877 crores. Some key things to watch out for going ahead will be the management's comments on the order book and execution, and an update on their key project, which is the delivery of the 8 ASW shallow water crafts, all 8 of which are to be delivered by the end of October 2026. And remember, the first one was delivered just last week to the Indian Navy. So overall, good set of numbers for GRSE, and expecting the stock to open in the green today.
Okay, all right. Thanks very much for that, Ria. Now the MSCI changes, and let's put the spotlight on some of those stocks where those revisions have happened. Vivek, take it away.
Well, that's right. So overnight or very, very early morning today, MSCI went ahead and announced the changes. This is as far as the May 2025 index review is concerned. The index that we track very closely is the MSCI Global Standard Index, where there are 2 additions that have been made, and there will be a significant amount of impact, especially in terms of passive fund flow. When will the adjustments take place? The adjustments will take place on 30th May 2025. 2 additions, no deletions. So when you're talking about the 2 additions, Coromandel International makes its way into the standard index. IIFL Capital expects close to $227 million of inflows into this particular name. The other stock is FSN E-commerce, or Nykaa, or more popularly as it is known as. Over $180 million of inflows is what IIFL Capital estimates. Along with that, there will be some stocks from the small cap and mid cap too in focus. MSCI small cap index has seen 11 additions and 22 deletions. So overall, Coromandel and Nykaa make their way into the MSCI Global Standard Index.
Okay, all right, Vivek. Thanks a lot for that. Well, let's hop across to Manisha. She's here to tell us about the crude sensitives, because they'll be reacting to a bit of a pop that we've seen in crude oil prices. Morning, Manisha.
Morning, and thank you for that, Nigel. Well, yes, a 4th straight day of gain coming in for the crude oil prices. It's trading at a 1-month highs right now, while the US and China coming together for at least a temporary truce for the 90 days is something that clearly has been supportive. But apart from that, the markets also are looking at improved outlook on global trade flows. The fresh sanction threats against Iran also seem to be doing the trick, that we have seen support come in for the crude oil prices. There are buying calls actually coming in for various banks and brokerages globally as well. The only thing to watch out for would be Saudi Arabia pushing for increase in production for the month of May and June. And it also says that they will penalize members producing more than the quota. So that is something that could perhaps cap the gains in prices. But apart from that, the last couple of weeks have been good for crude, and this one continues in the positive side as well.
Okay, all right, got it. Thanks for that, Manisha. Indeed, watching out for crude quite carefully now that it's back above 66. Quick recap of all the stocks to watch today. The ones that have positive news flow or earnings around them are Tata Motors, Bharti Airtel, Bharti Hexacom, Max Financial, Honeywell Automation, Garden Reach Shipbuilders, Coromandel International, and Nykaa, green on the back of the MSCI edition. The only stock with negative news flow on our list today is actually Siemens because of numbers. The crude sensitives obviously in the watch zone, that is OMC's paint stocks as well as aviation stocks. ONGC and Oil India could be reacting positively because of the surge in oil prices. Let's take a break on that note, come back on the other side, and we'll have the management of Syrma joining in to talk about their 4th quarter performance and outlook ahead.
Welcome back. Well, as promised, let's get to our first management on the show. Sirma SGS, we have with us Mr. Gujral, the MD at the company, who joins us. Hi, Mr. Gujral. Good morning. Good to see you. Well, on the top line, it appears a little bit softish, but your margins were a pleasant surprise. For the coming year, that's FY26, do you stick to the revenue growth of around 30 to 35%? And do you want to up the margin guidance of around 7.5% post the last quarter showing? So give us both those two numbers, revenue growth, margins, and what will exports come in at? It fell short a little bit of in comparison to the 1,000 crores that you had guided earlier.
Yes. So if you recall, when we had the earlier earning calls for the quarters, I had always advised and suggested that we should be looking the company for a year as a whole and not quarter on quarter. So the 12-point odd senior upwards of 12% EBITDA margin in Q4 is essentially driven by the product mix, where my industrial and healthcare accounted for almost 50% of my revenues. And these are margin accretive segments. We had guided that we would bring down the low margin consumer business to 35% of our revenue from 40% last year. We have achieved that. Going forward, we believe that for the coming year, we would be able to do a revenue growth of about 30 to 35%, which would primarily be driven by the product mix. If my high margin businesses go up, the revenue growth could be slightly lower, but it will be margin accretive. We had guided for a EBITDA margin of 7 on a blended thing for a year as a whole. We have driven 8 point something. On a conservative basis, I would guide 8% EBITDA for next year, which in rupee terms would come to about 400 odd crores.
400 crores. Just one more thing, sir. What about exports as a percentage of your mix?
Exports this year we were targeting, and I had shared with the street that we would be crossing the 1,000 crore marks, but they have been muted. We have almost been there where we are, though for a 4-year CAGR, we have grown at 15%. I expect to cross that milestone, which we should have crossed in FY25, in FY26.
So 1,000 crores in exports, that target remains.
Yeah,
Mr. Gujral, okay, got that. So Mr. Gujral, sir, for this year, FY26, you're saying that top line growth should be in the region of 30 to 35%, margin guidance of 8%. Let's talk about this product mix as it's changing, because you're bringing down the share of the consumer business. So what will drive the growth? I mean, how quickly can the industrial segment ramp up? What is the growth that you see ahead for industrials? Because that's your high margin business, right?
Yeah.
What kind of companies, so what kind of companies, what kind of contracts are you looking out for? And will, industrials, will that be driven more by local contracts and domestic growth, or will you focus on exports here as well?
Industrial would be driven both by local and exports. And in the domestic market, the key driver will be the smart metering business. Last year, we did almost like 4 million pieces of smart metering electronics. So growth in exports would primarily be driven by industrial and healthcare. Automotive exports are almost very minimal. So the growth in the coming year will be driven by the customers which we have onboarded and started commercial supplies in later part of this year. So I get a full 12 months in FY26 against maybe 7, 5, 6 months in FY25.
Right.
So can you just give that really helps, because your focus segments, very clearly as you're saying, are industrials and healthcare. So for these two businesses, what will be the run rate? Do you think you can grow revenue here, what, 20%, 25%? What would your target be for your teams for these two businesses, which are your focus areas?
So when I say that I would be growing my revenue at about 30, 35%, consumer, I'm saying I'll bring it down. I'll try to maintain it at 35 or try to bring it down. So obviously, if consumer remains stagnant, which accounts for about 35% of my revenue, so the growth will be driven by the 65%.
Yeah.
And in this 65% is the automotive, industrial, and healthcare.
Yeah.
Apart from little bit of railways and IT.
Mr. Gujral,
segments would drive the growth. Automotive, healthcare, and industrial.
Yeah. Just a couple of questions, Mr. Gujral. For industrials, you said it's smart meters, right? is the major product which drives
for domestic. For domestic.
For domestic. So this is largely driven by the government sector, correct? I mean,
Yeah, we don't supply to the government, we supply to the metering companies. But yes, the end consumer is the government.
That is all set, right? I mean, there is, for example, in Bombay, I can tell you, there is a lot of, in many parts of the city, there is a lot of opposition to smart metering. You know, big housing complexes, etc., written to the BMC here, opposing these meters to be. There is a lot of, I mean, you know, it's kind of back and forth. So, do you expect that to go smoothly since it's a growth driver for you?
Business with government, where the government is the end customer, is never a smooth ride. So let's be very honest about it.
Right.
But having said that, we have grown this year, and first 2 months also, the traction has been equally good. So I don't expect on a long-term basis a significant impact on this, and we believe this business would continue to grow at least for the next 2 to 3 years.
And this, you're making the meter itself?
No, we are making the electronics for the meter.
The electronics for the meter, got that. And the second is healthcare. What exactly are you making there?
So in healthcare, we are making the RFIDs and the end products. End products for maybe neonatal respiration, heart monitoring, beauty products, laser products. Yeah. And there we have got a very good traction in design and services, which is very high margin accretive, and which results in long-term sustenance of the growth, because the product which I designed in 1 year, it will see production, commercial production in the coming 2-3 years.
Got it. All right. Got it. Mr. Gujral, very quickly, if you could tell us, you have taken an enabling resolution for a QIP. You intend to do it some part of this year?
Yeah, I think we had taken it last year, so that was expiring. We have taken it again this year.
But will you raise money, sir? Because you have barely any debt. So I was wondering why you're going via the equity route and not debt. What will it be used for?
Inorganic acquisition, which we keep evaluating in the sectors where we are not present, as I've already been saying. Okay. And now the component policy of the government of India has also come in.
Yes.
And we would be participating in that. We are evaluating that. And should we participate in a vertical which requires a capex higher than what my internal cash flows and other things can manage?
Yes.
That's why we have taken this enabling resolution.
So sometime...
Primarily driven at acquisition, inorganic acquisition.
And components.
And maybe something for the components if I find it that the funding requirement is more than what my internal cash flow generations are.
So you will raise money via the QIP route around 1,000 crores if both these two need to happen, inorganic growth?
Both or any one of them. Both or any one of them. Both or any one of them.
Both or any one of them. So QIP is something we look forward to. Very quickly, final number I'll ask you before we let you go. What is your current order book?
My order book is in line with the revenue generation projections, which I have shared with you, a 30-35% growth over current thing. So quantifying into the numbers, it will be 5,300 plus crores.
All right. Mr. Gujral, appreciate you joining in. We'll hold you to these numbers. The margin number is something that we'll hold you to, 8%. And I think 400 crores is what you said in terms of an EBITDA number for the coming year. And we'll watch out for that fundraise by the equity route as well. Time to slip into a short break. Up next, we'll have Deven Choksi, who will be joining in to give us a fundamental analysis.
Okay, welcome back. Let's just take a quick look at what the GIFT Nifty is doing, and it's a 90-point, much stronger start. This morning, as far as the GIFT Nifty indication really is coming through. Deven Choksi is with us, Managing Director at DR Choksi FinServ. Deven, good morning. Pleasure to have you with us here on the channel. Let's just start with the Tata Motors numbers which came through. There is also additionally at the margin this India-UK FTA, so maybe some of those high-end JLR cars are able to come to India at a more reasonable price. Just as a stock, how do you evaluate things for Tata Motors?
Yeah, Prashant. Good morning. I think the fourth quarter numbers on expected lines largely, I think, has taken the toll on the profits. But more importantly, having said that, I believe that I think the fundamentals of the companies are shaping up well. On one side, the prospects of JL are remaining more brighter than before. And as a result of which, I think the numbers, even in European territory as well as I think in other parts of the world, I think are likely to show up in the 25-26 financial year. Similarly, the situation remains, I think, positive on the commercial vehicle front. On the electric vehicle domestic portfolio also, I think given the kind of distribution reach, I think the company remains relatively more stronger compared to earlier before. So in my viewpoint, I think if the numbers have to be looked at, I think one will have to look at sequentially improvement in the numbers on a month-on-month basis as far as the volume is concerned in 25-26. And should that be the case, and particularly contribution from JLR portfolio, I believe things could look up very smartly for Tata Motors going forward.
Okay, all right. Hi, Deven. Good morning. Good to see you, Ben. What about Siemens? Those numbers look quite disappointing. While Honeywell, in fact, the numbers look good out there. Any comment on either of these two stocks?
Yes, Nigel, good morning. Well, I think not very easy to conclude on the quarterly numbers per se, because in many of the situations, and particularly in case of any capital goods companies, I think somewhere the offtake hasn't happened in the system because of the government's inability, I would say, I think, to implement some of the projects in time. And as a result of which, I think some of the capital goods companies have actually, I think, not been able to justify the numbers that they would have otherwise reported based on the order book that they had. So that could be one of the reasons for which I believe that I think some disappointment on a quarterly result basis. But I would like to believe that given the trajectory of growth and the government's commitment for putting money into the infrastructure, including the railways in this case, I believe that the numbers could show up in subsequent quarters. But more clarity would probably be sought from the company on this particular front.
Okay. Deven, hi, good morning. We were just speaking to one EMS company. We'll be talking to another one soon. Sirma, I don't know if you caught a bit of that conversation or not. We'll be talking to PG Electroplast as well. What do you think? I mean, it all depends on which company is executing and growing fast, right? For instance, Sirma told us they're trying to change course a little bit, move a little higher up on the margin curve, look at high margin products like smart meters, etc. PG has been another good steady quarter. How do you find the stocks in terms of valuation and opportunity?
Yes, very good morning. Not sure about the valuation at this point of time because I find that everything seems to be in price from what numbers I saw. But importantly, I think in the EMS space, the companies are having relatively better time because the OEMs to whom they are supplying to, they are probably enjoying the best of the market times at this point of time. Maybe on a quarter-to-quarter basis, I think you may not be justifying those numbers, like I said earlier, before in case of Siemens. But the fact remains that I think they are the ancillary companies which are supplied to the OEMs. In this case, I think the complete designing, manufacturing, and supplying the entire kit to some of the OEMs. I would think that the business condition remains relatively more stable for them, but not sure about the valuation of each one can buy at this point of time.
Deven, any view on Z? One of the biggest underperformers, I think, of the last 10 years or so. Every time there was some hope, the stock gave it away. Now, suddenly the promoter has gone ahead. I mean, they bought only 16, 17 lakh shares on May 12th. That was reported on May 13th. So that could explain why the stock was up yesterday. They're guiding for better times ahead. But, you know, they've disappointed in the past. At around 120 rupees, would risk reward be favorable or you'll stay away?
Again, I think not completely sure, Nigel, because I don't see the moat in the business at current levels. And given the strength that the competition is providing currently in the universe, I think they will have a big time role to play in form of building the company back to the level at which I think the one would like to see it. However, I think at this point of time, I don't see that kind of a clarity. Maybe I think save and accept this kind of transaction. Some amount of re-rating may take place on the stock price, but not too sure whether fundamentally I can put money behind this company.
Devin, the theme yesterday which stood out even in a down market in a big way was defense. And the index, I think, ended about 4% higher, and so many stocks, BEL, BDL, and everything else actually, HAL, everything did quite well. What do you make of it? I mean, you think one should just let this, because this is on the back of recent events, and you got a bit of a sharp pull which has happened. The index itself is up about 10-12% since from the beginning, from before the beginning of this particular conflict. So let it cool off a little bit before you start to evaluate opportunities. Is it chasing things here or still looks good? What's your sense?
The long-term outlook, I think, remains absolutely convincing for most of the defense companies, including the ancillaries who are supplying to the mainframe business companies, I think, which are supplying ultimately to the government-owned companies. So in my viewpoint, I think there is no question asked on that aspect. I think the entire value chain remains quite interestingly positioned from the growth perspective. However, I think the market has priced everything in advance. In my viewpoint, I think some of the companies are quoting beyond FY27 earnings outlook. And that's where my concern would be. As I expressed even in past also, that I think these companies would be in a position to report a growth, but not beyond the certain premium above the GDP rate of growth. For example, if you are talking about nominal GDP of about 11%, some of these companies may end up producing growth between 15 to 20% at best. And if you are giving a valuation of 50, 60, 70, 80 times, then possibly I think there would be more disappointment or underperformance in the portfolio. That's where probably I'm a little bit more concerned about. I'm not doubting the ability to produce 15-20% growth. I'm possibly not comfortable with the valuation at which some of these companies are quoting currently.
Okay, all right. Valuations remain a concern, perhaps for some of the defense names as well. Devin, you tell us then, which stock or which company has been your earnings star in the fourth quarter?
It's a little difficult to pinpoint that part, but I think particularly very happy with the BFSI sector as a whole, in which I think we remain focused all along. And most of the companies, including SBI, including Kotak, I think we feel that the numbers have been probably better and in line with expectations. Maybe I think these companies are expected to produce relatively better performance year after as well, given the lower trajectory of interest rates. We believe that I think other areas probably we are seeing the kind of growth happening in FY25-26. But at the same time, many of the companies have remained, I think, higher on the valuation front. Maybe I think in auto space and auto ancillary space, one can possibly look at a little bit more favorably and closely in ancillary space, where we believe that 25-26 could be, I think, comparatively better year to 24-25. So the focus is on some of the companies in ancillary space at this point of time.
All right. What we'll do is, Devin, take a quick commercial break here. We'll also look at the price action, which Sudarshan and Sachin Utekar, who's going to be with us to run us through market technicals and what you should be doing. Stay tuned. Coming up.
Welcome back. Should be getting the pre-open rates in the next 2-3 minutes. The indication is that we'll have a positive start. So let's talk about the trading strategies then. Sudarshan Sukhani and Sachitanand Utrekar are with us. Gentlemen, good morning to both of you. Sudarshan, so we had a pause day yesterday. What would you be doing in the market today? Let's talk the indices first, Nifty or Bank Nifty.
Good morning. See, the pause day was the day when we wanted to buy, and I had suggested somewhere around 24,650. The Nifty obliged us by actually reaching that and going a little lower. That's okay. So the trade is today, and we are opening roughly around those levels. So the trade is to be long in this market. We've had a minor correction, but the tactics also needs to be considered. You should be long, but remember that it is possible that markets may consolidate and IV, implied volatility, could come down. So manage your trades either by buying call spreads instead of calls, selling put spreads, and taking care of the fact that IB could be coming down even as the markets consolidate and start going up. But essentially, be long.
Okay, all right. And that was one of the reasons as well. The IVs were coming down, and that's why the VIX cooled off in a market that actually came off yesterday. It was down close to 300 points, but yet the VIX was down close to around 1% in trade. Thanks a lot for that, Sudarshan. You have been maintaining your positive bias. Sachitanand, coming across to you. Good morning. Good to have you on the show. Tell us, what's your trade on the Nifty and the Nifty Bank?
Good morning, Nigel. Good morning, Surabhi. Clearly, we saw some unwinding pressure yesterday in both the indices, Nifty as well as Nifty Bank. But if you look at the price action, the 5-day support level was well defended. So if you look at yesterday's options data as well, we are seeing that there is a very strong support base at 24,500 for the Nifty. Corresponding level for Bank Nifty is placed somewhere close to 54,700. So we don't see that the markets would slip below this particular base, and we are expecting that eventually market should resume its up move towards 25,000, 25,180. This is our positional target. So from a trading momentum perspective, I think a conditional buy would be about that 24,640 mark, wherein some aggressive long positions for the day can be deployed. One can keep a stop loss at 24,590 on a closing basis and expect a swing back towards 24,900 for the day. The positional target for the Nifty is placed somewhere close to around 25,180. When we look at Nifty Bank, 54,700 looks like a decent support. And on the higher side, we are expecting that Nifty Bank could also swing towards 55,300 eventually, especially if you look at the placement of the ADX. It is on a verge of breaking that 25 mark when we look at ADX 9. So I think both these indices are still placed on the positive zone, but the reward to risk opportunity looks better in Nifty for the day.
Okay, all right, got that. Let's talk stocks now, gentlemen. So the individual trades, Sudarshan, what are you looking at today?
Well, it's an all-buy list. CDSL is a buy with a stop under 1296. Granules is a buying opportunity, stop under 452. LIC is a buy again, stop under 811. And Jindal Steel is a buying opportunity with a stop under 885. Mid caps spread across the different sectors, and a sense coming that eventually small caps and mid caps are slowly putting their act together.
Okay. And Sachidanand, your list?
So we like escorts. If you look at the way last two trading sessions have shaped out, we have seen a very strong V-shaped recovery here. The breakout was established at 3,500 levels, and the way the momentum indicators are placed, we are expecting that this particular rally may continue towards 3680. From a trading perspective, the target would be around 3560. One can keep a stop loss at 3470 and deploy long position in escorts. The second stock is HAL. There's a bullish flag formation on the daily scale. Again, a continuation pattern, indicating that price can get elevated towards 4770. From a pattern perspective, the target is placed at 4840. So the trading stop loss can be placed at 4570 on a closing basis.
Okay, Sachidanand, I'm glad you mentioned that because I was going to ask you about defense stocks very quickly. So, do you only see an opportunity in HAL? For instance, Garden Reach today is looking good. In the pre-open, it's up 4-5%. Numbers are good. Anything else in the defense pack? And is this a tactical trade? I mean, are these intraday or maybe 1 week positions, or do you see longer term trends also looking strong in these defense names?
Well, most of the stocks have been performing well. The other stock which we have recommended to our clients is BEL. Now, if you look at the overall monthly scale, there's a strong, bullish breakout on its monthly charts, indicating that the stock can, elevate towards 400, 440 zone in the coming months. So I think this is one particular idea that can also be considered. Mostly, all these stocks are showing good signs of, momentum. But the other stock which we like is also BHEL. Now, if you look at the overall structure, we have seen that the stock was trending below its 200-day exponential moving average. But this week, it has managed to sustain above that particular level. And if you look at the overall construction, it looks like a inverse head and shoulder formation with a price target somewhere close to around 270. So I think this is also one particular stock that can be considered from a momentum perspective. The stop loss for the trade can be placed at around 230.
No, absolutely. Gentlemen, thanks both of you for joining us with that, setup and those trades, etc. as well. Let's talk about the telecom sector now. Bharti, of course, has reported a good set of numbers. What next for the stock? Gaurav Malhotra is Executive Director at Axis Capital. He's with us now. Gaurav, good morning. Prashant here. What stood out to you in the Bharti numbers, Gaurav, and what does the stock do from here?
In terms of the results were broadly in line with estimates, right? It was a very steady quarter. We saw some flattish ARPU, but that was more on account of lesser number of days, adjusted for which, the ARPU would have gone up by like 2% quarter-on-quarter, which essentially tells you that there is premiumization, which is an ongoing trend which continues, right? Margins were also for the mobile business are going at a steady clip, right? So the EBITDA to revenue sort of transmission is almost 80-85%, which is very healthy. Capex on the full year was lesser versus last year, which was expected. So the India mobile Capex was only 75% of the full year Capex of FY24. So on the whole, that also helps you, generate reasonably healthy free cash flows. The company's obviously doubled its dividend this year to 16 rupees versus 8 of last year. We would have liked it to be a little bit more, right? Because to put things in perspective, this 16 rupees is almost say 20% of its operating free cash flow and almost 30% of its PAT. So we would have, ideally liked it to be slightly more, but we'll see what the management says in the earnings call. So on the whole, a decent set of results, very, very steady Eddie kind of numbers.
Okay, and what is the stock traded? What is it pricing in, and what are prospects there?
See, the India business is not cheap, right? It is trading at around 13 times 1 year forward EBITDA. The last time the stock went beyond this was, all the way back, you'll have to go to like 2007-8, when the multiple was almost say 15, 16 times. But at that time, things were different, right? The EBITDA growth was almost say 50%, 45, 50%. So multiple-wise, it is trading at a premium valuation. But we do feel that while there is limited scope for the valuation to expand from here, but these multiples can sustain because of very, very predictable earnings and with strong earnings growth. And, now that the company has started to slowly increase the cash return to the shareholders as well.
Okay, so then the question is, what next, and whether Gaurav, there are further triggers ahead. Now, till we get to another round of say price hike, I don't know if you're factoring in one this year because we had one last year itself. What would be the next triggers for Bharti?
Yeah, see, the next trigger will have to be the hike, right? And the way to think about is that, the ARPU transmission has been very strong for the operators in the previous hike. So when we say ARPU transmission, it means how much the ARPU rose versus the tariffs. So for Bharti, it was like 98, 100%. For Jio, it was almost 90%. So we do feel that, going forward, given the transmission is very high, for operators to see a steady uptake in ARPU, they don't need to take a very high sort of tariff increase. So the last time the hike was almost to the extent of 16-17%. So maybe going forward, they will take a smaller increase, say 10 to 15%. But a smaller increase also means more frequent increases. So our base case today is that we expect a hike, say, in 1.5 to 2 years from the last hike. So the last hike was in June 24. So we expect it to happen somewhere between December 25 to June 26. And our ARPU assumptions are roughly around 9 to 10% CAGR over the next 3 years, premised on both tariff hikes as well as premiumization.
And I know we've discussed this earlier, but let me just ask again and put it on the table because the buzz is so strong, right? The Starlink entry. And I think everyone's saying that it's just a matter of days now before those services get officially launched and there's an all clear, unless something changes, because geopolitics can be a very, very different beast, a different animal, and there's too much going on. But as and when Starlink comes, is there any reason for shareholders of the listed universe, whether it's a Jio, whether it's a Bharti, for them to worry on the data front?
Nothing to worry at all, right? The ARPU of a Starlink, right, if you look just to a global comparison, is between, say, $25 to $30, right? Operators today, right, with all the tariff hikes, are roughly at like $4, $5, right? So this is even, forget the mobile, even if you look at from a broadband perspective, the broadband ARPU say $7, $8, right? And Starlink ARPU tariff plan will be between say $25, $30, or even $40 in some countries. The second is on the terminal cost, right? In India, the what we get at home, you know, the routers and all, they are essentially given for free. There is a security deposit of 2,000, 2,500 rupees. The terminal cost of Starlink is between 25 to 30,000 rupees. So this is going to be an extremely premium service for essentially high-speed data, which can be provided by operators both using fiber as well as FWA. So nothing to sort of worry about for the foreseeable future.
Okay. So I get it. It's maybe only, you know, Prashant can maybe use those services exclusively, right? When you go on the private island, remote, no other form of network, then on the Starlink phone, maybe Prashant will make a call, right?
It damages the work-life balance for sure.
What did you say? I missed that.
It will damage the work-life balance. I was talking more from an access point of view, right? He can make that call. I can't. Definitely can't at those tariff levels.
I was thinking more like, you know, trekking to Pune or something. But well, private island sounds better. Gaurav, anything else in your coverage universe which you want to sort of highlight as looking interesting?
See, from our coverage universe, you know, we continue to like Reliance Industries, right? We feel that, you know, that's one stock which has which underperformed last year, has done well this year, but you know that has enough legs, you know, for it to sort of continue with its outperformance. Otherwise, within the telecom space, you know, we don't like Indus. It's like sort of a neutral for us because we feel that, you know, given the uncertainties which still remain around Vodafone Idea, you know, that is a stock which, yes, the multiple is cheap. You know, there could be potential dividend, but we would like to stay away from that for now.
You have coverage on Indus, Gaurav?
Yes.
And that dividend didn't come. But maybe it'll come. But what's your view? I mean, people have they were really pining for that dividend and holding on, etc. But yeah, go on.
So see, we were a little bit a candle in the wind when it came to Indus dividend, where we said that, look, you know, given the uncertainties around Vodafone Idea, you know, maybe the dividend may come, but not as substantially as what the street was sort of estimating. The street was estimating around 16 to 18 rupees. We thought that, you know, the company may give you a dividend, but not to that kind of an extent. Obviously, you know, the company has now spoken about setting up of a committee, so we'll have to see where things stand at. But definitely, you know, that was a disappointment because the market was positioning for a dividend, and now there is an uncertainty around both the timing as well as the quantum of what the dividend could be.
All right, we'll leave it there. Gaurav, good conversation. Thank you very much. And, you know, we'll have you back when the Starlink services are launched and, you know, talk more about that then. Well, no impact, though, in terms of incumbent players. Just, I mean, two on the other opposite side of the spectrum, really. Well, I'll just quickly run you through 9-10 calls as well. Sudarshan is back with us. Sudarshan, what do you have?
Well, I have consider buying Granules with a stop under 452.
Okay, Granules with a stop under 452. Thank you very much, Sudarshan. Well, let's go across to our Sudarshan now. Tata Motors is what he's focusing on. So take it away.
So in the pre-opening session, Tata Motors is down 2%. So while the company has reported Q4 earnings that were largely ahead of expectation, but on the back of cautious outlook, some of the brokerages have downgraded the stock. So I'll start with CLSA, which is positive on the stock. It maintains the outperform call at target is rupees 805 per share. It says Q4 earnings have met estimates, but JLR is cautious on demand in FY26, but company is confident in delivering on EBIT margin for JLR as well. Jefferies maintains underperform call and target target is 630 per share. It says Q4 EBITDA is down 2%, but 4% above estimate. And JLR may have tough FY26 on tariffs, increasing costs and rising competition in China. Nomura has downgraded the stock to neutral, and target is 799. And Kotak Institutional Equities too has downgraded to reduce, and target is 600.
Okay, all right. Thanks a lot for that, Sudarshan. Well, I'm looking at AB Capital. A couple of brokerages, they're quite positive on the stock. Macquarie, they have an outperform rating, target price at around 260 rupees. They say that the last quarter, that's the last quarter's numbers, the profit in AUM was in line with expectation. Now, all eyes on the slippages in the unsecured business segment, which they're keeping an eye out on. They also go on to say that on the insurance vertical, the performance is better than expected, and they're targeting to double the NBFC AUM as well as the VNB in the next 3 years or so. Morgan Stanley, they as well have an overweight rating. They have a target price of around 250 rupees. They say that there's a steady improvement and the better outlook across businesses. The NBFC, the largest part of their business, was in line with expectations, while the businesses are seeing the largest increase in estimates, and the valuations are, for life insurance as well as housing finance. They make a point on that as well. They see margins of safety along with the scope to re-rate from here on. So both the brokerages that we have, Morgan Stanley as well as Macquarie, fairly optimistic on the stock. It appears the leadership at the helm is making the difference out there.
Absolutely, Nigel, a point taken. Let's just take a look at I think we've got a minute and counting down to the market open. Maybe just Tata Motors, if we can take a look at quickly how that is starting. The pre-open is settled about 35 points higher. Tata Motors is down 2.5. Bharti Airtel and Bharti Hexacom, if we can just quickly look at, and then we'll look at Max Financial as well. Bharti is 0.5% higher. Hexacom will come up next. Max after that. And Max, of course, I think out of the lot, Max has reported a pretty good set of numbers. Hexacom is up 5%, so it's a more pronounced move. Max is up about 2.5%, as Yash was saying earlier. Honeywell Auto, maybe just a quick look at that one. So again, reacting to earnings. They're all earnings. Garden Reach Shipbuilders perhaps is another one we should look at as we wait for market open. So that's 13.5% higher on Garden Reach Shipbuilders with regards to that reaction. At least that's a pre-open, but we'll have the actual open coming up in a minute, in a few seconds actually. And we'll look at those stocks. Indices first though. So it's 24,642 on the Nifty, about 0.25% higher. The Nifty Bank is up about 0.4%, so stronger. Nifty Bank, of course, was down far less as compared to what the Nifty was. The mid-cap index is up. The small-cap index I can spot is about 0.75% in the green. Those indices were actually up on the day, even as the Nifty and Bank Nifty were lower. Otherwise, what? I mean, it's overwhelmingly, right out of the gates, positive for the broader market as well. I can see 1,500 stocks still opening, and maybe too early to point this out, but 1,500 up and about 250 stocks are lower. The heat map perhaps gives you a quick sense of how the Nifty pack is opening, and then we'll, of course, dive into individual names. That's the heat map. So about 14 odd names, 15 names in the red. Everything else is starting higher. Surbhi.
Okay, so like I said, the market in a bit of a what next mode, given that the two mega events are behind us now. 40 up on the Nifty. It's a lot more muted than what the implied open was suggesting. Tata Motors is cooling off quite sharply, 3% lower. Q4 was fine, but it's the commentary and this whole global trade uncertainty that's the bigger talking point in the commentary, and the market's reacting to that. Cipla is down about 2.5%. The broker updates have come in after numbers. In fact, we'll talk about this as we go along in the show. Hero Moto, Asian Paints, there's some more stocks that are losing ground. Eicher Motors is a little quiet, subdued ahead of its numbers. M&M is also on the back foot this morning. The Bank Nifty is also very quiet, gain of less than 0.2% on the Bank Nifty. So what is working for the market? Bharti Airtel for sure, 2% after numbers. Tata Steel is carrying on its good form. International markets have been looking good on the China-US trade deal, 2.5% up on this stock. Coal India is also looking good. JSW Steel, so basically metal and material stocks, they're having a good session. The Nifty is being saved by the likes of Reliance, L&T, ICICI Bank and SBI. It's these four stocks really. Otherwise, the picture could have turned into red. But Reliance is having a good morning, 0.5% up. And the banks sitting on the fence, but mildly positive right now. ICICI, SBI at least, showing some green, but a bit tentative overall for the market, Nigel, today.
Well, that's right. I think it should be actually a very good trading session. Let's see how that goes from here on. To highlight a few stocks that are moving around, though, from the broader markets, we have GRSE, that's Garden Reach, that's flying away. Kochi Shipyard as well as giving it company on the upside. And Dalmia Bharat Sugar, well, that's the other one that's actually doing well. The numbers were ahead of DAM's estimates. The revenue rose by close to 35%, which was driven by a good growth in the sugar segment as well as the distillery businesses. So that's why that stock is doing well. You have on the flip side, you have Paytm. Well, there was some hope that maybe, in fact, it could get included in the MSCI reject. That wasn't the case. Now all eyes on the next review, which comes in August. And Nuvama saying maybe there could be a possibility it gets included in the next review. For the time being, though, the stock is under pressure because it didn't get included. So keep an eye out on that one. VIP, the numbers were absolutely horrid. Though the stock is only getting away with a 3 to 4% downtick. So we'll have to keep an eye out on this one because it's seen massive delivery-based buying over the last few days. And it has a con call today at around 2:30 p.m. So that one's on the radar. Sigma SGX, good margin performance. However, the revenue number was below what the sheet was working with. So that's why that stock is getting clonked bang. And IQ Lighting, that stock is down 6%. Because those numbers as well were rather weak. And giving company on the downside, I think there's VST Tillers as well. So all these earnings reactions, so the stock is down. Sigma, VIP, VST Tillers, as well as IQ Lighting, all of them lower in trade.
All right, so yeah, it's a now I think 75-point higher start is what you have coming through. And it's looking pretty decent all across. I mean, I think the broader market especially, I think, deserves a mention because that is where yesterday as well, it didn't look like the market really missed a step. I think let's just bring in our market master. We have Krishna Sangvi now joining us, CIO Equities at Mahindra Manulife Investment Management. He's with us here in our studios. Krishna, great to have you with us here on the program. And, thank you for dropping by. So just, the common refrain when you talk, because the market was down very sharply, it's now come up very sharply, especially, at least on the HNI side, when you speak to people, they say, well, there's no really big ideas now. I mean, it's kind of happened. And now, of course, long-term is long-term, but I'm saying from here, and tactically or even slightly near-term, medium-term, it's kind of done in that sense. Would you agree with that, or you think there are still meaningful dislocations one can take advantage of?
It's really tough to decipher this. So you always need, in markets, we need to have two connects. One is what's happening in global markets, other is what's happening to Indian markets. So if we analyze the global markets behavior, I think India more or less replicates the trend, if not the intensity, or maybe both at times. And that's what has played out. If you look at this particular entire period of either you look at tariff or even, last 3-4 months, I think so directionally, maybe that color or the signal, I think comes more from global markets. And that's where globally every market is, back to what they were 2, 3, 4 months back. And so is maybe Indian markets. So that's, on the market flavor, I think from a company specific, you'll always find some pockets where either there is a valuation upside or there is some sort of a earning expectation change based on what, the new environment keeps on offering. So as a macro level, yeah, if 6 months back at a similar level of Nifty, if the worry was that we have some sort of overvaluation in some pockets, I think that worry is not typically changing because that's what,
that's what I'm
pretty much same.
My question, the background to my question was, you just assume for now that everything is slightly better now. Overall, things are better. But even with that, stocks have kind of reset. So is there a lot of dislocation really? I mean, something should trade at this and, it's unnecessarily very cheap now. Do you find a lot of opportunity, those kind of opportunities now?
It's difficult. Yeah. I agree. But that's not necessarily true at any juncture in markets, right? So if you look at, I think small cap still remains little bit on the valuation side slightly higher. But yeah, typically large cap does offer a value.
But Krishna, to supplement Prashant's question, and we're not trying to be very glum and bleak over here. I know we're sounding like that. But I'm going to ask you a glum question as well. Maybe it's good, right? When everybody's glum in the market, that's when the market surprises. Now, the other thing is that if you just go back, say, 5 years, COVID onwards, there were always very strong narratives in the market.
Yep.
Before COVID, it was all about financials, right? You ride that bull run and it was easy to make money. During COVID, it was IT and pharma. After COVID, we had this government capex theme coming in. Yep. So it was defense, it was railways and capex stocks. a very clear central theme seems to be missing in the market right now. So is this going to become a bit of a grinding, nerve-wracking kind of market? And to add to that, you're saying that there are not too many valuation dislocations, which are very easy, like a plum catch, as they say in cricket, those opportunities. So is this going to become an increasingly tough market to make money in?
No, I think markets are typically driven by narratives. The unfortunate challenge in the Indian markets is that the narratives are shifting pretty fast. Generally we call it as a sector rotation. If you really analyze, last maybe even 2-3 years entire period, you got a nice window of 2-3 months a particular sector drives the market, and then suddenly the relay race back and move somewhere else.
Yeah.
So I think that's a slightly different set of worry on markets, which says that the market participation route taken by investors in India especially is more of a leverage participation. And in a leverage trading pattern, if people want to follow, their time frame by default is short. Now, if from an institutional perspective, obviously we're buying long term, but we also have to go through those price moves on a shorter end because the other side of participants, typically.
No, I'm saying from an idea perspective, you don't have to think too much. The market was giving you narratives. You just had to find maybe good companies, slightly better valued, clean companies in that theme, and you could make money. Is that time over?
No, maybe that our need for narrative is dominating, but the bigger narrative is clearly the same. India is a growing economy, that 10%, 11% nominal GDP growth rate, which honestly has been the core narrative for the last 25 years.
So we go back to the mother narrative now. India's a growth story.
That's a real narrative,
absolutely,
right?
Absolutely.
Everything else is a deviation or a shorter term orientation by some set of investors. And let's look at markets the other way around. Monday was a great day for all of us, nearly 4% rally. If you look at the cash market behavior, we had what? FIIs, net buyers, DII, net buyers. So aggregate number was just 2,700 crores. Now just come to think of it, market of our size and, market cap, $5 trillion plus. And, you move by 4% on a 2,700 crore net cash buying. So which means clearly the driver is the leverage participants and their own ability, as they say, in a leverage, your ability to hold perhaps is a function of your risk management rather than your view. So somewhere, some of those things get triggered, but I think the core philosophy is intact for an investor. The challenge is when investor decides to take slightly more bolder call by taking a leverage route to the same pattern of investing. And then, those things happen.
In fact, I take that point on board, Krishna, because in the run-up to that entire skirmish on the border, we did see a lot of HNIs and retail participants that raised cash. And the last few trading sessions, actually, I've seen an outperformance coming from the broader markets, which is telling you more of the domestic money is at play, not institutional. That said, if I look at a couple of numbers, particularly from the commodity companies, yesterday I spoke to Tata Steel, and the management sounded very optimistic after a while. Yep. The stock ended lower yesterday, but some of these commodity stocks could do well. On the domestic front, you have the safeguard duty for ferrous names. And internationally, it seems a more rational Trump is what we're looking at right now. How do you view it, and what do you like, ferrous, non-ferrous?
Sure. So I think if you look at the current quarter result itself, we for a change have a season where the commodity companies are actually, driving the aggregate result season by a wider, YOY growth. So that's, first good sign. Clearly some supportive system, let's say on ferrous through the anti-dumping is in place, and as it gets played out, there's something positive there. Even that global factor, like a couple of months back or 1.5 months back, the worry was some trade dislocation, which can impact consumption of, commodities globally, and that's why some sort of price action happened there. Now, come to think of it, over the weekend, we had nice, series of announcements, almost everything happening same time. And so to that extent, commodities also is a good trade, because if world is back to it's what it was supposed to do in terms of
for the time
growth,
being.
For the timing.
Because and you prefer
events
ferrous,
are changing very fast.
Right. And you're saying you prefer ferrous.
We typically prefer ferrous, non-ferrous, both. But way the anti-dumping duty has been played out, it gives a nice, visibility. Again, let's wait. It's just a 200-day for now. The larger time frame of next 3 or 5 years can come in as the new order gets, revised or changed. Let's see what happens there.
Have you discussed within your team defense as a theme, so I don't know. It's difficult we can talk about it, to actually put money behind a theme, as Surabhi said, the narrative. And you said, well, those are sometimes those are fads, and you kind of it's too difficult to say when the fad stops becoming a fad. I don't know if it's a fad, but what's your sense? Defense
I think,
specifically.
see, we got to differentiate this fade between the business versus the stock price linked, right? If you look from a business perspective, what's changed in last maybe 3 years, 4 years, especially post-COVID, when this entire talk of Atmanirbhar Bharat and the government stance saying that I need localized, purchase, maybe, entire direction was changed. And a lot of Indian companies are entering that, space, whether in public sector or private sector. So that's a core business momentum of defense, and not only Indian companies can do it for India, but they can possibly start thinking of some exports, etc. as and when, things play out. Now fade part may be more linked to the stock price, which is in a way valuation worry rather than a business worry.
No, so have you tried to link both? I mean, are they meeting somewhere at a reasonable level, or have stock prices run up too far?
It does offer you opportunity. It's just a question of every day it will never tell you, because markets are never, going to give you exit repricing.
You have exposure in this space.
Yeah, we will have some exposure across, companies, across our funds.
Okay, let's talk growth. Where else are you seeing at least not outlandish, outlier growth, but at least reasonable, sustained growth? Because that seems to have become a problem for large pockets of the market, whether it's IT, FMCG. We're all crying about growth. Auto, we're just crying about growth.
Oh, I agree. That's clearly a challenge of last 6-12 months, and that's a thought process really, is that as government actually the monetary policy has gone into a favorable accommodative stance. That's the situation in which can ease the growth concerns. Is a core thought, and otherwise nominal GDP, credit growth are more or less converging. All you need is a little bit higher capex, which can possibly have the credit growth higher than the nominal GDP, and that drives a lot of other space in the market.
Okay, all right, Krishna, we appreciate you coming down and in fact giving us all of those views. Look forward to chatting up with you soon. Well, for the markets though, we are trading well in the green, Surbi. 150-point uptick is what we're seeing on the Nifty. The Nifty Bank is doing a relative underperformance, but the real game actually is in the broader markets. And that's been the case for the last few days as well. The mid-cap index doing very, very well. Breadth of the market looking extremely strong.
Absolutely. And don't keep your eye off on the defense stocks, because it's not just Garden Reach, which came out with very good numbers. Garden Reach's profits have doubled. Top line has grown at 60%. But it's carrying others along with it. Look at Zentech. Look at a name like Cochin Shipyards. This is still very much a sort of a lively, buzzing part of the market, defense in trade today. But for the time being, we are going back to the EMS space and putting the spotlight on yet another company you just heard from Sirma. Now it's time to tell you a little more about PG Electroplast, because the company also came out with numbers. Fourth quarter was a fairly strong one for PG. Healthy revenue growth and margin expansion as well was witnessed. So let's talk about this performance with Vikas Gupta, MD at PG Electroplast. Mr. Gupta, thank you so much for joining in. It's been a good quarter. And for our viewers, I just want to put up the FY25 performance as well. Good quarter and good year. In FY25, you've grown at 77%. Your margin is almost touching 10%. So, sir, let's talk about the outlook on FY26. Just break it down for us in the room AC segment and, washing machines, etc. What do you see ahead? Because there's been some concern, particularly on air conditioning, about the weather, perhaps dampening demand in some pockets in April. Your thoughts on how this year has opened out for you?
Good morning, Surbi, and thanks for having me on your show. Specifically, when we talk about FY26, we have already released a guidance where we are saying that we will grow our revenue again by almost around 30 to 35%. And when we try to break it down into each product categories, like last year in air conditioners, we did a revenue of almost around 3,000 crores. And this year, like in FY26, we are targeting a revenue of almost around growing by 35% to almost around 4,000 crores for air conditioners. Similarly, in washing machines, we did a revenue of almost around 440 crores. And this year in FY26, we are targeting to grow that business beyond 600 crores. We are targeting almost around 650 crores coming from washing machines. So all those product categories are kicking in well, and we are confident that we should be able to give the revenue growth of 35% for the FY26 for the full year. regarding the demand specifically for the air conditioners, yes, definitely there has been some kind of a slowdown on the industry level. But for us, specifically when we talk about PG Electronics, because we are serving 35 plus brands in air conditioners, and we are confident that in the kind of order book that we have with the clients right now, we are confident that the revenue will grow.
You know, but tell us one thing, Mr. Gupta, and if I look at the growth trends as well, it's a little volatile. I mean, you've had years where you've grown the top line at 100%. In FY24, it came down. Last year, it was 77%. Now you're guiding for 30 to 35. Why is your guidance of growth for this year lower than last year? And this is when you're commissioning new capacity as well. I believe there was, a line that was commissioned just earlier. So what is the steady state of, let's say, CAGR growth, top line for PG over the next 3 years? What should we expect? And why are you more conservative on FY26 versus the last year?
So, Surabhi, please understand, we are releasing a guidance based on the current visibility and the current order book that we have with our clients. You have seen in past also, we have been upgrading or revising our revenue guidances. So we feel that we will keep on updating you in the coming quarters. But as of now, the growth that we see is almost 30 to 35%. And regarding the horizon for next 3 years, we are confident that we should be able to maintain a CAGR growth of almost 35% going forward as well.
All right. Hi, Mr. Gupta. Good morning and good to see you. But, I need to compliment you as well as the team. I recall 3 years ago, there was no institutional holding as well in the company. And now because of the fundraise and the likes, you have 25% from institutional itself. So clearly, there's a lot of interest in the stock. Now, one factor that I want to focus on is your CAPEX. The CAPEX for the year, I believe, is around 8 to around 900 crores. Could you break it down for us between RAC, compressor, washing machines and plastic? First, break that down. Then I have a couple of more questions on the compressor segment.
So, Nigel, good morning. So what we are trying to do is now the CAPEX that we have planned for this year for 800 to 900 crores, please understand we are trying to position ourselves for the next round of growth in next 3 to 4 years. So we are trying to build up more plant, we are acquiring more land parcels, we are building up new buildings, and so that will cover the majority part of the CAPEX, like almost 600 crores will go into the acquisition of new land parcels and the construction of new buildings. When we talk specifically about the product categories, like we are targeting a CAPEX of almost around 350 crores to 400 crores in the RAC segment, which covers the compressor part as well. In washing machines, we are targeting a CAPEX of almost around 100 crores. And in refrigerator, there will be a CAPEX of almost around 160 crores on the plant and machinery side. But if you look at the total CAPEX, which includes the land and building, the CAPEX should be almost around 300 crores in refrigerators.
Okay, all right. I want to focus specifically on compressor. That's the talk of the town, right? You announced this more than a quarter or so ago. But what's stopping you from announcing the JV partner, sir?
So, Nigel, so we have not closed the agreement part, which is still under the legal vetting, which we should be able to close in next 2 to 3 weeks' time. On the background side, we have already started the working with the technology partner to develop the building and everything. So that work is still going on. And we are still hopeful that there will not be a much delay in that. And we should be able to start the mass production for compressors by January of 2026.
When do we announce the partner's name?
So we should be able to do that in next 2 to 3 weeks' time.
Okay, all right. We'll have you back on the channel then at that point of time. But just one more question on this compressor part. If you assume 100% compressor will be used for captive consumption, then what's the kind of, peak, say, gross EBITDA margins the company can achieve? Suppose you assume everything is used captively.
So, Nigel, I'll just make a small correction on that. So we are putting up a 5 million capacity in phase 1 for compressors. And in that, almost 50% will be used for us. Like almost 2.5 million compressors will go in for captive consumption. So that will be a margin accretive. I may not be able to give you an exact number by how much margin expansion will be there, but balance 50%, which will generate a revenue of almost around 750 crores, go for sales to the outside customers.
All right, but rough margin difference in basis points, I think you can give us a band, Mr. Gupta.
So
captive versus...
So we should be able to see margin expansion of at least 1.5 to 2% in that case.
150 to 200 basis points. Got it.
Got it. Vikas, hi, morning. that partnership for compressors, is that with Highly?
So, Prashantji, it will be difficult for me to comment on that. We are still not able to close that legal agreement, so I may not be able to make any specific comment on that.
Okay. The reason for viewers, the reason I asked about Highly is because most of the compressors that you kind of, you ramped up your, during the compressor shortage, I think you got them from Highly, and there was talk that, you probably will tie up with them. But I understand, we'll wait for that agreement to be closed. And we'll get you back on as well. On plastics, because if you can tell us a little bit more, what exactly, which segments are you doing? What are you doing right now?
So the plastic molding is also seeing a very strong momentum for us. Like it has surprised us also. And this year, we crossed 1,000 crores of revenue in plastics molding only. What we feel with the current geopolitical situation and with the tariff thing going on, we are seeing a lot of RFQs. We are seeing a lot of queries for the global requirement from our international clients. So we feel going forward, the plastic molding business should also maintain a good, healthy growth rate. And we are hoping to crack some good global business also on that front.
Are you, by the way, Vikas, going to look at, or are you already kind of working on this entire GLP-1 opportunity in any way? I mean, injections and that kind of thing? On the plastic side? No, nothing.
No. So not on that side. So we have some clients which are our existing clients for India market. We are exploring some their global requirement RFQs as well.
But would you be open, since this is a new segment and it kind of is expected to have a very long runway, would you be able to pivot to it? Have you looked at it at all? Or this is completely sort of, away from what you want to do or what your capabilities are?
So, Prashant, as of now, we have not explored that, but going forward, definitely we are open to new ideas as well.
Okay. Mr. Gupta, just 2 quick points on margin. You've already given us a hint, right? ACs are such a large part of your business, and that business will see margins expand maybe more than 100 basis points as you start using these in-house compressors. Overall, for margins, you ended 25 at about 10%. So 26, 27, how should we expect the margin profile of the company to change? And also just tell us, in terms of the PLI for this year, with this electronics PLI scheme being announced, are you hopeful of getting any PLI benefits this year?
Regarding the margin specifically, if you look at, we have given a guidance on the PBT level also for FY26. We'd like to stick to that. Please understand, Surabhi, so we are in a contract manufacturing business. We cannot expect a very high level of EBITDA margins in this because, again, this is a contract manufacturing business, okay? Regarding the electronic component manufacturing scheme, this is a scheme which has come out recently. We are also trying to go through that. And we are looking to participate in that in certain component categories.
And in which categories do you think you'll be eligible? Where would this be of interest to you, the electronics PLI?
So the electronic components manufacturing scheme, we are looking at least 3 to 4 components. We are talking to various potential partners in that, and we should be able to make some kind of definite comment on that maybe in next 3 to 4 weeks' time.
All right. And also, besides the profit and loss account, your net working capital days have come down a little bit, I think by around 5 to 6 days. Could you tell us what is the outlook out here, and is there further scope for improvement?
So what we feel, Nigel, as before the ramp up for this season, we try to build up some inventories in our to take care of the AC business. So what we feel, as the component ecosystem starts developing and the compressor thing starts coming out, so we should be able to further normalize our working capital days.
All right.
You want to give us a number, sir?
So it will be difficult to give any specific number on that right now.
All right, because we leave it there. We wish you all the best of luck as you and your team continue to execute, and look forward to our next conversation. Thank you very much for joining us. So that is PG Electroplast with some perspective. We're up 140 points, so 24,700 is back on the table. It's been a week so far, and this is Wednesday, a week of big moves. 900 points up on Monday, beg your pardon. Yesterday, it was 350 points down. Today, it's 145 up. So, it's got everything going for it this week in terms of just the drama and the big moves. We'll take a quick commercial break here. We'll have the management of Sai Life joining us on their numbers and more. Stay tuned. Okay, welcome back. We got the market, which is up 170 points. 5:1. I think now it would be a good time with about 30 minutes of trade behind us to look at market breadth, advanced decline ratio. And that is looking very, very solid. So 2,000 stocks are up and about 400 stocks are lower. So this is looking like a one-way session. And so much is happening with regards to individual movers, which we will come to in a bit from now. Okay, let's talk about the next company on our radar, and this is Sai Life Sciences. Earnings came through, earnings performance for the fourth quarter, healthy revenue growth and profit growth, but margins have contracted a little bit. There is, of course, the entire sort of, Trump back and forth, the executive order with regards to onshoring manufacturing to the US, etc. Sai Life, of course, is one of the largest CDMO players, and they are expected to be one of the prime beneficiaries if the CDMO space, as many investors believe, will pick up and, in terms of share gains, etc. Siva Chittur is Chief Financial Officer at Sai Life, and he's with us now to take some questions. Siva, good morning. Good to have you with us here. Thank you for your time. So let me just get that Trump question out of the way. With what we've seen so far, will it have any implication for Indian CDMO players at all?
So, none of us know what exactly will be the final outcome. With that as the preface, I think what this is leading to from our judgment is that there's a lot of uncertainty and uncertainty with respect to outsourcing into China. In our mind, the way this will play out is more the uncertainty, the more the need for diversification. We believe that there could be, a movement up and down here or there for a quarter, just depending on how things pan out. But we believe that the longer-term trend is towards diversification from China. And I believe that Sai Life Sciences, and not just Sai Life Sciences, but I think the industry will benefit from this uncertainty and the need to just mitigate from a pharma outsourcing strategy.
Siva, how much of the work that you do happens onshore in the US?
So we have a biology lab that actually is a smaller portion of our business. This is primarily into exploratory biology. This is, our feed into our discovery business, which is performed very well, and that's what we do in the US. Our manufacturing and larger scale, R&D contracts are delivered out of India from an optimal cost perspective.
So you do the discovery in the US and then you kind of manufacture here?
Yes, portions of discovery in the US and then do the large scale, both R&D and manufacturing out here.
So, Mr. Chittur, hi, good morning, Surabhi here. If I talk about your revenue overall, the revenue pie, what would the exposure to US be at this point?
So, very good question. The only problem with that model is, right, in a generic business, it's very easy for you to kind of provide what that number is year on year, because shipments that are made to a particular country are based on export filings that you do in a particular country and generally are not sellable in another country. Versus in the CDMO CRO business, you could be sending it to, let's say their corporate office, which is probably located in a different location, or you could be sending it to another CDMO, which is probably finishing up a formulation.
Okay, got it. Let me rephrase the question then, Mr. Chittu. Let me rephrase the question. How much of your order book comes in from American pharma companies?
I would say, 20% of our business would come in from there.
Okay.
And it changes year on year, so it's not a constant number, though this can change year on year.
Sure. No, got it. It just gives us a reference point to work with. Now, for this business, which is 20% of your overall pie right now, is there a risk because if regulation keeps changing and now there is this executive order? I mean, tell us what you think of it. Or tomorrow, if there is a demand to sort of onshore more of the work, wouldn't this 20% of your order book be at risk?
Good question, Surabhi, but I think there are two things that are needed to run a CDMO or a CRO business. One is people, second is a lab or a manufacturing location. For somebody to come back and put a manufacturing location or an R&D location takes time. This is not an immediate thing. This is probably a 3, 4, 5 year period. The second thing is about number of people needed for R&D, the number of people needed for manufacturing. We believe that the Asian locations have a lot more ability to put people on in demand. I think there are multiple things, right? On one hand, we are seeing a statement about bringing manufacturing in-house. On the other hand, we are also seeing statements that cost of the new drugs should be reduced. So at this time, without going into what it means, we feel that there are contradictions to it. And we believe that this is not going to happen at least for a reasonable frame of time. And more importantly, their need, immigration is getting tighter. Their need to kind of have people to be able to do this business, in our opinion, is for a large scale that pharma today is looking for, I don't believe is there.
Okay, so you're not too perturbed at this point in time. Got that, and you've explained the reasons why. So I just wanted to get to the numbers and in this guidance. Guidance you've given is 15 to 20% CAGR growth over the next 3 to 5 years and margin expansion. From 24, you're hoping to take the margin to 30%. What will drive that? Will it be high-profile, avenues like GLP-1? Will it be some other specialty drugs or some other form of research? What will drive your margin to 30%?
So I think margin will get driven. So this is a projection we gave at the end of last quarter. We said our revenues will grow 15 to 20% CAGR over the next 3 to 5 years if you actually look at it. And then we've taken a target of 28 to 30% EBITDA in the next 3 years time frame. A large portion of this will come from operating leverage on account of expansion in the business. And that's really what we are seeing today. If you look at what we did last year, we were a little about 20%, and then we ended this year at 25%. So there's a jump from 20 to 25. So what we had told the street at that point in time is that we will take 2, 3 years to get there. But you see the movement from 20 to 25, we've already done, more than halfway from where we were last time.
Siva, can we so on a CAGR basis, can we see 20% kind of revenue growth and 25% kind of EBITDA growth for the next few years?
So as I said, the business in the CDMO sector is a little lumpy. There could be a year where you're probably going lower, and there would be years where you're probably growing higher. That's why we gave you a CAGR over a 3 to 5 year period, and we are confident that we will get there.
Okay. Just talk to us a little bit about GLP-1, if you will. Are you a player in that segment?
Very difficult to comment because we are bound by a confidentiality agreement. But all I can tell you is any player in the CDMO segment, given the number of pharma customers who are working on the GLP side, not just the injectable, oral, there are multiple things. Other than those couple of drugs in the clinic, there is in the commercial world, there is enough on the pipeline. I believe anybody who's working in the CDMO sector is probably touching some GLP-1 at this time.
But it's not.
I would not be able to specifically comment on whether Sai Life Sciences is part of it or not, just given our confidentiality restrictions.
No, I'm not asking you to name companies, but you can at least confirm whether you are. I mean, I don't think there's any problem with that, right? You can tell us if you are involved or not.
I think we would prefer not to comment on specific modalities that we're working on. That's why I'm saying that any company working in this space is probably working on something there.
Okay, all right. And I'm assuming this will be on the fill finish side, right? I mean, but of course, okay, we won't go into specifics, as you said, maybe at some point when you can. Surbhi, you another one?
No, I think we've got the gist of it. Thank you very much for joining in, and I wish you all the best for the year ahead. Thanks for explaining the business dynamics to us. So still sounding fairly confident. They do have 20% exposure to the US, but they're saying that these things cannot be shifted overnight, even if there is a cry for more onshoring.
Should be that 20% number, just to put it in context. Yeah. I think the 20% is revenue coming from US companies.
It's the order book. I specifically said out of your order book, because he said that revenue, it depends on where we are shipping. It's booked at that point. So, it may not be the US, etc.
Yeah, my only small point is that if this were to, the US Trump actions, etc., has to impact, if it has to impact, I'm not saying it is, that number will be much greater than 20%, because that depends on what you're selling into the US. Yeah. It can come from Roche, which is a European company. It can come from Novartis, which is a European company.
Absolutely.
So that 20% is a smaller number. The actual impact has to be the percentage of sales which you asked, but we didn't get the number.
We didn't get that number. Yeah. That's true. So let's see how this plays out. But for the time being, the company is saying that it's on track for further growth. Speaking of, tariffs and trade and all of these uncertainties, let's take that discussion forward. We have Amitendu Palit, Senior Research Fellow at the Institute of South Asian Studies at the National University of Singapore, joining in. Thank you very much, sir, for being with us. And, we here in India have been watching the headlines, obviously the big US-China thaw that's happened. But my first question to you is that given the developments in the subcontinent over the last 7-8 days and the geopolitical escalation, and the US's stance on it, the statements that we've seen coming out repeatedly from the president, from J.D. Vance, from others, could that cast a shadow in any form on the India-US trade deal that is still being, deliberated? I think the Commerce Secretary is going to be in the US in the next couple of days.
Thank you, Survi, first for having me on this show. A pleasure being here with you guys. I think there's a dangerous trend that we are getting to see here, which needs to be looked at very closely. There is a tendency to connect trade with everything. And particularly when issues of bilateral conflict get connected with trade, or trade is taken as an instrument for resolving these issues or perpetuating with these issues, it's not a very healthy trend, because then trade does not remain market-driven anymore. Trade gets completely tweaked by other considerations, and that's not the way trade should be. Certainly, it's not the way trade can be done to benefit people. We see that having happened earlier. We see that having happened with respect to Russia, Ukraine, the Ukraine mineral deal that has been worked out with the United States. We saw shades of it coming up in the statements that you alluded to, the US president mentioning about his brokering a deal, India contradicting, he continuing to insist that it played a role in that. And yes, I agree with you. I think the fact that he would claim credit for having brought this current crisis to a datat, that's something on which there will be some conversation, certainly, in the forthcoming trade talks that are coming up. And I think India is also beginning to feel a bit agitated by this posture, because this is for the first time since the announcement of the tariffs that we did see on this round, India thinking of taking the US steel and aluminium tariffs to the WTO for a possible retaliation. So I think trade is really getting messy now.
No, absolutely. And on that, Mr. Palit, I'm glad you brought that point up, and it came through immediately when all these statements were coming in. So there seems to be a fundamental disconnect. The US president saying, you stop the ceasefire and I'll do more trade with you. But I don't think that posture is flying at all with the Indian side. There's been no acknowledgement actually of any of that in all of the Indian government statements. So do you think India will even be open to talking trade in exchange for, it's trade and terror? They're two very different things.
Subi, I take your point, but I'm just wondering about the room that you have in this regard for flexibility and maneuvering. Because if this point continues to come out of the United States that, look, guys, you better get into a good deal with us. Otherwise, we don't think that we will be able to play the role that you expect from us when future conflicts happen, and don't expect us to play a positive role in settling those issues. And there are countries across the world who have accepted what we are giving them. Why are you not accepting to those? I think this puts a country like India in a rather awkward position because on one hand, it does have a very solid and stable relationship with the United States on a number of areas, not just strategic areas, but economic areas. But on the other hand, it lives in a neighborhood which is getting hostile by the day. And the enmities are increasing. There are no signs of peaceful resolution around India and nothing in the foreseeable future. It does put India in an awkward position. And I think there is a further complication that comes in here. The US would have obviously noted the fact that India is engaged in simultaneous FTA negotiations. It's concluded one with UK, which has been a fairly progressive FTA by Indian standards. The mother of all FTAs is expected to come with the European Union. And there are issues which the US would want to be given to them, conceded to them, included in those FTAs and in addition to those FTAs. Now, it is this additional areas, say, for example, opening up India's government procurement market, which was listed as a factor by the US the day before the reciprocal tariffs were announced in the foreign trade barriers report that it brought out. Now, these are issues where it is not easy for India to immediately agree, and particularly when you have the threat of a conflict management role being offered to you, as some form of a carrot. It doesn't work that way.
Yeah, no, absolutely. Mr. Palit, good morning. So one is, of course, posturing. The other is seeing what the US is actually doing, right? I mean, if you are any of the trading partners who Trump has threatened with very high tariffs, he has imposed very high tariffs, and then you look at how quickly they've folded with China. You actually would feel, I mean, you'd feel better, I mean, of holding out. I mean, it's actually, I can't see any, there are 4 or 5 things which they wanted to achieve with these tariffs. The way they folded with China without China giving in too much, none of those objectives have been achieved. So they've folded in that sense, at least in round 1, and there'll be more negotiations. So actually, isn't that an indication of, I'm not saying we get the same deal, but my point is they're willing to do this. They're willing to come down very fast without very much in return.
I think the game is slowly getting exposed. If you look at the US-China deal or the issue on which the agreement was done, 80% of it was a discussion on fentanyls. It has nothing to do with anything else, any other consideration, any other trade fact, any other trade issues. If you look across the world, the kind of reactions that the US is generating through its trade policy is completely ad hoc and totally unconnected. Now, the point over here is that this is something which is becoming so obvious that sooner or later, all countries, I mean, there are countries who will have a bigger capacity to resist this ad hocism on part of the US. There are countries which will not. For example, a country like Vietnam, given its dependence on the US market, given the fact that it's sandwiched between US and China in a regional supremacy battle, it will not have that room for maneuver. But I was just listening to the earlier section that you just concluded, the executive order on local manufacturing. This is nothing new. This is what the CHIPS Act was all about. This is what the IRA Act of the President Biden was all about. There's only one difference. The difference is that this time it is being told that foreign companies will be scrutinized that much harder. Well, they were always being scrutinized. It's not that the foreign companies would have been coming in with their own agenda and then getting away with this. If you look at the fallacy involved here, just what's been going on with ByteDance and TikTok.
Yeah.
Disinvestment till now.
Yeah, no, absolutely. Mr. Pal, my short point was that other trading partners will feel emboldened. That's all. Maybe they won't hold out, and not everybody's got the same size and muscle that China has, and countries like Vietnam, of course, much more dependent. But everyone is watching this closely in terms of how this has gone on. So that's my short point. I think that's fair.
I would say I definitely partly agree to it, but I definitely also caution over the fact that the US is going to use national security and its ability to provide security guarantee as a very important tool in all the negotiations that it is going to do, and not all countries will be able to resist that. Some will not be able to do by that extent. So yes, I definitely partly agree with you, but not wholly.
All right. No, point taken. Is a nuanced subject, and we have to look at that in that way. Thank you very much, Mr. Pallit, for joining us and running us through your perspective. It's a pleasure having you with us here. What we'll do is just take a quick look at what markets are doing, and I think we have a quick view on the price action as well. Sachidanand is back with us with what he'd like you to do. I think markets have come off quite a bit from the day's high. I saw the Nifty Bank, which is maybe even slightly flattish to slightly lower. And of course, the Nifty is still up, but off the highs. Sachidanand, what would you do?
Good morning, Prashant. Prashant, clearly, I think the market, momentum strength is something which is significant. And especially if you look at the way Nifty IT is contributing, the expectation is that we may see a swing towards 24,900. These are the levels that we discussed in the morning as well. So I think it's better to stay, on the long side. The immediate support on an intraday basis is placed somewhere close to around 24,655. We don't see that this particular support getting violated. So probably, one can keep a stop loss at 24,630 and keep adding long positions here. We are expecting that, Nifty IT can also start contributing from here, and which may help the Nifty eventually scale towards 24,900.
Okay. All right. And stocks, Sachidanand, any specific fresh calls?
So TCS is one particular counter that is looking, lucrative right now. The reward is looking better. We have a breakout from a falling wedge formation. The base at 3,500 looks very strong. From a momentum perspective, one can keep a stop loss at around 3,530 and add fresh long positions for a pattern target of around 3,630. The second stock on the bullish side is Poonawalla Fincorp. Now, if you look at the 60-minute chart structure, it looks like an inverse head and shoulder formation with a neckline at 390. Now, this particular neckline has been breached, and the OI addition is also significant. So we may see this stock scaling towards 415, which is the pattern target. The stop loss for the trade can be placed at around 384.
All right, Sachidanand, thank you very much for joining us. Good getting that perspective on those trades specifically as well. Poonawalla Fincorp, inverse head and shoulder, breakout perhaps. The shipbuilders are the top two volume-led gainers. There's Garden Reach and there is Kochi, but there is Tata Steel also, which I think we will address in a bit. Tata Steel is the third largest volume-led gainer with a near 5% pop coming through at this stage. Okay, I think we have, we can cut across to the Chief Justice of India right now. Justice Sanjeev Khanna retired on Tuesday, marking the end of his tenure as the 51st Chief Justice of the Supreme Court. Justice Gavai was elevated to the Supreme Court on May 24th.
And it is Justice Gavai now taking over, taking his oath as the 52nd Chief Justice of India.
Okay, those are visuals coming in, and the oath-taking ceremony. The new Chief Justice taking oath, and of course, senior officials of the government present, and of course, the new Chief Justice being administered the oath by the President. We'll take a quick commercial break here. We'll come back. Markets up 150 points. Focus on stocks.
Welcome back. Well, let's focus on Tata Steel. You know, I told you yesterday that in fact the numbers were actually good and the commentary as well was very, very good. But yesterday the street ignored the commentary because in fact we did have markets that are a little bit brittle. But today the stock is catching up, and as we normally say, disco is doing the disco today. Let's run you through a few points though. The management spoke to us yesterday on pricing. They said that domestic prices have improved by around 3,000 rupees on a sequential basis. Even in Europe, pricing had improved out there. The second factor is the cost of coal. That is likely to fall by close to around $10 on a per ton basis, which is a positive. And finally, the EBITDA guidance that they gave us. Europe will turn into the black in the first quarter itself. And the UK, which has been a big drag, in the next couple of quarters, that as well turns profitable. So that's why, in fact, the street likes that. Nuvama, they are one of the brokerages that have gone ahead and upgraded the stock. The target price have raised to around 177 rupees. They have raised their FY27 EBITDA estimate by around 6%. Because they're factoring in higher profits coming in from Europe and also lower fixed costs. They are estimating that the first quarter of this fiscal, that's quarter 1 FY26, the EBITDA number could go up by around 2,000 rupees on a sequential basis because of higher steel prices, lower coal cost, and also they're saying that there could be some softness in volume, but both these other two will offset that. Finally, the European operations, they say that it is likely to turn profitable in this year and it will start contributing meaningfully. So it explains why the stock is up and about. The other one we're looking at is Garden Reach. Ria joins us to help us out with a quick analysis on that one. Ria?
Well, yes, Garden Reach Shipbuilders is in focus once again today after reporting a healthy set of numbers in quarter 4 of FY25. The revenue has gone up by around 62% on a year-on-year basis. Even the EBITDA and net profit have jumped up by 144% and 119% respectively, both on a year-on-year basis. Margins have also seen an expansion of 454 basis points, coming in at 13.5% in this quarter versus just about 8.9% in quarter 4 of last year. For the full year FY25 as well, we've seen good growth on all fronts. The net profit margin has also been above the company's guidance of over 8%. The order book details haven't been disclosed yet, but in the quarter 3 earnings call, the company had said that the order book is expected to come down to rupees 22,000 odd crores by the end of FY25 as execution is picking up. And the order book at the end of quarter 3 was around rupees 23,877 crores. Some key things to watch out for going ahead will be the management's comments on the order book and the execution, and also the update on the delivery of one of the key projects of the company, which is the 8 ASW shallow water crafts, all of which are to be delivered by October of 2026. And remember, the first ship was delivered just last week to the Indian Navy. Commenting on the results, the management has said that with their strong order book and healthy order visibility going ahead, including in the commercial shipbuilding segment, they are confident of even better performance in the next financial year going ahead. Resultantly, the stock has been trading higher in today's session, up around 12 to 13%, but still important to note that it is down around 25% off its 52-week high at the moment. But largely the results have been good for Garden Reach in this quarter, and the street is reacting positively to this.
Okay, big move as far as shipbuilders are concerned, and the defense theme very much well and alive. Let's focus on commodities now. Manisha is here with what she's got her mind on. Manisha, good morning.
Morning, Prashant. Thank you for that. I'm looking at the crude oil prices because we're trading at a one-month highs onto this one. The sentiment has been positive as the U.S. keeps talking about on how many countries they are talking to and the trade agreements are processing. Well, we also have seen the U.S. and China temporary relief for 90 days also improve the sentiment into the markets. That has been keeping the crude oil prices on the higher side. Apart from that, it also has to do with the U.S. producers. Remember, the U.S. has been talking about producing a lot, but that really hasn't been the case. If you look at the rig count in U.S., that has continued to decline. And the latest names that are coming in U.S. is Diamond Energy and Coterra, reducing the drilling activity, supporting the crude oil prices, not just for Brent, but the US WTI as well. And then it has been about fresh sanction threats against Iran. And this is coming in after the 4th round of talks that we heard in Oman. US also is talking about fresh sanctions on 20 individuals and companies who have been dealing in sense of trade with Iran. So that there you have that adds to premium to prices. And then it is also about decline being reported in U.S. inventories. The crude inventories have gained, but when it comes to gasoline and distillate inventories, in the last week, we've seen a decline coming in for both of them, more in case of distillates, and that in turn has been supportive as well. The U.S. president is in Riyadh, and we've heard statements coming in from there. One thing bearish and one thing bullish. The bearish has been that the US would look to lift sanctions on Syria. But the other thing is that US has been able to secure a big amount to the tune of around 600 billion coming in from Saudi Arabia in sense of investments within US when it comes to energy as a sector. So that is something that the markets see as bullish. And then it also has been about improved outlook in the global trade flows. Saudi Arabia also in the meanwhile seem to be pushing OPEC and allies to ensure that they do not produce more than or less than quota. So this deal is something that Street will watch out for. But there's a lot of uncertainty as well, because when it comes to crude oil, we do not know on what kind of sanctions or ease of business will Russia and Venezuela see coming in from US, and that will keep the markets in good favor as well. But when it comes to prices, well, the last couple of years were negative, and 2025 seems to be going that way as well. So even as we've seen the last couple of weeks see gains in case of crude oil prices, there you have it. 2025 is still down by 11% in case of crude oil prices. This comes in after 3% of decline last year and 10% of cut in 2023 as well. So it doesn't look very bullish coming in for crude oil prices. But if we are still in the first half of this year, markets will want to wait out for China demand and, of course, the trade numbers coming in.
All right, Manisha, thank you very much for that. 9% in the last 4 sessions on oil. Well, even as the situation along the border with Pakistan remains calm, US President Donald Trump again took credit for the cessation of hostilities between India and Pakistan on his Saudi visit. Meanwhile, US Department of State Principal Deputy Spokesperson Tommy Pigott emphasized the importance of direct communication between both countries. Listen.
India has refused any US effort to mediate between India and Pakistan. How hopeful you are that you will be able to bring them together in the same room for talks?
Well, I'm not going to speculate on that. What I can say is that we encourage direct communication. We have been clear on that. We continue to encourage that direct communication. The president has been clear on that. And the president, as I said, has also been clear in praising both prime ministers for choosing the path towards peace and the wisdom and fortitude that shows.
Has US sent a team to Islamabad or Pakistan following the reports that there have been leaks of nuclear radiation in some of the secure Pakistani sites?
I have nothing to preview on that at this time.
Okay, well, we'll take a quick commercial break here. And on the other side, it's our special segment, is the economy. Lata in conversation with Neeraj Gambhir of Axis Bank and Abhishek Upadhyay of ICICI Securities Primary Dealership. Stay tuned, coming up.
India's bond and currency markets are being swept by some unprecedented volatility. First, the latest news, April inflation is at a 6-year low of 3.16, and post the announcement, most economists have brought down their forecasts for full-year FY26 CPI to below the RBI estimate of 4%. Now, when did we last have a time when full-year inflation averaged below 4%? So, how low may India's rates and yields go? there is even more volatility in currencies. Since February, the rupee has touched an all-time low of 87.95 per dollar and a high of 83.75. I mean, that's a 4 rupee difference or a 6% difference between high and low, all in a matter of 3 months. So, where are bond yields and the rupee headed? I'm joined by 2 experts, Neeraj Gambhir of Axis Bank and Abhishek Upadhyay of ICICI Securities PD. Gentlemen, thank you very much indeed for your time. Neeraj, with your permission, first let us settle this inflation number that has come in. What's your sense now? The full year inflation likely to be 3.8 or 3.5, according to economists. Should we expect the end repo rate to be even below 5.5?
So yes, our expectation is that the full year inflation is going to be lower than 4%, which is Reserve Bank's target. And that does give RBI the space to do some more rate cuts. At this point in time, I am expecting 1 rate cut in June and 1 rate cut in August, and we'll take it from there. I think it's a bit too premature to talk about a full 100 basis point rate cut, as some have been talking about. But 50 seems to be something which is kind of given in some senses, given the inflation outcome. And the markets are also pricing in about 50 to 75 basis points in the next 2 months.
Exactly, yeah. If not 175, Abhishek, where do you stand on that? The CPI number actually has come below our poll. It may be different for you, but our poll for the last 4 months, the actual number is a good 5 to 10 basis points below the street expectation. So should we expect a lower than expected CPI, maybe 3.5 for the full year, and therefore repo rate?
Well, the CPI data was even more benign once you additionally consider there was no big base effect this time. Also, there were some one-off factors imparting upward pressure on this print, including higher gold prices, which are up 6%, more than 6% month on month. LPG prices were also higher. So if these were not headwinds, headline inflation would have been even lower. Given view this year, range will be above normal for second consecutive year, benign global commodity prices, and view of more or less sideways or softer growth compared to last year, RBI should have a lot more conviction heading into the June meeting that inflation will be below 4%. We think inflation could average around 3.5%, but we're less sure RBI will be aggressive in revising down their inflation forecast to that level. We do expect two rate cuts from here. If you're looking at the inflation trajectory, you would believe there could be scope for more. But if downside risks to growth are judged to be moderate, we would expect RBI to be reasonably conservative in setting the floor for the policy rates in this cycle. And 5.5% is a reasonably benign repo rate, and effective rate could be even lower, between 5.25%, 5.5%. Even right now, the weighted average call rates are below repo rate at around 5.85%. And the overall rate, the weighted average overnight rate, once you additionally consider the collateralized market borrowing and lending rates, is around 5.8%. So already quite close to 5.75%. This trend may sustain given surplus liquidity, but we don't expect more than 2 rate cuts with some stealth easing right now.
Okay. So very quickly, what's your end-year view of the 10-year yield, Abhishek?
Well, Lata, so bonds tend to rally most in the run-up and in the early stages of rate cut cycle. This time the move has been turbocharged by RBI injecting significant liquidity also in this period. We are still in the middle stages, and maybe there is some more downside from here. But we would expect 10-year yields to bottom somewhere around between 610, 620 levels, and maybe go higher once market comes to expect that rates have now bottomed and the next move is towards a higher policy rate. So end of the year could be higher than this range that I'm talking about.
Oh, okay. Neeraj, just that one number, and then I get to rupee. 6.26 now on the new 10-year. How low does it go this year?
I think hard to see it going below 6% for now because we have another 50 basis points of rate cuts to come. There is still no visibility of any possible rate hikes down the line, maybe 12, 24 months down the line. So I think market will kind of settle down somewhere close to 6%, give or take 10 basis points on both sides.
That also is unprecedented, right? Only during COVID, perhaps we had a couple of months, but otherwise, even 6% is kind of unprecedented in India for several decades. But Neeraj, now the more important question of the rupee. I've never been so confused. Is the direction of the rupee towards 87 or is the direction of the rupee towards 84? We don't know. Every day is a new day. What's your sense? Do you think the dollar is in for more sustained weakness and we are likely to see the rupee actually strengthen, go towards 84?
Yeah, so I think we have two opposing forces at this point in time from a global currency market perspective. Firstly, the dollar. We've seen some strength in dollar ever since the announcement of some kind of truce between China and US on trade talks. We'll see how that plays out, but I think there is, from here onwards, there is potential for some more positive news for the market as some of these trade deals get, announced with large countries, including possibly India. And there is more progress on China and US trade talks. So I think that on the balance will be positive for US market from a growth perspective, as well as from an inflation perspective. And that could actually bring some life back into long dollar trade. Although from a structural standpoint, I think the market is still quite bearish on dollar and feels that the dollar needs to, depreciate over a longer period of time. But you could have some, intermediate sort of rally in US dollar index. The other factor for us is China. And given what has happened has actually far bigger bearing on China than probably on US. And the fact that over the next 90 days, since the start of this kind of pause, we will see a expedited sort of amount of exports taking from China to US, which is going to be positive for Chinese economy and Chinese balance of payments. So I do feel that we will also probably simultaneously see some kind of yuan strength, which we're already starting to see in the market. And from rupee perspective, yes, strong dollar means weaker rupee, but stronger yuan means lesser sort of pressure for the rupee to weaken. So my view is that on balance, given these two opposing forces, we could potentially see some volatility around the current level, but not very large moves for some time, maybe for the next 2 to 3 months.
Okay. No, I'm worried. Even as you were talking, we were showing the year-to-date rally of Asian currencies. And currencies like Taiwan, for instance, have risen by 8.5%. And there are quite a few currencies which have risen about 3 to 4%. India included has risen against the dollar. So my point is this big worry in the market that it won't be just tariffs that will be negotiated, but countries like India would be pressured. There are people who even say China was that was one of the unspoken pressures in the Switzerland meet. That, you have to appreciate your currency or let your currency appreciate. And true enough, the Chinese yuan appreciated by 4% after the Switzerland talks. So will there be a arm twisting to allow the currency to appreciate or even something very overt like buy 100-year US treasuries?
I'm hard to see how you can actually bake in a currency weakness in the hard trade negotiations. Ultimately, if the objective of these trade negotiations is to balance US balance of payments more, maybe reduce the current account deficit, that itself should be some kind of a respite for US. So I'm not sure whether they can have a very formal agreement between the currencies to say, okay, weaken your currency versus US dollar, and that's something that kind of gets priced baked in. My sense is that any positive, trade agreement between US and India will be eventually positive for rupee. So I think there will be a pressure on rupee to, in some senses, appreciate against US dollar, provided we see a good outcome on the trade front. Otherwise, I think it's going to be pretty narrow range. Also bear in mind that too much of appreciation can also not be talked about because Reserve Bank has spent quite a fair amount of reserves in terms of defending the currency in the down move. And any significantly disproportionate appreciation will be used to kind of build back the reserves and sort of balance the forward position that Reserve Bank has. So I think, again, I don't expect more than 2 to 3% move on either side.
Okay, on either side, but more likely we will end the year towards 87?
I'm not so sure, Lata. I don't think it's a clear-cut case for depreciation from here onwards.
Abhishek, what is your best guess? Are we likely to see further appreciation of the currency from here on, considering that, your deficit with the US is going to fall?
What is peculiar about this move in rupee, Lata, is that on a real effective exchange rate basis, rupee has still weakened significantly. So on a real basis, we will now be closer to 100 levels, which will be lowest in about 2 years. That, from a trade perspective, allows RBI to still absorb more appreciation, perhaps. But I broadly am sympathetic to the view that given dollar weakened when US imposed very high tariffs and some of those proposals are now being reversed, it is possible dollar can bounce back a little bit. In this period, RBI can allow rupee to depreciate, and particularly now that the offshore short dollar book that RBI had has also now virtually been extinguished in this period of rupee appreciation. Medium term, I also agree that dollar is very rich. In fact, if you look at the USD on a real effective exchange rate basis, it is the most expensive since the dot-com bubble period. There is case for dollar to weaken, therefore, from a slightly longer perspective. In that period, rupee should be well behaved. Typically, rupee doesn't appreciate much in periods of dollar weakness, given our positive inflation differentials with the rest of the world, which anyways dictates some weakness every year. So typically, rupee tends to flatline in such a backdrop. Okay. That is what I would expect also, unless dollar weakness is very pronounced, basically looking beyond next few months. So broadly, I think rupee goes up, rupee depreciates a little bit near term against the dollar, but then stabilizes around these 85, 86 kind of levels further ahead.
Okay, interesting times we live in. It's quite possible that some geopolitical announcement comes tomorrow and all of us have to change our views, actually. Thank you very much, Neeraj Gambhir and Abhishek Upadhyay, for joining me. We must expect Indian yields to fall. You will see the 10-year yield go perhaps all the way to 6%, and the Reserve Bank cuts could be 2 or maybe even 3 cuts this year. Rupee likely to be flat to slightly declining, but it's anybody's guess. Wrap up on Bazaar on that note. Chartbusters coming up.
Tata Steel is among the top Nifty gainers, climbs more than 4% after bullish brokerage notes. Nuvama has upgraded the stock, issued a buy call, raises the target price to 177 rupees a share.
Bharat Airtel climbs on the back of its strong results. Consolidated numbers come in better than estimates, led by Africa business. The India mobile numbers also come in steady.
Tata Motors skids more than 1%, now 0.5% on the back of its results. Despite a quarter that beat estimates, the management has issued a cautious outlook for JLR in the coming quarter. Kotak Institutional Equities and Jefferies are bearish on the stock.
And Aditya Birla Capital rises close to around 5% after bullish brokerage notes. Macquarie issues an outperform call with the target price of 260 rupees, while Morgan Stanley issues an overweight rating with the target of around 250 rupees a share. Both cite a steady quarter as the key reasons.
A bunch of stocks in focus on the back of their results. We have Max Financial, Dalmia Bharat, as well as Garden Reach Shipbuilders on the back of their earnings, gaining big. Garden Reach Shipbuilders up 17%.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam, and we're getting used to our favorite color yet again. We have green. That should come up for you on the top of your screen. The Nifty has bounced back 150 points. The Nifty Bank not doing that great today. It's a bit of an underperformer, but the breadth of the market is good. So that's why your portfolio must be feeling quite good. Mangalam.
2 days in a row, over 2,000 stocks in the green. That looks fairly good. The important part, however, where we go from here on, because this 24,700 to 24,800 could be a bit of a supply zone. But if we sustain above these levels, then there are a lot of shorts in the system. Maybe ahead of weekly options expiry tomorrow, we may see some short covering. But let's talk about individual stocks. Ask Automotive. That's the stock on our radar. Reported a good quarter, posted strong revenue growth. Kuldeep Singh Rathi, who's the chairman and managing director of the company, joins in now to detail the quarter gone by, but more importantly, talk about the year that lies ahead. Thanks a lot, Mr. Rathi, for joining in. Just a two-part question. One, what's your outlook for FY26 when it comes to revenues and margins? And secondly, you were looking to increase your contribution coming from electric vehicles and exports. Where do those numbers stand right now? What's the prognosis for next year?
Good morning, Mangalam. This year, we have done well. As you see that the profit has grown by 43%, the year profit. And as you asked about the next year, so next year also looks very, very positive. And why I am positive on the two-wheeler is that we have still not reached the numbers that we achieved in 18-19. Of course, we were very close to this. So I see a good year ahead, and especially in view of all the macroeconomic indicators, that is the low interest rates, the tax cuts, which are going to benefit the two-wheeler industry, the forecast of the good monsoon, because a good monsoon, the agriculture sector, will be good, and from where the two-wheeler demands is going to come. So next year, we again expect the numbers revenue growth to be into the mid-teens, as always. We'll outperform the industry, which have been doing for the last 30 years. And the future looks very, very bright.
All right. Hi, Mr. Rathi. You're sounding quite optimistic about prospects. Give us a few more details. Could you tell us what proportion of your revenue comes in from EV? If you could help us out with that. And earlier, you were aiming at scaling up exports as well. But the globe itself has moved into a bit of a tizzy. So for the coming year, FY26, what kind of a revenue contribution can you get from exports, yes. EV and exports?
Good morning, Nigel. Yes, you're right. The EV sector has not picked up as yet. And as you will see, the EV share of the whole market, two-wheeler market, is less than 5%. It has not even crossed that. So our share is also around 4.7% or so. So we are moving as per the share of the EV sector. As you know that we are OEM to the 80% of the organized EV market. So we'll grow as per the growth of the industry in the EV side. On the export side, we have done a lot of groundwork. We wish to grow further ahead, but as you have rightly said, the geopolitical situation has not been good. The tariff uncertainties also came, but still we have held the ground. But this year we can see an appreciable improvement in the exports, as one of the customers, one new order of 75 crores is in the pipeline, which we hope that it will go as per the plans.
And what would that take your overall export contribution to this year? Where does it stand right now?
We are at about 4.5, around 4.5%, and next year we will definitely, hopefully improve it.
To what, sir? Because exports, I remember you had said, are better
Yes,
margins for you.
We are from 147 crore. Well, our aim is to go to 250 crores.
And what does that do to your margins?
Margins are always, exports are always good.
No, overall margins for the next year, what's your target?
Overall margins, we will certainly improve our overall margins by 150 basis points from this. So we'll be, but we are aiming to achieve 14% EBITDA margins.
Okay, and if I got that number correctly, exports move from around 147 crores to 250 crores. Is that correct?
Yes, please. Yes, please.
Okay, tell us a little bit more about the Karoli plant. You were looking at ramping up that, right? So
Yes.
what is the current utilization levels? How much are you factoring in terms of a contribution from here?
Karoli plant, continuously the investments are also going on, and the capacity utilization also remains at around 50%. And
Okay.
it is totally into the cash profits, Karoli plant. And after that also, we made one more investment. And that investment was in the Bangalore plant, which we commissioned on 14th January. So all the necessary QAVs have happened, and we are confident that from this quarter, even that plant will become EBITDA positive.
So Karoli plant, I remember the last time you joined us, you said at peak could do revenues of close to around 300 crores. Is that correct?
No. I said ultimately it will go to more than 1,000 crores.
Okay.
But it will need further investments, which will be making this year also about around 200 crores more investment will make. But already it has achieved 500 crores.
Okay, what is your current your capex plan for this year, sir?
CapEx plan, since I am an optimist, as you have seen, we'll be spending about 450 crores. And mostly this 450 crores will come from the cash generation that we'll make.
Okay, all right. What is the optimist in you telling you about your own stock price? The promoter entity still holds around 79% in the company. Yes. You have 4% to come down to the minimum public shareholding norms. Does it happen? Yeah.
We have 18 months left for that. We are not in a hurry, because we don't
you're
need,
in no hurry.
No hurry. We don't need the money. We are very cash-rich company.
You were also looking to, increase your contribution coming in from non-two-wheelers, commercial vehicles and passenger vehicles. Where does that number stand at right now? Have you won any client orders here?
Yes. We have got the orders, and that through Tier 1, we are not directly into the passenger vehicle, but we are through Tier 1, and that business is slowly and steadily growing.
All right.
So where do you expect this to go from here?
This will keep on increasing because the focus is there. This will keep on increasing. And the idea is to overall grow the business in the double digit, That's always the idea, because then only there is more capacity utilization, you get more economies of scale, and that's how the margin improvement is there.
All right, take that point. Thanks a lot, Mr. Rathi, for joining in and giving us your views on the year that is ahead. You expect better exports revenue coming in. EVs will grow in line with the industry. But for you overall, mid-teens revenue growth with margin aspiration towards 14% is what the street will take away from this conversation. Take a short break. On the other side, we have another management joining in. Puneet Lal, by the way, Vice Chairman of Anup Engineering, joins in to discuss the quarter gone by.
Welcome back. You're tuned into Chartbusters here on CNBC-TV18. Well, keep an eye out on the screen. Some of these defense stocks are moving quite well. Paras Defense is up and about. You have DCX Systems as well, has moved to the high point of the day. Now it's up, I think, close to around 5% as we speak on rather large volumes. A big move out there. And KPI Green as well. In a matter of, I think, the last few trading sessions, the stock is up more than 20%, corrected big time from the top. But I think the street likes those numbers and also likes the cash flows. Explains why that one is still holding well in the green. Well, I think next up, though, we could get in our next management. We have Anup Engineering. The company posted actually a strong quarter in the past, in quarter 4. Profitability, though, a little bit of a disappointment. The gross margins did contract a little bit. To help us out with the way ahead, we're joined by Mr. Puneet Lalbhai, the Vice Chairman of Anup Engineering. Hi, Puneet. Thanks a lot for joining in. And let's talk about business first in terms of a guidance for FY26. What kind of numbers are you looking at in terms of margins? I think it was in that vicinity of around 20% is what you were targeting, while revenue growth of around 25%. You're confident you can get to those numbers?
Yes. Usually we have, a very strong order book going into the year. And this year is no different. We already have about 80% of the order book locked in. And we are now looking at short lead time orders to ensure that our growth will be above 25%, and we should be in with that 20% plus EBITDA margin. So things are on track for next year.
All right, 25% growth with EBITDA margins upwards of 20%. So those are from the income statement outlook. Puneet, just wanted to know what happened to the trade receivables? Because I'm looking at your annual cash flow statement and it's actually turned negative from for this year. Cash flow from operations down from 170 crores to a negative 8 crores. And that's because trade receivables have increased by about 140 crores. If you could give us a sense on what propelled this and what's the outlook here in terms of receivables and your working capital days?
We expect the trade receivables to normalize in Q2. This is on account of one very large order that has a request for delay from the customer's end because their site is not quite ready yet. So we are holding that order, and the majority of the trade receivable impact is because of that. I would not be concerned about that. I think it will normalize by Q2.
And it's a solvent customer, right? There's nothing really to worry about, or one shouldn't worry about this going into bad debt or anything, right? It's just a near-term liquidity.
No, not at all. No, not at all.
You want to quantify this client's exposure?
I beg your pardon?
You want to quantify this client's exposure?
It's about a 200 crore order, of which 90 crores has been produced and billed, of which a good chunk of money has also been received. So everything is current. It's just about a 3-month delay after the jobs have reached quite an advanced stage. So I would not say that there is any risk of any bad debt on this customer. It's a very blue chip customer, and as soon as the jobs are shipped out, our receivables should normalize.
Got that. So that assuages some of the concerns that the street had this time around. So 25% revenue growth, 20% margins, receivables get fixed in the next couple of months. What about order inflow? What's your guidance for FY26? Where does your order book currently stand, and how many orders do you expect to get over the next 12 months?
So our current order book stands at around 750 crores. We delivered in FY26. We are under discussion for some large orders that should get finalized over the next 3 to 4 months. And after those orders get finalized, we should be able to cross that 25% growth rate. It's been an extremely challenging environment. In India, post-elections, there were a couple of quarters where there has been very low order inquiry bank from the PSU sector, especially, and with elections in the US and the tariff uncertainty, there has been somewhat of a holdback from the US as well. But the good news is that India projects are coming back on stream, and we are just maybe 1 or 2 inquiries away from fulfilling what we need to do in the next financial.
Well, that's
current
right.
financial.
And Mr. Trump is making things even more exciting with regard to the US. So my question to you is, how do you see your revenue mix pan out? Because as we speak, as of the last year, exports were a greater quantum. So what is the outlook out of this growth that you're talking about for the coming year? How much of it will be exports? And what is your current exposure to the United States?
So we would be about 50% exports even in the next financial year. And the current exposure to the US would be between 20 and 30%
20
of the
and
export volumes.
Of the exports. So overall, it will be around 10 to 15%.
Correct.
All right. And what is the margin difference between the two, domestic and exports?
Exports are usually a couple of percentage point higher in margin, but it really depends. It really depends on the product mix. It depends on the criticality of raw material, the criticality of the work content. So generally, as a rule, a couple of percentage points higher in exports, but that's just going on past averages. It can all change depending on what sort of orders we get. Right now, exports are about 2% higher.
Got it. And, you spoke about product mix. We saw a big jump in your vessels business, nearly 5 times, a low base. Towers and reactors grew by 46% as well, smaller base. You had health exchangers, which is your major revenue driver. That grew just about 2%. So what's your prognosis for all these individual products? How are they likely to do in the next year? And even the Mabel acquisition, right? It's been 1 year so far. What's the performance this year been? And next year, I believe, you will enjoy the benefits of synergies.
Absolutely. So I think the increase in reactors is because our Kheda plant has completed phase 1. Kheda plant is a greenfield facility where we have 20-meter high bays, where we have very heavy lifting capacity. So that facility is very amenable to large reactors, which we were not able to do through our Kotak plant. So the coming on stream of Kheda is the reason why you are seeing the jump in reactors and vessels, and that is according to plan. Kheda phase 2 is also in advanced stages, so we should be completing Kheda phase 2 sometime in quarter 3. So after that, we expect that the steady state order book, considering both Kheda and Odhav, should be about 60% vessels and reactors and about 40% heat exchangers. And yes, Mabel has done well. We posted about 43 crores of revenue from Mabel this year. And there is a lot of headroom to grow. The other interesting thing about Mabel is that the order cycle there, order to delivery cycle, is much lower. So we can turn around equipment in 6 months.
All right, very quickly, before we let you go, the Kheda plant, it adds to your capacity by around 20%?
Yes, and I think after Kheda phase 2, which will be completed in quarter 3, our overall capacity should reach about 1,200 crores.
All right. And I'm sorry, I didn't get the Mabel guidance. This year you did 46 crores. Next year, what is your target?
We should be upwards of 70, 80 crores next year.
And EBITDA break-even and margin synergies enjoying, right?
Absolutely. Absolutely. That's all part of the overall 20% guidance.
Okay, all right, Puneet, appreciate you joining in, giving us all of those details. Wishing you all the best for FY26. We've taken a lot of numbers from you. We'll hold you to that guidance all through the year. Thanks a lot for joining in. Well, for the time being, let's slip into a short break. As we do that, here's some good news for all our viewers. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates. All of this at your fingertips. Just download the CNBC-TV18 app from the Apple Store or the Google Play Store, or just scan the QR code that's up for you on the screen.
128 points on the Nifty, 500 points higher on the mid-cap index. The Nifty Bank, an underperformer right now, but nothing really to worry about as far as the frontline indices are concerned. BEL continues to do well. And pharmaceutical stocks, for the second day running, they're feeling good. Devi's Lab, Dr. Reddy's, a bunch of them up and about. Let's talk about GAIL, though. The company reported a steady set of earnings in the fourth quarter, 13.5% jump in the EBITDA. Our colleague Sapna Das caught up with the chairman and managing director of the company, spoke about the APM gas allocation and how that's affecting the company. Listen in.
APM gas, as far as we are concerned, we are only distributor of that APM gas that is allocated to us from the upstream producers. But since we already have CGD business and we have taken a lot of CGD entities besides GAIL's own CGD, so any reduction in allocation of APM gas definitely affects our profitability as far as CGD business is concerned. Now, for our own purpose as well as for CGD companies, which are our group companies or otherwise, whoever wants to have more RLNG because of this reduction of APM, we are extending due support in sourcing that RLNG to all the entities. But yes, profitability-wise, we do lose out because of our CGD business.
So any impact that you saw in your just announced results?
The allocation, the revision in allocation happened in the fag end of the financial year. So the impact will come in the next year, yes.
Or probably in Q1?
Yes, in Q1 also, definitely, yes.
Okay. We would also like to understand that, Petrochem business, the EBIT has turned negative again. So can we expect a positive margin sometime in the first quarter FY26?
Again, the prices are not in our hands and it's largely a factor of international prices of polymers, which are ruling very bad, in fact, and that is why the results are so. We expect that the petrochemical prices do improve world over, which will give us margin, and we also expect that there should be softness in the natural gas prices, because our feedstock is natural gas only, unlike other players where naphtha is also one of the feedstocks. And we also expect Government of India to put certain tariff protection measures by increasing the import duties so that the cheap sub-quality polymers are not imported in the country.
Okay, so anything specific on that in terms of the import duties? Because right now it seems that the world is going towards zero tariff.
So, yes, while there is a talk of rationalization of taxes everywhere, but we are not asking for any great increase. The present tariff is 7.5%. We believe that it should be raised to, say, a level of 10%. Yeah.
Yeah, absolutely. So this proposal has already gone to the petroleum?
No, this is an industry. There has been industry demand for a very long time. Yes.
Okay. You also mentioned about natural gas prices. So what's the outlook given what's happening internationally at the moment, and also how crude has been behaving?
Yeah, it's a very volatile situation and it's very difficult to hazard any guess. But since the crude oil prices have also softened, and because of the increased production and commitment to increase further, I believe the HH prices should also be in the range of $3.5 to $4, at least in the near term. So I do not see any major upset on the price levels of natural gas.
Well, moving on then, government sources say that 25 days of coal stocks are currently available at the pit heads of thermal power plants. Abhimanyu joins us to fill us in with further details. Abhimanyu?
The situation on available coal stocks continues to be comfortable for the government. As per government sources, around 25 days of coal stocks are currently available at pit heads at thermal power plants. Also, government sources added that the government is looking to increase and better the last mile connectivity for transport of coal to different parts of the country. As far as enforcement of the larger scheme for better logistics is concerned, that is already being undertaken, but last mile connectivity is something which the government is working on. Also, the government is working on beneficiation of coal, of increasing the use of washeries to purify coal before transport to increase the overall efficiency of the transport and logistics system which is used to transport coal. And also, this will possibly increase the efficiency of thermal power plants and will provide them a better perspective as far as calculation and computation of available coal stocks is concerned. Now, last week, there was an interministerial meeting between the Ministries of Power, coal and new and renewable energy, where the ministers took stock of the available situation. Now, the peak demand scenario across the country is varying depending on the climatic condition, on the weather condition. Now, while state-wise projected peaks have already been witnessed due to heat waves in states like Gujarat and Telangana, there also have been states in northern India where the influence of rainfall and thunderstorms have kept power demand in check for a certain period of time. It remains to be seen how the situation is going to pan out with respect to the availability of coal stocks, and also more importantly with respect to local weather conditions, which are going to determine the overall demand going forward.
All right, with that, we're out of time on this edition of Chartbusters, but not without the news. There our director who brings the show to you and fires all these wonderful graphics that
Shalini's birthday. Happy birthday, Shalini.
Happy birthday, Shalini. Have a great one, and hopefully we'll be better behaved in all the other shows that you roll with us. Thank you so much for watching. Trading Hour comes up next.
Good morning. Welcome to Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Reema Tendulkar. With me is Hormuz Fataki, and it's broadly a strong and steady start to this Wednesday morning. So at 11 o'clock, the Nifty is just shy of the 24,700 mark. About 10 minutes back, we were firmly above that level, but given up a tad bit. All in all, up close to about 0.4% on the benchmark indices. Mid-caps faring better. The mid-cap index is up 0.9%. We've got a positive advance decline ratio of 4:1. One key level to watch when it comes to at least the benchmark index for a potential directional breakout will be the intraday high that we hit yesterday, 24,973. And that also pretty much aligns with the 25,000 level, which is a psychological level. So that will be key to watch that level, so keep that in mind. And one of the big drivers of the upbeat investor sentiment today is the softer than expected inflation print, and that is fueling hopes of an RBI rate cut, many of them later this year. Global cues also fairly supportive. Hang Seng is up, I think, 1.5%. The last time I checked, the Taiwanese market, the index was up nearly 1.8%. And again, investors are asking the question, is there a risk that hot money now flows out of India back into China on the back of that trade deal? But strength, I think, is broadly visible across sectors. Defense is doing well, metals is higher, PSUs are up and about, and I don't think there's a single sector which is currently in the red, Hormuz.
You know, and you mentioned hot money. Our colleague Yusuf had done a very interesting story on this last evening about whether there will be questions raised on whether the money will be flowing back out to China or the US. More importantly, now that both the countries have reached a temporary truce, you can catch that on our website, CNBC-TV18.com. But since you spoke of sectors, of course, you can't take your eyes off defense stocks, can you? And look at Garden Reach. The earnings reactions there, 18% higher now on Garden Reach Shipbuilders. 20 to 60 is where the stock is, still 20% below its all-time high of around 2,800. It shows you the kind of frenzy that you had in these names just around 7 to 8 months earlier, the ferocious fall that you saw, and then the recovery as well. Cochin Shipyard is not far behind, 13.5% higher on that stock as well. So that continues to move higher. And Mazgaon Dock too, 7.5% higher. So it is the three shipbuilders that are continuing to march ahead in today's trading session. Also, not to forget HAL is reporting results today, so we'll be keeping an eye out on that stock as well. So defense as a theme has been in focus over the last 2 weeks. It continues to do so. But of course, the MSCI additions as well. Just a quick note on that before we move to Bharti Airtel. Acme Solar is one of them. That is 7.5% higher. It is going to be included in the MSCI small cap index from the 30th of May. So Acme Solar are doing well for itself. But otherwise, it's a fairly green screen across the broader markets. But a lot of earnings reactions, of course, that we need to track, and Bharti Airtel, of course, was one of them, Reema.
Oh, indeed. And Bharti Airtel is also one of those big movers, right? So this year, Bharti Airtel is up nearly 17%. In the last 1 year, it's gained 45%, and it's up 170% in the last 3 years. So it's a big wealth generator. More details will come out in the conference call, which is at 2:30 p.m. today. But broadly, consolidated numbers are better than what the street was anticipating, and this is driven by the Africa numbers. But Africa was already known. The India numbers came out yesterday post-market hours, and once again, it shows that this telecom major continues to execute very well. So the India in Q4, Jio has done better than Bharti Airtel. So Jio's revenue growth in Q4 was about 2.5%, higher than Bharti, which is a 1.3% growth. But over this year, Bharti Airtel's revenue growth at 18% for the India mobile business is better. Even Bharti's margins at nearly 60% now for the India mobile business is higher than peers. And you know, this is a industry where whenever you have tariff hike, it directly flows through. About 70-80% of it comes down into the EBITDA. So the EBITDA has been constantly increasing for telecom companies, and now it's as high as 54% for Jio and 59% for Bharti Airtel. ARPUs too for both the companies. For Bharti, in fact, it's now inching towards 250. It's 245, while for Jio, it's about 206. A steady improvement seen in the ARPUs of these companies over the last couple of quarters. And for Bharti Airtel, even the subscriber addition has been robust at 5 million. So all in all, it's a good quarter. The company continues to execute well. The next trigger will be, of course, a tariff hike, because the last one took place in July. So we're done about 9 months. Is there another one coming? We spoke to an analyst today, and they said his expectation is that December of this year to June of next year, we should see another tariff hike.
And it shows, right, despite the tariff hikes, there has been no such resistance among subscribers. There is no significant churn or anything of that sort. So, it is show, and Sunil Bharti Mittal has been saying about talking about this, right, that the tariffs have been really low in India, so they deserve
lowest in the world. And for the return on capital to make sense, it has to go to 300 rupees over the long term. And currently, we're at 245.
So yeah, we're heading towards that 300 rupee mark on the ARPU front for Bharti Airtel, closer to all-time high levels now as the stock at 1830. But the other top mover today on the index is Tata Steel, and that is on the back of an upgrade that has come in from Nuvama. Nigel is here to tell us more on that. Nigel.
Well, Tata Steel is high in today's trading session. And to be fair, in yesterday's interview to CNBC-TV18, the management had made a couple of very, very positive points. So I'll make three big headers out here. One is on pricing. They said that current prices here in India are 3,000 rupees higher on a sequential basis. Even in Europe, they have said that the pricing is much higher. So there's an improvement both in Europe as well as India. That's point number one. Point number two, on the coking coal consumption cost, they said they're expecting some softness. It could be down by close to $10 on a per ton basis. And point number three, they gave a guidance on EBITDA. Europe, they said, turns back into the green, which is phenomenal. Good news out there, though UK will continue to struggle, at least initially. But in the next few quarters, they're expecting even the UK business that's been given the big loss, that as well, to turn into the green, which is a positive. Remember, as of now, Netherlands has turned into the green, and that will likely move it, stay in the green. But UK turning around at some part of the year as well is a positive. Nuvama, they have gone ahead. They have upgraded the stock. The target price has been raised to around 177 rupees per share. They've increased their EBITDA estimates by around 6% because now they're factoring in higher profits in Europe and also lower fixed costs. They are estimating the EBITDA to go up by around 2,000 rupees on a sequential basis because of higher steel prices, lower cost, and also they are saying that volumes could be a little bit softish, but both these two will offset the lower volumes. And finally, they are building in better numbers coming in from Europe. So put all this together,
Tisco is reacting in today's trading session. But to be fair, the commentary from the management itself ahead of their con call here on CNBC TV18 was extremely positive.
Yeah, you used to love saying, right? Tisco doing the disco.
Yeah, I try to stay out of that one for now. But yeah, Tisco is doing the disco yet again.
All right, let's talk about Aditya Birla Capital. That's in focus in the back of some brokerage notes. Nigel, tell us more.
Well, that's right. Aditya Birla Capital, in fact, is higher in today's trading session. I've picked out two big brokerages that are fairly positive. First, Macquarie, they have an outperform rating with the target price of around 260 rupees. They say that the profit and the AUM was in line with expectations. Now, all eyes are on the slippages, particularly in the unsecured business segment, which will be important. On AB Sun Life Insurance, out there, they're saying the performance actually was better than expected. So they're quite positive out there. And they're also highlighting that the management is targeting to double the NBFC AUM as well as the VNB in the next 3 years. So that's why we have Macquarie that's positive. Moving to Morgan Stanley, they as well have an overweight rating with a target price of around 250 rupees. They see a steady improvement and better outlook across businesses. They're saying that the NBFC, which is the largest business, the performance out there was in line with expectations. While they also go on to make this point that they are seeing a margin of safety and there is scope for a re-rating as well. Explains why AB Capital as well is doing well, because both the brokerages, Macquarie and Morgan Stanley, are optimistic on the business prospects.
Indeed, and it's showing up on the price as well. Almost 16% higher in the last 1 month is Aditya Birla Capital, and has done well for itself though, and almost 20% higher so far in 2025. So good going for Aditya Birla Capital as well. But we spoke of defense names earlier in the show, and Garden Reach, of course, can't not talk about that. Rhea is joining in with more on how the numbers fared and what did the management say on the road ahead for the company. Rhea.
Well, yes, Garden Reach Shipbuilders is in focus once again today after reporting a healthy set of numbers in Q4 of FY25. The revenue has gone up by around 62% on a year-on-year basis. Even the EBITDA and net profit have jumped up by 144% and 119% respectively, both on a year-on-year basis. Margins have also seen an expansion of 454 basis points, coming in at 13.5% in this quarter versus just about 8.9% in Q4 of last year. For the full year FY25 as well, we've seen good growth on all fronts. The net profit margin has also been above the company's guidance of over 8%. The order book details haven't been disclosed yet, but in the Q3 earnings call, the company had said that the order book is expected to come down to rupees 22,000 odd crores by the end of FY25 as execution is picking up. And the order book at the end of Q3 was around rupees 23,877 crores. Some key things to watch out for going ahead will be the management's comments on the order book and the execution, and also the update on the delivery of one of the key projects of the company, which is the 8 ASW shallow watercrafts, all of which are to be delivered by October of 2026. And remember, the first ship was delivered just last week to the Indian Navy. Commenting on the results, the management has said that with their strong order book and healthy order visibility going ahead, including in the commercial shipbuilding segment, they are confident of even better performance in the next financial year going ahead. Resultantly, the stock has been trading higher in today's session, up around 12 to 13%, but still important to note that it is down around 25% off its 52-week high at the moment. But largely, the results have been good for Garden Reach in this quarter, and the street is reacting positively to this.
Yeah, thanks a lot for that. And as a result of which, the expectations for its peers have also skyrocketed now when it comes to delivering on their quarterly results as well, be it Mazagon Dock or be it Cochin Shipyard. Take a short break. On the other side, we discuss all things commodities. Manisha Gupta joins in. Stay tuned.
Welcome back. Let's turn our attention now to the commodity space. Manisha Gupta is now joining in and she's going to be talking about gems and jewelry. Why are you watching that?
I am, because the numbers are not so great really, Reema, because the first quarter we all understand was high, volatile, all-time high gold prices, and there was all this tariff concerns. So not too many people were buying jewelry. They were buying gold, yes, and they were investing in gold, whether it was in sense of physical gold, ETFs and funds as well. But the jewelry numbers were not so strong. So when this quarter started, people believed that because of Akshaya Tritiya in India, and then it was Mother's Day, which is celebrated quite strongly in the international markets, you could be looking at some jewelry demand coming back, but that also seems to be quite absent. This is the latest data that has come in from Gems and Jewelry Export Promotion Council, which tells you that for the month of April as well, the exports for jewelry actually have declined by nearly 5%. Also, when you look at the gems and jewelry imports into India, that is the number that you have in April 2024 and April 2025, and you can see a decline in that as well. Also, when it comes to import of cut and polished diamonds, within that as well, we've seen 46% of a decline coming in. Gold jewelry exports have declined by 5% as well. Colored gems seems to have done better, where there is a 12% increase in that. And this basically is semi-precious stones, lab-grown diamonds, which have seen some bit of a positivity on a month-on-month and year-on-year basis. But apart from that, this really is showing you on what the slowdown in US and China has done to numbers when it comes to jewelry exports from India, escalating geopolitical tensions, recently introduced Trump-era tariffs as well. And then, of course, the consumers really seem to be buying gold bullion as an investment and not jewelry really. And that really seems to have impacting the markets. The expectation is that this quarter and perhaps the next also could be slightly slower in sense of exports. The domestic market, because of the wedding season, could see some positive cues.
Indeed. Manisha, thanks a lot for that. Moving on then, Max Financial Services reported their fourth quarter numbers. Their total annual premium equivalent numbers met street expectations. The value of new business was also a beat. Now, to take this discussion forward, we are being joined by Prashant Tripathi, the MD and CEO of Max Life Insurance. But Yash is also joining in on the conversation. Yash, you tell us some factors as to what worked for the company this time around before we go on to the management as well.
Well, absolutely, Orma. So, it's not just one thing that worked for Max. There are two important triggers that are working for the stock today. The first one, of course, as you pointed out, the fourth quarter results, AP, retail AP, both ahead of what the street was anticipating, VNB margins. Again, both of them ahead of what the street was anticipating. In fact, margins came with a big beat for the fourth quarter. Apart from that, as I said, the second thing which has been working is the April number. The April numbers for Axis Max Life Insurance came in at a very strong growth, and this strong growth has come on a strong base. So as I said, two things working for the company. A, ending the year with the fourth quarter on a high note, starting the year, the next financial year, with the month of April, again, on a very strong note, and that's what clearly is working for the stock today.
Indeed, I will take this conversation forward with Prashant Tripathi, who is the MD and CEO of Axis Max Life. Mr. Tripathi, good morning. Thank you for joining in. Now, with the kind of year that you've had now in FY25, what are the growth targets that you have penciled in for FY26? If you could shed some light on that first up.
Good morning, Vivek and Yash, and thanks for having me. Firstly, thank you to Yash for his analysis. Actually, my day began reading his notes. So thank you, Yash, for that, for the acknowledgement. I think Axis Max Life Insurance has been on a good journey. And not just last year, but if you were to look at last couple of years, our growth is 18%, which is significantly more, almost double the rate of private average. And for last 8 quarters, quarter on quarter, we have done very well in terms of growth. Our margin numbers also were on the higher end of what I was thinking, which is another good news. Yash is right. We began the year with positivity. And, it's very hard to give an absolute number on growth, but I must share with you that we'll try to maintain 3 to 4 percentage points with respect to the private average growth. So if the private industry grows at 13%, you should add 3-4% more for our growth expectation. And in terms of margin, while we finished at 24%, we'll definitely target a range of anywhere between 24 to 25%, trying to increase it further. We finished last quarter with very good margin numbers, 28.1, and I'm personally very enthused. We took a series of actions to focus on product mix and trying to drive our product mix in a manner so that the margin numbers become better and better. So with all the work that we've done over last few quarters, I remain positive about the next year, and we are going to approach this year also with the same confidence that we did. We finished last year second half as position number 3 on the retail APE or retail new business premium in the industry, private industry, and the objective will be to consolidate our position as we go forward.
Prashant, thank you so much for joining us. One question as far as quarterly margins are concerned. Of course, in the fourth quarter, they were much ahead of street estimates. This despite ULIP having its negative impact on the margins for the quarter. Would you say that quarterly margins at about 28-29% is the peak? And what I want to understand is that despite the negative impact which came from ULIPs, what really helped you to take your margins to that 28-29% band?
Yes, if you look at our margins, typically our margins are lower in the first quarter and they pick up as we go along. Quarter 4 generally is the highest sales month where we get the leverage on the business, and hence our margins are typically highest in quarter 4. That's been the trend always. I must say 28% is the higher end of the margin, so you shouldn't expect margins going beyond of that. But your observation is right. Despite having high ULIP share, our margins were good. And the reason for that is our focus on trying to look at other areas of business, especially the category of protection, health and riders. You would notice that our riders have gone up by 270% over last year. So we try to attach more riders to ULIP, hence having a positive outcome on VNB margin. We also did a few things with respect to product variants to try and drive those product variants where inherently the margin numbers are higher.
Okay. Also, one very quick comment. Surrender value, higher surrender value regulations, that kicked in from October. So you've had about the second half, which means about 6 months impact of higher surrender value. On your margins, what was the impact in H2 because of higher surrender value? And now in FY26, what is the quantification of impact that you expect coming from this new regulation?
That's a very good question. And I did mention in quarter 3 that impact was close to 1%. But you know how businesses work, how operating people like me work. We look at the impact, but we then deploy corrective mechanisms to take care of the margin impacts. On a net basis, I will say the impact was less than 50 basis points for the second half of the year, because we almost nullified the impact by the corrective mechanisms that we deployed in quarter 4. As we look at next year, I think it should have a minimal impact because, we'll look at product mixes, we'll deploy, certain products which will have inherently more margin. So we'll take care of the impact of surrender regulations on overall margin.
So minimal would be less than 50 basis points?
Yes.
Okay. One question as far as Axis Bank and the distribution there is concerned. What was the counter share at the end of FY25? Also, just to compare, what did you start FY25 with? And now in FY26, what is the optimal or the ideal distribution mix that you would want to see as far as Axis Max Life is concerned?
We are extremely proud of the relationship that we have with Axis Bank. It's a very privileged relationship, not just now, but for now 15 years. And we just celebrated 15 years of working together, which was a very positive, step and a milestone in the journey of Axis Max Life Insurance. Our stated position is we will be between 65 to 70%, kind of a broad range of counter share. And suffices to say that we were in that range. We finished around 66% of counter share last year. This was more or less similar to how we finished FY24, maybe 1% up or down. But otherwise, despite the challenges of open architecture with the work, product mix, execution skills that we bring to the table, as well as, of course, support of the bank, we have been able to maintain our counter share.
Okay, now 2 questions with respect to 2 important product portfolios. One is with respect to protection. Protection in FY25, that grew at 35%. Do you expect similar rate of growth going in FY26 as well? And the second one is with respect to the ULIP share. The ULIP share was 42% in FY25 versus 35% in FY24. Do you expect this to come down further in FY26? And if yes, then to what point?
That's a very good question. Operating people like me are always very aggressive about growth expectations. I know that there will be base effects working against us, especially on, when we talk about protection, it's protection, health, and rider. Those 3 put together, we call as protection. We grew at upwards of 35%. On a base, 35% may be more difficult, but I will give a guidance of more between 20 to 30%. That's where we will be on protection. In terms of the overall ULIP mix, of course, increasingly the ULIP mix has been coming down, predominantly because whatever is happening in the market. I do expect the ULIP mix to fall further from the current level that we finished in FY25.
Prashant, a lot of the market participants, aside of the business, would be wanting to know one very important aspect of the business, and which is, when do you start that process of merging Max Financial into Max Life? When does that get completed? And when it does happen, when do you see the listing of Axis Max Life taking place?
So the listing will become automatic the moment we merge, because as you know, Max Financial Services is a listed company already. So, of course, like everybody else, it is also the expectation and dream of all the shareholders as well as the management team to embark on that journey as soon as possible. I think we're just waiting for some clarity. The Act actually, the bill will pave the path for this merger. And I'm hoping that that happens soon. The moment that happens, we'll begin the exercise of collapsing both the structures. Max Financial Services is a listed company, and hence we do want to make sure that we follow a path where most of the stakeholders are aligned, including the regulators.
And what are you... Sorry, Prashant, also on the road ahead as well, right? April has been a strong month for you, both on the premiums front, on the APE front as well. For the first, do you expect this trend to continue, say for the first quarter and then going into FY26 as well?
As CEO, we actually love when we begin the year strong, because that really paves the way for a stronger year. And, well begun is half done, as they say. So we started well. But I must highlight a few things. While our growth was robust, this is the smallest month. April is the smallest month. So there's a lot to focus on. What we can confirm is our execution will be of a superior order. We are starting the year with positive momentum. So one would hope that this positivity will continue. Some of the early indicators in May are also very promising. But I must highlight that, I think the peg will be how the industry grows. We are in the industry. We are not outside. And hence, the overall momentum on the industry will be one big determinant of how Max Financial Services or Axis Max Life Insurance grows. Again, I'll repeat that we will try to maintain higher growth than private industry average, and we'll try to gain market share as we go along.
All right, Prashant, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. Yash, thank you for stepping in as well. We'll take a short break. On the other side, we discuss market technicals. Sneha Snate of Angel One joins in, and she also shares some top trading ideas. Stay tuned.
Welcome back. The Nifty is back above 24,700 and Hero MotoCorp is gaining in trade. In fact, in the last 20 minutes, it's added on close to about 1%. The conference call just, I think, is ongoing or must have just concluded. Sudarshan was listening in very closely. Sudarshan, looks like the company is fairly upbeat that May and June will be strong months for the industry.
So it has talked about Q4 performance, it has given near-term outlook, and also it has talked about EV business. So overall commentary that has come out so far is looking very positive after company reported Q4 earnings that were higher than expectations. So first, I'll talk about Q4 performance that company has said. It has gained 600 basis points market share in the entry-level segment. Talking about the realization improvement that company has seen, it has said that 2/3 of the improvement has come from two-wheelers. So basically it has two major businesses, two-wheelers and auto spare parts. So 2/3 of the realization improvement has come from two-wheelers. So it's very positive. Also that all the other companies were talking about the retail finance impact in Q4. Hero Moto is saying that it did not see any impact. In Q4 FY25, retail finance penetration for Hero Moto was at 55%, same that company had seen in Q4 of FY24. Now about the near-term outlook, it's the leader in the entry-level segment. So now it's saying that more number of marriage dates in 2025 will have positive impact in the month of May and June. And also it's saying that it's confident of outperforming the industry growth in FY26. So industry growth is likely seen in the range of 6 to 7%, and it believes that it will maintain the margin in the range of 14 to 16%. And last is about EV business, because question was asked that when do you think EV business will turn EBITDA positive? Then he said at the levels when the company starts selling 25,000 to 26,000 units, and that is 2 years away. So overall, after better than expected earnings, commentary is also looking positive for Hero MotoCorp.
Sudarshan, thanks a lot for that. Strong earnings, positive commentary. So good going for Hero MotoCorp. The stock, as you can see, has reversed its earlier losses and has now moved into the green. But what has moved into the red after starting off in the green has been REC. And you can see the flashes on your screen there. The company has cut its AUM growth guidance to 11 to 13% for FY26 from 15 to 17% earlier. And they have done this in their earnings call. Remember, the numbers came out last week. So REC now at the lowest point of the day, 0.8% lower on the stock at 400 rupees. Remember, the stock had gone up to levels of as much as 650 rupees last year and has seen a significant correction from those levels. Almost 40% lower from those levels is REC, and now they have gone ahead and cut their AUM growth guidance to 11 to 13% from 15 to 17 earlier for FY26. But good timing to get a chart check on the markets and some trading ideas as well. Sneha Seth of Angel Ones joining in for that. Sneha, good morning. Thank you for joining in. Now, what is the index looking like right now? We saw a very strong day on Monday, a very weak day yesterday. You're trying to recover from those losses in today's session. So in this topsy-turvy move, how do you position yourself on the index and couple yourself with your stock-specific ideas as well?
So, very good morning. Looking at market, we have seen wide swings in last two sessions. I believe there are chances of consolidation for at least next 2-3 days from here. I believe on the higher side, there is a very strong resistance now around 24,900, 25,000 would be acting as a resistance. Only an up move above this would, bring some momentum in the market. On the lower side, I believe there is a good support zone placed around 400, 500 zone should be acting as a good support zone. So in case of any declines, one can go ahead and take a long positions. There is nothing to be worried as such, looking at the overall chart structure, unless and until the levels of 400, 500 is respected. I think one can maintain a buy on dip strategy in the indices. Talking about stock specific ideas, I am liking two stocks. First one is L&T. This counter has given a very strong up move recently, has managed to surpass the resistance place around 3,530, which should now act as a support. So I would suggest buying this counter with a strict stop loss of 3,530 as a stop loss, and the target can be maintained around 3,720. Apart from this, the next counter is DLF. The counter has been consolidating since quite some time. On the higher side, 700 is the resistance zone, but interestingly, in the options activity, I believe 700 call, which holds an highest open interest concentration, now we are seeing some unwinding. So that is a very positive development. So I believe we may see some buying interest coming in once it surpasses 700 levels. So I would suggest going ahead and taking a long position in this counter as well. Keep a strict stop loss around 678 zone, and the target expected will be around 720.
Thank you, Sneha. So Sneha is maintaining her bullish stance in the market, a buy on dips approach when it comes to the index and some buy calls like DLF2. Get into a break. On the other side, we'll discuss market fundamentals. Siddharth Vora from PL Asset Management joins in on the other side.
Welcome back. Now shifting focus to market fundamentals, then Siddharth Vora from PL Asset Management is joining in with his views. Siddharth, good morning. Thank you for joining in. I'd want to start off by asking you about the flavor of the last 2 weeks, and that has been defense. They had a very, very sharp up move towards the mid part of last year. Then they had an equally sharp fall when most of these defense names fell 30, 40, 50, even 60% from their top. And now they have started to move back at an equally fast speed over the last 2 weeks, moving back towards the record high levels as well. Do you have any exposure to this theme? And for those who do, what should they do?
I think defense, on at least the sector, the narratives have been shifting very fast from the darling sector of everyone for like 1-2 years to people launching index funds and mutual funds focused on defense, to everybody saying, okay, valuations are frothy, valuations are excessive. Let's unwind the whole defense position because now order books have been built in, but their whole execution and recovery cycle is ahead of us. So I think we've seen a lot of phases for the defense sector. And in the last couple of weeks, I think the reason sector is so well positioned is, of course, geopolitical stress in India. And I think irrespective of where the trade war goes or where the tariff situation evolves, the defense sector is quite protected in terms of domestic production, domestic consumption, and an elevated trigger for fresh demand. And I think the biggest two breakthroughs that have happened on the defense sector have been fastening up the whole timeline, the whole approval process of selecting products, approving products, placing the orders, getting the whole delivery timeline quicker. That is one thing. And secondly, I think the way our defense equipment has demonstrated its capability in the last 5-6 days, I think it's for the world to see and for India to also appreciate. And I think defense on overall will do pretty well. We do have, I think, 4.5-5% exposure to defense as a sector, and we're likely to bulk it up as we get better entry opportunities. But this exposure we are maintaining for the last 3 months. So I think we're well covered. People should hold on to their defense bets.
So in a way, a structural opportunity. Siddharth, hi, morning, and thanks for joining in. This is Rima here. Let's get to your market view now. Because while you do believe markets will consolidate, your bias is a bit bearish, and you are holding on to 15 to 20% cash levels. Right. What is it? What are the risks that you anticipate on the horizon? And why the bearish call, the cautiousness?
So I think chaos is pretty much the new normal in the markets, whether it's chaos driven by domestic conditions, geopolitical conditions, global conditions. So rather than saying that things are looking very good, there's no uncertainty, everything is going to just fall in place. I think a lot of bad news was earlier factored in, in Jan, Feb, and then some good news started getting factored in, and now there's a brand new set of bad news. I think India has recently lost its status as the only geopolitically stable large country or large market in the world. So of course that has some bearing on how we will be perceived globally. Also, we believe despite the ceasefire, things will remain on the edge for some more time. And I think the bigger negative trigger for India is, the whole tariff relaxation and the pause between US and China is going to steal that position of global relative strength from India. I think India was literally the golden market, the way things positioned over the last 30, 60 days post the tariff announcements. I think that uh, prime position is now taken away because other markets are also getting equally attractive. So I think those are some of the key reasons I feel, India is not going to be as well positioned as it was just 10, 15 days back. Many
No,
things
but
in the last 15 days.
But Siddharth, this remains a very fluid situation, right? Despite the fact that there has been a temporary tariff agreement between the US and China, there is still tariffs nonetheless. And with Donald Trump, you never know. And it might just end up happening that the things don't work out 3 months later, and then the tariffs end up going back to previous levels, and then the geopolitical situation deteriorates again in terms of the global situation between the two countries. Isn't that a risk that an investor would want to take by putting money into India, knowing that, okay, now that the situation at the border has normalized, you can go back to growth, earnings, and so on?
So I think that risk is for every investor to take across good times, bad times, because from a medium to long term, India is a fantastic story. This is just the near term, like the next couple of months could be choppy for India. I think that's more my view rather than a 3 or 5 year view. 3 or 5 year, India is a runaway market. There's no doubt about that. But from the near term, I think we could see our valuation premiums contract a bit. And given that we are already trading at, not a very cheap valuation anymore, we don't have extreme room on the upside. Mid and small caps are still trading at 15%, 15 to 20% premium to long-term averages. Large caps had gone down to 20% discount. They're now at roughly 7-8% discount. So I don't think there's meaningful upside left. FIIs were returning aggressively, but I think now whatever's changed in the last 6 days, that could also, see a change in stance. And I think that is where my near-term concern sort of stems from. And US bond yields are rising quite decisively.
So Siddharth, can you tell us how you're constructing your portfolio now? We know 15 to 20% is cash, 4.5%, 5% is defense. What else?
So I think metals, IT, both of them, we're well positioned there. I think the structure of the portfolio is have domestic focused plays which are not vulnerable to global situations, and then have domestic and global plays as well, which can ride the risk on if things play out well. So I think our metals and IT positions have been planted for a while. And of course, it saw a little choppiness. And now I think the global is evolving. And we were always trying to factor this tail risk, right? That if things play out well on the global front, then IT and metals should do much better than even pharma. So I think that call is now playing out the way we had intended it to. And I think it's a good 65-70% is domestic focused. Within domestic, it's high quality lenders, capital market plays, and domestic consumption. These are the three big buckets. And on the global side, we have metals and IT. And other than this, I think minor allocation to alcohol and telecommunications, defense. I think these hold side ancillary weights like 4.5% each. But the bigger focus is on the lending, capital markets, and domestic consumption, followed with IT and metals.
What are the sectors that you would want to stay away from, Siddharth, at this point of time? Does pharma feature in that, because we still don't know what's happening on the tariff front?
We've been out of pharma for the last 3 months, and we're not turning, greatly bullish on pharma yet. I think this is now the cycle for higher beta sectors to do well, because our quantitative models are suggesting that the high beta to low beta sector spread is hugely in favor of high beta. And high beta sectors have much better valuations compared to lower beta sectors. With India inflation moderating and an interest rate environment in India also coming down, we think higher beta sectors are likely to outperform, quantitatively at least. So we are positioned on the higher beta sectors. Within the defensive also, we've chosen IT over pharma. So that's how we are currently positioned.
All right, Siddharth, thank you so much for sparing time and joining us today. Looking forward to having you more often on the platform. Siddharth Vora there of PL Capital. Now take a short break. On the other side, the management of Orion Pro Solutions joins in to discuss the road ahead for the company along with their fourth quarter results. Stay tuned.
Welcome back. Orion Pro Solutions is in focus after reporting the Q4 numbers. Net profit and revenue surged over 30%. Margins came under slight pressure. Ashish Rai, Global CEO of Orion Pro Solutions, is now with us on the show. Thank you very much for joining in. While it's a good quarter, and even for the full year, Ashish, you've clocked in a 32% revenue growth. So maintaining that 30% plus trajectory. I remember our last conversation, and you said that you are hopeful of pushing the top line for the full year to about 1150 to closer to 1200 crore. Has the year, the quarter turned out in line with expectations? And for the full year, next year, FY26, what can you guide for? Can we sustain 30% growth?
Hey, Mahai, good morning. Yeah, thanks. And thanks for remembering the last conversation as well. Yeah, look, it's been a great year for us. We said we'll come in between 1150 and 1200. We came in at 1170. The business has now grown at 30% plus 4 years in a row. I don't think there are many other tech businesses in Asia, anywhere in the world, growing at that pace so consistently. So I think we feel good about where we are. We feel good about the demand environment and also feel very, very good that both the segments of the businesses have grown at a good clip. Banking grew consistently through the year. TIG had a slow start, but we picked up the pace going into the second half. And it came in at a good thing. I think so overall we are good. The margins have been good. At the pace at which we're investing, of course, margin will go up and down 1 point or 2 here and there. But I think overall the pace at which we are accelerating, we feel very, very good about where we are. There's also been fairly strong conversion of EBITDA into cash, and that's again, sort of points to how efficiently the businesses have been run over the year. Going into FY26, I think we've stayed on a trajectory for the last 4 years since we pivoted the business into building out the global products, global platforms player that we're building out. I think we'll stick to the growth trajectory and we'll continue to grow at about the same pace.
So 30% plus should sustain even in FY26. But there were also a few acquisitions that you concluded. They were small tuck-in. But can you tell us what was the organic growth last year?
So all of it is organic growth, Rima. I don't think there is any material number coming in from the acquisitions. We don't really acquire for revenue. If you were to attach a percent to it, I would say it's probably 1% or thereabouts, or maybe slightly less than that coming in from the acquisition. So I think why we acquire is mostly for the IP and the quality of the team, and it's fit with our longer term strategic blueprint, not so much for revenue. So there's it's not a material number.
Good morning. Thank you for joining in. Most of this large IT companies during this quarter in their commentary mentioned that clients have been turning cautious. They are in a wait and watch mode and so on and so forth. I know it's still early days. It's just a couple of days since this tariff easing happened between US and China. But what have you been hearing from your clients on ground? It's been almost 45 days into the first quarter of FY26. What have you been hearing on the ground?
Yeah, so look, we are not really that much affected by what goes on in the US. First of all, 90% of our business is in Asia. Asia, India, Southeast Asia, Middle East, and Africa, and I think the demand environment has been fairly strong. The second part of it is we are in spaces where you're going through a little bit of a demand super cycle almost, right? So on the banking side, we see the move away from custom software, which is very legacy, into buying out mature enterprise software that brings in the best practices in the spaces we are in, transaction banking, lending. I think we've never seen a demand environment so strong. Similarly, on the transit side, the movement from closed loop to open loop, I think is a massive movement around the world. So again, a very, very strong demand cycle. So overall, I think, from a demand environment, honestly, pipeline is very, very strong. Our win rates are very, very strong. We've built out products which have proven to be very competitive. We will, I think, keep on accelerating at the pace we've been accelerating last few years. I'm not really qualified to comment on the broader IT services space. We don't really know much about that space, but in the products that we build, the platforms that we build, demand is very strong.
Ashish, margins in FY25 were 20.6% versus 22% last year, FY24. So there was a margin compression of 140 basis points. 3 reasons why that happened when you look back, and what can you guide on margins going ahead?
Yeah, so Rima, I think we guided beginning of the year for EBITDA to land between 20 and 22, PAT to land between 15 and 16. PAT came in slightly ahead of 16. EBITDA came in the band at 20.6. I think the way to look at it is this, right? I mean, I would not look at it as margin expansion or compression. I look at it as we are building a business out. We are growing at a very fast pace, which means we are investing at a very, very fast pace. And most of our investments are actually expenses because we don't really capitalize much other than, where we need in small parts of our business for regulatory reasons, right? So most of that build out, expanding into newer geographies like Europe is a huge bet for us this year. So we've been investing close to 60 crores plus in that. Overall product build outs, we've invested in transaction banking, in transit, in lending. So there is a massive amount of investment going on. So it would always be very, very hard for us to calibrate the margin down to a percentage point. And that's why we give a 2% band when it comes to margins. This year, we will step up the investments. Right? Overall, so again, we will operate within a band. I think 20% is about the level we feel comfortable with, but it will go up and down depending on the quarter. It's very, very hard to calibrate down to a fine point. But overall, I think the business economics in the business is improving, which allows us to invest more and more in building products out, go into new geographies, and keep powering the growth ahead. This is not the time for us. I've said this before, the next 3-4 years is the time for us to really grow global scale. This is not the time we'll try to optimize EBITDA.
No, got that. You need to step up investments, prioritize growth, and increase your total addressable market. Get that. That's the logic behind it. But in terms of numbers, will there be a downward bias? So you're saying FY26 margin should be closer to 20%. Versus the 20 to 22% margin band that you operated in the prior year? So is there a downward?
Yeah, I think so. So I think, there may be some pressure for a couple of quarters as we expand into Europe. So Europe, as you know, is basically zero. Or very close to zero last year. This year, we expect Europe to climb up to at least 7 or 8% of revenue, which means a very significant investment in building a sales team out. That we've already done half of it, and a very significant investment in building the products out to make them ready for the markets we are going in. So for the next couple of quarters, the investment will be pretty heavy around market expansion. Overall, I think we should be able to hold to a number in the range of 20%, but from one quarter to the other, it will vary. In terms of growth, I feel we should be able to grow certainly excess of 30% on both revenue and earnings thereabouts. And I think that's roughly where we'll be on the guide.
So just some numbers. PAT margin guidance, 15 to 16% stays?
It stays, yeah.
Okay. What were your investments in FY25, Ashish? Because you're talking about stepping it up. And what would the number look like?
So FY25, mainly around the product, we invested close to 98 crores in terms of product build out. And incremental channel investment was fairly incremental. I don't think it was significant. This year, I think it will certainly be a number more than about 165 crores, including product and channel investments.
Okay, so investments of 160 to 165 crore this year versus about 97, 98 crore last year. Go ahead.
Yeah. Ashish, I wanted to ask you about your order book currently. At the end of the third quarter, it stood around 1,300 crores. What was at the end of the fourth quarter? And what is the kind of pipeline that you're looking at? You mentioned that the deal pipeline continues to remain very strong, but if you could quantify that.
Yeah, so the order book now stands at about, it's suddenly more than 1,400 crores. So typically the way it works for us is we don't really declare that many multi-year orders. We also keep most of the AMCs and all out. So most of the order book for us is executable over the next 4 to 6 quarters. So every quarter we sort of consume from the same order book and we add to it. So an incremental 110 odd crores addition is a pretty significant thing in a quarter. So it's very, very strong, and most of it will get consumed in FY26, and that gives us a lot of confidence in terms of the demand outlook for 26. Pipeline, I would say, is at least 50% larger than when we entered FY25. It's probably 60% larger than what we FY25. So I think the demand pipeline is really something we've not seen before. And I think part of the reason is the transformation spend on the banking side, which has really gone up, especially with demands around AI and almost all the banks want to catch up on the technology stack. So I think that demand is really strong. And second also is because now we are in a lot more newer markets. So we've gone into Europe, Middle East is a lot stronger, Southeast Asia is a lot stronger. So that also adds to the pipeline. So the pipeline is really very, very large right now. And we feel good about the win rates we will have on that pipeline, given how competitive our products have proven to be.
Since you are stepping on the investment pedal, what is the cash in the books and the cash generation that you anticipate? And also, I think your banking revenue contribution has come down. Last year, it was more than 50%, and this time it's about 34%.
Yeah.
So explain that also to us, and is that going to change?
Yeah, so look, that is a very tough one, Riva, right? So I think, look, both sides of the business are growing at 30% plus. And from one quarter to the other, one side of the business may grow a little bit stronger, and that moves that percentage up or down 1 point. I would not read too much into the 1 point movement as a change in mix. Banking will continue to grow very, very strongly as we go. And a lot of that constraint, the growth comes not so much from the demand. I think the pipeline is strong. The conversion of the pipeline is strong. It comes from the capacity. It takes us time to really build. And that's why we feel comfortable around the 30% growth, because we feel that is a safe pace of growth for us when we sort of grow, but we also keep the delivery reputation intact, make our customers successful, right? So I would not, I think from one quarter to the other, it will change, but broadly, I feel it will stay the same. Both businesses will continue to grow at roughly the same space. If you look at a 4-quarter period, on a 1-quarter period, that may go up or down a little bit.
All right, Ashish, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. Take a short break. On the other side, more on the market. Stay tuned. Welcome back. The stock over the last 15 minutes has been REC, and ever since we flashed at the bottom of your screens that the management has cut its FY26 AUM growth guidance, the stock has taken a bit of a nosedive. At one point was down around 3.25%, still down 2.5% is REC. So 391 on the stock, and it's seen a significant fall from the high. So it's almost down 42% from the peak, and now comes this AUM guidance cut as well, Rima.
While markets also have turned negatively. So there has been a turn in the markets. The Nifty, which was comfortably cruising around the 24,700, is now up just close to about, I think, it's at 24,731. So we've seen the market slip a tad bit from about 11 o'clock. And it's some of these banking names, at least my screen is showing the Nifty Bank is now dipped into the red. SBI, ICICI Bank are also under pressure. So watch for the volatility there. Get into a break. On the other side, we'll get you more in the markets.
Stocks pep up after a weak session on Tuesday as inflation cools off and tariff fears recede. Metals and realty lead the charge with mid-caps putting on a better show for the second day running.
Tata Motors delivers a strong performance in Q4 with JLR achieving its aim of turning cash positive, but a cautious outlook on growth given the global uncertainties is a damper.
Bharat Airtel delivers a steady performance with healthy subscriber additions. The stronger show in Africa has a positive ring. Analysts remain upbeat on the stock.
Economists pulled down full-year FY26 CPI estimates to 3.5 to 3.8% after the April consumer inflation came in at 6-year low of 3.16%. Consensus expects 2 more rate cuts from Reserve Bank of India, but MK expects 3 cuts and Kotak sees 4 cuts. Hello and welcome to Halftime Report, live from the CNBC-TV18 Motilal Oswal studio. I'm Ekta Batra and with me is Manglam Malu. Well, it's turning out to be a session where we are seeing some amount of green on the market. So we have the Nifty, which is up around 77 odd points. We have the mid-cap index, which is holding with a good gain of around 0.8% at this point in time. Bank Nifty a bit sluggish, but it's all about big stocks today. So the likes of Tata Motors, which is down around 1.5%, Cipla, which is down around 1 odd percent, Hero Moto is in focus as well. So it's a lot about larger stocks in today's trading session. But nonetheless, we're waiting by for the WPI data. So that's going to be an important cue to watch out for in terms of the macros. Hi, Mangla.
Hi, Ekta. There is some green, but by and large, there is consolidation. You know, the Nifty was supposed to face supply between 24,750 and 24,800. That's exactly what took place. And what took the market lower today is the Nifty Bank, which is showing signs of underperformance. So where it goes from here will be extremely crucial. 55,000 is an important fulcrum out there itself. HDFC Bank is the one which is lower in today's trading session, as is Kotak Mahindra Bank at the low point of trade. But a couple of broader market stocks are doing extremely well, and this was the second day running. So that tells you that, you know, your portfolios are looking a lot better. 2,000 stocks on the advancing side as against just about 600, which are at the lower end itself. We do have Berger Paints, which has moved to the high point ahead of numbers. Intellect Design Arena continues to do well. In fact, had a good week behind it so far. Third day of the week, the stock is up 16% already. We have NBCC and Titagarh Rail Systems, both of them spiking as well. And why is Berger Paints? Pull up other consumer stocks as well. Godrej Consumer, for instance, has now recovered a lot of its losses, currently at the high point of trade. And we are seeing some traction in the banking pack. An unusual mover is IndusInd Bank. Remember, the stock has seen a big knock a lot has happened on that one. And on a day the Nifty Bank is underperforming, we've seen a big spike on IndusInd Bank. So we'll keep an eye out on all those stocks as we do and as we await the WPI as well. Remember, the CPI that came in yesterday was at a near 4-year low at a little over 3% itself. While we do that, while we await the WPI, let's speak about Tata Steel, which is the top gainer on the Nifty today after a brokerage upgrade coming in. Nigel joins in to tell us more. Nigel.
Well, Tata Steel is high in today's trading session. And to be fair, in yesterday's interview to CNBC-TV18, the management had made a couple of very, very positive points. So I'll make three big headers out here. One is on pricing. They said that current prices here in India are 3,000 rupees higher on a sequential basis. Even in Europe, they have said that the pricing is much higher. So there's an improvement both in Europe as well as India. That's point number one. Point number two, on the coking coal consumption cost, they said they're expecting some softness. It could be down by close to $10 on a per ton basis. And point number three, they gave a guidance on EBITDA. Europe, they said, turns back into the green, which is phenomenal. Good news out there, though UK will continue to struggle, at least initially. But in the next few quarters, they're expecting even the UK business that's been given the big loss, that as well, to turn into the green, which is a positive. Remember, as of now, Netherlands has turned into the green, and that will likely move it, stay in the green. But UK turning around at some part of the year as well is a positive. Nuvama, they have gone ahead. They have upgraded the stock. The target price has been raised to around 177 rupees per share. They've increased their EBITDA estimates by around 6% because now they're factoring in higher profits in Europe and also lower fixed costs. They are estimating the EBITDA to go up by around 2,000 rupees on a sequential basis because of higher steel prices, lower cost, and also they are saying that volumes could be a little bit softish, but both these two will offset the lower volumes. And finally, they are building in better numbers coming in from Europe. So put all this together, Tisco is reacting in today's trading session. But to be fair, the commentary from the management itself ahead of their con call here on CNBC-TV18 was extremely positive.
Okay, all right, Nigel, thanks very much for that. That's on Tata Steel, top gain on the Nifty. But we do have the WPI data for the month of April, which is flashing on your screen. So it's come in lower on a month-on-month basis. 0.85% is currently where the WPI data for April has come in. And that compares to 2.05% month-on-month. So there has been a softening which has taken place. Lata has more details. Over to her. Lata.
Well, the important point is the inflation coming in below 1% at 0.85. I didn't do a very thorough poll. It was more a dipstick survey because not everyone gives you a WPI forecast. Remember, the interest rates are pegged on CPI, not on WPI. So there are fewer people who give you a number. But the number I got was 1.2%. From a reading of best of 5, the Cogensis number is 1.4. But either way, at 0.85, it is giving you an indication that repeatedly, no matter which index you take, inflation is coming below analyst forecasts. For CPI, for the last 4 months, we have been seeing inflation coming below the street forecast. And for WPI, much the same is getting repeated. The biggest fall in the case of WPI also has been on food, but not only on food. Fuel is another very big element that has come in at minus 2.18 compared to 0.2% higher in March. There is a contraction in April, and we need to spend a minute understanding this because in WPI, you take the price at which an HPCL or BPCL procures its petrol or the landed price of petrol. You don't add the excise duty. What happened is for you and me, the petrol price did not fall because the government raised the excise duty. But for the marketing companies itself, the price had fallen, and that is what gets factored into the WPI. So the fall in crude prices gets crude and crude derivatives gets factored into WPI. You're seeing a minus 2% as far as fuel inflation is concerned. And likewise in food inflation, the index is up 0.3% on the month. It's, at 0.3%, you multiply it by 12, you're actually looking at an annual inflation of only 3.6%, multiplied by 12. So the food inflation, even if you take it at this pace, is not going to be more than 3.6 for the full year. But individual commodities like the all commodities index, all the commodities in WPI are down 0.2% on the month. Manufactured products is the most expensive, and that is up 2.6%. Now, that's what I call expensive, because that's the only one which is pulling up the average. Else, we would have had a negative, a contraction in the WPI. It's because of the manufactured products as a whole, the index rising at 2.6%, you're able to bring up the overall all commodities index to 0.85% year on year. Would we have a guest with us? Yes, Aditi Nair, the chief economist at ICRA, is joining us. Aditi, 0.85 is better than what you thought. How does it fit into the macro picture?
Yeah, Lata, we were also at 1.4% for this month, and this is coming significantly lower than that. Interestingly, I think manufactured prices inflation is a little bit higher than what we had penciled in, so we need to go through the internals to really understand how to do the modeling going forward. Having said that, we were expecting the inflation to dip further in the month of May. So now I'm guessing that we're probably going to get a May inflation print that's going to be between 0.5 and 0.7%, so a very, very low number. And the average for the full year is also getting worked down, just the way that we spoke yesterday about the CPI. We have reduced our average CPI forecast for FY26 to 3.5%. I suspect the average WPI forecast for FY26 is probably going to be 2% or a little lower than that now.
Okay. Well, would you say that CPI now crucially depends on fuel? Because in WPI, the lower fuel price is already getting reflected. We are having a fuel inflation of minus 2.1%, I think, year on year. So there is a contraction in fuel prices. Okay, minus 2.18 is the fuel index. If at some point in time the Indian government is able to, not take away our fuel gains as excise duty and instead pass it on to you and me, can you even undershoot 3.5?
In that case, yes. But I think there's a low probability of that being passed through to us. One more small thing I just want to point out as far as fuels is concerned, if you look at the overall WPI particularly, electricity tariff revisions would now be underway. So the next 2-3 months are pretty crucial for that. So that will start working into the data only over the next couple of months. But overall, we're looking at a very, very benign WPI, benign CPI for sure in FY26, and obviously opening up the space for continued rate cuts over the next few months.
And what are your rate cut expectations in terms of number of cuts?
So right now we're at 25 basis points each over the next 3 policy reviews. Possibility of a front loading in the next policy review only if we get a fairly negative surprise coming in from the GDP data, which we will get a few days before the next NPC review discussion starts.
Yeah, that's
if you are tracking the developments in the United States as well, and what your call on the Fed is from here on, because earlier the expectations of inflation were high because of the trade tariff uncertainty. Now there is a near-term pause out there. US, China have made that deal for the next 90 days at least. Tariffs are capped at 30%. What are your expectations here?
As far as the Fed is concerned, with the amount of data and with the amount of uncertainty that's been coming out from the tariff policy point of view, it's been really difficult to kind of take a call which endures for what the Fed is likely to do this year. I think this is going to be a year of some amount of caution. I don't expect the Fed to take very quick calls. I do think that they're going to be in a little bit of wait and watch mode. So maybe 2 rate cuts, slightly back-ended.
The reason I asked you was that how much of a bearing would that have on any of the RBI policy decision making?
Look, if the CPI inflation in India is going to be below 4%, I think we need to really go with the domestic growth inflation fundamentals.
Point taken, Aditi. Actually, we look at interest rate differential only because there is an inflation differential. But when the inflation differential has narrowed so much, I mean, what is the US at 2.3 and we are at 3.1 or 3.15. So the difference is narrowed. So it never before has there been a less than 1 percentage point difference between India and the global inflation. So considering that our inflation is down, the Reserve Bank will be less worried about interest rate differentials. And in any case, actually, we have seen a string of rate cuts all across Asia. Although the Fed has stood pat over the past few meetings, clearly indicating that domestic compulsions will be way more important. If anything, currencies are appreciating. Initially, or hitherto, people didn't want to go against the Fed because you expect a run on the currency. Now you would be very glad if there was a run on the currency. It's appreciating too much. So I think, as Aditi points out, now domestic considerations will far outweigh what the Fed is doing because of political economy itself becoming very domestic thanks to high tariff walls. Aditi Nair, thank you very much for joining us. The key takeaway from the inflation numbers is that once again it is lower than expected and may accelerate the extent to which even the CPI inflation will fall, provided, of course, there is a cut in pump prices, in fuel prices at the pump. I just want to point out one thing. February inflation has been revised higher, not much. From 2.38, it has been revised higher to 2.45. That's not saying much.
Okay, all right, Lata. Thanks very much for that. So that's on the April WPI data. We need to take a short break on that note. But up next, the management of Shakti Pumps India will join in to talk about their Q4 performance. Stay tuned. Welcome back. You're still tuned into Halftime Report on CNBC TV18. Let's talk about some numbers then. Shakti Pumps is on our radar now. For Q4, their margins came in at a multi-quarter high and the company reported its highest ever revenue in FY26. Joining in to talk about more of the numbers, we have Dinesh Patidar, who's the chairman, and Dinesh Patel, who's the CFO of the company, joining in. Thank you, gentlemen, for joining in. Mr. Patel, I'm going to start with you, considering that you look into the numbers quite closely. The multi-quarter high that the margins have come in at around 37.12% this quarter. What led to that performance this time?
Actually, the overall execution of the Kusum scheme and the export market, both. So altogether, we are getting good orders and good execution. So this led to this revenue growth.
All right. If you could give us a sense, Mr. Patel, what are you likely to do next year in terms of revenue, and how much higher can your margins go from here? Because there has been a big jump all the way up to 24%. And export contribution has been coming down. So, what is that likely to settle at?
I think Mr. Patidar can...
yeah, Mr. Patidar, go ahead.
Okay. Yes, thank you. Actually, डोमेस्टिक सेल और सोलर सेल की इंक्रीज होने के कारण आपको एक्सपोर्ट का सेल का परसेंटेज कम दिख रहा है, क्योंकि जैसे लास्ट ईयर हमने बिफोर लास्ट ईयर 1300 करोड़ किया था, अभी लास्ट ईयर हमने 2500 करोड़ किया और अभी हम जो है वो 3000 करोड़ के ऊपर की बात कर रहे हैं कि हम 25 से 30% ग्रोथ करेंगे. तो एक्सपोर्ट में जो स्पीड से जो ग्रोथ हम लोग लास्ट 10 सालों से कर पा रहे हैं वो रिटेन रहेगी अभी भी. लेकिन यस, हम चूंकि सोलर में इंडिया में लीडर है, इसके कारण हमारी सोलर की सेल इंडिया में बढ़ रही है. इसके कारण आपको एक्सपोर्ट का परसेंटेज कम नजर आ रहा है, क्योंकि सोलर में इंडिया में हम लोग लीडर है और सोलर मार्केट में अभी इस टेक्नोलॉजी पे हमने बहुत काम किया है. हमारे पास करीब 28 पेटेंट भी हैं और हम खुद इंडिया की पहली ऐसी कंपनी है जो खुद अपना सोलर कंट्रोलर और वीएफडीज बनाती है.
तो 84% का ग्रोथ पिछले साल हुआ था आपके रेवेन्यू में, एबिटा का ग्रोथ करीब 170% का हुआ था। वो ग्रोथ किस लेवल पर मेंटेन रहेगा अगले साल के लिए, आपके क्या प्रोग्नोसिस है?
हाँ, अगले साल जैसे हम मिनिमम हमारा जो टारगेट हमने हमारी टीम को दिया है वो 25 से 30% ग्रोथ दिया है, लेकिन जैसे फिगर की बात करेंगे तो 3,000 करोड़ अगर हम देखते हैं कि 3,000 करोड़ मिनिमम हम करेंगे तो उसमें हमारा प्लानिंग है कि हम 24% एबिडा पे उसको वर्कआउट करेंगे। इस तरीके से हमने अपनी कंपनी का, क्योंकि हम लोग पीछे तक हमने काम किया है, जो हमारा सोलर का इन्वर्टर है, सोलर की वीएफडी है, हम मोटर बनाते, खुद ही मोटर बनाते हैं, हम पंप भी बनाते हैं, हमने स्ट्रक्चर की डिजाइन पे बहुत काम किया है, हमने वीएफडी की डिजाइन पे बहुत काम किया है, इसलिए ये ईबिडा आप देख पा रहे हैं, क्योंकि शक्ति पंप्स एक R&D कंपनी है।
Okay. All right, fair enough. Mr. Patel, then if you could just narrow down on the India opportunity for us, what might the India order book be for you currently? And when you come to, the orders that you're bidding from, within the Indian states, how much would it cumulatively come to, and what is the pipeline looking like?
Yeah, so actually currently we have order book of around 1,650 crore, and we are expecting more orders from Punjab and MP also. And export order book is also we are expecting for this year around 500 crore. So more or less whatever sir said, we will close around 3,000 crore in the next fiscal year.
All right. Okay. You've also made an investment in your EV battery business. So I just wanted to understand what are your targets here and what is the kind of differentiation? आपका product बाकी सबसे different कैसे है, Mr. Patidar?
बिकॉज हम मोटर बनाने वाली हमारी कंपनी जो है शक्ति पंप जो है पिछले 40 सालों से मोटर बना रही है, और मोटर बनाने का जो एक्सपीरियंस हमको है उसी वजह से हमारे टीम ने ये डिसाइड किया था कि हम इलेक्ट्रिकल व्हीकल्स में जाएं, और हमने मोटर्स डेवलप किए। अभी हम कुछ बस मोटर्स को अपनी मोटर सप्लाई कर रहे हैं, वहां हम स्टेब्लिश हो चुके हैं। अभी इंडिया की करीब 10 कंपनियां ऐसी हैं जिनके लिए हम मोटर डिजाइन करके उस स्टेज पे आ चुके हैं कि उनको अब अगले क्वार्टर से हम उनका सेल चालू करेंगे।
तो इस बिजनेस से कितना सेल आ सकता है आपको अगले 1-2 साल में?
ये अभी जल्दी होगा ये बोलना, क्योंकि जब ये ओईएम के लिए काम करना होता है, जैसे हम जेबीएम के लिए काम कर रहे हैं, तो उनके लिए जैसे जितनी वो 10,000 मोटर्स बनाने वाले हैं, 10,000 बस बनाएंगे, तो उसमें हमारी 2 मोटरें कंपलसरी लगेगी। उनके साथ हमारा जेबी भी हुआ है, एक मोटर उनके स्टीयरिंग में और एक उनके कंप्रेसर में। इस तरह की हम धीरे धीरे आगे बढ़ रहे हैं। दूसरी कंपनियों से भी जैसे टाई अप होगा आगे हम उसके बारे में और इन्फॉर्म करेंगे।
Okay. So, Mr. Patidar, what might the capacity utilization be in all of your plants right now, and what is your capex plan considering that you are projecting so much demand?
Yes, presently our capacity we are using 60% capacity हम लोग अभी यूज कर रहे हैं, और 100% कैपेसिटी पे इसलिए नहीं जा पाए क्योंकि हमारे पास सोलर सेल की अवेलेबिलिटी नहीं थी। इसीलिए हम एक्सपांशन में अपना एक 2 गीगा का प्लांट हम सोलर पावर के लिए आए हैं कि 2 गीगा हम हमारी खुद की कैप्टिव कंजम्पशन के लिए यूज करेंगे, तो उससे हमको हेल्प भी मिलेगी। और आज की तारीख में जो हिंदुस्तान में डिमांड सप्लाई की वजह से डीसीआर सेल अवेलेबल नहीं है, तो आने वाले समय में हमारी कंपनी की जो कैपेसिटी जो हम बढ़ाने भी जा रहे हैं, और आने वाले समय में उसकी रिक्वायरमेंट भी होगी, और हमारा कैप्टिव कंजम्पशन ही 2 गीगा का आने वाले समय में हो जाएगा। तो इसीलिए हमने उसका इन्वेस्टमेंट का प्लान किया है।
Okay. Mr. Patel, let's just shift focus to the balance sheet also. Give us a sense in terms of what the cash on books is right now and the debt on books, and what might the plan be in terms of FY26?
So actually last year we have debtors of around 177 days, and right now we have around 152 days. So we have done a very good job in that part, and our target is to do or draw down it around 120 days. So our historical trend is also 120 days, and we are targeting the same.
All right, you want to plan to cut receivables days to working capital days to 128. That was my next question actually. Your cash flow from operations has come down from over 4,000 crores to a little around 200 crores. What explains this, and is this something structural? Receivable days are increasing so much.
Actually, we are in the government. We are in a government receivables also and export receivables also. So the things is like that. Earlier it's around 170 days, and we are now getting it's on 152 days. So nearby around 20-25 days, we are reducing, and we are reducing day by day. So we are targeting for it. It's come down to 120 days, and the working capital cycle also go down by around 100 days. So that is a historical trend of this company.
What about PM Kusum and rooftop solar? What is the business opportunity there, and how much do you expect to get from these businesses?
Yes, PM Kusum is our dream project. PM Kusum ही हमारे शक्ति पंप्स के लिए PM कुसुम ही अपने आप में एक ड्रीम प्रोजेक्ट है, और उसी के लिए हमने इतने दिनों से जो एनर्जी एफिशिएंसी पे और हमारी टेक्नोलॉजी पे काम किया था। तो कुसुम में हम लीडर है, और आने वाले समय में हमारे जो इन्वर्टर्स भी बन के तैयार हुए हैं, अब आने वाले समय में हम सूर्य ग्रह जो रूफटॉप है उसके लिए भी हम आगे बढ़ेंगे। तो अगले क्वार्टर से आप हमारी सेल में रूफटॉप का हिस्सा भी देखेंगे।
तो ये दोनों टुगेदर आपके बिजनेस में कितना बड़ा ग्रोथ कर सकते हैं, मतलब कितने बड़े कंट्रीब्यूटर्स हो सकते हैं?
हमने ये डिसाइड किया कि ऑलरेडी कुसुम की स्कीम में हम लीडर हैं, और सूर्य ग्रह में भी आने वाले 3 साल में उसको हम लीडरशिप की पोजीशन पे ले जाएंगे, क्योंकि ऑलरेडी इन्वर्टर हमारा हो जाएगा, सोलर सेल हमारा है, स्ट्रक्चर हम बना रहे हैं। तो अभी आज की स्थिति में सारी चीजें सप्लाई करने वाली एक कंपनी कोई भी नहीं है। हम अकेली एक वन कंपनी होगी जो कि अपना इन्वर्टर होगा, अपना सोलर सेल होगा और अपना स्ट्रक्चर होगा।
Okay, all right, Mr. Patel and Mr. Patidar, thanks very much for joining in and speaking with us. So that's Shakti Pumps. That stock is up around 3% at this point in time. They are targeting revenues of around 3,000 odd crores and are seeing a massive amount of demand coming in from the domestic market vis-a-vis exports. We'll take a short break now, but up next, Pritesh Mehta of Yes Securities will join in with his trading calls.
News18.com marches way ahead of the Times of India with 38% more users on native and social platforms. Network 18, the undisputed leader of news networks, way ahead of the Times.
Welcome back. It's a bounce back of thirds that we're seeing in the market. The day before yesterday, we saw a 900-point jump, and then we saw a third of that taken away by a 300-point cut yesterday. But today, a third of that is higher on the Nifty. About 100 points is what we're seeing, 85 points to be precise, with a bunch of stocks doing a lot better. The broader markets in particular doing better for the second day running. So if you look at the market setup at midday, you have the mid-cap index doing well. We have the Nifty, which is doing well. The Nifty Bank is a bit of an underperformer, and that's causing a bit of a cap on the gains, or putting a lid on the gains that the Nifty is making today. No problems for portfolios. The mid-cap index is actually at the higher end of today's trading range so far, with the advances far outnumbering the declines. And we have less fear in the market because all the major events are behind us. Now, even the US-China trade issues have been resolved and there is peace around the world. And that's reflected in the India VIX, which is now at the low point of trade as we speak. So a lot of these option writers from last week are sitting on good gains. If you look at the active Nifty options, 24,700 seems to be a bit of a fulcrum, and these are options that expire tomorrow. 24,700 call, 75 rupees premium. 24,700 put comes up for you. The premium would be a little over 125 rupees. Club both of them together, you're playing for a premium of 200 points on either side of 24,700, which implies that all those who are writing this option, both the call and put together, you're waiting or playing for a range of 24,500 to 24,900 in terms of a broad range for expiry that takes place tomorrow itself. A lot of stocks are on our radar. Max Financials post numbers doing extremely well. A lot of long positions being added out there. And we have Tata Steel as well. The top Nifty gainer today. Brokerage is positive on it. The European operations seem a lot more optimistic. A lot of long positions added on Tata Steel too. Ekta.
Okay, all right. Pritesh Mehta joins in to discuss the technicals now. Pritesh, hi, welcome to the show. If you could just start by detailing what your strategy would be in terms of stocks today.
Yeah, good afternoon. See, there is a case of strong outperformance for mid caps. If I look at ratio of mid cap versus Nifty, it is moving higher. It is inching closer to the peak of Feb 2025. Once there is a break about the same, we can have a case of strong outperformance of mid caps over Nifty. And also, what we have seen that there is risk on mode going on in the markets internally. So there are more areas which had not done well earlier. They are doing well. Something like autos, mid cap IT, PAC index, they are all showing gains in the last couple of days. So I think it is a good time to be in this market. When it comes to stock specific action, so we have two recommendations. First one is buy on Dalmia Bharat. Now the stock has made a strong comeback since March, and in the process, it is confirmed a multi-month base breakout. We have series of double top buy, bullish at a breakout, and it is showing signs of outperforming against our customer cement index. So buy for a target of 2300 and stop loss would be 1970. The second recommendation is buy on Max Health. Now the stock is attempting to break out of a basic pattern. It is already confirmed a bullish at a break, and it is following through post of bullish anchor column. So buy for a target of 1330. The stop loss would be 1120.
All right. That's about Max Healthcare and Dalmia Bharat Sugar. On the back of good numbers, the stock's doing extremely well. Pritesh, thank you so much for joining in and giving us your view on individual stocks and the index at large. We take a short break, come back, we focus on a lot of other stocks which are moving around as we speak. A lot of these auto stocks, Eicher Motors, M&M, Maruti, have moved to the high point of trade. Come back, we'll talk about all of them. Second day running, pharmaceutical stocks doing well. Divi's Labs and Dr. Reddy is doing extremely well right now. But before going into break, we spoke about some of these auto names. So pull up the intraday chart of Maruti Suzuki at the high point. We have Eicher Motors, which too has moved to the high point. And We have Hero MotoCorp, which is also on our radar, has recovered a fair bit from lows. In fact, up about 4% from lows after having rallied about 2.5–3% yesterday post numbers as well. What is it that is powering Hero MotoCorp ahead and perhaps the entire industry right now? Could it be the commentary that has come in from their conference call? Sudarshan joins in. He was listening into the conference call. Sudarshan, what are the key takeaways here?
So Hero MotoCorp today held its analyst call after reporting Q4 FY25 earnings, and those earnings were higher than expectations. And now the commentary from the con call is looking largely positive. So first, company has talked about Q4 FY25. His company has said that in the entry-level segment, it has gained market share of more than 600 basis points. And another point it has talked about is the improvement in realization that company has seen both on a sequential and year-on-year basis. So positive part on that front is the improvement has come largely from two-wheeler space. So two-wheeler has contributed 2/3 of the improvement and 1/4 has come from auto parts. Now it has also talked about the retail financing part. If you would know that in the Q4 of FY25, majority of the companies were talking about the impact on the retail financing part. Hero Motor is saying that in Q4 FY25, its retail financing penetration was at 55%, same that company had seen in Q4 of FY24. What about the near-term outlook? Company is saying that in the near term, number of marriage dates in 2025 is more than what it was in 2024, and it's going to have a positive impact on Hero Motor because it's the leader in the entry-level segment. On the margin front, it says it will continue to hold margin in the range of 14 to 16%, and the recent income tax cut that government had announced will also aid the growth. On EV front, company is saying that it will turn EBITDA positive once company starts selling in the range of 25,000 to 26,000, and that is now 2 years away. So overall, commentary is looking positive after better than expected Q4 FY25 earnings.
All right, Sudarshan, thanks a lot for that. Let's talk about Cipla. That one is under pressure. Underperforming the pharmaceutical stocks by and large, and this could be attributed to their fourth quarter numbers. Stock down about 1.5%, Ekta.
Well, yes, with Cipla, I think it's the conference call takeaways which actually are making the stock a bit subdued today. That was post-markets. So, for example, they said that the FY26 revenue guidance was going to be continued growth trajectories. So, analysts are interpreting that as maybe flat to low single digits at this point in time. The US revenue is also expected to be around flattish for Q1 at around $220 million. Now, the EBITDA margin guidance is what disappointed a couple of analysts. It is estimated at 23.5% to 24.5% versus 25.9% in FY25. So now the takeaways from the analysts which have concerned the street is FY27 margins could probably contract further. This is as Revlimid generic fully phases out. The US business, remember, seems to be heavily reliant on Revlimid generic at this point in time. And US launches such as Abrixon generic, Advair generic are unlikely to offset the FY26 decline from Revlimid. Now, a couple of brokerages, for example, Nuvama has retained their hold with a target price of 16.20. Margin guidance is below expectations according to them. Nomura has a buy call and a target of 17.60. Q4 EBITDA is a miss, but the outlook is in line with estimates. Equirus is long with a target price of 17.20. Revlimid near-term overhang remains and long-term levers, however, are intact. And Kotak has also said that they have a buy fair value of 1,800 rupees. It stays on track according to them, aided by the healthy traction that they've seen across markets. So the street is concerned about what the pipeline is looking like for Cipla once Revlimid generic mainly phases out for the company.
All right, so that's about Cipla. Garden Reach Shipbuilders, though, on the back of very strong fourth quarter numbers, surging. In fact, all the defense stocks are buzzing around, and Garden Reach Shipbuilders has the added impetus of their results. Stock up 17% right now. What exactly entailed in those numbers? We have Ria joining in with the details there. Ria.
Well, yes, Garden Reach Shipbuilders is in focus once again today after reporting a healthy set of numbers in Q4 of FY25. The revenue has gone up by around 62% on a year-on-year basis. Even the EBITDA and net profit have jumped up by 144% and 119% respectively, both on a year-on-year basis. Margins have also seen an expansion of 454 basis points, coming in at 13.5% in this quarter versus just about 8.9% in Q4 of last year. For the full year FY25 as well, we've seen good growth growth on all fronts. The net profit margin has also been above the company's guidance of over 8%. The order book details haven't been disclosed yet, but in the Q3 earnings call, the company had said that the order book is expected to come down to rupees 22,000 odd crores by the end of FY25 as execution is picking up. And the order book at the end of Q3 was around rupees 23,877 crores. Some key things to watch out for going ahead will be the management's comments on the order book and the execution, and also the update on the delivery of one of the key projects of the company, which is the 8 ASW shallow water crafts, all of which are to be delivered by October of 2026. And remember, the first ship was delivered just last week to the Indian Navy. Commenting on the results, the management has said that with their strong order book and healthy order visibility going ahead, including in the commercial shipbuilding segment, they are confident of even better performance in the next financial year going ahead. Resultantly, the stock has been trading higher in today's session, up around 12 to 13%, but still important to note that it is down around 25% off its 52-week high at the moment. But largely, the results have been good for Garden Reach in this quarter, and the street is reacting positively to this.
Okay, all right. Well, Bharti Airtel has gained after reporting a good set of numbers. Reema's here with more.
That's Bharti Airtel has been a big outperformer. This year itself is up about 17-18%. In the last 1 year, stock has gained 45%, and in 3 years, well, it's up 170%. Numbers were good. We'll get more clarity in the conference call at 2:30 p.m. The consolidated numbers were better than expectations, aided by Africa, and the India mobile business has seen a steady and a strong performance. So strong execution continues to power Bharti Airtel. So the India mobile business, while in Q4, Jio did better. Jio's top-line growth was 2.4%, ahead of Bharti Airtel's 1.3% growth. But on other parameters, Bharti's done better. For full year, India mobile revenues were up 18%. EBITDA margins for Bharti Airtel are now inching towards the 60% mark. ARPUs are now 245, and the subscriber additions have been very strong at 5 million in the quarter gone by. So all in all, Africa has been very healthy, aided by the tariff hikes taken in Nigeria. And on India Mobile, the B2C business that we use, that the company continues to execute very well.
Right, Reema, thanks a lot for that. That's about Bharti Airtel. With that, we'll sit in a short break. As we do that, small programming note for all you viewers. CNBC-TV18 and HSBC India are back with Season 2 of the SME Champion Awards. This prestigious platform celebrates SMEs that are pushing boundaries, making an impact and shaping the future. Nominations, they're now open. Scan the QR code now and submit your entry for the SME Champion Awards Season 2.
Welcome back. Aditya Birla Capital is in focus at the on the back of brokerage news. Nigel is here with more.
Well, that's right. Aditya Birla Capital, in fact, is higher in today's trading session. I've picked out two big brokerages that are fairly positive. First, Macquarie, they have an outperform rating with the target price of around 260 rupees. They say that the profit and the AUM was in line with expectations. Now, all eyes are on the slippages, particularly in the unsecured business segment, which will be important. On AB Sun Life Insurance, out there, they're saying the performance actually was better than expected. So they're quite positive out there. And they're also highlighting that the management is targeting to double the NBFC AUM as well as the VNB in the next 3 years. So that's why we have Macquarie that's positive. Moving to Morgan Stanley, they as well have an overweight rating with a target price of around 250 rupees. They see a steady improvement and better outlook across businesses. They're saying that the NBFC, which is the largest business, the performance out there was in line with expectations. While they also go on to make this point that they are seeing a margin of safety and there is scope for a re-rating as well. Explains why AB Capital as well is doing well, because both the brokerages, Macquarie and Morgan Stanley, are optimistic on the business prospects.
All right, Nigel, thanks a lot for that. That's about Aditya Birla Capital. Just keep an eye on the market, though. We're seeing some bit of profit booking from the top. The Nifty is actually at the low point of trade right now so far. And the stocks which are taking it lower, we have, the Nifty Bank, which is lower. That's led lower by ICICI Bank. So over the last few minutes, we had ICICI Bank move to the low point of trade. Also seeing HDFC Bank, which is a fair weight on both the Nifty as well as the Nifty Bank, currently trading at the lower end of today's trading range. But the biggest gash in the last 5 minutes or so has come in from the FMCG heavyweights. So pull up, ITC, that is moved lower. Bharat Airtel itself, Rima was telling us good numbers coming in, but the stock has actually declined from the highs after having rallied about 40% in the last 12 months or so anyway. And Tata Motors continues to go lower despite good numbers and good commentary coming in from the management. So just keep an eye out. We do have, the index holding on to gains. It's just about 50 points right now, as against about 90 points when we started the show. Ultratech Cements and LTI Mindtree, on the other hand, are moving higher. So Ultratech had a bit of a dip earlier and now has moved higher. That dip has been bought into. LTI Mindtree is the other one. I'll wait to see whether you have all the other IT stocks moving higher as well, especially given the sort of rally that we saw in NASDAQ overnight. But amidst all of this, a stock that is surging in trade today is Siemens, despite a tepid performance in the quarter gone by. Upasna joins in to tell us what is moving the stock higher despite the tepid quarter. Upasna.
Yes, before I talk about the results, let me point out that this quarter there was a demerger of company's energy business effective from 25th of March 2025. Now, Siemens Limited ex demerger, talking about the overall quarter, it was a tepid quarter, but order inflow in this quarter remained quite strong. Now, coming to the revenue, it was likely in line with the Nomura estimates with a growth of 3%. EBITDA margin and net profit, there was a miss on Nomura estimates on all these three fronts. Coming to the EBITDA first, it stood at 467 crore with a downtick of 27%. EBITDA margins were also under pressure, down about 436 basis points at 11%. And PAT also under pressure, down about 37% at 407. Now, PAT declined due to under absorption of fixed cost and higher cost of material in company's digital industries business. Also, it was impacted by extraordinary gain of 192 crore from the sale of property in Q2 SY24, and also demerger expenses this quarter of nearly about 63 crore. Now, Nomura has a neutral rating on the stock with a target price of 3,200 per share. It says that the digital industry segment continued to see demand slow down, but now if we look at the order inflow of the company for its non-energy entity, it was quite healthy, up about 44% on a YoY basis, which provides a good revenue visibility for the future. It expects execution ramp up in FY26, FY27 as order inflows have been quite healthy in H1 FY21 for the non-energy segment. Now, it also expects a CAGR revenue growth of 11%, EBITDA growth of 13% and PAT growth of over 10% from FY24 to FY27. So certainly a positive outlook from Motilal Oswal on Siemens on the back of its strong order inflows.
Okay, all right. Thanks very much for that, Upasna. Well, REC is under pressure after it cuts guidance for...
Hi, afternoon. So yes, REC is clearly under pressure after this highlights have actually come in from the con call. AUM guidance now is at 11 to 13%. Previously, it was around 15%, so cutting the guidance on that front. Loan book target, nonetheless, they're keeping it at around 10 lakh crore rupees is what they expect it to be by 2030, targeting almost a 12% annual loan book growth. Now, NIMs also what they're maintaining their guidance, 3.5% to 3.75% in that range. That will continue for FY26 as well. And infrastructure lending, the company highlighted, that is also expected to contribute to the NIMs as well as the spread going forward. So that will be something that will be supporting them going forward. Regulatory environment, they highlighted it has been stable. Timely tariff orders in most of the states have come in. So that is why regulatory everything is fine on that front. They're targeting a net zero NPA status by FY26, and the generation projects are yielding 10 to 11.5%. That is expected to support the margin sustainability going forward as well. But the cut in the AUM guidance is something that is impacting the stock today.
Okay, all right. Thanks very much for that. Well, that's some news on Zydus Life. The US FD has inspected their Ambernath API manufacturing unit and has issued an EIR, which is an establishment inspection report with a no action indicated status for the Ambernath unit. So positive news coming in there. It's more normal course of business. So that is an inspection from the 10th to 14th of Feb, and now they've received an NEI in the EIR. So positive news there. We'll take a break now, but on the other side, Manisha Gupta joins in. She has with her the management of NK Protein. Stay tuned.
Welcome back, and joining us on the show now is Priyam Patel. He's Managing Director at NK Proteins. Priyam, hi. Thank you so much taking time out for us here at CNBC TV18. Your sense on edible oil as a sector, because we've seen prices gain up in the last 1 week. In last 2 days, actually, the soybean prices have gained up by nearly $50 to $70 a ton there. The palm also seems to be surging. So soy and palm, the kind of gains that we've seen, how are you reading these price appreciations?
Good afternoon, Manisha. I think one of the major effects was the US biodiesel policy, which has just come in yesterday. So that has been a big boom for the pricing to increase in the recent times. Over and above, what we see is that the demand for edible oil has been sluggish since the last few weeks, but now it has started picking up, especially in India, after the entire events of the India-Pakistan conflict. There has been a lot of stocking which has been happening at the distributor, retailer and household levels. So we see those levels coming up, and now that once that the demand is there, after the demand has disappeared, I think then the prices should stabilize around these prices. The soy oil availability for the year is ample. The crop in Brazil, China, everything is good. Also, the trade talks between US and China, which have come to a 90-day halt of the tariff going down from 145 to 30% will be a big boom especially for the soy industry. So I think the markets, the roller coaster ride should be over, if not completely over, but should be over for now, at least for the next 90 days.
Priyam, would you also expect the imports picking pace from here? Because the first quarter, most of the months, the imports were slightly lower, especially for palm. Do you see that that equation kind of change as we go ahead from here?
Yes, I think India was self-sustainable in terms of its own oil supplies because of the crops of cotton, rice, soy. But I think now that those crops are starting to disappear, I think we'll see more palm coming in. Palm was much more expensive at that point of time. But going forward, I think palm is becoming more competitive, and palm imports will kind of pick up slowly and gradually, which we've seen a lot of trades has been happening since the last 2 weeks from India. So that has also helped push the palm markets a little higher.
Priyam, how would you look at the Indian demand growth going forward? I mean, we do understand that India as a consumer is price sensitive. We tend to consume what is cheaper, and then the Horeca demand is quite on the stronger side as well. But when you look at various oils, as you spoke about from rice bran, you do a lot of work in that, and soy and cottonseed oil for that matter. How have you seen demand shift between various of these oils?
The demand usually shifts specifically for Horeca. It shifts from farm to whatever is the cheaper oil. So that shift is always going to happen because the margins and the value addition is so little, so they will have to go for the cheapest available oil. But having said that, I think from household demand perspective, we see there is a firmness in branded demand, and that branded demand is increasing year on year by 8 to 10%. And I think we've all seen a good growth in that. And I don't see that stopping anytime soon, because the household demand, the per capita consumption, all of those factors are going up every year. And this next 2 years also, I don't think there will be a dip in demand, especially from household. And Horeca demand is again increasing, which will increase the consumption of palm oil or whatever the cheapest oil is, which was rice bran maybe a few months back. Right now, again, palm has come down to that level.
Priyam, there also have been reports on how duty-free imports seem to be coming in from Nepal. I mean, that clearly seems to be an issue. What as an industry and how as an industry are you putting that representation with the regulator, with the government?
So as a chairman of the Western Zone SEA, we have been talking to, as SEA as an organization, we've been talking to various government bodies, and we've represented to various government departments on how this is affecting us. There are a lot of strategic calls that the government are also reluctant to take because of the SAFTA agreements, and there are a few other things that are also in place. So we are continuously talking to them. We are trying to explain to them what is the situation, how the industry is getting hit. And I think the government is understanding. They're giving a good ear to whatever we have to say. Even IVPA, one of another organization from edible oil industry, is also representing. So I think seeing all of this, I think there should be some kind of a resolution in the near future.
Priyam, also, how do you look at the next season coming in? I mean, as you said, the next couple of years, we are looking at good demand growth continuing from the Indian markets. It's supposed to be a good monsoon as well. And the way edible oil sector seems to be like right now, it's not really heading towards in way of inflation. Do you see the next season as positive?
Next year, whatever we are getting data from IMD and all the other sources is that the weather is going to be good. We are going to see a lot more sowing, especially in oilseeds. So the goal of self-independence in oilseeds, especially for India, is dependent very much on the monsoons. And monsoons this year look pretty good. So I don't see a problem for the next, at least this year, the way the monsoons are going to play out. But I think it's too early to say what will happen. I think we'll have a more clearer picture maybe by July, August.
Prem, I also want to put in a question on US and India conversations where soybean perhaps can be, could find mention. Is there any representations, any conversations within the industry?
No comments on that, please.
Okay, Priyam, I'll also want to talk about on what is the kind of play that China perhaps could have on soybean, because after US and China, as you mentioned, we've seen soybean prices surge quite a bit. The ethanol story is something that seems to be picking up in various other countries as well. How much of an impact would that have on soybean prices?
I think it will not have a big impact because the way the crude oil is going down, we've seen the price of crude oil go down quite a bit. And also we have an example right in front of our eyes of Indonesia, where the B40 was implemented on paper from 1st of January, but it has not been, the government has not been able to implement because of the difference of the subsidy that they need to provide, and the government buffers do not allow for those kind of values. And even though people would want to go there, but if the crude oil continues to be cheaper, it will be difficult for most of the parts of the world, except for the European Union and the US, to implement a higher biodiesel mandate. So, and the crop, even if we talk about the crop, especially only in Brazil, we've seen the increase of crop from last year, which was 154. This year, we are already seeing 169 million tons. So the size of the crop is also increasing. The additional crop can also go for your biodiesel mandate. But next year also, there is a talk or there is a prediction of almost 175 million tons. So with the increase in crop, I think there is enough supply available for both food and for fuel.
And as you said, the consumption is rising and the prices perhaps may not see too much of a run up there. Priyam Patel, really appreciate your time here at CNBC TV18. So clearly, edible oil is going to be one sector, Ekta, where you wouldn't see inflation concerns at all.
Okay, all right, Manisha. Thanks very much for that. Well, for the markets, it's absolutely flat now for the Nifty. Mid-cap index still holding its head above the water, but nonetheless, there is some amount of deceleration which has taken place and come off the day's low, day's high. We have the Bank Nifty, which is down around 370 points as well. Well, it's a wrap on halftime report, but Business Lunch is going to take all the action forward as well as the dip that we've seen in the market. Stay tuned.
Indices give up morning gains to trade near day's low. Nifty Bank slips over 0.5%, led by large private banks. Defense stocks again for the second day. Metals and realty stocks also rise, with mid-caps putting up a better show. Tata Motors delivers a strong performance in Q4 FY25, with JLR achieving its aim to turning cash positive. But a cautious outlook on growth given the global uncertainties is a dampener. Bharat Airtel delivers a steady India performance with healthy subscriber addition, but the stronger show in Africa has a positive ring. Analysts remain upbeat on the stock. Economists pulled down full year FY26 CPI estimates to 3.5 to 3.8% after April consumer inflation came in at a 6-year low of 3.16% and the wholesale price index at a 1-year low of 0.85%. Majority of economists expect 2 more rate cuts from the RBI, but a growing number of 3 to 4 cuts more. Hello, good afternoon. You've tuned into Business Lunch, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in. While we started today's trading session on a positive note on a strong footing, as of now we're seeing a bit of a decline coming in the markets, almost at the day's lowest point is what we're seeing. The Nifty is trading at. So yes, managing to hold on to that slight bit of a green is what the Nifty 50 is doing. Sensex is actually down and out and trading in the red. So look at the Nifty also, went in the red and then came up again, just holding on to gains of 0.1%. Sensex is still trading in the red, almost nothing, not much of a gain there or a decline. So flip-flopping between the red and the green maybe is what we could see coming in for the Sensex in the next half an hour or a couple of hours as well. Bank Nifty, looking at that, that's seen a sharper fall from the day's highest point, was managing to hold on to green till the first half of the trading session, and as of now is in the red. Mid and small cap, that's the outperformance coming in from that front. So yes, the Nifty mid cap holding on to gains of 0.8%, small cap holding on to gains of more than 1% as well. A lot of earning movers today. So Sirma, Metropolis, and Coromandel International, these are the ones that are seeing some bit of a pressure coming in because of their earnings, while Sai Life Sciences managing to hold on to good gains. A trend that is shaping up as well is also coming in for the defense shipbuilding kind of stocks. So GRSC, obviously they had their numbers as well, good numbers, but other than that, Cochin Shipyard, Mazgaon Dock, that is managing to hold on to gains. And railway stocks, that's another trend which is chirped up in trade. Ircon International, Titagarh Rail, as well as RailTel, that is managing to hold on to good gains, but we've seen a bit of a dip coming in overall the trading session, especially on the Nifty as well as the Sensex side. Let's move on and actually start the show by talking about the CPI data that we had coming in. Now, India's April CPI, that came in at a 6-year low of around 3.16%. That was dragged down by the food inflation. In further good news, the wholesale price index for April has also come in at 1-year low of 0.85%. Most of the economists are now lowering their full year CPI estimates to below 4%. Let's go across to Lata, who's joining in with us to give us a roundup on what is happening on this front. Lata, afternoon.
Yes, every inflation number that we are getting is coming in below estimate. The CPI for April, 3.16, our poll had indicated 3.2%. And largely because of food, that's come in at a 3.5-year low or a 42-month low of 1.78%. Cereals, pulses and vegetables have fallen the most month on month. One can understand cereals and pulses because the Rabi harvest comes in, but vegetables normally inch up in April. The fact that they have fallen and fallen by a good 7% is seen as extremely positive. A word on core CPI, which is non-food, non-fuel, the more steady part of inflation, that's risen by 4.1, but that's largely because of gold and silver. You take that out, then that is also 3.4%. Remember, the RBI's mandate is to keep inflation at 4%, and now on all major headings, the inflation is way below the 4% mark. The wholesale price index for April was also a shocker, coming in at 0.85%. The dipstick poll I did gave a number of 1.2%. So even over there, surprises on the downside. There it is dragged down severely by fuel prices, which fell at the wholesale level but didn't get passed on to the consumer, to us, because of the higher excise duty. Now, we will concentrate more on CPI because the RBI's mandate is on CPI, keeping it at 4, not on WPI. What we hear from economists is they've all reduced their CPI forecast for the full year from the earlier 4%, which is the RBI forecast, to between 3.5% and 3.8%. For instance, Goldman Sachs actually is looking at the May CPI at 2.9. So you can imagine the kind of falls that inflation is expected. Kotak and ICRA are the two people who have reduced the CPI for the full year to 3.5%. And some others like MK, HDFC Bank and even Citibank. Citibank is at 3.8. MK HDFC Bank at 3.7. But the point is everyone is looking at the 12-month inflation at below 4%. So the guess obviously is what will RBI do. Even now, the majority are expecting only 2 cuts more. Already 2 cuts are done. Repo is at 6. It's expected to go to 5.5. But there are a growing number of economists who believe it could be 3, like the economist in ICRA and MK. And there's at least one who's expecting 4 more cuts, taking the repo to 5%. And that's from Kotak. I think that tribe will increase. The number of people expecting more than 2 cuts.
Absolutely. That will be interesting to watch out throughout the year as well, and where the inflation data is going to be coming in, especially given that, most of them are cutting their estimates now to below that 4% mark. But moving on and getting more stock specific, let's talk about Tata Steel, the top Nifty gainer today. After a brokerage upgraded the stock, we have Nigel to give us more details on this front. Nigel, afternoon.
Well, Tata Steel is high in today's trading session. And to be fair, in yesterday's interview to CNBC-TV18, the management had made a couple of very, very positive points. So I'll make 3 big headers out here. One is on pricing. They said that current prices here in India are 3,000 rupees higher on a sequential basis. Even in Europe, they have said that the pricing is much higher. So there's an improvement both in Europe as well as India. That's point number 1. Point number 2, on the coking coal consumption cost, they said they're expecting some softness. It could be down by close to $10 on a per ton basis. And point number 3, they gave a guidance on EBITDA. Europe, they said, turns back into the green, which is phenomenal. Good news out there, though UK will continue to struggle, at least initially. But in the next few quarters, they're expecting even the UK business that's been given the big loss, that as well, to turn into the green, which is a positive. Remember, as of now, Netherlands has turned into the green, and that will likely stay in the green. But UK turning around at some part of the year as well is a positive. Nuvama, they have gone ahead. They have upgraded the stock. The target price has been raised to around 177 rupees per share. They've increased their EBITDA estimates by around 6% because now they're factoring in higher profits in Europe and also lower fixed costs. They are estimating the EBITDA to go up by around 2,000 rupees on a sequential basis because of higher steel prices, lower cost, and also they are saying that volumes could be a little bit softish, but both these two will offset the lower volumes. And finally, they are building in better numbers coming in from Europe. So put all this together, Tisco is reacting in today's trading session. But to be fair, the commentary from the management itself ahead of their con call here on CNBC-TV18 was extremely positive.
Thank you so much for that, Nigel. But moving on from the top Nifty gainer to the top Nifty loser today, we have Tata Motors in that list. And this is after its 4th quarter numbers. What are they looking like? What are more details coming in on this front? Sudarshan is joining in with us for that. Good afternoon, Sudarshan.
Good afternoon, Vinny. So Tata Motors yesterday post-market had reported earnings for Q4 FY25, and those earnings were largely better than estimates. But while the stock is under pressure, it's down almost 2% currently. It's on the back of the cautious outlook. Company is saying that in China, things are not that great, while the situation has improved a bit in UK and Europe. But the problem related to the tariffs are going to be an overhang, and the company is saying that exports that would be done from UK plant, for that tariff is increased by 300% to 10% from 2.5%, and exports to be done from EU plant, for that tariff would be increased to tariff would be increased by 3,000%. So those will remain an overhang. Now, after that, majority of the brokerages have turned negative. But first, I'll start with the brokerage which is positive. That is CLSA. It maintains outperform call, and target is 805. It says Q4 earnings have met estimates, but JLR is cautious in demand in FY26. But company is confident in delivering EBIT margin for FY26. Jefferies maintains underperform call, target is 630. It says Q4 EBITDA was down 2% year-on-year, but 4% higher than the estimates. But it believes that JLR may have a tough FY26 on tariffs, increasing costs and increasing competition in China. It has cut FY26-27 EBITDA estimates by 8%, but has raised EPS estimates by 3 to 4%. Nomura has downgraded the stock to reduce, and target is 799. And Kotak Institutional Equities has downgraded the stock to reduce, and target is 600. So earnings were above estimates, but on the back of cautious outlook, stock is under pressure.
Cautious outlook is keeping the stock under pressure, as of now down 2%. But let's move on and talk about some more details that have come in on MSCI. They have released their quarterly review today. We have Vivek joining in with us to give us and tell us actually what are the changes to the global standard index. Vivek, take it away. Good afternoon.
Well, that's right. Good afternoon. So MSCI overnight or very early today morning has gone ahead and announced the changes as per the MSCI May 2025 quarterly index review. Now, these adjustments, remember that MSCI has announced, will take place on the trading session of 30th May 2025. As far as the global standard index is concerned, they have made two additions from the Indian stock market to the MSCI. Which are the two additions? Coromandel International, IIFL Capital estimates that there could be inflows of close to $227 million into Coromandel. The other stock that will make its way into the MSCI is Nykaa. A little over $180 million is what that particular stock can hope to garner. As far as the passive indices are concerned, that will go ahead and make the changes in trade on May 30th. Now, along with that, there are actually quite a few additions and deletions as far as the small cap index is concerned. Almost 11 additions and 22 deletions from the small cap index. Overall, India continues to remain the second largest or second position as far as the MSCI EM index is concerned in terms of weightage. Overall, a positive development for Coromandel as well as Nykaa.
Okay, Vivek, thank you so much for that. But on that note, we're going to step into a very short break, viewers. And when we return, we'll get you the latest on India and Pakistan tensions, what's happening on that front. So stay tuned for that.
Network 18 is now the clear leader in digital media, with 55% more users on native platforms and social media than Times Internet. Network 18, the undisputed leader of news networks, way ahead of the times.
Welcome back to Business Lunch on CNBC-TV18. Now moving on, the meeting of the Cabinet Committee of Security on Security concluded a while back. We have Abhimanyu who's joining in with us to give us the details of this meeting. Abhimanyu.
A meeting of the CCS and the Union Cabinet concluded some time back at the Prime Minister's residence. This was the second meeting held after the commencement of the Operation Sindoor and the fourth meeting held after the terror attack in Pahalgam. While there is a pause on hostilities between India and Pakistan, the pause continues on military action. However, the vigil has been stepped up across the land, sea and air borders by different forces to ensure no misadventure or untoward incident by any element. It remains to be seen how the situation is going to pan out, even as de-escalation efforts continue from India's side. Also, India's BSF Jawan, who was held by the Pakistani forces, has been released. And in another development, India had expelled an official working with the Pakistani High Commission in New Delhi. And a similar action in retaliation has also been taken by Pakistan. So clearly, de-escalation efforts are continuing, but still there is skepticism over the actions by Pakistan and the kind of provocative statements which have been made by several Pakistani leaders and the entire Pakistani leadership in the recent past. Also, India till now has rejected any efforts or claims by any other country to intervene between India and Pakistan as far as dispute resolution is concerned, be it countries like United States or China. So clearly, de-escalation efforts are being looked at and the vigil continues to be high on the Indian side.
Thank you so much for that, Abhimanyu. But moving on to some updates related to India-Pakistan tension, the chief of India's 3 services called on President Draupadi Murmu and updated her about the Operation Sindoor. The president's official handle on X commended the valor as well as the dedication of the armed forces that made India's response to terrorism a sterling success. Now, even as the situation along the border with Pakistan remains calm, US President Donald Trump again took credit for the cessation of hostilities and Pakistan on his Saudi trip. Meanwhile, US Department of State Principal Deputy Spokesperson Tommy Pigott emphasized the importance of direct communication between both the countries. Listen in.
India has refused any US effort to mediate between India and Pakistan. How hopeful you are that you will be able to bring them together in the same room for talks?
Well, I'm not going to speculate on that. What I can say is that we encourage direct communication. We have been clear on that. We continue to encourage that direct communication. The president has been clear on that. And the president, as I said, has also been clear in praising both prime ministers for choosing the path towards peace and the wisdom and fortitude that shows.
Has US sent a team to Islamabad or Pakistan following the reports that there have been leaks of nuclear radiation in some of the secure Pakistani sites?
I have nothing to preview on that at this time.
Let's move on. The Supreme Court welcomed a new Chief Justice today. Earlier today, Justice B.R. Gavai took oath. Now, President Draupadi Murmu conducted the swearing-in ceremony. Ashmit is joining in with us again to give us details on this front. Ashmit.
Well, Justice B.R. Gavai, assuming charge as India's 52nd Chief Justice, the President today administered the oath to the new CJI in the presence of the Prime Minister as well as the entire top deck of the government. Now, bear in mind, this is for the records book. He'll only be the second judge from a scheduled caste community to come to the top chair of the Indian judiciary. He will, however, have a brief tenure of just a little over 6 months. He's due to retire in November of this year. Now, speaking of his journey, he began his journey in 1985, first as a lawyer. In 2003, he was elevated to the Bombay High Court, and in 2019 he was elevated to the highest court of the country, the Indian Supreme Court. And since then, he's had a prolific body of work, over 700 benches, over 300 judgments that he's authored. And speaking of judgments, in January of 2023 is when he was a part of the bench that had upheld the 2016 demonetization exercise. Later that year, in 2023, in December, is when he was a part of a bench that had upheld the abrogation of Article 370. Cut to 2024, he was a part of a bench that struck down electoral bonds and their legality. Subsequently, he also was a part of a 7-judge bench that had granted states the right to subclassify the SC/ST quota. And further, in December of last year is when he had come down heavily on bulldozer demolition by various state governments as a form of penal action. So a phenomenal body of work. The Indian judiciary looking now to him for leadership for the next 6 months.
Thank you so much for that, Ashmit. But on that note, we're going to slip into a very short break. And here's some good news coming in for our viewers. India's business news leader is now a click away. Introducing CNBC TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC TV18 app now from the Apple Store or the Google Play Store, or you can just scan the QR code on your screens.
investing.
Welcome back to Business Lunch on CNBC TV18. You know, we have HAL that has reported their numbers. Just quickly taking a check because the stock has fallen after its numbers. Revenue is down 7.2%. EBITDA is also seeing a decline coming in, and margins are also under pressure versus last year. So keep an eye out on that. EBITDA is down 10.2% on a year-on-year basis, and stock has seen a bit of a dip coming in after the numbers were reported. So that's something that we're watching out for. But let's move on to some other important news flow that's coming in. Microsoft has said that it is laying off 3% of employees across all levels, teams and geographies, which is affecting about 6,000 people, marking the largest round of layoffs since the elimination of nearly 10,000 employees we saw in 2023. Now, the company said that they continue to implement organizational changes to positions the company for which will position them for a success in terms of a dynamic workplace. This comes after the company announced a small round of layoffs in January that was performance based. So that is the update that we have coming in on Microsoft. Now let's move on to the latest on trade negotiations. US trade negotiator Jamison Greer is in an exclusive interview to CNBC said that 10% universal tariff will rebuild domestic manufacturing. Let's listen in.
The focus of this agreement and the talks over the weekend were really to address the current escalated situation, which was tantamount to an embargo, which was not sustainable for either side. So we're able to get to a position where the United States still has substantial tariffs on China. China retains some, not nearly as much as we did, but we're in a position where we can actually talk. We can do it constructively. And to your point, taking down non-tariff barriers, of which there are many, China's the largest challenge by far on that front. That will take time, but the Chinese, they want to talk about it, we want to talk about it, and we'll see where that leads. I'm going for my standing call with the Indian Commerce Minister, who's my counterpart on trade matters. Then this afternoon, I'm flying to Korea to meet with the Korean Trade Minister over the next coming days, as well as trade ministers from many other Asian countries who are gathering for APEC meetings. So all of this is happening in parallel, and we are happy to move as quickly as other parties are willing to move. Everyone saw the UK move very quickly. In Switzerland, in between all the meetings with the Chinese, I met with the Swiss president. They want to accelerate things. So we're moving as quickly as we possibly can with folks who want to be ambitious. We just want to make sure we have secure supply chains, we get as much production back home as possible, and having a 10% global tariff, that's going to help reduce the trade deficit, which is the primary driver of the whole program.
Okay, now getting you the latest on Trump-related developments. We have Dia joining in with us in our special segment Trump Watch. Take us through all of that.
Big headlines this morning, from high-stakes diplomacy in the Gulf to shifting U.S. policy at home. With billions on the table, sanctions in motion and lawsuits flying, a busy week is unfolding on multiple fronts. U.S. President Donald Trump kicked off his West Asia tour, securing a $600 billion investment pledge from Saudi Arabia, covering sectors like energy, defense and mining. Trump, touting the visit as a landmark in U.S. Gulf relations, went a step further, saying he expects the kingdom's total investment in the U.S. to eventually reach $1 trillion. President Donald Trump also said he would order the lifting of sanctions on Syria at the behest of Saudi Arabia's crown prince, in a huge boost for interim Syrian President Ahmed al-Shara as he seeks to stabilize a country shattered by war. Foreign Minister Assad al-Sharbani said he welcomed Trump's announcement, calling it a pivotal turning point for the Syrian people. Meanwhile, Trump also sent a stern warning to Iran. Speaking in Riyadh, he offered what he called a new path, but threatened maximum pressure if Iran rejects renewed nuclear talks. Let's listen into what he said.
I want to make a deal with Iran. If I can make a deal with Iran, I'll be very happy if we're going to make your region and the world a safer place. But if Iran's leadership rejects this olive branch and continues to attack their neighbors, then we will have no choice but to inflict massive maximum pressure, drive Iranian oil exports to zero like I did before. If you know that, they were a virtually bankrupt country because of what I did. They had no money for terror. They had no money for Hamas or Hezbollah.
And the pressure is already on. The US took a fresh step seeking to curb Iran's oil revenues with sanctions on an international network that it said facilitates the shipment of millions of barrels to China, an effort by the Trump administration to further pressure Tehran while negotiating over its nuclear program. According to officials, the sales support Iran's military and its development of ballistic missiles and drones. In a speech, President Trump also voiced hope that Saudi Arabia will eventually recognize Israel, calling it a key step toward broader regional peace. Meanwhile, back in the US, the administration is tightening the purse strings. Harvard University is facing another $450 million in federal funding cuts, adding to the $2.2 billion slashed just last week. And lastly, a major legal challenge is brewing in the United States. 20 states, including California, New York, and Illinois, have filed a lawsuit against the Department of Homeland Security, accusing the federal government of illegally conditioning billions in funding on cooperation with immigration enforcement. The states argue the move oversteps congressional authority and are asking a federal court to block the policy. That's all we have for today. Now, back to you.
Thank you so much for that, Dia. But that's all the time we have on this edition of Business Lunch on CNBC TV 18. Thank you so much for tuning in. Up next, your Midcap Radar.
Good afternoon and welcome to Midcap Radar, live from the CNBC TV18 Motilal Oswal studio. I'm Vivek Iyer, and joining me shortly is Hormaz Fatakia as well. Well, it's a day where we're actually seeing a little bit of a sell-off, especially as far as the Bank Nifty is concerned. Bank Nifty trading near the day's lowest point. We have quite a lot lined up on the show. It's an action-packed show. Let's start off with the top headlines. Indices give up morning gains to trade near the day's lowest point. The Nifty Bank slips 0.5%, led by large private banks. Defense stocks gain for the second straight session. Metals and realty stocks also rise, with mid-caps putting up a better show. Tata Elxsi gains after it collaborates with Mercedes-Benz R&D India for vehicle engineering and software-defined vehicle development. The stock up over 2%. ITD cementation in focus after reporting a good set of Q4 numbers. Revenues up 9.8%. EBITDA rises 17.6% on a year-on-year basis. The company also secures orders worth nearly 600 crore for construction of various infrastructure works at Jaipur International Airport. Aditya Birla Capital rallies more than 6% after bullish brokerage notes. Macquarie issues an outperform call with a target of 260 rupees a share, while Morgan Stanley issues an overweight rating with a target price of 250 rupees a share. Both cite a steady quarter as key reasons. Max Financial Services total APE met street expectations while value of new business was a beat. Management tells CNBC TV18 that they will try to grow 3 to 4% higher than private insurance players. Well, overall, it's a steady session, but what we are seeing, especially in the last hour and a half, has been the fact that there has been selling pressure witnessed both by the Nifty as well as the Bank Nifty as far as higher levels are concerned. Select NBFCs like REC and PFC have been under pressure. This on account as far as guidance trimming is concerned for AUM growth in the conference call that was just underway. But a whole host of other stocks is what Hormaz has on its radar. Hormaz today has gone by to the wall. Hormaz it's an action-packed session. A lot of earnings reaction is something that we're seeing to take us through the top movers.
You can't take your eyes off the defense names, earnings or no earnings. And if you look at the shipbuilders in particular, they have been on an absolute tear. Meet the likes of Garden Reach reacting to results 17% higher on the stock. Cochin Shipyard too is up 11%. Mazagon Dock, all of them are slightly off the highs of the day, but they are still trading with very, very substantial gains in today's trading session. Some of the others that are reacting in today's trade include the names are the MSCI additions, and particularly the small cap names. Look at Atom Investments, Acme Solar, Sai Life Sciences, all of them 5 to 10% higher on news that they will be part of the MSCI small cap index from the 30th of May. Now, if you look at the earnings reactions as well on both sides, but the negative ones in particular, look at Sirma SGS is now down 7% at the lowest point of the day, as is Metropolis, and REC is not an earnings reaction, but the management cutting its AUM growth guidance for FY26 has led to that sell-off on the stock. Stocks that are doing well on the back of volumes today, and they include the likes of HBL Engineering after the Kavach approval that it received. Linde India too is up 5.5%, and Aditya Birla Capital, as you just highlighted, 7% higher on some positive brokerage commentary on very strong volumes in today's session. And lastly, the railway PSUs too continue to do well for themselves as they have been over the last week, and Railtel, Ircon, Titagarh, all of them seeing gains of anywhere between 5 to 7%, Vivek.
Thank you so much, Hormaz, for joining us, giving us a good sense of what exactly is transpiring in terms of stock-specific action in the broader end of the markets. But it's a very good time to welcome Rajesh Palvia from Axis Securities for a technical check on the market. Good afternoon, Rajesh. Thank you so much for joining us. First up, give us your view as far as the Nifty and the Bank Nifty is concerned. Some profit booking seen at the higher levels. Do you see further upside, or do you see some exhaustion at the current levels?
Good afternoon, Vivek. So, Nifty is still holding the important support area of 24,500, which is the major put-based concentration. So for near-term perspective, 24,500 is likely to act as a good support area as overall, buying interest is still intact around those levels. But on the higher side, 24,700 to 750 are the major call concentration area. So I think we may remain in the range for some more time in the Nifty and consolidate further. 24,500 on the downside and 24,700, 750 would be the higher band for the Nifty. But definitely some substantial profit booking has been witnessed in Bank Nifty. Most of the large cap private bank have shown some profit taking, and Bank Nifty has broken its 10-day moving average in today's corrective move. But still, looking at the medium term to short term structure is still on the positive side for Bank Nifty. But yes, maybe some pressure would be there for near term perspective. On the downside, 54,500, 54,400 are the important and key support area for Bank Nifty. If at all Bank Nifty able to defend these level, some support buying action can be there around those level. But on the higher side, 55,000 to 55,200 are likely to act as a supply zone for near term perspective.
What about specific stocks, Rajesh? On the broader markets, index names, what are you tracking this afternoon?
So the mid-cap space is doing good, and a lot of mid-cap stocks are showing good traction in terms of buying. Exide Industries looking attractive. The way stock recovered after a brief correction. I think here we may see good traction further towards 395 to 400 kind of zone. So one can look to buy this stock with stop loss of 372. Another stock that we like at this juncture is NBCC. Stock managed to give breakout of its multiple supply zone. And looking at the weekly as well as on the daily structure, we believe that here also we could see further more traction. 112 to 115 would be the next target. Keep your stop loss around 103. And Genius Power, another stock, is looking very promising. The way weekly charts are now shaping up, stock now managed to cross 100-day moving average. So Genius Power can extend its gain towards 330 to 340 zone. This stock's also looking attractive for buying side. One can keep his stop loss around 310 to buy Genius Power also.
Thank you so much, Rajesh, for joining us. NBCC and GS Power are the two stocks on your radar. Well, moving on, we'll now slip into a short break. But while we slip into that, here's some good news for our viewers. India's business news leader is now just a click away. Introducing CNBC TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
News18.com marches way ahead of the Times of India with 38% more users on native and social platforms. Network 18, the undisputed leader of news networks, way ahead of the Times.
Welcome back. And one of the other earnings reactions that you are witnessing today is Siemens. Numbers, of course, came during market hours yesterday, and they are higher in today's session despite a tepid quarter that they had. Upasana is joining in to tell us the key factors that are contributing to this up move today. Upasana.
Certainly. First up, let's note that the company's demerger of energy business is effective from 25th of March 2025 onwards. Now, Siemens Limited ex demerger Q2 SY25, if we look at the overall result was tepid, but order inflows this quarter remained quite strong. Revenue was in line with Nomura estimate with an uptick of 3%, while EBITDA margin, net profit missed Nomura estimates. Now, coming to EBITDA, it saw a downtick of 27% on a YoY basis. EBITDA margins under pressure, down about 436 basis points at 11%, and PAT was also under pressure, down 37% at 407. Now, PAT declined due to under absorption of fixed cost and higher cost of materials in digital industries business. It was also impacted by extraordinary gain of 192 crore in Q2 SY24 and also demerger expenses of 63 crores. Now, Motilal Oswal has given a neutral rating on the stock with a target price of 3,200 per share. It says that the digital industry segment continued to see demand slow down, but order inflow for company's non-energy entity were healthy, up about 44% on a YoY basis, which provides a good revenue visibility for future. It expects execution to ramp up in FY26, FY27 on the back of strong order inflows, and it also expects a CAGR revenue growth of 11%, EBITDA growth of 13%, and PAT growth of 10% from FY24 to FY27. Hence, we can see the stock moving up in trade today on the back of strong outlook and order inflows.
Thank you so much, Upasna, for joining in, giving us a sense of Siemens. Remember, Siemens operationally was a miss as far as what the street was anticipating, but the strong order inflow, similar to what ABB witnessed, has led to quite a big up move. Well, talking about another stock that's doing very well in the session after its Q4 results, that is ITD Cementation. ITD Cementation came out with its numbers last evening. Having a look at the numbers themselves, strong top-line growth, almost 10% higher on a year-on-year basis. The EBITDA coming in quite strong at close to 260 crore, which is an indication that the core EBITDA has moved higher by close to 18% on a year-on-year basis. Margins too have expanded almost 70 basis points and profitability higher by 27%. So the strong operational performance has led to a 27% up move as far as the profitability is concerned. Now, talking about the Q4 order inflow itself, coming in at close to 803 crore. FY25 order inflow at close to a little over 7,170 crore. And when you're talking about the order book quite steady, 18,300. However, when you're looking at it on a year-on-year basis, it's moderated compared to at the start of FY25. They actually had an order book in excess of 19,900 crore. Now, when you're talking about one update, the company said that yesterday they received an order of close to 600 crore. Now, this is for infrastructure works as far as Jaipur International Airport is concerned. FY25, the profitability moved up by close to 36%. Onwards, the other important thing to keep in mind as far as ITD is concerned, the promoter is no longer Thai. It's now an Indian promoter. The Adani Group now owns majority stake as far as ITD is concerned. So that was the other major factor that played out as far as ITD Cementation is concerned for FY25.
Oh yes, 9% higher now. Slightly off the highs of the day though is ITD Cementation, but still holding on to healthy gains as we speak. So almost last 2 weeks has seen the stock surge about 25%. So healthy gains for ITD Cementation. But what's not been in the pink of health today is REC. It started off well, but after the earnings call began and the management cut its AUM growth guidance for FY26, the stock is facing selling pressure and now is down to the lows of the day. Vinny is here with more on this. Vinny.
Hi, Verma. So, yes, absolutely. We're seeing that REC is trading at the lowest point of the day. Now, at the beginning of the con call, only they said that the AUM guidance, now they've given a new one, 11 to 13%. The previous guidance was in the range of around 15%. Until Q3, they were very confident that this would be something that would be sustaining. So that is something that is coming surprising from the company side. So AUM guidance now for FY26 is 11 to 3%. They've cut that. Loan book target, what they've highlighted, 10 lakh crore rupees by 2030. That target is still on track. They are targeting a 12% annual book of loan growth that one could see coming in from REC. NIMs that will continue to be in the range of 3.5 to 3.75% in FY26. Infrastructure is something they believe will lead the growth, especially coming in terms of the NIM side as well as the spread going forward, and that will be something that will support the growth. Regulatory environment, the company highlighted, has been stable. They're targeting a net zero NPA status by FY26, and generation projects are yielding around 10 to 11.5%, which is expected to support the margin sustainability going forward. So the main blip that came in today from REC was in terms of AUM guidance, which was being cut in terms of concerns on that front.
Thank you so much, Vinny. REC trading near the day, lowest point of the day, and along with that, PFC that's yet to declare its results, that too has seen a rub-off effect, and PFC too is under pressure today. But another stock, from the NBFC pack, but that's seeing contrasting fortunes is actually AB Capital. AB Capital, this particular stock is up almost 7%. Nigel joins in. The company declared its results yesterday. Whole host of brokerages have reacted. Nigel joins in with more details.
Well, that's right. Aditya Birla Capital, in fact, is higher in today's trading session. I've picked out two big brokerages that are fairly positive. First, Macquarie, they have an outperform rating with the target price of around 260 rupees. They say that the profit and the AUM was in line with expectations. Now, all eyes are on the slippages, particularly in the unsecured business segment, which will be important. On AB Sun Life Insurance, out there, they're saying the performance actually was better than expected. So they're quite positive out there. And they're also highlighting that the management is targeting to double the NBFC AUM as well as the VNB in the next 3 years. So that's why we have Macquarie that's positive. Moving to Morgan Stanley, they as well have an overweight rating with a target price of around 250 rupees. They see a steady improvement and better outlook across businesses. They're saying that the NBFC, which is the largest business, the performance out there was in line with expectations. While they also go on to make this point that they are seeing a margin of safety and there is scope for a re-rating as well. Explains why AB Capital as well is doing well, because both the brokerages Macquarie and Morgan Stanley are optimistic on the business prospects.
Yes, 7% higher there on Aditya Birla Capital. Nigel, thanks a lot for that. And the other one that's not having a very good reaction to its results is Metropolis, and Ekta is here with that fine print. Ekta.
Thanks for that. Well, yes, revenue was up around 4% this quarter. Street was anticipating around 8% growth. Margins came in at 18%, and the profit was under pressure as well. The company did say that the Q4 margins were impacted because of nil margins from Core Diagnostics, a recent acquisition by them, lower than usual revenue in Feb in focus markets, and the 3 acquisitions, one of them being Core Diagnostics just in the past couple of months. Now, in terms of a couple of key metrics, True Health, their preventive testing segment, who did well, was up 20%. Specialty Diagnostics was up around 11%. In terms of a couple of key takeaways, they did mention that there were lower volumes in Feb. Q1 revenue build-up will be in line. They expect around 12% growth in FY26. But the street, remember, a lot of the analysts were expecting mid-teen growth to come through. They also expect 1% expansion in margins in FY26. That is because of the acquisitions which they've undertaken. They, however, have said that the phase of heavy capex is over and will be looking at accelerating their collection centers going forward.
Thank you so much, Ekta, for joining us, taking us through the earnings fine print as far as Metropolis Healthcare is concerned. But the other stock that's doing quite well is Max Financial Services. It's up almost 4%, reacting to its Q4 earnings. Their total APE numbers met street expectations, while value of new business was beat. Earlier today, we spoke to Prashant Tripathi, the MD and CEO of Axis Max Life, on their performance and growth outlook. Let's listen to excerpts from that conversation.
Began the year with positivity. And, it's very hard to give an absolute number on growth, but I must share with you that we'll try to maintain 3 to 4 percentage points with respect to the private average growth. So if the private industry grows at 13%, you should add 3-4% more for our growth expectation. And in terms of margin, while we finished at 24%, we'll definitely target a range of anywhere between 24 to 25%, trying to increase it further. Q4 generally is the highest sales month where we get the leverage on the business, and hence our margins are typically highest in Q4. That's been the trend always. I must say 28% is the higher end of the margin, so you shouldn't expect margins going beyond of that. We look at the impact, but we then deploy corrective mechanisms to take care of the margin impacts. On a net basis, I will say the impact was less than 50 basis points for the second half of the year, because we almost nullified the impact by the corrective mechanisms that we deployed in Q4. As we look at next year, I think it should have a minimal impact, because we'll look at product mixes, we'll deploy certain products which will have inherently more margins. So we'll take care of the impact of surrender regulations on overall margin.
The management there of Axis Max Life and the numbers of APAR Industries were flashing on your screen just a few minutes ago. Revenues and profits were higher. Margins were slightly narrower, though, on a year-on-year basis. The stock has seen a bit of a choppy move after the earnings announcement, still trading with gains of around 1% in a quarter. Vivek, APAR Industries, 5 years ago, the stock was at 300 rupees. Now it's at 6,600 rupees, and this is after the stock is down 44% from its highs. So it has gone up to almost 12,000, and now trading at around 6,600 rupees is APAR Industries. So clear the kind of returns that the stock has delivered over the last 5 years. We'll take a short break. More on the markets on the other side. Stay tuned.
What was the one that surprised you? What was the one that you were absolutely sure of?
Barfi was one which was the most difficult to pin down, but you knew it at a visceral level. You reacted to the material. Chennai Express actually was another film where there was a full narration that happened with a group of 20 people, and we were laughing off and like falling off our chairs.
What was a casting call that you made that kind of worked out the way that you had imagined it to?
I think probably Dangal. And at that time, of course, Irfan, he was someone we had in mind. He would have done a wonderful job. But then I got a call from Amir at that time. Many other stars of his stature might not have been okay with playing an overweight wrestler who's like a bit of a has-been, who's living out his dreams through his daughters.
Welcome back. Now, government sources are saying that only 25 days of coal stocks are currently available at pitheads at thermal power plants. Abhimanyu is joining in with more details on this. Abhimanyu.
While the mercury is rising across the country, ample coal is available at pitheads. That's the word coming in from the government. Government sources have told CNBC-TV18 that around 25 days of coal stock is available at pitheads and thermal power stations across the country. Now, this is despite an increase in temperatures which has been noted in the past few days. Also, there have been several patterns with respect to different regions, and these regional patterns are also governing the kind of power demand in respective regions. While places like Gujarat and Telangana have witnessed heat waves already, and due to several heat waves being witnessed, the projected peak demand for power has already been witnessed in these particular states. However, in places in North India, there have been several showers and several reliefs in terms of rain, and that has led to some cooling down of temperatures, which has ensured till now that the projected peak demand has not been achieved. It remains to be seen how the situation is going to pan out, even as the government is working to improve last mile connectivity in terms of transportation of coal and logistics to ensure that it's not just high production of coal, but also last mile connectivity, which will boost power generation and will provide ample coal not just to the power sector but also to the non-power sector like the steel sector. The government is also looking to beneficiate coal in a large way to ensure that purification of coal takes place even before transport, to improve overall logistical efficiency and to also save on infrastructural costs while transportation of coal.
Thank you so much, Abhimanyu, for joining us and with those important updates. But moving on, life insurance stocks are reacting to their April business updates. Yash is here with more details on April performance of various insurance players.
Well, so if we start with the industry, the life insurance industry in the month of April has grown its premium by about 8%. Private life insurance companies a tad bit lower with a growth of about 6%. AP for private industry growing at 8%. Retail AP growing at just 2%. Now let's speak about individual players. The strongest performance came from Axis Max Life Insurance, and that came on a strong base which the company had as well. Premium growing at 17%, AP growing at 23%, retail AP growing at 24%. After Max Life, Axis Max Life Insurance, it was HDFC Life Insurance. The premium growing at 23%, APE growing at 10%, and retail APE with a growth of 3%. ICICI Prudential Life Insurance, it was a weak growth, but the company had a strong base to work on. Premium growth of 10%, APE growth of 5%, and retail APE a contraction of 16%. SBI Life, again weak growth, but had a strong base to work on. Premium growth of about 0.3%, APE growth of 8%, and retail APE growing at about 2%. Finally, LIC, premium growth of 10%, coming in at about 13,611 crore rupees. AP, a contraction of 11%. Retail AP also contracting in the month of April by about 4%.
Yash, thanks a lot for that. And the life insurance players as well, they're in focus. By the way, HBL Engineering, we just mentioned that at the start of the show, now is 10% higher as we speak. There are numbers of rights that were flashing at the bottom of your screen just a few minutes ago. And railway stocks have continued to do well all through this week. And rights are reacting to its results, still holding on to gains of around about 4%. That other railway stocks, though, are continuing to build on to those gains. Railtel is now up 7%. Titagar is now up 6.5%. Ircon is up 6%. So railway PSUs are hogging the spotlight, and that's been a while since they did that. So coming on the back of some strong moves in today's session. Some numbers flashing on your screen as well. Responsive Industries, profits growing up 18% from last year. The stock, though, trading with gains of around 3 to 4%. So numbers continuing to trickle in thick and fast. And pull up HAL as well. See how the stock has moved after its results. The numbers on a year-on-year basis were lower than expectations, but have been a convincing beat on estimates. So 3.5% higher on the stock, a very sharp spike after falling off the highs after the initial print. With that, we call time on this edition of Midcap Radar. From Vivek, me and the team that put this show together, thank you so much for watching. Your stocks when we return.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in. As always, a slight bit of a recovery is what we've seen coming in the market since the last time we spoke at 1 o'clock. So yes, now 24,600 is what the Nifty is managing to hold on to. Sensex, you can see, is still in the red. So it's flip-flopping between the red and the green. Let's keep an eye out on the Sensex as well. Broader end of the market managing to perform much better than what we're seeing in terms of the Nifty 50 and the Sensex. So versus the benchmark indices, broader market is where we've seen that bit of a better performance. Coming in, all the Nifty mid-cap, small-cap stocks are doing quite well. Advance decline ratio also clearly, if you look at that, is in the favor of advances even as of now. versus decline. So that is something that we're keeping an eye out on. A whole host of stocks that are buzzing in on the back of their numbers as well. HAL, a sharp recovery after we saw the numbers come in. A year-on-year basis decline, but then a recovery that came in the stocks because beating the estimates of the street. So keep an eye out on that. But this is a show where we solve all your stock-related queries. And for that, today we have our experts joining in with us, Astha Jain, research analyst at HEM Securities, as well as Somil Mehta, head of alternate research, capital market strategy, Mirai Asset Sharekhan, joining in with us for helping you all solve all those doubts. Astha as well as Somil, very good afternoon, and thank you so much for joining in with us. Somil, I just want to take a quick check in terms of the market as well. What are we watching out for in terms of a level? Obviously, last week, given the tensions that were going around, we'd seen that fall coming in. Then we saw a sharp recovery a couple of days back. Then yesterday, a bit of a correction. And again, today, a bit of an up move and a slight bit of a correction. So what are we watching out for in the swings that we've seen in the market right now?
The short-term and the medium-term outlook remains positive. That's the first thing I wanted to mention. Whatever the correction we have seen in the last couple of days has been a little worrisome. But at this point of time, I think the previous resistance, which was around 24,600 and 24,500, that will remain a very crucial support now from here on. If we close below 24,500, I think that will be the first sign that we may decline further. However, at this point of time, buy on declines would be the strategy, and I will expect a target of 25,000 and 25,200. That will be my short-term targets. In the Bank Nifty, same. I will be expecting markets to go above the previous swing high, and the buy on declines should be the strategy. The support zone for Bank Nifty is 54,400, and the first target would be 56,000, and the second target would be 56,800.
Okay, keep an eye on those levels over there for the Nifty Bank Nifty as well. Thanks so much for that, Somil. But on that note, let's get started with the queries. And the first query for today, we have this coming in from Vansh Kapoor, who's writing to us from New Delhi. He asks if he can buy some shares of Tata Motors at the current levels. Astha, your view coming in for Tata Motors. Yesterday, we did have the numbers that came in. It was above estimates, but the cautious outlook is something I think that is fearing the street. So what are you watching out for now, and is it a good time to look at Tata Motors?
Hi, good afternoon to everyone out there. Talking about Tata Motors, I think one can wait for some dips to arrive in and then make entry into the counter. Now, talking about the JLR business is showing a very strong momentum, especially if I talk about their balance sheet position. So balance sheet position is in a very strong and a very good shape right now. But the kind of macro environment we are working into, I think that can lead to some sort of a downside in these stock prices, and hence we are recommending it buy, but not at the current level. Maybe buying it around the level of 680 to 670 odd zone is a better levels to take entry in. So this is what we are recommending. Buying on dip strategy can be applied. However, on the positive side, our targets which we are keeping for this counter is around 750.
Okay. You're keeping an eye on 750, and buy on dips is your strategy. Somil, on the charts and technicals furthermore, what's your view coming in for Tata Motors? We've discussed this time and again, and given that you've not seen such an outperformance, actually it's an underperformance when you look at it from Tata Motors. So what should you be watching out for in terms of a level on the technical front, and do you think there is room for a run-up now?
After a very long time, Tata Motors have started sustaining about 20 and 40 daily moving average. Since I think October, November 2024, Tata Motors have not been able to, struggling to go about 20 and 40 daily moving average. This is the first time after 6 months that the stock is sustaining about 20 and 40 daily moving average, which is a very good sign. On the weekly charts, on the higher time frame, higher tops, higher bottom formation is already started. So I think a very good risk reward ratio is there, and my view would be positive in the short term. In the medium term, both buy and declines would be the strategy, and a very strict stop loss at 633, and the targets would be at least 820 levels in the short term for next probably 1 or 2 months.
Okay, keep an eye on those levels over there for Tata Motors. Let's move on and talk about IndusInd Bank. Now, IndusInd Bank, we have a lot of news flow that's coming in the recent times here. Ravi Kumar was writing to us from Bangalore. He's holding 250 shares of IndusInd Bank. This is at a price of 830 rupees per share, so making a loss on this one. He's asking if he needs to be worried about his investments. Given the recent scenario that we've seen coming in. Asta, your view for IndusInd Bank. At one point of time, I remember everyone used to, like IndusInd Bank, talk a lot more about IndusInd Bank. But now they've made those changes in the management as well, right? Which were in terms of concern. So what is your outlook on the fundamental front?
So on the fundamental front, we are very much, looking after the asset quality, because what we have seen that their GNPA ratio has inched up to around 2.25%, which was 1.3 or 1.5%. So I think that is a major issue, and that is mainly due to the MFI stress which this bank is witnessing in their books. So asset quality is definitely an issue. Along with that, we have seen the kind of management changes which is happening. So I mean, all these points are indicating towards more downside from here. Maybe today we have seen some sort of a recovery, but we are not very much positive on the near-term outlook. But here, my stances hold. Maybe some downside can be seen, but I think the cost price of 800 rupees definitely will come after 3 months or 4 months. So it will take some time, but definitely we can see the cost price in the medium to long term. So hold is a strategy from our view, from our side, keeping in view that some downswing in the stock price.
Okay, hold is a view. Maybe keep an eye out. There may be good ups and downs, but long-term view, yes, still stands positive there. But Samil, on the technicals, is your view similar? Or should the viewer just get out of the stock, look at another private bank? What is your suggestion?
Definitely look for some other private bank. Axis Bank looks great. ICICI Bank looks great. But if you're talking about IndusInd Bank specifically, medium-term outlook negative. In the short term, maybe a spike is possible till 20 simple moving average, which is around 805, 806. But that is a very, very strong hurdle for the stock. In the very short term, or in fact in the short term, in the medium term outlook, this stock behaves very sharply. It's very high beta. So short term and medium term targets are achieved very quickly. So in the short term, my view is negative, and the previous swing lows could be retested, which is around 600, 610 levels. So those would be the targets in the short term, in the medium term outlook.
Okay, keep an eye out on IndusInd Bank, and Somil said that if you can, then look at some other banks as well. Axis Bank is also something that he mentioned on the private bank side. Let's move on to the next query then for today. We have Suja, who's writing to us from New Delhi, holding 5,000 shares of PFC. This is at a price of 110 rupees per share. So currently 403, so they're making a good amount of profit. Wants to know the future outlook of the stock for PFC. Asta, your view coming in for PFC. Today we did have REC, that gave some bit of a cut in terms of the AUM guidance, which has given bit of a fear for REC. But PFC is still left to give its numbers. What are we watching out for? And obviously, these are stocks that give dividend as well. So, the outlook for the stock, does it merit continuing to hold it given the profits they're making?
Yes, I think it is very well, placed right now fundamentally also, because what we are seeing is that their asset quality is showing the sharp improvement, especially in the terms of GNP and NNPA ratio. And this company is also set to announce its number on 21st of this month. So I think it's better to hold the counter at least till 21st of the month, because if the number comes in accordance with our expectation, which we believe it on the stronger side, then definitely the prices can move more upwards from here. So there are chances to exit at much higher level rather than at the current level. So it's a matter of only few days. Just wait till 21st and continue holding this counter. This is what we are recommending. For us, the price target which we are giving to this counter at the initial level is 430 to 435.
Okay. And Somil, your view coming in for PFC, what should the viewer do? Is it time maybe to book out some bit of a profit according to you?
Definitely. This stock has been struggling to go about 20 and 40 daily moving average, which is very important in the medium term outlook. If the stock goes above 444, which is way high from here, if it closes above 444, 45, that will be the level to go in and buy this stock for a very good medium-term outlook. But at this point of time, medium-term, short-term, both view negative. And I'll be expecting the previous swing lows to be retested around 380 levels.
Okay, surely keeping an eye out on PFC over there. But let's just mark Graphite India. They came out with their numbers. Revenue was down 7.5% on a year-on-year basis. We are seeing what to watch out for in terms of profit and EBITDA as well. We had the EBITDA that came in at 39 crores versus an EBITDA loss of 10 crores last year. So yes, in terms of margins also, we've seen an improvement there as well. So that is something to watch out for, a spike up in the stock price. Today, you have more earnings coming in on the screen as well, Ajmera Realty. But yes, keep an eye out on earning-specific moves in the stocks as well. But on that note, we're going to slip into a very short break. And while we slip into the break, here's some good news coming in for our viewers. India's business news leader is now a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or the Google Play Store, or you can just scan the QR code on your screens. Welcome back to Your Stocks on CNBC TV18. We still have with us Asta Jain as well as Somal Mehta to solve all your stock-related doubts. Let's move on, and the next query is coming in from Rahul Maurya, who's writing to us from Mumbai. Holding 4,220 shares of Bharat Electronics is at a price of 316 rupees. And also he's holding 6,700 shares of Union Bank. This is at a price of 134 rupees per share. So for Union Bank, it's around the buying price as well. For BEL, it's slightly above right now, the buying price. Wants to know the future prospect of both these stocks. Asta, on the fundamentals, BEL and Union Bank, what should they be doing? BEL obviously has the defense story also, and right now we've seen that run-up coming in since the last week for these defense names. But long-term story for both these, how does it look?
Long-term story for BEL is looking very strong, and we are recommending a hold on it, as well as buy on dip strategy can be applied whenever some dips arrive at around the level of 335 to 330, with a price target of 370 to 380 at the initial levels. Talking about this counter, they have got a leadership position. In fact, with the increase in the share of electronics in the defense, and in fact, they have received the order of around 2210 crores from the Air Force for the electronic warfare suit. So I think looking after all these factors with a strong order backlog this company is enjoying, I think it is well set to show more upside from here, and a 400 levels can also be hit in the medium term. So a hold is recommended on this counter. Talking about Union Bank of India, this is also looking good. We are very much impressed by the results, as well as the bank has shown a CAGR growth of more than 8% in their AUM, which looks to be very impressive. So this bank is also looking good to us, recommending a hold on this. The price target of 150 at the initial level. So both these counters are looking good. Buy on dips as well as hold strategy is recommended for both this count.
Okay. Whole strategy for both these counters is what you're saying. Saumil, on the technicals, BEL as well as Union Bank, does it merit holding both these names, and or do you think that there is a better option in both these sectors, whether you look at the defense or the PSU bank side?
I think BEL is definitely one of my favorite counters on the defense side. You can also try HAL. HAL looks great at this point of time and has very good potential on the upside. BEL has already broken out of it, is consolidation from last 6 months, and that targets at least 400, 420 level. But you can also look at HAL. HAL also looks great, and the risk reward ratio at HAL is better than BEL. Coming to Union Bank I think has broken out of an inverted head and shoulder pattern, and I think it is looking great for a medium-term outlook. Medium-term outlook targets for Union Bank would be 140, 150 levels from here, from these levels, and the stop loss would be around 128, 125 levels, and for a medium-term outlook for an investor. So Union Bank definitely good, but you can also look at Canara Bank. Canara Bank looks great as well for a medium-term outlook. It has also broken out of an inverted head and shoulder pattern, and the target for Canara Bank would be 110, 115 in the medium term.
Okay, Saumil, thank you so much for that. Surely can look at Union Bank. He's given the, targets where you can look for Union Bank, but Canara Bank is also something that is looking interesting on that front. But let's move on to the next query. We have Vikram Singh writing to us from Noida. He's holding 250 shares of transformer and rectifiers at a price of 510 rupees per share, currently trading at the similar levels. Wants to know if they should continue to hold this for the long term or switch to another stock. Asta, your view.
I think this is a stock to keep in the holding for a longer term with a price target of 590 to 600 at the initial level. Talking about this counter, definitely the results were exceptionally well. In the Q4, they have shown a whopping rise in their bottom line. So we were very much impressed by the numbers. The only thing is that the valuations were on the higher side, and that's why we have seen some sort of correction after the result announcement. But in the longer term, I think the stock is well placed to show more upside from here. 590 is the initial target which we would like to assign to this counter, and recommending a hold for that.
Okay, and your view on the technicals for transformers and rectifiers, Saumil?
Medium-term outlook positive. In the very short term, maybe consolidation, a small correction, but not below 440, which is a 200 daily exponential moving average. A long-term good trend on the upside, and in the medium-term outlook, I think the higher end would be around 600 levels, and that would be my my target in the medium term.
Okay, keep an eye out on those levels over there for transformer and rectifiers. Next query for today coming in from Avinash Bhargava, who's writing to us from Hyderabad. 35 shares of JSPL is what he's holding at a price of 693 rupees per share, making a profit on this one. Wants to know, and he's saying that can he hold this for 3 years more from here on? So what is the outlook for JSPL from here? Asta?
Outlook is positive, but not very much, highly positive or highly optimistic. But yes, we are restricting our price target to 1,000 odd levels. Talking about the numbers, we have seen the rise in the EBITDA, but that was led by due to the lower coking coal price, etc. So there was a lower cost, and hence we have seen some sort of improvement in their EBITDA. But we really need to see how the company will be performing going ahead. So right now, we are positive on this counter, but it is like cautiously optimistic with the price target of 1,010 to 1,050, and a hold is recommended from our side for this counter.
Okay, and Samal, your view coming in for JSPL?
GSPL, one of my favorite counters on the metal side, and has broken out today. And a consolidation from last 6 months has been broken on the upside, which is great. A high bottom formation on the weekly charts. I'll be aiming for a new high from here. So keep a stop loss of very strict stop loss of 868, and aiming for a new high, lifetime high, which is around 1100 levels.
Okay, JSPL, surely Somal's favorite stock, and he likes this one in the metal pack. So thank you so much for that. Somal as well as Asta, thank you so much for joining Unitasa and helping our viewers solve their stock-related queries. And viewers, we'll wind down this edition of Your Stocks on CNBC TV18. Thank you so much for tuning in. And remember, you can always email us your queries and we'll address them with our experts as always. So stay tuned in. Up next, now you have Closing Bell to take you through all the market action.
Now you believe that India has been poised to have its crossover or breakout moment, just as we've seen with the parasite and so on and so forth. Why has it been so elusive?
Because we've been victims of our own success in a way that traditionally India has never really had to reach out to the world.
What's exciting you about the stuff that you're seeing being made today?
A show like Kora, for example, right? It's very local, very rooted. But I think the beats of the way that the story unfolds is told in a very international way.
Are you also seeing a diversity from where these scripts are coming in?
I think the number of people from the smaller towns, I'd say even sometimes from villages, who reach out to us with, even if it's a concept note, it might not be a full screenplay, is quite significant.
beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
A mixed picture, but largely in the green is what the Asian screen is suggesting.
The big cut, of course, was in the Nifty stocks, not so much in the Nifty Bank. And of course, the broader markets actually, if anything, ended higher. The mid-cap index is up. The small-cap index I can spot is about 0.75% in the green.
Globally, every market is, back to what they were 2, 3, 4 months back, and so is maybe Indian markets.
Close to about 0.4% on the benchmark indices. Mid-caps faring better.
The commentary from the management itself ahead of their con call here on CNBC-TV18 was extremely positive.
You're able to bring up the overall all commodities index to 0.85%.
There is skepticism over the actions by Pakistan and the kind of provocative statements which have been made.
We're actually seeing a little bit of a sell-off, especially as far as the bank Nifty is concerned.
Hello and welcome. You're with us on Closing Bell. We're here with the last 1 hour. And it's been a more quiet day for the market. No major moves, and we've kind of given up a little bit from the highs of the morning as well. I'm Surabhi Upadhyay. As always, with me is Rima Tendulkar, and today Nigel's here with us in the studios. Hi, guys.
Hi, thanks for accommodating me.
Special day, we have you with us.
It's our lucky day.
Yeah, but it's, though the headline index is not indicating that much of gains, but actually the broader markets are looking good. You still have a number of stocks advancing in the ratio of around 3:1. So you'll have to say that maybe the headline index goes through a period of consolidation. But after getting hit hard, it appears the broader markets now, the excitement is out there. And individual stocks, a lot of them giving decent numbers. And you're seeing stocks that are flying away in today's trading session. You have GRSE, you have HAL, many stocks in today's trading session that have done well, KPI Green as well. So just to name a few, a lot of stocks have done well. And stocks like VIP that actually delivered a poor set of numbers, the stock's down 2-3%. In another market, the stock would have easily been down 10% with the awful numbers that we've seen from a company like VIP. So clearly, the street is looking ahead.
It's just disappointing to see the way banks have sold off, and perhaps it's smacking of FIs selling, which might come through. But the Nifty banking index is down 240 points right now at 231 hour to go. But from the session highs, it slipped close to about 500, 550 points. So, and it's heavies like HDFC Bank and ICICI Bank, Kotak Mahindra Bank, across the board. Banks are weak in trade. In fact, even the Nifty and the Sensex has come off quite a bit. So selling pressure, profit booking did creep in as the day progressed. The high today on the Nifty was 24,767. As we speak, we're 24,616. So lost about a good 150 points from the day's high. And, it's been through the day. The first hour was good. Markets open strong, and then you're slowly seeing this profit booking creep in.
Absolutely. I just have one worry for this market from a tactical point of view, and that's competition from China. Look at what the Chinese market's done today. Look at the Hang Seng. The closing there is 2.5% higher. There are gains in the mainland China markets as well. So in the short term, will FIIs make that tactical shift towards China? That's a question we'll try and address with our guests on the show as well. But first up, lots of stocks and lots of earnings in focus. And Tata Motors is one of those names. The stock is actually ending or is trading lower, despite the fact that the fourth quarter was fairly in line with estimates. It seems that there are concerns about the outlook. Parikshit actually caught up with the company's chief financial officer, PB Balaji, and started off by asking him about the demand outlook, which is what the market's concern is as well. Take a look.
Overall demand situation as far as India is concerned is, I would say, is modest, is decent, not scorching. At the same time, neither is there any major concern at this point in time. So I would expect modest growth coming into this year. On the commercial vehicle business, I think the underlying fundamentals of the growth is very much intact, be it on freight rates, be it on interest rates, fuel prices. Overall, GDP growth in the industry economy is good. At the same time, even investment plan for the government also continues to remain strong. So all of them portend well for a decent growth. When does the cycle begin? When does the cycle, which part of the cycle we are in? Very difficult to predict. But medium to long term, no major concerns as far as the CV growth is concerned. On the passenger vehicle growth, I think we did have a lukewarm growth last year. Nothing much to talk about last year. And I would suspect that this year would be an year where it'll be modest growth once again and gradually build back as the year progresses. So overall, I'm quite comfortable with the demand situation in India, and we should be in a position as Tata Motors to continue to do well in this market.
Okay, I would also like to ask you about market share loss in the passenger vehicle segment. In fact, analyst reports this morning have expressed some caution and concern about continued market share loss in passenger vehicles. Would you like to weigh in on this concern and how the company is looking to address that?
I think for me, last year was a year of consolidation, 13.2% share. In many months, we were number 2 in the market. So it's not so much a market loss, share loss issue. It's more about how do we grow market share from here on. In that, there are 2 angles here. One is our product launches start from now on vis-a-vis competition, which was more last year. And at the same time, we also had a challenge with respect to our capacity available on our service network, which created some amount of challenges from a customer perspective. Both these are addressed. So we have an intensive product launch pipeline starting now. And we also have more or less fixed the service capacity issues that were there. And that should ensure that the customer sentiment on that goes up as well. Both these augur well in terms of delivering growth well ahead of the market. And we are quite confident of how we are stacking up as we enter the new year.
Right. Speaking about EVs, you have a 55% market share in the electric vehicle segment. Now, the launches by your peers has, of course, impacted the space. There are more players entering, and there are companies which have increased their sales numbers on a month-to-month basis as well. How do you see competition? Do you think your EV strategy needs some rethink right now?
Not really. We just need to execute that with speed. And let me tell you how we intend to go about doing that. The first focus of the EV business is to drive penetration of EVs in the overall portfolio. I am not focused on market share here. It is more about how do we grow this market sequentially. Last year, we had a fundamental issue with respect to the fleet segment getting into challenges because of FAME incentives going away, as well as some of the EV players, EV fleet players are having a few challenges. And this year, we intend to address that in terms of catering to a wider EV portfolio than what was there last year. So that is going to be an important aspect of fixing the bleeders first. Then in terms of the portfolio itself, we are the widest range portfolio in the market with Tiago at one end, and when the Harrier EV launches, that is the other end of it. And then we have a Sierra that's coming in as well. So this kind of a wide portfolio with multiple range offerings makes us cater to different customer segments well. And that is what we intend to leverage as we go forward.
Okay. All right. Now, JLR, you've met your target of making the company cash positive by the end of FY25. How do you expect to perform on this parameter in FY26 and 27? Given the company's capex plans?
Yeah. There are two metrics that were critical to deliver last year. One was actually three. One was delivering the revenue of about 29 billion, which we have done. Second was to deliver 8.5% EBIT, and we delivered that 8.513%. That is what the final number was, the third decimal point. And third is to ensure that we go net cash. I think all these targets, if you go back in Q2, when there was the aluminum issue that we faced, there was a lot of skepticism on whether we can pull it off. And here we are after 6 months confirming, yes, we have indeed delivered that. So one thing which you want to ensure in anything that we do is the say-do ratio has to be of a very high order. And from our perspective, what we are seeing now is in this kind of external environment that we are currently facing, which is a bit unclear. Because one is, of course, it's challenging. The other is also we are not clear what exactly how it plays out. Take the UK-US tariff, for instance. We welcome really the deal that has been done, which is now reducing tariffs from 25% to 10%. But it has gone up from 2.5 to 10, number one. Number two, even that reduction, we are not clear when does it become effective? Is it applicable for parts? Is it applicable retrospectively? So those are questions that are still out there, and we are hopeful to get clarity on that. Once we get clarity on that, it's our ability, then we'll be in a position to be in a better position to predict what the numbers are going to be. Having said that, what we are distilling out of this situation is that there could be two impacts. One is your demand is likely to be impacted, particularly in the US, for which we need alternate sources of demand, number one. Number two, the tariffs are going to have a significant impact on your costs, and therefore, how are you going to ensure you manage the cost in that environment? So if I look at the first one, that is demand, what we have going in with is US is probably likely to be having a lower growth next year compared to what we had last year. And therefore, we need additional sources of growth. The first market that is looking very good for us is UK, and we would intend to accelerate that. Second is Europe is always a very large market and a market that we are doing well, and it's a market that is starting to stir up, and therefore we would want to leverage that. China, which had been bleeding, is now, I think, is now stabilizing, at least for us, and therefore we would want to see how much we can build back on that front. And there's an overseas market that is doing very well for us, which is Middle East, India, etc. And there again, we should want to diversify our.
Okay, that is Tata Motors. Demand sentiment for JLR remains unclear and challenging in the current environment. Demand is likely to be impacted in the US. So even as the tariff uncertainty, peak tariff uncertainty may be behind us, currently the outlook is still a bit uncertain, and Tata Motors share price is down 1.5%. But Bharti Airtel stock is only up about 0.5%. At the day's high, it was up about 2.5%. It's come off. The conference call is currently underway, so let's quickly cut across.
Our digital portfolio with cloud, which we've launched just now, cybersecurity, financial services, IoT, and CPaaS, and all of these are getting additional investments. Airtel Finance is growing fast, and our new partnership with Bajaj Finance will further bolster our portfolio. On the payments bank, our monthly transacting users now stood at just under 100 million. They're at 96 million, growing 10% sequentially. The annualized revenue run rate stands at 2,900 crores, which has grown by 35% year on year. Deposits remain strong at over 3,600 crores, growing 30% year on year. A quick update on Africa. The underlying constant currency revenue growth was strong at 3.5% sequentially. With stabilization in the Naira, reported revenue growth came in at 6.3% sequentially. EBITDA was 4,085 crores with a margin of 35.9%. The balance sheet for Airtel Africa remains solid with net debt to EBITDA of 0.9. Let me now comment on each of our areas of focus. We continue to build a diversified and resilient portfolio. The underlying performance across the portfolio remains strong. Africa now accounts for 24% of revenues. India Mobile is at 56%, and India Non-Mobile and Indus is at 14 and 7% respectively. Our investments are directed towards future-proofing Airtel and reshaping our portfolio to drive growth across segments. The second area of focus is to win quality customers. Let me start with broadband. We see strong tailwinds led by growing penetration for smart TVs and changing content consumption habits. We estimate the industry base to grow from 80 to up to 80 to 90 million homes from the current level of 46 million. To capitalize on this growing opportunity, we are focusing on three areas. First, we're expanding our market presence with continued rollout of fiber home passes and offering fixed wireless access in newer PIN codes where we've not been able to get fiber in. Over the past 3 years, we've extended our fiber network across 629 cities and are deepening our coverage to accelerate share gain. We're adding over 1.7 million fiber home passes per quarter with a plan to increase this further. Second, we continuously enhance the value we deliver by offering compelling content bundles and driving convergence. As I mentioned, we've strengthened our broadband offer through exclusive partnership with Apple TV and Apple Music. This, combined with Extreme's 22 OTT apps that we've aggregated into the platform, gives us a competitive edge. The third area of focus is channel expansion. As I mentioned last quarter, this was a top priority for us. Today, I would say all our channels now sell all our services, and this is continuing to accelerate our growth. This integrated approach will help us expand our footprint and drive momentum in the broadband segment. Let me now turn to mobile. As I mentioned earlier, India mobile tariff continues to remain one of the lowest globally and needs further repair. We've also said that the current telecom tariff structure in India is broken, with a one-size-fits-all pricing model, which is not appropriate for upgradation, nor is it in line with any other market. Restructuring the tariff architecture is essential to improve financial health of the industry and sustain future investments. This could simply mean reducing data allowances on some of the packs and charging more for those who can afford to pay. The other area of focus on mobile continues to be postpaid. Smartphone upgrades is a second area of focus, and driving penetration of international roaming is a third area of focus. While our rural rollout has driven our market share gain trajectory, we still have an opportunity, I believe, to sweat all our assets. We do not believe that the rollout in coming year will be accelerated. This rollout will substantially lower as we've completed our footprint today.
All right, we'll cut back to the management as and when they say something more market moving. But for the time being, just keep your eye at the bottom of your screen. By the way, when we cut across to hear out what Tata Motors had to say, as well as what Bharat Airtel have to say, take a look at what happened to the markets. The Nifty is now up close to around 80 points. And I'll tell you what, the Nifty Bank has gone ahead. If you can plot the Nifty Bank and pull up a 20 DMA, you'll see that it went to the 20 DMA and from there it's seen a bit of a bounce. So for the day, the Nifty at least has defended that 54,500 odd mark, which is approximately where the 20 DMA comes in at. And, after going down close to around, I think, 350 points, we've seen a quick 100-point bounce out there. A few stocks actually that are doing well. Tata Motors has cut its losses. Management commentary out there could have had some impact. So the stock is now down 1.3%. It was down more than 2%. And you have Bharat Airtel as well. That's perked up a little bit. Nagraj Sethi joins us on the show. Hi, Nagraj. Well, it appears like a market that doesn't want to go down. You're seeing buying coming in at lower levels. What kind of a stop loss would you have if you had a long position? And at current juncture, what would your fresh trade be?
Hi, good afternoon, Nigel. Nifty has been finding support around 24,500, 400 levels. I think anyone is having a long position at the lower levels, you can place a stop loss around 24,450 odd levels. And I'm not expecting any bigger decline from here onwards. Market is likely to test the supports and could bounce back from the lower levels. In the last 10-15 minutes, we have seen some surge from the lower levels. I'm expecting to bounce back to take place in the from next 1 or 2 sessions. And in the next 1 week, I'm expecting Nifty to reach the recent high of around 24,970 odd levels.
Okay, all right. So you're maintaining a bullish bias out there. What about individual stocks? What are the ideas you have for us?
Yeah, rightly. I have 2 stocks. One is HEG. Chartically, if you look at HEG, after a long consolidation moment, dip, it has bounced back sharply recently in the last 2-3 sessions and witnessed a decisive upside breakout in today's session above the trendline hurdle. Currently trading around 488, 489 levels. One can look to buy at this point of time. And immediate target would be around 530, and one can place a stop loss at 470, 75 levels. Second one is from the IT front, Mphasis. Mphasis was moving in a larger consolidation phase over the last few months, and it has repeatedly tested to move above the 2550, 2560 levels. Today, it has started to break above the hurdle. The overall chart pattern is looking positive. Currently trading around 2572. One can look to buy at this point of time. 2770 is going to be the upside target in the next couple of weeks, and one can place a stop loss at 2450.
Okay. Nagraj, thank you very much for that. Let's also bring in Prakash Devan into the conversation. Prakash, good afternoon. Great to have you on as always. Let's start with Tata Motors, right? We were just listening to the management and everything is fine. It's just, I think the market's also worried about demand for JLR, particularly in the markets like US. What's your sense on the stock? They've met the targets that they laid out, whether it was the margin guidance or the cash break-even. So they've done well. What about the stock?
Good afternoon, Subi. So, no, I think it was a very balanced
what do you call it, explanation of sorts. Um, Most of the stuff that got covered, which would have been areas of concern. But they also, the management also mentioned that the US piece is still very challenging. The environment, the demand environment, it's uncertain, and especially things around the tariff. Because remember, most of these premium cars do not have the luxury of the cars are luxury, but the margins are not luxury. So that's where things are. And if there's any tweak in tariffs which is not very favorable, it would need much more revenue to kind of make up for the profitability that they are seeking to do. But what's interesting is, he mentioned about the slew of launches that they have. If Tata Motors were to make some sort of a comeback on, certain segments of its portfolio, the SUV portfolio, for instance, or the EV portfolio, and they are electrifying a lot of the existing popular brands like the Harrier and all, that could probably get them some very good traction. Of course, we know Mahindra is also trying to do that. Maruti's thrown its hat in the ring, but that's the space that could grow faster because of adoption metrics. But on the stock, what do you do? I think the stock's probably going to rest here for a while till some of these things get clear. But it starts delivering start building up a lot of value at this level of 700 odd, because you're not overpaying for anything here. Everything is being discounted to the extent that there's caution on balance sheet, there's caution on market share, growth, margins, everything. So my sense is you'll probably see it move only when there's a little bit of that FI interest that comes back. I don't think Indian institutional or non-institutional investors are going to be very keen on buying into the stock at this point. So when the FI inflows start increasing, that's the time to probably see some move on this. But offers great value for sure, but no sparks at the same time, as I mentioned earlier.
Okay, all right. Well, we have Shree Cement's numbers that are flashing at the bottom of your screen, and the top line itself, it appears like it's a big beat out there. And remember, Shree Cement, they have exposure to North as well as East India, and out there pricing actually was much better than the remainder of the country. So it appears that the top line beat actually has percolated further down. We're waiting for that EBITDA number that should come up for you on the screen. But you're expecting a fairly decent performance. I think we're working with around 1,298 crores in terms of an EBITDA number. And margins were in the vicinity of around 26%. That's our expectations. Let's see what they delivered. Prakash, Shree Cement, yeah, there we have the number up for you. It's a beat. It's a beat. It's coming at around 1,381 crores. That compares with around 1,298 crores. So the absolute EBITDA number is better. The top line was better. It had a few things going for it. Q3 was a washout. Q4 looked much better. Volumes have come back. Realizations they gained because they have exposure to North as well as East India. And as we know, the benefit of lower input cost would have played out as well. Explains why the stock is up 2.2%. Prakash, want to come in out here on Shree Cement? Mr. Bangur was the one that the market was betting on big. And suddenly the stock seems to have lost, its momentum. It lost investor interest as well, as a lot of investors flocked towards the Adani twins as well as Ultratech. Now with the numbers coming back, it appears Mr. Bangur as well has got the right team in place and clean balance sheet. Do you think Shree Cement can get its old mojo back?
Oh, absolutely, right. Absolutely. I think if you really see in the top 3-4 names within the cement pack, which would probably lead the entire revival of the sector, the re-rating that's kind of imminent. We had December end was bad. This quarter probably was a repair quarter. And these numbers that you see are part of a repair. Okay? It's not something where there's any growth, significant growth that was likely to make a big difference. But here on, and the key out there, why would one expect Shree Cement to start doing very well from here on is their capacity expansion has been done at one of the most efficient prices. Okay, they've done it organically wherever possible using internal accruals, and they're known for that. So my sense is when the industry expands and price, hikes start coming in, volumes start picking up, they will have operating leverage that will start kind of playing out. So I'm quite positive on this. In fact, if you really ask me, between ACC and Shree, it will end up taking the lion's share of any allocations that come into the sector as we go forward. And remember, good quarters are yet to come for them. So definitely very positive. These numbers, as you rightly said, could probably give the confidence. There's nothing to complain even at these levels, which are fairly decent in terms of where it traditionally trades. Historically, it's always been trading at higher P multiples as well.
Okay, all right. Got that. That's Shree Cement. Thank you very much, Prakash. Slightly shorter chat today, very heavy on earnings, so, a little shorter, but thanks very much for joining in. We do have to take a very quick break on that note. Come back on the other side. We'll have Vaibhav Sanghvi join in with some market perspective. And specifically, we'll ask him about this big defense rally. Last 2-3 days, we've seen consistent gains on defense stocks. So, what's the setup? We will discuss with Vaibhav in a bit. Welcome back. Well, as promised, let's straight away go across to Vaibhav Sanghvi. He's joining in, CEO of ASK Hedge Solutions. Vaibhav, great to have you with us. I mean, never a dull moment in the markets, right? And just so much going on, from trade to geopolitics to a full-fledged war we had almost at our hand, right? So what's the sense? I mean, the market got the twin bonanza, the great news of at least, an end to hostilities right now between India and Pakistan. Then we had the news on the China deal, China-US. So there was a quick reaction. But the worry that I had, and that's what I wanted to ask you, I was discussing this at the start of the show, is that tactically, it seems there's a shift towards China, right? We don't know how long it lasts or not, but it's very evident in the way the markets have been reacting last 2-3 days. Is this potentially a risk in terms of flows and the large cap performance for India in the near term?
Absolutely right, Sylvia. I think because of the announcement of a 90-day period for the trade deal to be negotiated, in my sense, I think there is some amount of preference or some amount of reshuffling happening towards China. Doesn't mean that it is completely going from India, but on an overall basis, what do I think is basically that if the overall flow is coming to China or probably emerging markets as a basket, then India would be a beneficiary of that flow in any case. Of course, if it's not coming to an emerging market basket, then probably there is some amount of reshuffle towards China. But in my view, I think as things have steadied and as things appear to be on the constructive path, my sense is basically that emerging market flow on an overall basis, will start increasing. And there is a correlation that, whenever China sees a good amount of interest in terms of the flows, doesn't necessarily mean that it is coming from the other emerging markets, but it is actually coming towards a whole basket, wherein India tends to be benefited.
Okay, so perhaps we need to see how the flow situation plays out. But otherwise, Vaibhav, let's leave that aside. I mean, that's a flow situation, tactical. We'll see what it brings. Otherwise, how do you rate the earnings season? And now that like I said, we've had the two good news pieces. Markets bounced back very smartly. We're some 4.5%, 5% away from the all-time highs. How do you see the next 6 months?
No, of course, the macro events, which were headwinds, from a market perspective, are now behind. One, of course, the tariffs, and the two is the geopolitics. And it is a situation where markets will start looking at earnings, valuations closely. Having said that, this earnings season, barring one or two sectors, I think the earnings have been pretty decent and a little marginally higher than the expected kind of run rates. What do we also expect is basically going through the year, that a combination approach of combined effort, both from the fiscal side in terms of tax rebates, which we have already seen, and two, from a loose monetary policy in terms of liquidity being better, rates decreased, and risk weights kind of taken off from the unsecured piece in some segments. My sense is basically, I think we will see revival or probably GDP growth surprising, on the higher side as against your, street expectations, which is where we do think that in the second half of this year, we may see some amount of revival of earnings also starting to happen.
Okay, all right. Hi, Vaibhav. I want to ask you about the defense space, because from everyone quizzing about how expensive these stocks are, now everyone is asking, what's your allocation to the defense stocks? I'm going to come and ask you that question itself. For the time being, though, let's hop across to my colleague Ria, who's here to tell us about Garden Reach Shipbuilders as well as HAL. Both of them are buzzing post their numbers. Ria?
Well, yes, defense and shipbuilding stocks have been in focus yet again today, and let's talk about the three big movers. The first one is Garden Reach Shipbuilders, which reported quite a healthy set of numbers yesterday. The revenue saw an increase of around 62% on a year-on-year basis. Even the EBITDA and net profit jumped up by 144% and 119% respectively, both on a year-on-year basis. EBITDA margins also saw an expansion of 454 basis points, coming in at 13.5% in this quarter versus just about 8.9% that we saw in Q4 of last year. For the full year FY25 as well, we've seen good growth on all fronts. The net profit margin was also above the company's guidance of over 8%. The order book details haven't been disclosed yet, but the company did say in their Q3 earnings call that they expect the order book to come down to about 22,000 odd crores as execution is picking up, and the order book at the end of Q3 stood at about rupees 23,877 crores. Some key things to watch out for GRSE going ahead will be the management's comments on order book and execution, and also an update on the delivery of one of their key projects, which is the 8 ASW shallow watercrafts, all of which are expected to be delivered by October 2026. And remember, the first ship was delivered by the company to the Indian Navy just last week. The stock is trading with gains, very strong gains of around 17 to 18% today, but still down about 20% off its 52-week high. Cochin Shipyard is also trading with gains of up to 13% today in a rub-off effect from GRSE, and this company is also expected to come out with a good set of numbers tomorrow, so we will be watching out for that. HAL is the third stock that we'll be talking about, up around 3 to 4% after reporting a good set of numbers today. The revenue did go down by around 7.2% on a year-on-year basis, but this was off a high base. The net profit and EBITDA also declined by around 10% and 7.8%, but they were significantly higher than our estimates. EBITDA margins came in at 38.6%, down about 129 basis points on a year-on-year basis, but still well above our expectations of 27.6% margins. Order book details again haven't been disclosed for HAL, but they do have an FY26 order book target of about rupees 2.6 lakh crores. Some key things to watch out for in the earnings call on Friday will be the management's comments on the LCA Mark 1A delivery timelines and further engine deliveries from General Electric, improvement in working capital execution schedule of ALH, and of course the management's comments on the order book and execution ahead.
Hey, thanks a lot for that, Ria. Vaibhav, that's the question. What's the allocation to defense? What this recent skirmish has showed is that this equipment is battle ready. India is focusing more on indigenizing the defense equipment here in India. And as our defense minister said, that the exports of defense equipment from India to the globe can reach 50,000 crores by 2030. How interested are you in this space?
I think I am hugely excited about it. And, I think what India has shown to the world, and with some sense of pride also, I can say that I think it is, what India has achieved in terms of defense production, in terms of technology, I think it's just outstanding. What we've seen is probably an inflection point for the defense exports likely to happen from India. In my view, I think the order books are likely to balloon. And what better way in terms of showing the product performance in that sense of what we've seen in the last week. So in my view, I think it's a much of a very long-term story here now. I'm not talking about a shorter-term perspective, but the order books, in my view, are likely to swell or balloon pretty quickly going forward.
Okay, so I mean, you still see some value given the fact that there's growth ahead in defense. That's right, Vaibhav?
Of course, because here it is very difficult to put a PE valuation matrix here. in the light that when your order books are going to exponentially rise or likely to exponentially rise from various other countries, my sense is this opportunity will be captured by our public companies which are doing some excellent work.
Sure. Okay, so that's one clear theme. Defense, you think, still has some more legs to run. What else, Weber? Because this market doesn't have too many growth ideas, right? Clear growth ideas. Large sectors are still struggling in single digits or mid-single digits. What else are you liking?
So I think one difference which I did mention earlier is basically one of the bigger headwinds, from the global perspective, which is your tariff-related stuff, I think has kind of eased off. And any incremental news regarding that is not kind of having an impact on the margins or impact, on the sentiment of the markets. What we do see is because of this, the overall worry, of IT discretionary spend, which are likely to kind of get suppressed because people didn't understand, how the situation is likely to pan out. I think now it is very, very clear that deal will be done, whether it is a matter of 1 month, 3 months, or 6 months. So all in all, I think the confidence of the companies to do business, to expand, to spend on IT is likely to come back. In the wake that, I think IT as a sector, we've seen good correction in terms of the valuations. My sense is basically, I think we should be looking at as a good opportunity from here onwards to kind of invest in. Lastly, I think because of the rate movements, likely rate movements, there can be a shorter term pressure on the banks in just for the sake of worries in terms of the rate kind of gets reduced, then probably there can be some amount of margin pressures on the NIMs. So we'll wait for the bank rate cut to happen to probably get into the frontline private banks post thereon.
Okay. All right, Weber, I've got that. Good perspective. Thank you very much for joining in today. And we look forward to the next call soon. Thanks for joining in. Well, with that, we'll take a quick break. Let's quickly have a look at the market. The market, mid-cap's absolutely rock steady. No problems there. Nifty is actually trying to find some mojo back. 82 points higher on the Nifty. That's the mid-cap index. It's always been steady. There you see the Nifty is trying to sort of pull back from the day's lows. Let's take a break, come back, and we will get you a check on the dealing room chatter today. Nimesh will join in. And then, of course, some final trading calls as well.
Welcome back. Well, the markets are still holding with good gains. By the way, we have a cabinet meet outcome out there. The cabinet has approved HCL Foxconn JV for the semicon plant. So I think we'll wait by. I think Ashmit is bringing us this information. It's the HCL group, keep in mind, not HCL Tech, which is the listed entity. So I think that as well should come up as an alert. We'll get back to that. For the time being, let's hop across to Nimesh. He's here to tell us what he's picking up in D Street Chatter. Nimesh.
Hi, Nigel. While the Nifty has been consolidating, it's the second day running or the third day running, the broader markets are relatively outperforming. So again, a day when a lot of individual broader market stocks are buzzing in trade and the volumes have also picked up from retail and HNI categories. So that's the space which is really doing good today. From a sector perspective, it's the defense which has done well for the second day running, and add to it, the metals have also done well. But within the defense names, it's the defense PSUs and overall PSUs which are well bid by larger institutions. So, this rally in the PSU stocks is backed by some bit of institutional buying as well, is what I understand. Overall, the flow seems to be quite mixed today. I understand there is going to be a small marketed close basket selling at a leading FID. So maybe you'll see some pressure on some Nifty names in the last 30 minutes of trade. But barring that, largely it's the broader markets which has seen the momentum, and clearly looks like it's backed by institutional buying, as well as some bit of interest is back from larger HNIs and retail investors as well.
Okay, all right, Nimesh, got that. What about individual stocks? What are you picking up?
Well, Nigel, so I'll continue with the theme of large blocks. So a couple of mid-cap names where I'm expecting large blocks very soon. One is Kirloskar Ferrous, and the other one is Segality. In both the names, I'm expecting large block deals very soon. So watch out for those. Second, couple of PSU names where there is a bit of buying interest, which is BHEL and NBCC. Both are actually buzzing in trade today. The volumes have also picked up, and I understand a leading domestic mutual fund has done fresh, buying or fresh additions into both these names in one of the small cap schemes. So that's the reason why those stocks are buzzing in trade. The third stock is BEL. I spoke about defense as a theme doing good. BEL stands out in terms of very aggressive buying from larger institutions as well as some larger family offices as well. So expect high delivery volumes on the buy side in BEL today. And the last name is Birlasoft. While post earnings, it's been a bit of a weak stock, has been consolidating of late. But even in Birlasoft, for the last couple of days, I understand some domestic mutual funds are accumulating at lower levels. And also in Birlasoft, there is a strong buzz of some corporate development as well. So that's the reason why it looks like some bit of domestic interest is back in Birlasoft.
Okay, all right, Nimesh got that. So watching out for all of these stocks that are buzzing around on different pieces of news. Thanks for joining in today. Well, with that, let's quickly go back to Nagaraj Shetty, get some final trading ideas. Nagaraj, so what do you think? What's the final advice on the index positions and also any final stocks?
Yeah, index, I'm remaining bullish. Market is showing some strength at the supports, and I think more upside is likely to come in the short term, at least in the next 2 to 3 days. And the stocks, I think I have discussed the stocks. Right now, I have one more from the railway front, IRCON. If you look at the chartically, IRCON has been in a consolidation phase over the last couple of months, and today witnessed a decisive upside breakout of the range, currently moving out of the range. The overall chart pattern is looking positive. I think this upside momentum is likely to continue for some more period, and currently trading around 172. I'm expecting this to move up further. 188 is going to be the next hurdle, which is near to the 200-day EMA in the at least 1 to 2 weeks.
Okay, got it. All right, Nagaraj, thanks a lot for that. By the way, let's focus on a couple of other stocks on the broader markets. Apar Industries, I recall that stock saw a sharp downtick here in the last couple of quarters. But these quarters' numbers actually look good. I'm looking at Aquarius note, and they're saying that the EBITDA number actually beat their estimates by close to around 20%. The EBITDA number itself has come up by close to around 29% on a year-on-year basis. And on the revenue front, it's just 3% ahead. So bulk of the beat has come in because of the EBITDA margin beat. And that's why that stock, I think, is fairly excited. But let's talk about Tata Steel. Tisco's done the disco today. Remember yesterday, actually, to be fair, We are at CNBC TV18 had put out various alerts that these numbers actually were quite good. And the management as well, in their commentary to me, they were very, very positive. So 3 big points they made when they spoke to CNBC TV18. One was on pricing. Indian prices are up by 3,000 rupees per ton on a sequential basis. Even European prices actually were looking up by around 22 to around 30 euros per ton. So that was on pricing. Coking coal cost, the cost of consumption per ton, that's likely to fall down by close to $10 per ton. So higher prices and you'll have lower input costs. That's obviously going to help the margin aspect. On EBITDA, all eyes were on Europe. When do they see it turn around? They said in this quarter. That's quarter 1 FY26. Some were expecting the Europe to turn around in quarter 2 or quarter 3. But they are saying from the first quarter itself. And the UK business, which is a so part of Europe, well, they are saying that will turn around in the next few quarters. Nuvama, they've gone ahead. They've upgraded the stock. They have a target price of around 177. The EBITDA estimates they're upping out there for FY27 because of higher profitability at Europe and lower fixed cost. Also, Nuvama goes on to say that in quarter 1 FY26, they are expecting the EBITDA per ton to improve by 2,000 rupees per ton. So good going for Tata Steel. Yesterday, the commentary was positive, but the markets were a bit of a risk of was playing out. Today, metals are doing well and Tata Steel is participating, one of the top gainers on the Nifty today. Survey.
Absolutely, Tata Steel doing extremely well, in today's trading action. The other group company, that's Tata Steel, Tata Motors is something that we've been discussing as well. Like we've been mentioning, the fourth quarter performance kind of hit the mark on most notes, but I think it's the commentary about the future, what's happening with global tariffs, and one of JLR's big markets, the US. That is something that's been weighing on the stock. Sudarshan is joining in. Sudarshan, I think you must have also heard a bit of the commentary that Parikshit got from the management. So what's the takeaway? Q4 and looking into this year, what do you make of Tata Motors?
Tata Motors yesterday post-market had reported earnings for Q4 FY25 and those earnings were largely better than estimates. But why the stock is under pressure, it's down almost 2% currently. It's on the back of the cautious outlook. Company is saying that in China, things are not that great, while the situation has improved a bit in UK and Europe. But the problem related to the tariffs are going to be an overhang. And the company is saying that product exports that would be done from UK plant, for that tariff is increased by 300% to 10% from 2.5%, and exports to be done from EU plant, for that tariff would be increased to tariff would be increased by 3,000%. So those will remain an overhang. Now, after that, majority of the brokerages have turned negative. But first, I'll start with the brokerage which is positive. That is CLSA. It maintains outperform call and target is 805. It says Q4 earnings have met estimates, but JLR is cautious in demand in FY26. But company is confident in delivering EBIT margin for FY26. Jefferies maintains underperform call, target is 630. It says Q4 EBITDA was down 2% year-on-year, but 4% higher than the estimates. But it believes that JLR may have a tough FY26 on tariffs, increasing costs and increasing competition in China. It has cut FY26-27 EBITDA estimates by 8%, but has raised EPS estimates by 3 to 4%. Nomura has downgraded the stock to reduce and target is 799. And Kotak Institutional Equities has downgraded the stock to reduce and target is 600. So earnings were above estimates, but on the back of cautious outlook, stock is under pressure.
Okay, all right, got that. Sudarshan, thanks very much for that. Let's move on now. REC has been under pressure after cutting its guidance. The AUM growth guidance now stands at 11 to 13% versus 15 to 17% earlier. Vinny is here with more details. Vinny, you were listening to the conference call. So why has REC sounded this very cautious, subdued note now?
Absolutely. So this guidance cut is mainly coming in because of the repayments that have happened, and that is much higher than what was anticipated. So yes, that is the main concern coming in. So in Q4 also, that was the main impact. Now because of this, AUM guidance has been cut to 11 to 13%. Previously, the guidance was around 15% is what they had spoken about. Until Q3, they were very confident that in Q4 also they would be able to achieve this. But yes, there's a change in stance that has come in for FY26. But other than that, they're expecting the loan book target that they have for around 10 lakh crore crore rupees by 2030. That stays as it is. They're targeting a 12% annual loan book growth. Their NIMs they're expecting in the range of around 3.5 to 3.75%, and that will mainly be supported by infrastructure lending. That is expected to contribute to the NIMs as well as the spreads going forward, and especially in FY26. Regulatory environment, they highlighted that it was quite stable during this quarter and not much of a concern on that front going forward as well. They're targeting a net zero NPA status by FY26, and generation projects that has yielded around 10 to 11.5%, and that is expected to support the margin sustainability going forward for the company. So these are the overall key highlights, but we're seeing the stock falling in trade today mainly because of that cut in AUM guidance.
Okay, all right, Vinny, but it's your day. The spotlight's on you. We can't let you go just at the RAC guidance cut. You've got a few more stocks that you're tracking. Good going, girl. Tell us more.
So yes, keeping an eye on a few more stocks. Couple of pharma names that we have today. Sai Life Sciences, that's the one in focus today. Good set of numbers that came in from the company. Revenue up 32%. Margins, yes, a bit of a compression and contraction on that front. 27.2% versus last year 28.4%. But when we spoke to the management today, they did highlight that they are aiming for a 15 to 20% annual growth over the next couple of years, as well as in terms of the margins, they're expecting that to be in the range of 24 to 30%. So we could see an improvement further in terms of margins going forward in the next 3 to 5 years. So Sai Life is something that is buzzing in trade. Now Metropolis Health on the other side has seen a weak set of numbers that's come in. We're seeing an impact coming in because they made a lot of acquisitions this time, and because of that we're seeing an impact coming in on the numbers of the company. So margins are contraction because of that. This time what we saw was Core Diagnostics didn't support in terms of margins. That is the newest and the latest acquisition coming in from the company. Profits of the company were down by 20% as well, and they've seen lower than usual revenue in the month of Feb in their focus market, which is also leading to lower revenues than what one was expecting, and that is why an impact in terms of the overall performance of the company. Lastly, Syrma SGS also is in focus. Now this is a good growth that one has seen in the company, especially in terms of the margin, which came in as a surprise, 11.6% versus 6.5%. Even the estimate was around 7.9%. Other than that, they spoke about growth in FY26, 30 to 35% growth. Product mix is something that will be driving the growth. EBITDA margin 8% guidance is what they've given on a conservative basis. So we could see furthermore higher margins on that front as well. And they're sticking to the 1,000 crore export target by FY26. So that is why Syrma SGS also is a stock that is in focus today.
Okay, all right, got that. Thank you very much for that neat wrap. Quite helpful, Vinny. Thanks for joining in today. Let's discuss some of these trends in these stocks with Anand Tandon, who's joining us now. Anand, thanks for joining in. I want to start off by asking you about the EMS space. And we caught up with two companies, discussed numbers today with both PG Electro as well as Syrma. So the management still sound quite optimistic about their order book, about growing the business. They're putting more money to work. But the theme has also had a fantastic run till the market correction set in. What would your advice be on some of these companies, whether it's Amber, Dixon, or the others that I mentioned?
Mostly it depends on the kind of product one is making. If you're looking at very low margin products, there is a little bit of an issue because it depends mostly on the PLI. So for example, the mobile phones, they have not yet managed to scale up their product to a level where the margins become sustainable. And you'll see an operating margin of still around 4% or thereabouts, which if you assume that there is also a 6% PLI benefit from the government, means that you're not really making any money there. So the others are not so bad. They are actually doing quite well. Some of the other smaller players are perhaps even making double digit or even mid-teens or higher teens margin, which is obviously very good. The space is something that is expanding, and clearly it has potential to go more from here, because no matter what happens to the China kind of market, there is no question that people will want to diversify, and India, so long as it is able to support and expand the product portfolio, will do quite well. But as you said, I think that most of it is in the price and then some. Especially for those companies where the margins are low, there is always a problem that a small hiccup in one quarter can actually upset the entire apple cart in terms of the valuation. For the others, not so much. But again, the valuations are such that there is no scope of a lack of execution. So, anyone holding on to it, especially the higher margin product companies, would do well to stay invested. But keep an eye out for any kind of slowdown in terms of the execution capability, because you are betting for very large growth.
Okay, all right. Hi, Anand. Good afternoon. Good to see you, Ben. What about the pain stocks? The numbers yet again from the leader Asian Paints was disappointing. But the hope is that, say, in the second half of this fiscal, things improve. It's anyone's guess whether it will improve or not. But at least valuation-wise, it's more palatable. Good enough reason to buy into the stock, or you believe the competitive intensity as well is going to keep the lid on some of these valuations, on pricing as well, so you stay away from a stock like Asian Paints, which is the top Nifty loser today?
So you have to keep in mind that whenever management or analysts say that the second half will be better, which means 6 months down the road, what they are really saying, we haven't a clue. So the best way is to avoid it, right? Because when people are fighting for market share and for establishing themselves, they are not going to be satisfied, especially the new players who've come in with deep pockets and large relationships in the trade. From getting a marginal market share. You are expecting to see something like when Jio came in, the kind of tectonic shifts that happened in the telecom. I would expect that you would see similar kind of market share changes. So the incumbent is under threat, and you will, no matter what they do, they will have to fight to maintain their market share, and that will mean that they will have to erode on margins even further. If they don't do that, then their volumes will drop. So either which way, it's a no-win situation for the incumbent. It is best when fights like this happen that you stay away, and until and unless the market share is established, it is you shouldn't be looking to find winners in the space, because the people who are trying to get in the market are going to fight hard tooth and nail and not worry about the bottom line, and those who are incumbent are going to lose money to be able to keep their position where they are. Like I said, remember this. It's something that I've learned over years of experience. Anyone saying next half is good means he doesn't know what he's talking about.
All right, and we've seen a fair bit of that over the last many quarters in the market. Anand, stay on. We'll come back and have some more questions for you in just a bit. But right now, a break. Back with the market close in a while.
Welcome back. Well, before we wind down on markets, let's throw a question to Anand Tandem. Anand, I wanted to ask you about Coal India. Any view on that one? Because that's a stock actually normally people like to hide in. There is dividend yield. Valuation is not very, very expensive. And they have a good amount of cash in their books. Good enough reason to buy it. It's corrected a fair deal from the top. Or would you stay away?
No, as you said, it is actually a high dividend yield stock, and there is no doubt that it will continue to generate the kind of cash flow that it does. It is not a very favored stock from an institutional investor point of view, especially those who are worried about ESG, etc. Because obviously there are problems in terms of using coal for the environment, and at some stage, while that has taken a backseat in the current environment, it will come back at some stage later. But given the fact that we are continuing to push thermal energy, and that is going to remain a mainstay for India's power, we will continue to need coal. So both in terms of volume growth potential as well as cash flow generation, I don't see that there is any sustainable problem. It's just that their inability to expand quickly has always been a problem for them, and that continues. So while they do make incremental increases in top line, it is still that it is incremental and not dramatic, which is something one could have easily achieved if it had been private sector player. But on the other hand, like you said, it's probably reflected in the price.
By the way, today has actually turned out to be a really good day for PSUs overall and across market capitalization. Coal India would be one example, but look at others. Railtel, Aircon, as we are closing, Railtel is up 9%, Aircon is up 8%. The SAIL, Nalco, of course, that's the entire sort of metal story that's been quite strong. But even otherwise, lots of these names, RVNL, IRFC, a lot of railway names doing quite well.
There are many stocks actually, Surbhi, from the broader market. Just to pull up a few, JG Chemicals, pull up this stock. That's, some of these stocks have seen a sharp correction, but they're the top volume mover. So that's why I'm just pulling them up. So JG Chemicals, Reliance Infra, the stock from 350, it came down to around 200 rupees. Now it's in the last, I think, 2 weeks or so, it's bounced up close to on 20%. Supreme Petro, another stock that's seen a fair correction. Last Friday, there was big volume out there. And today as well, the stock has spiked up. And I think Prakash Devan had spoken about this other defense name, DCX.
Systems.
Just take a look at it. From 280, I think he spoke about it on Friday. Today it's at around 330. But you need to keep in mind, the stock was at 400 rupees earlier. So even after such a big pullback, still, in fact, they're a far cry away from the highs that we saw earlier. 8% in today's trading session. Massive volumes is what we have seen out there. I think let's wind down on markets, and then we'll get to talking about stocks on markets forward. Well, for the time being, the markets go home with a century. The Nifty goes home with 100 points. But remember, during the course of the session, we even went in the red. What did well in today's trading session? Metals. They were the guys that got whacked yesterday. There was a bit of risk off that played out. But now the globe seems to be in a better place. And the hope is that with US and China getting onto some kind of trade deal, at least the global recession is averted for the time being. Tata Steel's con calls details were good. With their, their commentary to CNBC-TV18 as well was fairly positive. So that one bounces up close to around 4%. Shriram Finance got smacked post its results, but that one as well has bounced back. It was up 3%. And BEL, one of those defense stocks from the Nifty pack, that did well in today's trading session. Coal India and Kotak Mahindra as well add to the winners list. On the flip side, Asian Paints, the stock was down close to 2%. Cipla as well, a day after its numbers, the stock was down 1.5%. And you had Tata Motors, there is that fear that yes, UK has struck a deal with the United States, but Europe still needs to strike a deal. Also, there are stranglehold on the EV market share here in India. That's fallen from around 65% to around 42%. So because of some kind of jitters with regard to the outlook, that stock is well under pressure. But winners, plenty from the broader markets. Garden Reach Shipbuilders, HBL Engineering, Railtel. Surbhi, take it away.
No, absolutely. It's a long list, right? Even a stock like MobiKwik, imagine that. 8% up, having such a good day. Dredging Corporation about 11% higher. And then a whole host of other, PSUs that we've been talking about. Cochin and Garden, of course. But even otherwise, a lot of the railway stocks have come back after a long time. Railtel, Aircon, IRFC, all of them seeing gains between 4% to as much as 10%. Big day out there. And of course, then the PSU metal names as well, like SAIL and Nalco, having a very good session. HBL Engineering, some more names, Titagarh Rail. So the railway pack, PSU as well as private, was very, very solid today. And let's not forget something like a Mishra Dhatu Nigam, 15% up on Mishra Dhatu, Midhani. Good day. Rallis India, as we've just heard the bell go off, 13% higher. So the broader market alive and kicking. Mid caps, slow and steady was the mood today. Well, with that, it's a wrap on this edition of Closing Bell. Many thanks for watching, but do stay tuned. Markets Forward comes up next.
The large street ends largely higher as buying continues in the broader markets. The Nifty and the Sensex gain closer around 1%, but the mid-caps outperform. The index ends up by more than 1%. Banks, though, underperform in trade.
Bharat Airtel delivers a strong India performance. Tata Steel gains after good guidance and a brokerage upgrade. But Tata Motors and REC fall after both firms cut their guidance.
But the broader markets outperform, courtesy some earning surprises. We had Garden Reach Shipbuilders, ITD Cementation, both of them delivered good set of numbers, while you had Dalmia Bharat Sugar, that is well reported, an inline set of numbers. But brokerages are positive on the stock. Well, hello and welcome to a fresh new edition of Markets Forward, your go-to show where we get you up to speed with regard to today's trading action and we set you up for tomorrow as well. I'm Nigel and joining me today is Vinny. Well, Vinny, it was a bit of a roller coaster ride, but at the end of it, well, we went on with some gains.
Absolutely went on with some gains. I thought that, maybe we would see a downside coming in, given in the afternoon we saw that fall and it did go in the red for a bit, at least the benchmark indices. But interesting day coming in, 24,600, above that mark.
Well, that's right. And in the next 20 minutes or so, we have got you covered. We'll get you all the big news, the key developments on the large street, and also we'll get you some top corporate voices and the events to track. But first up, let's tell you about what went on in today's trading session. Well, the Nifty ended in the green. The Nifty, in fact, scored a century. We were up by close to around 100 points or thereabouts. That doesn't take away from the fact that at one point of time, we almost dipped into the red. The Nifty Bank, that's normally the top batsman, right? It has the highest weightage on the Nifty, banks as well as financials. That was a relative underperformer. But if you pull up that intraday chart of the Nifty Bank, you'll see that it took support at around the 20 DMA. And from there, it did a bit of a fight back. So that's the reason why, in fact, the Nifty could manage to end with some green. The India VIX, it had gone dancing away all the way to around 22 odd. From there, it's seen a cooling off. And even in today's trading session, it ended lower. You want the VIX to be under control because that gives you a sense in terms of the bullish sentiment. VIX, remember, is the fear index. So that's cooling off. That's good. Mid-caps, well, that's where the party was. And yet again, yesterday as well as the previous trading session, mid-caps did well. And today as well, your portfolios will be feeling good because the breadth of the market was firmly in favor of a number of stocks that are advancing. And the sector of the day was the metal stocks. The globe is a better place to be in. You have commentary that's coming out of the United States as well as China. Temporary deal, trade deal. So it helps avert global recession, which in turn is good for metal stocks. And you had some softness on the dollar index as well. All of them bode well. Sector of the day, 2.5% up.
Absolutely. Other than Nifty Metal, also we had seen Nifty Real Estate and Realty. That was among the other sector gainers, as well as Nifty IT today was showing some bit of a strength as well, both managing to hold on to gains of more than 1%. So both these sectors were also among the top sectoral gainers. Other than that, defense, that continues to be the play, and all those defense stocks were buzzing, railway stocks were buzzing in trade as well. But, well, we'll take you through, and here's a lineup of what we have for you all in store in today's move in today's day. We start with the top movers and shakers for the day with Hormas, and stocks on our radar include Bharat Airtel. Following a steady Q4 performance, defense stocks took the spotlight in today's trade. We'll also bring you more on that and other top stories in just a bit. But last but not the least, we'll delve into what are the key market events to watch out for in tomorrow's trading session. So first up, let's go across to Hormas, who's waiting by to tell us from the big wall what are the top stock movers in today's trading session. Hormas.
Well, all's well that ends well, isn't it? After the roller coaster, we still ended in the green. But what ended very much in the green was the defense space. Higher yesterday, higher today has been the case over the last 8 to 10 trading sessions. Look at Garden Reach, 14.5% higher. And with Garden Reach's results, the expectations of its peers have also gone up, with Cochin Shipyard and Mazagon Dock, Zentech having another 5% upper circuit, and BEL2 among the top Nifty gainers in today's session. Some of the other movers in today's session included the newsmakers, which was HBL Engineering after the Kavach 4.0 approval that it received, 12.5% higher. ITD Cementation after the order win. And the next three names are the inclusions in the MSCI Small Cap Index: Autumn Investment, Acme Solar, and Sai Life, gains of up to 11%. And earnings reactions, HAL, the numbers year on year were lower but well better than estimates, so 3.5% higher on the stock. Rights too reacting to results, but negative earnings reactions coming in from Sirma and Metropolis, when REC cut cutting its AUM growth guidance for the year, and as a result, the stock ending lower. And lastly, it was the railway names that were doing well in today's session, as has been the case over this entire week. Railtel, Titagarh, Ircon, all of them seeing gains of anywhere between 4% to as high as 10%. Back to you guys.
Okay, all right. Thanks a lot for that, Hormuz. Well, let's get in our market experts. We have Anand Tandem as well as Shrikant Chavan of Kotak Securities who join us on the show. Hi, gentlemen. Thanks a lot for joining in. Shrikant, you go first. The Nifty Bank, today it gave that fear that maybe, in fact, it's going to be giving it away. But it took support at around the 20 DMA, and it did end only with a cut of around 100 points. What are the levels you're looking at both on the Nifty as well as on the Nifty Bank?
Good evening, Nigel, and good evening, everyone. Today, the most interesting part was that in the second half, when the market was down completely, it was around 23,500. We saw specific buying interest in Bank Nifty as well as in Nifty IT index. And both these indices actually helped the market to move higher by at least 100 points from the day's lowest level. So, also, if we go through with India's volatility index, then there also we saw sharp cut from the highs, and there also based on its formation we can say that the certainty is again returning back to the market. So based on all these facts and the overall formations, I am of the view that the markets are heading for again 24,800 or 850. I'm not expecting this market to cross the level of 25,000 so easily. We are expecting now market to consolidate within the broader range of 25,000 and 24,500 on the downside. We have, the market is having support of 10 days exponential moving average, 20 days simple moving average. So broadly, 24,500, 400 going to act as major support. And there we should look for taking some contraweights in the market. For the Bank Nifty, there also 55,500 is the hurdle to watch out for. Above that only we can see some more bullishness.
Okay, thanks so much for that, Shrikant, and those levels over there. So keep an eye on that. But let's move on and a bit more stock specific now. Bharat Airtel delivered a steady India performance and even stronger show in Africa. Analysts were quite upbeat on the stock as well. Rima is joining in with us here to give us more details on this front. Rima.
Thanks so much for that. So, Bharti Airtel is a big outperformer. The stock has gained 45% in the last 1 year. And in the last 3 years, the stock return stands at a whopping 170%. Now, the company seems to be delivering on all fronts. At least the Q4 numbers were solid. Consolidated numbers ahead of expectations. So one piece of the business is Africa, where in their key market, Nigeria, the company undertook tariff hikes. There were large tariff hikes. So some benefit came through in Q4, but even in the subsequent quarters, Africa numbers will look good. And then the other piece of the puzzle for them is the India mobile business, where again, the company continues to execute well. There were no tariff hikes. The tariff hikes in India took place in July. So there was not much benefit in Q4, but on account of premiumization, strong execution, the company's delivered a good performance. 1.3% revenue growth. For the full year, revenue growth was about 18%. EBITDA margins are now inching towards 59.2%. ARPUs have been strong at 245 rupees per share, higher than its peer Jio. Subscriber addition has been also very good, 5 million on a quarter-on-quarter basis. So in all fronts, the company has done well this time.
All right, Rima, thanks a lot for that. Well, let's focus on Tata Steel. That was one of the top gainers in today's trading session. Remember, we here at CNBC-TV18 had spoken to the management, and there were 3 big points that the management had made. One was in terms of pricing. They said that pricing here, both in India, was up by close to 3,000 rupees per ton on a sequential basis, and even European pricing was looking up. So that was point number 1. Point number 2 was on cost. The coking coal cost, they said that on a consumption basis, it'll fall by around $10 per ton, which is good news. And finally, on the EBITDA front, they said that in Europe, we'll have the EBITDA number moving into the green in the first quarter, and UK, which is the sore point in the European operations, well, that will gradually move back into the black as well. So that was the commentary. Brokerages like Nuvama, they went on their con call as well, and similar points were made out there. So they upgraded the stock to buy. They have raised the target price around 177. They've tweaked their earnings estimates for the next few years. FY27 EBITDA estimate by around 6%, factoring in better profitability and lower fixed cost as well. And for the first quarter of FY26, they're saying that the EBITDA per ton will increase by around 2,000 rupees. Higher steel prices, lower coal costs, that seems to be the big takeaway. Anand, your view on Tata Steel? The stock, remember, had gone to around 180. Then it cracked to around 130. It spent some time actually in this vicinity of around 130 to 150. With the positive commentary, you think it's good enough to take the stock higher?
Well, the commentary comes from the fact that, we have a lot of protection for steel companies in India, and the government continues to do that. So the latest salvo that they have fired is on the US, where they are again saying that, they will make it more difficult for importing steel from there. So far it was China, now it is other countries as well. Broadly, so long as there is protection, there will obviously be ability to build more money, and the volumes have been rising. So net, this is an industry which is well protected and therefore will continue to show growth.
Right. Shrikant, what's your view coming in also, both in terms of Tata Steel as well as Bharat Airtel? On the technicals, how are they looking like?
See, for Bharti Airtel, I can see, or I would say that the stock is finding a lot of, I'm to say, profit-taking sort of pressure close to 1900 levels, and it is rallied a lot to its extreme levels in the near term. So here I'm expecting stock to consolidate within the range of 1900 and 1800. So the upside looks limited. But for Tata Steel, after very long time, the stock has broken its important resistance level at 150. It is gradually moving upward, but today we saw substantial rally along with volumes. So based on the overall performance of this sector and in that Tata Steel, I'm of the view that the stock is heading for at least 165, 167 in the near term. So it looks good, and if there is any correction, we should look for taking long bets on Tata Steel.
Okay, can look to take long bets on Tata Steel. If you see a correction, keep an eye out on those levels also. But let's move on. Tata Motors fell nearly 2%, and this is despite a strong Q4 performance on account of a cautious commentary and outlook that came in amid the global uncertainties. Sudarshan is joining in with us to give us more details on this one. Sudarshan, over to you.
So Tata Motors was amongst top Nifty losers today, and it's despite company reporting earnings for Q4 FY25, and those earnings look better than expectations, but on the back of cautious outlook, you saw Tata Motors stock slipping almost 2%. And after the cautious outlook, most of the brokerages have turned negative. So we'll start with CLSA, which maintains the outperform call with a target of 805. It says company has reported Q4 earnings that met estimates, but JLR is cautious with respect to demand in FY26, but it believes that company will be able to meet FY26 margin guidance as far as JLR is concerned. Jefferies maintains underperform call and target here is 630. It says Q4 EBITDA was down 2% year-on-year, but 4% higher than expectations. Also, it believes that JLR may have tough FY26 on tariffs, increasing costs and rising competition in China. It has cut FY26-27 EBITDA estimates by 8%, but has raised EPS estimates in the range of 3 to 4%. Nomura has downgraded the stock to neutral and target is rupees 799. Kotak Institutional Equities has downgraded the stock to reduce and target is 600. Let's listen to what management had to say on Q4 earnings and the growth outlook.
Overall demand situation as far as India is concerned is, I would say, is modest, is decent, not scorching. At the same time, neither is there any major concern at this point in time. So I would expect modest growth coming into this year. On the commercial vehicle business, I think the underlying fundamentals of the growth is very much intact. On the passenger vehicle growth, I think we did have a lukewarm growth last year. Nothing much to talk about last year. And I would suspect that this year would be an year where it will be modest growth once again and gradually build back as the year progresses. In this kind of external environment that we are currently facing, which is a bit unclear, because one is, of course, it's challenging. The other is also we are not clear what exactly how it plays out. Take the UK-US tariff, for instance. We welcome really the deal that has been done, which is now reducing tariffs from 25% to 10%. But it has gone up from 2.5 to 10, number one. Number two, even that reduction, we are not clear when does it become effective? Is it applicable for parts? Is it applicable retrospectively? So those are questions that are still out there, and we are hopeful to get clarity on that. US is probably likely to be having a lower growth next year compared to what we had last year. And therefore, we need additional sources of growth. The first market that is looking very good for us is UK, and we would intend to accelerate that.
Okay, Anand, does this one excite you? Tata Motors, it was a 1,000 rupee stock. It's given a 30% correction. Exciting enough, or you'll skip this one?
Well, let's look at the good things first. The debt levels have come down, and therefore, to that extent, GLR is looking a little more able to handle the volatility that you're likely to witness in the market. But that pretty much is it. They are losing market share in India. They are not going to be able to do much in the US and UK. UK is not not a great growth market. China is not going to do anything. US is actually is going to be in trouble as far as Tata Motors is concerned. So I don't see much to be bullish about for the company as a whole.
Okay, all right. You're not too bullish about it. Shrikant, what about you on the charts? How's it looking? A stock after 35% correction. It took some support at lower levels. Do you think this is a dead cat bounce, or can it, take support and bounce up further?
See, like Nigel, this stock has spent a lot of time below 200 days simple moving average. And after hitting the extreme levels of 550, now again it is like crossing all its important levels. So I am of the view that it is into mean reverting trend, where we see most of the time retesting of 200 days simple moving average, which is currently at 800 levels. So based on technical formation, I am of the view that the stock is heading for at least 800, 825. There we should look for taking either profit, or we should look for reducing exposure. But at these levels, the overall formation is suggesting us that all this bad news is already priced in and stock is heading higher.
Okay. That's the view coming in on Tata Motors. But let's move on, talk about defense stocks, because they were rallying in trade today. This came in after we saw Garden Reach Shipbuilders as well as HAL. They beat their Q4 estimates. Ria is joining in with us to give us a roundup in terms of the numbers of both the companies.
Well, yes, defense and shipbuilding stocks have been in focus yet again today, and let's talk about the three big movers. The first one is Garden Reach Shipbuilders, which reported quite a healthy set of numbers yesterday. The revenue saw an increase of around 62% on a year-on-year basis. Even the EBITDA and net profit jumped up by 144% and 119% respectively, both on a year-on-year basis. EBITDA margins also saw an expansion of 454 basis points, coming in at 13.5% in this quarter versus just about 8.9% that we saw in Q4 of last year. For the full year FY25 as well, we've seen good growth on all fronts. The net profit margin was also above the company's guidance of over 8%. The order book details haven't been disclosed yet, but the company did say in their Q3 earnings call that they expect the order book to come down to about 22,000 odd crores as execution is picking up, and the order book at the end of Q3 stood at about rupees 23,877 crores. Some key things to watch out for GRSE going ahead will be the management's comments on order book and execution, and also an update on the delivery of one of their key projects, which is the 8 ASW shallow watercrafts, all of which are expected to be delivered by October 2026. And remember, the first ship was delivered by the company to the Indian Navy just last week. The stock is trading with gains, very strong gains of around 17 to 18% today, but still down about 20% off its 52-week high. Cochin Shipyard is also trading with gains of up to 13% today in a rub-off effect from GRSE, and this company is also expected to come out with a good set of numbers tomorrow, so we will be watching out for that. HAL is the third stock that we'll be talking about, up around 3 to 4% after reporting a good set of numbers today. The revenue did go down by around 7.2% on a year-on-year basis, but this was off a high base. The net profit and EBITDA also declined by around 10% and 7.8%, but they were significantly higher than our estimates. EBITDA margins came in at 38.6%, down about 129 basis points on a year-on-year basis, but still well above our expectations of 27.6% margins. Order book details again haven't been disclosed for HAL, but they do have an FY26 order book target of about rupees 2.6 lakh crores. Some key things to watch out for in the earnings call on Friday will be the management's comments on the LCA Mark 1A delivery timelines and further engine deliveries from General Electric, improvement in working capital execution schedule of ALH, and of course the management's comments on the order book and execution ahead.
Thank you so much for that, Ria. Anand, your view coming in on the defense names, not only GRSE, HAL, but all these defense stocks have been buzzing since the last 1 week that you look at it. Even smaller names like Zen Technologies, that's also seeing a run-up coming in. So what's your view on the defense pack? Is it something that you would be looking at now?
Well, you have to stop worrying about the valuations if you want to invest in any of these. There is no question that their order book will continue to rise, and as will the order book of all defense companies around the world. So the smaller ones obviously make more sense because they will automatically gain a little more. But the large ones as well, I mean, Hindustan, for example, HAL, for example, should actually be delivering some Tejas aircraft this year, given that they are supposed to be getting some engine And if that happens, obviously their conversion from order to revenue will also improve considerably. So there is going to be growth in the sector for the foreseeable future. The only thing is that, the valuations are already reaching the same level as the global majors without the same kind of technological capabilities that the global majors have. The one company I'd love to invest in, unfortunately, is not listed, which is BrahMos.
Okay, all right. Thanks a lot, gentlemen, Anand as well as Shrikant, for joining in, giving us a view on markets and a whole host of stocks. Well, we'll take a short break. We'll come back, getting you all the top corporate voices that we got through the course of the day, and we'll set you up for tomorrow as well with the events to watch. Don't go anywhere.
Welcome back to Markets Forward on CNBC-TV18. Now let's get you the top corporate voices that we had on the channel through the course of the day. First up, we spoke to Sai Life Sciences. The management said that they will be outsourcing from China. That will remain a bit uncertain. Long-term trends is clearly shifting towards diversification away from China. It added that 20% of its business came from America pharma firms, while business growth would also come from operating leverage. It has guided for a 20% CAGR growth over 5 years, and this is due to a lumpy CDMO business.
Well, then PG Electroplast delivered a solid set of numbers in the fourth quarter. The management guided for 30-35% revenue growth in FY26 and has pegged the capex at around 8 to around 900 crore rupees. It also noted an industry-wide demand slowdown expected in FY26. The firm also said that the production of its AC compressors is expected to commence by January next year, and that will help them in terms of margins.
Finally, Syrma SGS Technologies management guided for a 30 to 35% revenue growth in FY26, driven by favorable product mix. It pegged a FY26 EBITDA margin at 8% on a conservative basis and reiterated its export target of 1,000 crore rupees.
And before we wrap up, we need to get you set up for tomorrow's trading session. So let's get you all the key events to watch. Ria standing by to help us out with that list. Ria, take it away.
Let's take a look at the key events to watch out for tomorrow. First up, we have the UK GDP data coming out. There's also the employment and GDP data in the European Union. In the US, we have the retail sales print and the manufacturing output, as well as the initial jobless claims data that will be coming out tomorrow. Fed Chairman Powell is going to speak at the Thomas Lobach Research Conference. US President Donald Trump will be flying to meet the Abu Dhabi Prime Minister and is expected to continue his travels in the Middle East. Ukraine President Zelensky will attend peace talks in Turkey, and China is expected to reduce its bank reserve requirement ratio by 50 basis points. Back home in India, we have a lot of companies reporting their quarter 4 numbers, which include the likes of Allied Blenders and Distillers, Balrampur Chini Mills, Cochin Shipyard, Godrej Industries, IKS, ITC Hotels, JSW Energy, Keynes Technology, NCC, PB Fintech and Signature Global as well. A lot of companies are also going to hold board meetings tomorrow to consider a fundraise, which include Allied Blenders, Godrej Industries, Omax, Tube Investment Investments and Wellspun Enterprises as well. Siegel India is also going to hold a board meeting to explore any investment, including the merger of Siegel Infra Projects Private Limited, which is a subsidiary of the company, with CNC Construction Limited. Another event to keep your eye out on is that the Finance Minister Nirmala Sitharaman will be meeting PSB chiefs for an annual review. So keep your eye out on all of these events for tomorrow.
Thank you so much for that, Ria. But with that, we wrap up this edition of Markets Forward on CNBC TV18. Thank you so much for tuning in. And after the break, we'll be back with more news and updates, so don't go anywhere.
Hello and welcome to Business 360. I'm Shriram Finance. The headlines that we're tracking for you this evening. Prime Minister Modi chairs the first Cabinet Committee on Security meeting post-Operation Sindoor. The Chief of Defence Staff and heads of the tri-services brief President Murmu about India's military action against Pakistan. The BSF soldier who had been detained by Pakistan after inadvertently crossing the border last month handed over to Indian authorities. The US announces investments worth $600 billion from Saudi Arabia. This includes an arms deal worth $140 billion. Trump, who's in West Asia, reiterates claims that the US helped broker the ceasefire between India and Pakistan, tells Fox News, and I quote, "I told them that we can do better with peace. They agreed," end of quote. Indian equities end flat after a highly volatile session as the focus turns to earnings. Stock-specific action in focus today. The Nifty and the Sensex end with marginal gains. The rupee continues to strengthen as dollar selling by exporters offsets dollar buying by importers. The Cabinet clears HCL and Foxconn Semiconductor joint venture worth 3,706 crore rupees, paves the way for a plant in UP's Jewar, which would be India's sixth chip-making facility. The plant is likely to have a monthly manufacturing capacity of 36 million chips and is expected to create 2,000 direct jobs. Automaker Tata Motors says it will focus on new launches in its passenger vehicle business to keep competition at bay and deliver better than expected growth. Indicates that launches in the EV space will be a priority, adding that JLR will look at expanding into other markets and step up operations in the UK and EU to offset the hit from US tariffs. Microsoft to cut over 6,000 jobs across departments, levels and geographies. This will be its second largest layoff exercise. The company says this is part of organizational changes necessary to best position itself for a dynamic marketplace. Israel resumes airstrikes after briefly pausing military action in Gaza for the release of the last known American hostage in Hamas captivity. Over 60 people, including children, are killed overnight. The European hospital complex in Khan Yunis was struck as well. Israel claims it targeted a Hamas command center that was operating under the hospital. Russia and Ukraine continue to trade fire even as Ukraine's Zelensky agrees to travel to Turkey to meet with Russian President Putin. Russia has yet to decide on attending. European leaders threaten tighter sanctions on Russia if it fails to agree to a 30-day unconditional ceasefire. Justice B.R. Gavai takes oath as the 52nd Chief Justice of India. He's the first practicing Buddhist and the second person from the scheduled caste community to lead the nation's judicial system. He will have a short tenure of just over 6 months. Well, straight to the top story this evening. Prime Minister Modi chaired the first Cabinet Committee on Security meeting since India and Pakistan halted their military action. Now, the government has already rejected claims that the US and China intervened to broker a ceasefire deal between the two sides. Chief of Defence Staff Anil Chauhan and the Tri-Services Chiefs briefed President Draupadi Murmu about Operation Sindoor. The President commended the valour and dedication of the armed forces. Reports suggest that the security of External Affairs Minister S. Jaishankar has been beefed up after a review of his Z category cover. Security has also been tightened at the Paradip port in Orissa after a ship with 21 crew members arrived with crude oil for Indian Oil Corporation. No crew was allowed to leave the ship. And Abhimanyu Sharma joins us now with the latest developments. Abhimanyu, take us through what transpired at that CCS meeting and some of the other crucial developments in the India-Pak standoff and where things currently stand.
A meeting of the CCS and the Union Cabinet concluded sometime back at the Prime Minister's residence. This was the second meeting held after the commencement of the Operation Sindoor and the fourth meeting held after the terror attack in Pahalgam. While there is a pause on hostilities between India and Pakistan, the pause continues on military action. However, the vigil has been stepped up across the land, sea and air borders by different forces to ensure no misadventure or untoward incident by any element. It remains to be seen how the situation is going to pan out, even as de-escalation efforts continue from India's side. Also, India's BSF Jawan, who was held by the Pakistani forces, has been released. And in another development, India had expelled an official working with the Pakistani High Commission in New Delhi. And a similar action in retaliation has also been taken by Pakistan. So clearly, de-escalation efforts are continuing, but still there is skepticism over the actions by Pakistan and the kind of provocative statements which have been made by several Pakistani leaders and the entire Pakistani leadership in the recent past. Also, India till now has rejected any efforts or claims by any other country to intervene between India and Pakistan as far as dispute resolution is concerned, be it countries like United States or China. So clearly, de-escalation efforts are being looked at and the vigil continues to be high on the Indian side.
Abhimanyu, many thanks. US President Trump reiterating his earlier claim that he did a good job convincing India and Pakistan to pause military operations. In an interview with Fox News on board Air Force One, Trump reiterated that he did not like what was happening between the two nations. Trump's comments during an interview to Fox News come in the middle of his official visit to West Asia since becoming the president for the second time. Yesterday, he signed a $142 billion defense sales agreement with Saudi Arabia. The kingdom has pledged an overall investment commitment of $600 billion in the US. Speaking at the summit in Riyadh, President Trump also announced plans to lift sanctions on Syria following the fall of the Assad regime. He met Syrian President al-Shara before he departed for Qatar's Doha. President Trump is also expected to travel to the United Arab Emirates later this week. He also issued a strong message to Iran.
I want to make a deal with Iran. If I can make a deal with Iran, I'll be very happy. If we're going to make your region and the world a safer place. But if Iran's leadership rejects this olive branch and continues to attack their neighbors, then we will have no choice but to inflict massive maximum pressure, drive Iranian oil exports to zero like I did before. If you know that, they were a virtually bankrupt country because of what I did. They had no money for terror. They had no money for Hamas or Hezbollah.
Well, that is President Trump speaking in Saudi Arabia. On to the day's market action. Indian equities ending the day flat after a volatile session. The Sensex and the Nifty ending with marginal gains, while the mid-cap index rose more than 1%. That's the story there. 88 points higher for the Nifty. The Sensex 180 points higher. The Nifty Bank down 139. It's a 600-point uptick on the mid-caps. Financials underperformed today. That's the story for our market. Surbi standing by now to wrap up the market action for us. Surbi.
Well, middle of the week, and it was another quiet day. Quiet, especially if you were looking at the large cap screen, and not so quiet and fairly pleasant and green for the mid caps today. The market is consolidating at the Nifty level, which is why for most parts of it, the index was either flat or up about 0.2, 0.3%. But like I'm saying, it's the broader market action being driven by specific stock news, by earnings, and that index, the mid-cap index, was up 1%, and the advance decline ratio was very strong, over 3 stocks advancing for every one that was declining. Once again, defense was the clear, favored part of the market. Today, the Nifty Defense Index was up about 2.5%. If you talk about the gains so far this week, then this index has put on about 8%. That's the sense of buying. And a couple of good earnings, for instance, Garden Reach Shipbuilders, they've only added to the sentiment and the excitement around this space. In fact, the defense stocks that were really up and about today included names like Garden Reach, Cochin Shipyard, and even HAL. The Achilles heel for the market is proving to be banks once again. The Bank Nifty was underperforming. It actually ended down with a minor red cut as well. And the question here is FPI flows. And I'm going to come back to this point in just a second. But let's complete the Nifty tally. The gainers today included Tata Motors, Shriram Finance. A lot of the metal and material stocks are doing very well. So whether it is Hindalco, or Tata Steel, or names like Coal India and ONGC, this entire side of the market, commodities, had a very good going for itself. And of course, there was Tata Steel, which was reacting well to the brokerage upgrades as well. Eternal, these were some of the other names that performed fairly okay. Technology pulled back, so it's like one day up, one day down for tech. Today was one of the up days, so HCL Tech, Tech Mahindra, etc. These names were up and about. The losers on the Nifty included names like Asian Paints, Cipla, and Tata Motors. Mid-caps, now this is where the action was. Let me talk to you about the high flyers. A lot of these numbers, a lot of these stocks responding very well to numbers. ITD Cementation, Sai Life, then there were others. Novama had a very good session, 7% higher. And some of the PSUs like Ircon, Railtel, Mishra Dhatu, all of them had a good day. The downside included names like Sirma and REC. The key challenge for the market is now going to be the Chinese outperformance. The Hang Seng was up 2.2% today. It's already up about 3.5% for the week. And the critical question is, will FPIs make a tactical shift towards China, given the valuation comfort and the good news on the US-China trade deal? That could put some pressure on flows coming to us in the near term. And that's a big watch point over the next couple of days.
All right, Surbi, many thanks for joining us. From equities to commodities, crude oil prices softened after nearing 2 weeks highs. This after industry data showed that US inventories rose last week. Meanwhile, gold prices are down. In fact, they've eased after the trade tensions between US and China dented safe haven demand. Profit booking has also followed, which, as we've been seeing, has weighed on the yellow metal. The wholesale price index easing to its lowest level in 13 months for the month of April, led by a fall in prices of food, manufacturing goods and fuel. Wholesale inflation coming in at 0.85% as against over 2% in March. Food inflation declined to 2.55% and manufactured products inflation decreased to 2.62%. Retail inflation also slid to a 6-month low in April, so good news continues there on the inflation front. In a big boost for India's semiconductor drive, the Union Cabinet has approved the setting up of a new semiconductor unit in Jewar in UP. Now, the plant will be a joint venture between Foxconn and the HCL Group. The project will have an outlay of 3,700 crore rupees and will have the capacity to generate 36 million chips per month. Speaking at the briefing, Ashwini Vaishnav, the minister, said that this will create 2,000 direct jobs. He also added that the plant will meet 40% of domestic demand. Take a look.
Foxconn, yes, this is the second attempt they have made. The partner they have selected is a very good partner. Last time also they had their own internal reasons for not taking that unit forward. I don't want to comment on that. But HCL has a very long history of manufacturing electronics and computers. In this particular, they have come with a very specialized technology. This is a technology called wafer level packaging. And this is especially focused on the display driver chips. There, what we understand is that once this unit is there, the display panel will also come to India. So this will more or less meet about 40% of India's capacity.
Well, that's Ashwini Vaishnav there on the decision taken by the Cabinet to clear the joint venture between Foxconn and the HCL Group to set up a chip manufacturing facility in Jaipur in UP. The US Trade Representative Jameson Greer has clarified that the baseline tariff of 10% on all imports into the US, irrespective of country of origin, is here to stay. Speaking to CNBC, Greer said that US officials are in active discussion with several countries to reduce additional tariffs. He also said he plans to meet India's Commerce Minister Piyush Goyal very soon.
The focus of this agreement and the talks over the weekend were really to address the current escalated situation, which was tantamount to an embargo, which was not sustainable for either side. So we're able to get to a position where the United States still has substantial tariffs on China. China retains some, not nearly as much as we did, but we're in a position where we can actually talk. We can do it constructively. And to your point, taking down non-tariff barriers, of which there are many. China's the largest challenge by far on that front. That will take time, but the Chinese, they want to talk about it, we want to talk about it, and we'll see where that leads. I'm going for my standing call with the Indian Commerce Minister, who's my counterpart on trade matters. Then this afternoon, I'm flying to Korea to meet with the Korean Trade Minister over the next coming days, as well as trade ministers from many other Asian countries who are gathering for APEC meetings. So all of this is happening in parallel, and we are happy to move as quickly as other parties are willing to move. Everyone saw the UK move very quickly. In Switzerland, in between all the meetings with the Chinese, I met with the Swiss president. They want to accelerate things. So we're moving as quickly as we possibly can with folks who want to be ambitious. We just want to make sure we have secure supply chains, we get as much production back home as possible, and having a 10% global tariff, that's going to help reduce the trade deficit, which is the primary driver of the whole program.
Well, that's the U.S. Trade Representative. Now, speaking of China, India has rejected Beijing's attempts to rename certain places in Arunachal Pradesh. Officials from the Ministry of External Affairs have said that China's attempts will not alter the reality that Arunachal Pradesh is an integral part of India. This is China's fifth attempt to rename places in the state. The boundary dispute between India and China over Arunachal Pradesh has been a long-standing source of friction. Beijing has repeatedly claimed that the state is a part of historical Tibet. Back to corporate news, Tata Motors says the company plans to intensify its passenger vehicle launches in the current fiscal year. Speaking to my colleague Parikshit Luthra, the company's CFO PB Balaji said that driving up sales in the electric fleet segment will be a priority. Added that Jaguar Land Rover will look for alternate markets and will accelerate its growth in the UK and the European market. Take a look.
Overall demand situation as far as India is concerned is, I would say, is modest, is decent, not scorching. At the same time, neither is there any major concern at this point in time. So I would expect modest growth coming into this year. On the commercial vehicle business, I think the underlying fundamentals of the growth is very much intact. On the passenger vehicle growth, I think we did have a lukewarm growth last year. Nothing much to talk about last year. And I would suspect that this year would be an year where it will be modest growth once again and gradually build back as the year progresses. In this kind of external environment that we are currently facing, which is a bit unclear, because one is, of course, it's challenging. The other is also we are not clear what exactly how it plays out. Take the UK-US tariff, for instance. We welcome really the deal that has been done, which is now reducing tariffs from 25% to 10%. But it has gone up from 2.5 to 10, number one. Number two, even that reduction, we are not clear when does it become effective? Is it applicable for parts? Is it applicable retrospectively? So those are questions that are still out there, and we are hopeful to get clarity on that. US is probably likely to be having a lower growth next year compared to what we had last year. And therefore, we need additional sources of growth. The first market that is looking very good for us is UK, and we would intend to accelerate that.
And you can catch that entire conversation with Tata Motors CFO PB Balaji on Motor and Centimeter at 6 p.m. and 10:30 p.m. right here on CNBC-TV18. The big global story, tech giant Microsoft is set to lay off around 6,000 people across geographies, levels and departments, though this will be about 3% of its workforce. It will be the second largest layoff exercise that the tech giant is implementing. In a statement to CNBC, the company said, and I quote, "We continue to implement organizational changes necessary to best position the company for success in a dynamic marketplace." Analysts also believe that the organizational change will help Microsoft achieve its $80 billion capital spend target with this fiscal. Electronic giant Sony's operational income ahead of street estimates, however, dropped 11% on an annual basis. The company also announced a share buyback of up to $1.7 billion. And defence equipment manufacturer Hindustan Aeronautics surging in trade after its profit and margins both ahead of street expectations. Net profit fell by nearly 8% year-on-year basis, but that was higher than what the profit was higher than what was expected. Revenue also fell by 7%. Meanwhile, margins came in at 38.6%. The management said they are working on improving working capital and execution schedule of advanced light helicopters. We will head into a break, but up next, Justice B.R. Gavai takes oath as the 52nd Chief Justice of India. He's the first practicing Buddhist and the second person from the scheduled caste community to lead the nation's judicial system. That and more when we return.
Network 18 is now the clear leader in digital media with 55% more users on native platforms and social media than Times Internet. Network 18, the undisputed leader of news networks, way ahead of the times.
In international news, Israeli forces have intensified attacks on Gaza, killing at least 65 Palestinians since midnight. Missiles hitting 2 hospitals in the region, killing 45 people, including 22 children. Israel claimed it targeted a Hamas command center that was operating under the hospital. Russia, China and the UK have rejected a US and Israel plan for distributing aid in Gaza and said they've urged Israel to lift the 2-month blockade on Gaza. Ukraine's Zelensky has maintained that he will leave Turkey's capital of Ankara to attend the peace talks in Istanbul only if Russian President Putin is present. Moscow has not clarified if the Russian leader will attend the negotiations in Istanbul. Meanwhile, European leaders have indicated that they will press ahead with further sanctions against Russia if the talks in Turkey do not result in a ceasefire. Justice B.R. Gavai took oath as the 52nd Chief Justice of India. President Murmu administered the oath. Justice Gavai will have a tenure of over 6 months. He is the first Buddhist Chief Justice and only the second Chief Justice from the scheduled caste community. Ashmit joins us to give you a brief profile of India's 52nd Chief Justice of the Supreme Court. Ashmit.
Well, Justice B.R. Gavai, assuming charge as India's 52nd Chief Justice. The President today administered the oath to the new CJI in the presence of the Prime Minister as well as the entire top deck of the government. Now, bear in mind, this is for the records book. He'll only be the second judge from a scheduled caste community to come to the top chair of the Indian judiciary. He will, however, have a brief tenure of just a little over 6 months. He's due to retire in November of this year. Now, speaking of his journey, he began his journey in 1985, first as a lawyer. In 2003, he was elevated to the Bombay High Court, and in 2019 he was elevated to the highest court of the country, the Indian Supreme Court. And since then, he's had a prolific body of work, over 700 benches, over 300 judgments that he's authored. And speaking of judgments, in January of 2023 is when he was a part of the bench that had upheld the 2016 demonetization exercise. Later that year, in 2023, in December, is when he was a part of a bench that had upheld the abrogation of Article 370. Cut to 2024, he was a part of a bench that struck down electoral bonds and their legality. Subsequently, he also was a part of a 7-judge bench that had granted states the right to subclassify the SC/ST quota. And further, in December of last year is when he had come down heavily on bulldozer demolition by various state governments as a form of penal action. So a phenomenal body of work. The Indian judiciary looking now to him for leadership for the next 6 months.
Ashwat, many thanks. The government has said it has enough coal to cater to power demand, which is expected to peak this month due to heat waves in some states. Government sources tell CNBC-TV18 that thermal power plants have enough coal to last at least 25 days. Abhimanyu is back with us with more. Abhi.
While the mercury is rising across the country, ample coal is available at pit heads. That's the word coming in from the government. Government sources have told CNBC-TV18 that around 25 days of coal stock is available at pit heads and thermal power stations across the country. Now, this is despite an increase in temperatures which has been noted in the past few days. Also, there have been several patterns with respect to different regions, and these regional patterns are also governing the kind of power demand in respective regions. While places like Gujarat and Telangana have witnessed heat waves already, and due to several heat waves being witnessed, the projected peak demand for power has already been witnessed in these particular states. However, in places in North India, there have been several showers and several reliefs in terms of rain, and that has led to some cooling down of temperatures, which has ensured till now that the projected peak demand has not been achieved. It remains to be seen how the situation is going to pan out, even as the government is working to improve last mile connectivity in terms of transportation of coal and logistics to ensure that it's not just high production of coal, but also last mile connectivity, which will boost power generation and will provide ample coal not just to the power sector but also to the non-power sector like the steel sector. The government is also looking to beneficiate coal in a large way to ensure that purification of coal takes place even before transport, to improve overall logistical efficiency and to also save on infrastructural costs while transportation of coal.
Abhimanyu, many thanks for joining us. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned. We're back in a minute with more. What was the one that surprised you? What was the one that you were absolutely sure of?
Barfi was one which was the most difficult to pin down, but you knew it at a visceral level, you reacted to the material. Chennai Express actually was another film where, you know, there was a full narration that happened with a group of 20 people, and we were laughing off and like falling off our chairs.
What was a casting call that you made that kind of worked out the way that you had imagined it to?
I think probably Dangal. And at that time, of course, Irfan, he was someone we had in mind. He would have done a wonderful job. But then I got a call from Amir at that time. Many other stars of his stature might not have been okay with playing an overweight wrestler who's like a bit of a has-been, who's living out his dreams through his daughters.
Let's Talk Money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. This week, we are going to put the spotlight on investing in global equity markets via global funds, or you can call them international funds. Now, mind you, these are funds that are being run by Indian asset managers. So why do you need to look at these funds in the first place for your portfolio? What is their taxation structure? And what funds could perhaps be suitable for investors given the risk appetite and the risk-taking ability? Well, this is what we talk about, and to help us demystify this world of international investing, we have with us Nasir Salim of Flexi Capital and Niranjan Avasthi of Edelweiss Mutual Fund. Gentlemen, great to have both of you on the show. Thank you so much for joining in. And I thought perhaps it's an apt time, right? Because I don't think we've seen so much of volatility in the Indian market, in the international market. The headlines are changing by the minute. And you realize that perhaps for an involved investor, it might make sense to have some exposure to shores that go beyond India as well. So let's get your opening thoughts. And Niranjan, you folks at Edelweiss have so many of these global funds, from China to US tech to I think even Europe, right?
Yeah.
Why should one go global?
Yeah. First of all, thanks, Surabhi, for having me. Broadly, over the last 2-3 years, we have seen huge traction for investing globally. And especially in last 1 or 2 years, when we have seen global markets, Indian markets going through volatile times, it is very, very important to study this category and take exposure. 2-3 reasons, One, if you see last 10 years, India has been amongst the top 3 performing markets maybe 3 to 4 times. US has been there 6 times and China has been 2 times. Now, if you want these winning markets to be in your portfolio, you need to invest beyond India. And if you have them, it's basically easier to navigate, cycles in the market. The second is, if you see India as a market cap, contributes maybe 3 to 4% in the MSCI World Index. It's broadly 3-4%. US, on the other hand, is roughly around 65 to 70%. China is around 14-18%. Now, if you look at a portfolio, you can't ignore a large cap in your portfolio, right? From a market perspective, these are large cap names, or these are large cap nations out there which you need to have in your portfolio. Second, if you see the top 100 market cap companies in the world, 50 plus are from US. Only 2 are from India, and maybe 16 are from China. Now, again, you can't ignore these, heavyweights, big global companies. And for all these, you need to invest globally. Last, but very important, you need to build some dollar assets. If you see our INR against dollar over the last 30 years, it has depreciated every year by 3 to 4%. In last 10 years, US S&P 500, if you see, has given somewhere around 12.75% returns, whereas in INR terms, it has given 16%. So 3.25% return just adding up just because of INR depreciation.
Yeah,
so these 3 are very, very important reason why you should have some exposure to global.
Oh, I can't argue against any of those 3 points. They seem perfectly logical, actually. Let me ask Nasir as well. Nasir, your thoughts. And the thing is that now that everybody has access to information, typically it ends up being a bit of fad investing. When the NASDAQ is going up, you see people want to invest in NASDAQ and they want to invest in NVIDIA. When suddenly there is a boom in China or some stimulus in China, everybody starts talking about China. But there has to be better reason and scientific logic behind looking at global funds, right? What would you say?
Good morning. Thank you once again for having me back on your show, Surabhi. Always a pleasure. So, great question again there. I think, there are multiple reasons why global funds need to be part of your portfolio. And I think it stems from the very fact that, the decision starting from the basics of core and satellite, I think that is something which, is one of the main constructs and the reasons for one holding global funds. But I think broadly 4 broad reasons, So number 1 is geographical diversification. I think, lowers dependency on India-specific macro cycles, politics and weather-linked risks. So that's one major reason. The other one is access to sectors absent in India. For example, very thin, there are thinly available in India. World-class tech platforms, you've seen FANGs of the world, semiconductor majors, global healthcare, innovators, luxury brands would be, some of these are not available in India to Indian investors. Third, I think, one of the very important factors, while, index and indices keep changing, I think currency hedge is a very, very important factor which needs to be kind of factored in. The INR has depreciated over 3 to 4% per annum versus the USD. over the last decade or so. Foreign assets priced in USD act as a natural hedge survey for long-term rupee obligations, such as overseas education for children, for example. Then there is the entire valuation and cycle, which you just mentioned. US-China bear phases often coincide with rich valuations at home. And owning both of those markets kind of smooth the ride. And our view is that, for example, the 2025 market note recommends that one should, in current times when we spoke about, at least 10 to 15% allocation should be to international funds for precisely these main reasons.
Oh, okay. So 10 to 15% allocation. That's fairly sizable that Nasir is talking about. But Niranjan, let me ask you the same question. We want to do this scientifically for long-term wealth creation, right? In and out, timing the market, knowing that, okay, China is bouncing in next 3 months, China will do better than India, and then buying a fund, getting out of it. That I think requires some next level rocket science, market predicting ability.
Yeah.
Now, we don't want to talk about that because not everybody might have that.
True.
Then how can you benefit? And over longer periods, what is the kind of wealth generation that these international funds have given investors?
Right. So broadly, it should be satellite portion of your portfolio, but this satellite portion also needs to be invested in a strategic way, right? Now, Nasir mentioned that 5 to 10% or maybe 10 to 20%, depending on which way you are looking at your portfolio.
Yeah.
For most beginners, maybe 5 to 10% is a good starter to get into these funds.
Okay.
Strategically, if you want to invest structurally, what you need to see is 3 things. One is go for countries which complements India, which are large. Like US definitely is one country where you cannot ignore to have in your portfolio. It's growing. Most innovative companies are coming from US. The market size is huge. That is one. Second is also look for a region, if at all, which again has maybe lower correlation with India.
Okay.
Again, US comes up first because it has probably 0.3, 0.25 correlation with Indian markets, which means when Indian markets aren't doing well, probably US markets along with currency depreciation will add to your portfolios and improve your risk adjusted returns. So strategically select these kind of countries. Go for plain vanilla index funds or diversified funds in these countries and go for maybe SIP and long-term allocation. There are people who want to do it tactically, as you mentioned, forget about US or China. Even in India, it's very difficult to tactically get in and get out.
Yeah.
But if you still want to do it, maybe spot a market which is trading at lower valuation, take that contrarian bet. Maybe China, for instance, last year we gave that call. China was trading at less than 10 forward P.
Yep.
From there, it's up almost 30-40%.
Yeah.
Even today, amongst the top countries or top markets, China is still very cheap. It's below their long-term average in terms of forward P. So China kind of market can be a contrarian market. But again, it's very, very difficult. As you mentioned, you need to time it well. So for most investors, go for a strategic allocation, select a country like US or even maybe China for long-term allocation. These are 2 superpowers we already have. Go for SIP, simple 5 to 10% allocation. I think so you should be done.
Since we're on the subject, Nasir, I have to ask you as well. Let's talk about China and US, these 2 big markets, right? If someone has to make fresh exposure to international funds, would you look at international funds that are investing onwards into China right now and the US?
Absolutely. So, with specific question to your US and China, see, as far as US is concerned, US indices have rallied since the tariff war has gradually eased off, right, which we're currently in the middle of it. NASDAQ 6.13, S&P 500 4.9% are close to all-time high levels. Negative 6.13 and negative 4.9%. Staggered approach to a US equity is currently a more prudent strategy. I completely agree. An SIP or an STP does warrant at this kind of point of time. A strong positive is the US-China trade war de-escalating. So it's a very, very strong positive for both US. And as far as China is concerned, we have some very interesting themes which you usually don't get to capture otherwise. So there is energy transition, there's frontier China, but active alpha still exists. And this entire lithium space, I think opportunities there if you have enough active fund of funds or some index, we can index funds or passive routes which are available currently. Those both can be explored between US and China. Our view, of course, is that currently, until things don't get more clear in terms of the tariff war, which is kind of starting to de-escalate, Until then, we should still feel that there's a lot of opportunity in market neutral options available, which we can talk about as we go along.
Okay, fair enough. So let's now talk about the other aspect of this. In the Indian market, when you have decided that you want to invest in international funds, you have to then make the next choice. An active fund, one that's actively managed, where a human being is deciding what stocks will go in that fund, or a passive fund, which will only track an index. It could be any underlying index, like the S&P 500, like the NASDAQ, or many others. Nasir, I know you've done a lot of homework on sort of looking at the buckets and what is available in the market. So tell us, how many funds are there? How many are active? How many are passive? Where are the AUMs greater?
Okay, so before we get into that, so I think currently in the active space, between active and all the international funds that are available right now, we have 66. That's the last count that I have, Surbhi. And out of those, again, we need to check which ones are open currently for subscription for investors. I believe the Edelweiss are all open and available at the moment. But broadly, to answer your question on active versus passive, see, a passive fund basically tracks the index, or it's an FOF into an ETF. FOF is a fund of fund which is investing underlying into ETFs, and those basically track the S&P 500, for example, the Nasdaq 100 or the MSCI China or other such indices. And 38 of the 66 of these international schemes are currently, which is about 57%, are passive, right? Those are US and China focused, and typically a broad market for holding low cost, no manager risk in a typical passive fund. Now, if you come down to the active fund of funds, we have roughly 28 schemes, about 43% of these, where usually Indian fund by units often oversees the active fund. For example, JPM Global Equity, Schroders is another example, Global Innovation Fund, which tracks that particular fund. And most of these, again, they capture niche themes, which are not available in India for investors. And that's where we feel there are a lot of active alpha can still be generated on portfolios. So that's broadly it. Amongst the ones which are, by and large open, we have a fairly large list between passive and active. In passive, we have the Mirai Asset, FANG, which is available. It's an ETF plus FOF. We have something on the passive side again, Motilal Oswal S&P 500, which is available. We have the ICICI Prudential Nasdaq 100 Index. In the active space, we have Invesco, India Invesco Global Consumer Trends, which is doing very, it's active and it's open at the moment. As I said to you, Edelweiss Europe Dynamic Equity Offshore Fund is there. Edelweiss US Tech Equity Fund of Fund is there. And then on the fixed income side, because that's again something which one can't ignore completely, we have DSP US Treasury, which is a fund of fund, and something which comes in from the Aditya Birla Sun Life Group as well, which is the US Treasury 3 to 10 year bond ETF fund of fund. So again, some of these between active, equity, passive equity, and then fixed income.
Okay, so lots of choices out there. But on the active passive bit, Niranjan, I think this could be confounding for investors, right? You have, like Nasir said, you have 66 funds. Many are active, many are passive. So what should the approach be? I mean, because you're ultimately trusting maybe a foreign, not even an Indian fund manager, a foreign fund manager, probably don't know if, what is the underlying portfolio. So is it safer to just, dovetail on an index, or should you look at some active management as well?
So I think so, like in India, we also say midway is a better approach. Over here also, specifically if you are investing in US, probably a mix of active and passive makes sense. Go for a FOF active fund, underlying active fund, which has a long track record. Like we have tie-up with JP Morgan. These funds have been in India for almost 10 years or even more than that, 15 years. Look for an active fund, FOF. Passive, you can definitely go for passive, but specifically if you're going for an ETF and buying it in India, it is very, very important to see whether the ETF is trading at a discount or at a premium. What has happened over the last couple of months, or in fact a year, that because the inflows have been stopped, many of these ETFs are trading at a huge premium. In some cases, the premium is as high as 20%. Now, mind you, even if market gives you zero returns and this premium comes down to zero, your return can be negative 20%. So if you're investing in passive, and unfortunately we don't have any index funds, most of these passives are via ETFs, and ETFs trade on Indian markets, Indian exchanges. They trade at a premium because the underlying is closed.
So you have to just buy in, sell the units of that
only
ETF.
on the exchange.
So you're already paying a premium.
Already paying
to
a premium.
the underlying NAV.
The moment the underlying fund flows open up, this premium can come down. And we have seen premium hovering from 10% to 30%. So be very mindful if you're picking for a passive. My bet today would be go for a simple active FOF, which doesn't have this issue for a retail investor. Go via SIPs and all and don't worry about all this.
Okay. Fair enough. We do have to take a very quick break on that note, but we'll come back on the other side to discuss the other important aspect, which is taxation. A lot of the international funds now enjoy better, favorable taxation compared to where we were historically. But still, how does that eat into your returns? What should be your return expectation? We'll discuss that on the other side.
Let's talk money. Let's talk money.
Welcome back. This week we are discussing how you can take advantage of global equities, international equities, via the Indian mutual fund route. And as we've discussed, lots of options. There are actively managed funds, there are passive funds, but we need to understand the technicalities of that investment now. One thing that we must keep in mind is the best part is that we have to invest in Indian rupees. We don't have to take the pain of the whole exchange rate, whether it's China, US, or any other market that you're investing in. But then there is tax, Niranjan, and we need to understand how taxation is arrived at, because there's capital gains, there could be dividends that companies are giving, or any other formats of taxes. There's TCS otherwise when you're remitting money overseas. So I don't know, just explain all the tax layers to us.
Right. So broadly, you have two routes to invest outside India today. One is LRS route, one is mutual fund route. Let's talk about mutual fund route. It's very simple. You invest in an FOF or an ETF. Any capital gains after 2 years is taxed at 12.5%. Anything before that is short-term capital gain as per your tax slab. Dividends, whichever you get from these funds, are taxed as per your tax slab, like any other mutual fund. That's very, very simple. Now, these funds investing in maybe US funds and all, they may attract some withholding tax depending on which jurisdiction they invest, but you don't need to worry about, because everything is built in the NAV.
Okay.
On the other hand, if you're investing via LRS, there are two taxation that you need to be aware. Three, in fact. One is while you are investing, there is a TCS, which is tax collected at source. There is a 20% TCS if you are investing about 10 lakh in any, whether it is US or China.
That is through the direct. If you're directly going to buy stocks, send your money overseas through LRS, then you need to pay this TCS.
This tax. When you invest, and if these companies pay you dividend, there is a withholding tax. If you're investing in US, the withholding tax as per the DTA is 25%. So you need to pay 25%. If you're investing in Chinese stocks, that tax rate is around 10%. So that is second layer of tax. Third layer of tax is capital gain, which is equally, which is similar to what you pay in MF. After 2 years, 12.5%. Before 2 years, short-term capital gain as per your slab rate.
Okay,
so that's how it
it's a little complicated. Let me try and recap. So let's start first with capital gains. Capital gains is what's become favorable for international funds now. So if you're holding on your investment for 2 years, then you have to pay long-term capital gains at 12.5%. And short-term would be less than 2 years at your slab rate, right?
Yes.
TCS, we don't have to bother. If you're going through the mutual fund route, then tax collected as source is not a worry.
No.
What happens to the dividends if $100 is coming as dividends from a US company? Then what is
the fund?
In the fund, I'm just bothered about the dividend that I'm getting, along with my return.
So basically, if the fund is investing in a stock or maybe a fund which is paying dividend, then at the fund level, right, there is a withholding tax which the fund pays, or it's deducted at source, and you don't need to worry as an investor.
Okay.
Now, dividend, if the fund which you are investing in, if that pays a dividend, it is equally like, an equity fund in India paying you dividend, it is taxed at slab rate.
Okay.
So you don't need to worry about the underlying paying dividend, you need to pay tax on it. It's not like that.
Okay.
So in fund of fund or a mutual fund route, it is very, very simple. Better to go for a growth option and in a fund of fund structure, the only thing you need to worry is stay invested for more than 2 years and pay that 12.5, nothing else.
Now, if I'm invested for at least 3 to 5 years in a global fund, what should be the return expectation? For Indian equities, everybody says that 12 to 15% steady state returns, good returns. What about these international funds?
So for US, if you see, I think so, because the way market has been structured in US, it's completely different. It is no more linked to the nominal growth like we calculate in India, because US tech stocks are, just buzzing. They are giving extraordinary returns, which may continue because even today, the earnings growth expectation over the next 10 years or so is above 15-20%. Looking at that, I think so anything between 10 to 15% is a reasonable return to expect. Over and above, you should add maybe 2-3% return from currency depreciation.
Oh, yes, yes.
So whatever return US market gives you, we saw an example 12.75, but last 10 years in INR, it's 16%. So I think so same expectation you can take over the next 5 to 10 years. But be mindful because tech stocks specifically are highly valued. There can be bouts of volatility. The drawdowns could be higher. Better way is to, as Nasir mentioned, go in a staggered way, start an SIP. Even if you're investing lump sum, invest now, start an additional SIP so that even when markets fall, you buy in more.
Okay, got that point. Nasir, coming down to final thoughts then, you've already given us some ideas, the kind of funds that you like, but recap it all for us. The do's and the don'ts and the mistakes to avoid when you're taking this 10 to 15% exposure to global funds in the portfolio.
The question between active and passive, that is something that remains, as one of the main reasons for construction of the overseas portfolio. But clearly, I think, first and foremost, please do not chase returns because of momentum. There are enough changes happening dynamically as we speak. US-China was never thought of that they will come in with a trade agreement so soon, but we see it happening. It's obviously going to ease tension between both US and China. A few weeks ago, we were market neutral. We continue to be market neutral, but US started to look interesting. So don't chase themes basis news flow. You have to be more pragmatic. Look at medium to long term generation of wealth. Number one. Number two, I think very, very important is the end objective, your expectation on returns. I think on international returns, the global fund returns, an investment opportunity vis-a-vis expectation has to be staggered. It can't be lump sum. Please do not look at any money which is lump sum going into any of these funds, because a lot of this changing dynamically, and we feel that a lump sum approach, staggered approach, and again, currency hedge. I think please make sure cognizant of the fact that your underlying investments are going into a different currency. Are you adequately hedged or not from an overall portfolio perspective? I think some of these are very, very important. And last but not the least, I think we need to look at whether the funds that you're investing in are those currently open or not, because there are enough regulations in place today which have been brought in by RBI and in terms of freezing some of those investments, there's partial relief, and what may or may not be open today. So those are again something which need to be very, very clearly looked into when you're looking at the international funds broadly. And I think the last but not the least is, please don't expect superior risk-adjusted returns very quickly. I remember this old saying that it is not the time, but the timing. It's not the timing, but the time spent in these markets. And the same holds true also of international funds and international markets. So I think broadly, we focus on some of these, and of course, not to forget your taxation impact, which we discussed right now. I think those are again something which need to be factored in when you're looking at international funds between active and passive.
Okay. All right. Good points there. Thanks for that. Niranjan, any final tip, word of advice, word of caution to investors as they're getting set on this global journey?
Be measured in your approach. Look for long term, because end of the day, these are also equity funds that you are taking exposure. Don't try to be over smart with the market, because it will, hit back.
If it doesn't work in India, chances are it won't work internationally.
Absolutely. The risks are same. There is no easy way to make money. Be very methodically, and your approach should be staggered way.
Okay. All right, gentlemen, thank you so much. Niranjan as well as Nasir, thank you for joining in and giving us a nice sort of bird's eye view on the whole, piece of international funds. Plenty of choices. And now, as you know, a lot of the funds are opened up in India. At least partially they're open. So you have some choices. You can go out, do your homework, and then decide if you want to invest or not. Thank you very much for joining in. It's a wrap on this edition of Let's Talk Money. We'll see you again with another theme next week.
Let's talk money.
Hello and welcome to our special broadcast. I'm Parikshit Luthra. India may have halted its military action against Pakistan for now, but Prime Minister Modi has laid out what could be argued as India's new doctrine against terror. 1. Operation Sindoor will be the new normal. 2. There will be zero tolerance for nuclear blackmail. 3. There shall be no distinction between terrorists and their sponsors. Prime Minister Modi chaired the first Cabinet Committee on Security meeting since the government has already rejected claims that US and China intervened to broker a ceasefire deal between the two nations. US President Trump, however, reiterated his earlier claim that he did a good job convincing India and Pakistan to pause military actions. In an interview with Fox News aboard Air Force One, he reiterated that he did not like what was happening between the two nations. Chief of Defence Staff General Anil Chauhan and the Tri-Service Chiefs briefed President Draupadi Murmu about Operation Sindoor. The President commended the valour and dedication of the armed forces. To take this forward, we have now with us former Deputy National Security Advisor Satish Chandra. He was also the former Indian Ambassador to Pakistan. And also joining us is Meera Shankar, former Indian Ambassador to the US. Ambassador Chandra, if I can begin with you, how do you think Donald Trump's statements, and he went on to say yesterday, he claimed credit for the 4th time for bringing India and Pakistan to a ceasefire. He said probably the leaders of the two countries should go for dinner together, should have a nice dinner together. Why do you think this has happened? And where does this leave India-US relations, according to you?
Well, I don't think one can take what Trump says at face value. It's not only on this issue, on many other issues in the past. He has made certain statements which are completely incorrect. The classic one on this, of course, is that India and Pakistan have been warring for 1,000 years or something like that. So I really don't take it seriously, and I don't think anyone should either. Really, I think the facts speak for themselves. And on that, I'd like to underline that it isn't that Trump got the two leaders together to have this understanding on ceasefire. It is the Pakistani DGMO who actually contacted our DGMO and requested for a stoppage of the confrontation on the border. So really, I don't think Trump had anything to do with it. Certainly, India didn't make any such request to him or to anyone else, because why should it be necessary for India to do it, given the fact that we have imposed such heavy punishment on Pakistani targets, including critical air bases deep within Pakistan. So I think this is a story which is just what I said it is. It's a story and not based on any type of reality. As regards the relations between India and USA.
Okay, Ambassador Chandra, I'd also like to ask you that now we have an understanding not to fire, to stop military action at the border between India and Pakistan. This is the result of DGMO talks. India maintains that Operation Sindoor will continue. There is no change on the Indus Waters Treaty or any other trade or business relations or economic relations with Pakistan. But how do we ensure that we effectively corner Pakistan in the days to come? When we formally have any sort of understanding on a ceasefire, what should be the contours of any such agreement, according to you?
Look, we have Pakistan on the mat, and I think what the Prime Minister said is clear, and that is the way we will go, is that we will judge Pakistan not so much by what it says, but by what it does. And should there be any type of action, military action particularly by Pakistan, or a terrorist action by them, there would be retribution which would probably be of a higher order than what has happened so far. And you had asked also about India-US relations. I may add on that
The relationship between India and US stands on its own. I think there has been a lot of progress over the years with earlier governments and with this one as well. And that will work out on its own. However, I must say that one is a little bit disappointed with the US actions that have gone on so far in terms of equating India and Pakistan. I think that's wrong. I think if the US wants to stand against terrorism, it should clearly come out against Pakistan. And I think this has been noted all over India, and certainly that will be kept in mind, I'm sure.
All right. Ambassador Shankar, to welcome you to the program. As someone who's watched India-US relations closely, every US president in the past has stood for US interests. All of them do that. Perhaps Donald Trump is more direct in doing so. Having said that, do you think the kind of remarks that Donald Trump has made, tweeting about the ceasefire well before the Indian side could make any announcement or make any press conference or could give any feelers to their own media or people about it, do you think the kind of comments he's made, does that in a way impact India-US relations at all, especially at a time when we're discussing a trade deal?
I think that it will blow over because the substantive aspect of the relationship still stands, both in terms of the economic and technological engagement and in terms of the strategic convergence to some extent in the Indo-Pacific. But I would say that the US has not handled it diplomatically. In the past too, there have been US interventions because one standard theme has been the danger of nuclear escalation. And that is something that neither the US wants nor the world wants. So each time there is a kind of an engagement, a military engagement between India and Pakistan, I think this kind of background pressure to bring it to an early halt comes into play. Now, for India, I think, as far as I know, the whole Operation Sindoor was about messaging. It was not intended to destroy Pakistan, to destroy its nuclear assets, because these are things which are not, within the realm of responsible policy. I think, but what India wanted to convey was that between doing nothing and showing strategic restraint and going in for an all-out conflict, India is going to use that intermediate space to retaliate if there is an act of terrorism against India. And I think that messaging has gone on. So if you see yes.
Yeah, Ambassador Shankar, you maintain that India has managed to send out a strong message, not just to Pakistan, but and the world. But if in this crisis, if we had to identify nations which came to India's support and which did not, what would those be in terms of direct support in the military operation or even diplomatically?
Look, as far as the military operation is concerned, a country as large as India, which is taking the initiative to launch a response, a military response, will have to do it on its own. And I think we have to be very clear about that. But many countries, condemned Pahalgam, and there was a UN Security Council resolution also saying that the perpetrator should be brought to book. And in UN discussions, countries such as France, Russia, Israel said India had the right to self-defense, though some qualified it. In the US, I think the Defense Secretary, Pete Hegseth, said that India had the right to self-defense. I think the State Department was more keen on bringing an early end to the conflicts. Now, inadvertently, what happens in this process of giving priority to de-escalation is that a moral equivalence is drawn between the victim of terrorism and its right to respond and the perpetrators of terrorism. And I think that is unfortunate because it sends a very wrong message to the world that, you can get away with it if you use the threat of nuclear blackmail. And I think that is what India wanted to demolish. This myth that because of nuclear deterrence, there are no options that India has to respond to the provocation posed by the terrorist act against innocent civilians in Pahalgam. So I think for India, a ceasefire was not unwelcome. In fact, we signaled that right in the beginning. We didn't attack military targets. And after the attack on the terrorist camps, our military spokesman said, our statement said justice has been served. Basically saying we are prepared to let it rest, not carry it further, but the ball is in Pakistan's court. And Pakistan chose to respond recklessly, attacking our military facilities, and we responded forcefully against that. So I think we were not, in a sense, opposed to a ceasefire because we also did not want a long, drawn-out engagement.
And we had been saying from the very beginning that our action was only against terror camp. In fact, that was the only objective of the operation. It was not to attack or be the aggressor against Pakistan as it was made out. Ambassador Chandra, if I can get you in at this point. Now, the United States has also been an arms supplier to Pakistan historically. What do you think was at stake for Donald Trump vis-a-vis Pakistan? What was important? Why was it important for him to make sure that this conflict stops? US had been in touch with both nations. India has made it very clear that we did not get anybody to mediate. It was Pakistan which rushed to the US. This was something we solved bilaterally. But what is the United States' stake in Pakistan as of now?
Well, Pakistan, as you know, has been a pet child of the US for many, many, many decades. And it still continues to have strong links with Pakistan. It has supplied arms. It has certainly been behind the move, which I think was something which was very unfortunate, of allowing the IMF money to be supplied to Pakistan at a time when it was in a military engagement with India. I mean, if they really wanted to put Pakistan to deal with this crisis and put an end to the fighting, it should have stopped the money supplies through the IMF, because had that been done, this fighting would have been stopped in its tracks, because Pakistan is bankrupt. It could not afford to fight if money was stopped. And this was a very easy option, which the US, if it wanted to be even-handed or friendly or even friendly to India, it would have done so. But I want to add another dimension to this, and that is that what has happened is really not new, in the sense that Pakistan has come out with the nuclear dangers and the threat of nuclear dangers in the past. This is history. It repeated history. And yes, the US, for its own reasons, perhaps used this and wanted to put an end to fighting. But as I stated earlier, a much easier way of doing so, without appearing to support Pakistan, it should have stopped the funding. And the fighting would have stopped ab initio. So I really do fault the US on this account. But to reiterate, the US has had a very long relationship with Pakistan. They have close links at multiple levels. And those links continue and they will continue. And as far as India is concerned,
that's why
we should be prepared
to
fight our own battles with
and perhaps
Pakistan
that was the
directly.
reason. And that was the reason why Donald Trump intervened and took credit for bringing the two countries to a ceasefire, even though we're not using the term ceasefire, and neither we have acknowledged. In fact, the Ministry of External Affairs has gone on record to say that there was no discussion on trade in any of the conversations with the United States since Operation Sindoor began. Ambassador Chandra, Ambassador Shankar, thank you very much for joining us. We're taking a break on the program. Up next, we turn the spotlight on India's indigenous defense arsenal and its role in Operation Sindoor. Operation Sindoor highlighted the efficacy of indigenous Indian weapons as they helped the armed forces respond powerfully to the offensive launched by Pakistan. The BrahMos supersonic cruise missile featured as the superstar of India's retaliation. The fire and forget missile is a precision-guided weapon which was most likely used during the Indian Air Force's coordinated precision attacks. The weapon was developed by a joint venture between India's DRDO and a Russian defense firm. Pakistan's attacks also put the spotlight on India's very own Iron Dome. The Akash Tir air defense system, the DRDO, ISRO and BEL designed system successfully neutralized hundreds of Pakistani drones and missiles. The Akash missile was yet another example of Indian-developed artillery that thwarted Pakistani attacks on several Indian cities on May 8. Another DRDO engineer Marvel, the missile is equipped with 60 kg of explosives and advanced guided systems to intercept aerial threats. India's precision strikes during Operation Sindoor featured India's eyes in the sky, the Nagastra-1 loitering munitions, also called suicide drones. The unmanned aerial vehicle's ability to hover around targets was critical in dismantling terrorist camps with surgical accuracy. Operation Sindoor also saw the Sky Striker suicide drones in combat mode. The drones developed by Bengaluru-based Alpha Design are capable of delivering direct fire aerial precision attacks within a range of 100 kilometers. Joining me now are Ashok Alturi, CMD at Zen Technologies, and John Livingston, former UAV pilot at the Indian Navy and founder of Jonet Technologies. John, if I can begin with you, give us a sense of how drone technology took center stage in this conflict in Operation Sindoor against Pakistan.
Well, we were already preparing ourselves in terms of using drone technology in all the upcoming difficult situations, especially the border situations. Why? Because of the original awareness when the Armenian-Azerbaijan war started. So that was a first wake-up call for the whole world, where drones would have been drones are making a lot of changes around the world. And then we saw from 2022 February onwards the Ukraine-Russian war, where more than any other equipment, any other fighter craft, aircraft, drones have been very, very useful. So we were already preparing in all our future battles for this thing. And when the right time came, India did not even think of using any other equipment more than drones. So drones have contributed for more than, I think, 60% of its battle when we had this Op Sindoor.
All right. Let me also go across to Ashok. Ashok, are you there with us?
Yes, please. I'm here.
All right. Ashok, I would like to understand from you, give us a sense of how this operation will somehow urge defense manufacturers in India, drone manufacturers, to double down on indigenous manufacturing of drones in the country.
Yeah, I think there is no doubt about this. Not only, the thing is this, the drones are one part of the equation. The other part of the equation is how do you protect yourself against the drone? That is the anti-drone systems or a counter UAV strategy that we need to have. So, as he said, John had said that, in the first war was won by Armenia in 1994. It was a 6-year war. And when in 2020, 27 September 2020, they attacked, Azerbaijan attacked, the war was over in 44 days. So that is how effective the drones were when Azerbaijan took revenge on Armenia. So we have to get a complete paradigm shift that's happened. And what in 2018, when we were looking at the ecosystem, everyone was talking about only drones. And, we always think, in that Zen, we always believe the, noise is not the signal is in silence. So sometimes when nobody was talking about anti-drone system, then started investing. And today, we had that investment has paid off. And, there is a huge shift, completely, it is a drone-based warfare. The F-35, the Rafales, they really are not very, very, very useful at this point in time. So, we need to, and I think that this change is permanent. It's not, it's like sword fighting to gun fighting. It has completely changed the paradigm.
Right. John, would you agree with that, at a time when we are looking at filling in the gaps in the capabilities of the Air Force in the short, medium and long term, especially with fighter jets, there has, of course, been a delay in the Tejas program as well. Do you feel that somehow this strategy of making sure that the Indian Air Force has the required number of aircraft in its fleet perhaps needs a rethink after what has happened in Operation Sindoor?
I wouldn't say we should rethink on that. Our air power, as on date, still stands with the fighter jets. I would not completely say just because last, say, 10 years, we are watching drones are more effective and more probably proving to be more effective in wars. We need to have both the technologies. Of course, having inducting new technologies like drones, anti-drone systems is very much important. At the same time, we should not stop our programs of inducting fighter aircraft. Of course, having the Tejas makes us more stronger, self-reliant, and it will only enhance our air power. And drone is not just going to be our air power, it's going to be a new force all in all. So that's a new force which we have to change our approach, like how Ashok sir has been mentioning. Then there's a paradigm shift that is happening. We need to move with the shift, yet retain our past powers. That's what I would feel.
Right. John, now also we're looking at a situation where we were seeing from Pakistan 300 to 400 drones being sent in. Of course, they were intercepted by the brilliant Indian air defense grid. But the fact is, what is the kind of pipeline or inventory that India would have to build up in the next few years, considering that drones had played a center stage, and you would have 300 to 400 drones coming in one go, and perhaps on one night, we saw drones coming in 2 swarms.
Yes. So what's happening now is that is something we are also adapting. We have not started inducting too many swarm drones because that's quite a latest technology which last couple of years we have seen a lot of swarm technology in drone shows. Now that shift is moving from commercial activities to military operations. Swarms are going to be the next future of drone usage in all the wars. We have to, I would say, at least induct more than 10 million of swarm drones within our inventory. If that is not done, we won't be able to handle our adversaries around us, because it's not just one adversary what we have right now. We have many around India. So we need to be more prepared and we need to have more inventory. It's not just one type of swarm drones. It's multiple types of drones is what we need to look for inducting in the immediate future. And there's a surge in demand from the armed forces to induct more drones, loitering munitions, FPV kamikaze drones, and bomb droppers.
Right. That's an important point. And Ashok, coming back to you, looking at the lessons from Operation Sindoor, at Zen Technologies, what is the kind of drone technology that you would like to focus on for future?
The first thing is that we should be having a very, very strong anti-drone ecosystem. Because no matter what drones come, we should be able to block them, soft kill them, and where required, we use hard kill to eliminate them. But again, to your question, what is the kind of infrastructure we need to build? The answer is this. First of all, we stock them enough. And second is, we should assume a multi-front war going on with all our adversaries getting together and attacking India. And in that situation, whatever we spend per day, the industrial defense capacity should be enough to replenish the whole expenditure. So that is how big the capacity should be there. Worldwide, what the governments do is, listen, you're only manufacturing 30% of the capacity, but here is the money to build the 100% capacity. Keep it spare and ready with us. I think government would need to take very, very, prophetic decisions in this regard and build a capability to last a full-fledged multi-front war, and we should be able to replenish during that conflict.
All right. Thank you very much, Ashok Alturi and John Livingston, for joining us for a very interesting conversation on the importance of drone warfare in India and how high-tech warfare took center stage between India and Pakistan as well. Thank you very much, John and Ashok, for joining us. That's all we have time for on News Center. Goodbye.
welcome to this very special edition of the Global Dialogue. I'm Shriram Finance. Let me try and introduce my guest to you today. In his own words, he's a made-in-India product, having gone through the Indian education system, started his career at Nestle, worked at Pepsi, Citi, and then spent over a decade at MasterCard, and then has made a very unusual turn, taking over as the president of the World Bank Group. His mandate, again, in his own words, is to make the bank bigger, bolder, better. Joining me today on this very special CNBC-TV18 exclusive is the man himself, Ajay Banga. What an absolute pleasure. Thank you very much for joining us. And may I say, welcome home.
Thank you very much, Shri. It's nice to be back.
Well, it's great to have you here, Ajay. Since you are here in India, let me double down on your view on India to start with. The World Bank estimates a growth of 6.7% over the next 2 years for India, but you do believe that we need to do 7.8% on average over the next 22 years to be able to get to that high income aspiration by 2047. As you look at India today, size up the opportunity for me.
Look, I think first of all, I think the opportunity of becoming a fully developed country is a really cool target to aim for. Because I think when you set up a target like that, you set up a plan like that, you can get people driven and motivated with a single vision of where they want to go. So I'm a full believer in that perspective. Getting from here to there, I don't measure things in straight lines, and therefore I don't really care about the 6.7 and the 7.8, because you will have years when things will work better. You will have years when things will be difficult. Part of those will be outside of your control as a country. Part of those will be within your capacity as a country. The important thing to do is to figure out what you can do in your capacity to insulate yourself to the maximum extent possible from the vicissitudes of global economic systems. So right now, for example, the global economic system was powering along just fine. We do have challenges currently. People believe that those challenges caused by a change in geopolitics, by the circumstances around tariffs, could create a slowdown. No one's been able to show that yet, because if you look at the US numbers, they're still powering along. So I think you've got to try to take this one step at a time rather than read too much into any one direction.
So you don't believe we're heading into a situation where global growth is going to be impacted severely on account of the tariff uncertainty and the possibility of a recession in the US?
So I think those are all possibilities, probabilities. As my old boss Bob Rubin used to say, life is full of probabilities. These are probabilities. My way of thinking about it is, if things continue the way they are today, meaning if uncertainty and volatility remains part of the system, then definitely there will be a slowdown in global growth. But you don't know that. You don't know if tomorrow or the next 10 days, 2 or 3 trade deals get signed, and all of a sudden, people will say less uncertainty and it changes. So my own vision of this is, compared to where we were a little while ago, it is more volatile today. There's no doubt on that. Volatility creates uncertainty for a CEO, for an investor. People will hold back on 10, 20, 30-year decisions. It takes a little while to turn that tide. So that will be a problem if it continues for a while, but you don't know how long it'll continue for.
No, we don't know. And you talked about trade deals. And one, of course, is, the UK-India FTA has finally been done after many years of negotiation. And President Trump tweeting, saying that there is a possibility of a deal being done later this evening. And in all likelihood, it's going to be the agreement with UK. As we look at these bilateral agreements being signed up, how do you see this next wave of globalization, so to speak? Because there are concerns that we're retreating from globalization, but are we perhaps in a new era of globalization?
So somebody asked me this the other day, and I said to them, actually, this change of the model has been going on for a little while. So if you look at the data, in the last 10 years, 100 different regional and bilateral trade deals have been signed. If you go back 20 years, 250 of them have been signed. Today, there are 375 plus regional and bilateral trade deals operating. It's just that the public conversation was not about this, and now it's got focused onto this issue of bilateral and regional trade deals. The reason that this model has been changing over time is, I think, quite fundamental, and the real fundamental issue is the idea that you could outsource an OECD job to a developing country by changing the location where something was made because of a change or because of an arbitrage in labor costs. And eventually, also an arbitrage in logistics, because these developing countries tend to do logistics very efficiently when they start from scratch, right? So if you moved a T-shirt manufacturer from the Carolinas to Vietnam, you went there originally because of the labor cost difference. And eventually, you also got a logistics cost benefit. And so you stuck around there, and in theory, you created jobs in Vietnam, and Americans got T-shirts cheaper. Yep, and then macro, America should have been doing more digital, less T-shirt manufacturing, also good at a macro level. At a micro level, the person in the factory in the Carolinas, their life changed. And unless you believe that that is a one-to-one relationship where that person seamlessly moved into an outstanding, higher productivity, higher paid job, which did not happen, then you have to believe that this model cannot persist forever. All you're seeing today in the political firmament is that coming to be seen in the developed world. And I think, therefore, what you're going to find is jobs being created in the developing world, critical factor of jobs, but being created probably in sectors that don't rely as much on the preponderance of global trade caused by labor cost arbitrage or logistics arbitrage. And I think some other form, which I'm happy to talk to you about, but that's where I think life's going.
No, so what is the new normal then likely to be when we talk about this reset, this global reset that you just kind of alluded to? And in the context of this global reset, then how do you find India positioned?
So it's not that global trade will stop. I'm just saying relying on that as the sole engine of driving jobs in the developing world, that's something you should rethink. My belief is that jobs are even more critical in the coming 10 to 15 years than they were in the past 20. And that's because if you look at the demographic numbers in the world, the emerging markets are going to have 1.2 billion young people coming through the pipe to become eligible for a job in the coming 10 to 15 years. The same countries are currently slated to generate about 400 million jobs. Now, these are forecasts, and they're made by economists, so I would be careful about that. But we're not going to be wrong by 800 million people, right?
We hope.
We hope not. So and forecasts are not destiny, so you can do something about them. But you're not going to. You have to find a way to change what we're doing today if you're going to step from 400 million to 1.2. And my belief is that you'll get 5 sectors that address the topic we were discussing. That'll help to create these jobs. The first is infrastructure. It's construction, but then what it enables. Bridges, roads, airports, schools, skilling institutes, digitization, healthcare, electricity. And the World Bank is very focused in that space. The second big sector is agriculture as a business. I think the phenomenon of smallholder farmers and their children not wanting to be a farmer, selling off their property, thinking they're rich, and 4 years later ending up as urban poor is a very poor outcome of development. That's not the way to get it done. We have to find a way to get smallholder farmers' children to feel that this is a productive opportunity for them as well. That requires an example like Amul to be repeated many times over in many countries. Cooperatives that enable you to access better techniques, better technology, better growing, better fertilizer, better seeds, better water systems, better prices for your produce. AI app today that allows you to say that stain on my crop is this disease for which I can get this spray from my co-op. I don't need to be a rocket scientist to do that. I just need to be a farmer with access to a phone. That is to me a big opportunity, and the bank has said that we will put $9 billion a year into making smallholder farmers think about business of the agriculture as a real opportunity. It's not very different to what India wants to do with rural prosperity. The third is primary healthcare. So obviously a healthy labor force is important, but actually what you'll do with the right primary healthcare systems is you will create jobs for nurses and medical diagnostic readers and technicians. You'll create a job for PPE manufacturers. You'll create jobs for pharmaceutical manufacturing. You'll create jobs for midwives. Things that are not just doctors, but create a ladder of jobs that you need to provide in a growing economy of the type we're describing in the developing world. And a fourth category, and again there, by the way, in primary healthcare, we've said we'll reach 1.5 billion people by 2030 with improved access to healthcare. I mean, the other side of this is that the diseases of prosperity, blood pressure, diabetes, heart attacks, and strokes, the non-communicable diseases, if you diagnose them early, you can bring healthcare costs down in a country dramatically. So this will help with that. The fourth one is tourism. That is a more obvious one to most people. And I don't mean over-tourism, and I don't mean numbers. I mean quality tourism done the right way. I was in Sri Lanka. It's a big opportunity for them. We're not experts in tourism, but we are very good at designing skilling institutes that work backwards from what the opportunity of tomorrow's jobs will be in the private sector. Work with the private sector to run those. And the last one to me is manufacturing, both for local and regional consumption, as well as global trade, but in a way in which you create value-added jobs in the country. So if you're a country that is blessed with minerals and metals for the energy transition, extraction is not where the money is. It's the value-added processing of that extracted material that's where the value of jobs is. And I'm trying to enable people to think about whether a job with a small company, medium-sized, large one, whether as an entrepreneur, think in these 5 sectors. You will notice there's almost zero necessity here to outsource an OECD job.
You know, Ajay, you've very clearly articulated for us the 5 pillars that you believe the bank needs to focus on and governments and policymakers need to focus on to address the jobs challenge because, you've said previously that jobs are the nail in the coffin of poverty. But address that in the context of the challenge that we find ourselves faced in India. You've got this young population, you've got an economy that's growing, but jobs not being created at the pace at which we need. Of those 5 pillars, what do you believe India needs to prioritize as we look at addressing this jobs crisis?
I think there's 2 things. I'll come to the 5 pillars. There's one other thing that you need to understand about jobs, which applies for India as well, but applies to many countries. And that is that to create jobs, you need 3 things to happen. You need infrastructure, what we were talking about, which India is doing a great deal of work on in the past 10 to 20 years, whether it's roads or bridges or airports or electrification and water availability. And there's work to be done on education and skilling. I don't think that task is done yet, but there's a fair amount of progress across the range. The second part is the regulations and policy clarity that enables businesses to succeed. And there, while I think India has made a lot of progress, there's much more still to be done. And I think that's a topic of regular public debate, so I'm not telling you something new. It's everything ranging from further land reform and labor reform to things in that form that enable the private sector, which is the 3rd pillar of this strategy, to actually grow and develop. 85% of jobs are created in the private sector, the overwhelming majority of them in small and medium businesses. They cannot navigate challenges on regulations and policy the way others can. And I think, therefore, thinking through these 3 pillars of infrastructure, the right kind of regulatory policy, enabling the private sector with blended finance and insurance and guarantees and the like, is how I think about the job cycle, the virtual cycle of it. India, in the context of those 5 sectors, is doing fine on infrastructure with work to be done on education and schooling. I think India can do much more on agribusiness. It has done. Amul, to me, I've been quoting Amul for the last 8 or 10 years because of my days at Nestle. I used to admire Amul for what they got done. And I think it's just one example. There are more like that. But because that one is such a shining star, I think it's worth studying and understanding and trying to replicate to the extent possible in many countries around the world, including in other parts of India. On primary healthcare, India has made progress, but there's enormous more to do. India's progress is on neonatal and maternal care and vaccinations and the like. This I'm talking about is an early diagnostic system spread across the country in a way that catches these diseases of prosperity earlier in their cycle. And in the process, you'll also catch pandemics earlier while also creating jobs. There's work there. India's tourism, much improved from earlier. But if you look at the numbers of tourists that come to India, just remember to keep it in context. New York City gets 62 million a year, just so we know what we're talking about. London gets 64 million. Paris gets 64 million. So India, with its culture, beaches, mountains, history, food, shopping, fabulous people. I mean, there's much more that we can do here. It starts with the infrastructure and works its way through. Manufacturing is the one that India is very focused on as well. And I think you guys are making enormous progress with things like what you're doing for Apple. And the circumstances around the geopolitics now means that actually India could stand to pick up some more benefit from there. But But I'm telling you, you don't create a lot of jobs by manufacturing Apple phones in the numbers that you need to change the tide in the Indian context. You do create fabulous jobs, don't get me wrong. Yeah. Anybody who works in an Apple assembly factory is very fortunate to have that job. But you're talking about a challenge of many millions more than that. That requires a focus on all those other sectors as well.
But if I could specifically talk about manufacturing, because India believes that this could potentially be the big manufacturing breakthrough in light of this global supply chain diversification, global supply chain resilience that people are talking about. You gave the Apple example as one of the examples. What do you believe needs to happen on the manufacturing side to really leverage what has opened up as an opportunity for India today? And how big of an opportunity do you really see? Do you believe this is India's manufacturing moment or could be India's manufacturing moment?
To be honest, if we don't seize it quickly, the moment will pass us by because others are moving on to it very quickly as well. So, but that doesn't mean India doesn't have an opportunity. The real issue is India's logistics cost is very high, even now. And if you look at the arbitrages I was referring to in the beginning, labor and logistics, you've got to be careful about the logistics cost, and fixing that logistics cost arbitrage is going to take some out-of-the-box thinking into how to change that. And I think those are not, it's not a one-year cycle to change that. But there's work that can be done. I believe that India has the benefit of a huge workforce that could be put to work. It will need skilling. That's why I kept talking about skilling a little while ago. I think India wants to do it. I think the Prime Minister is very clear in where he wants to go with it. So that will help on one side. Working on logistics will help. And clearing up the processes of opening a business, acquiring land, managing labor, those are going to be very important, Shireen, if you want to really get into the global supply chain the way you want to. The other thing is, what will help really in global supply chains is a zero for zero discussion. So if the trade deal that comes through is that kind of deal, boy, that will facilitate the reduction of friction enormously, which is what you need for a global supply chain. So there's a number of pieces that happen to be falling into place. And India, through its effort on infrastructure construction over the past few years, has managed to move itself into the right place. Now the question is, can you make the next move and take advantage of all that?
also get a view from you on what's happening in the region. You've just come into India from Sri Lanka. The World Bank has signed now a new agreement with the government of Sri Lanka for $1 billion. This is a complex region, and we're currently also talking about an escalation of tensions between India and Pakistan. How do you see the region, Sri Lanka, Bangladesh, Pakistan, and of course India?
Yeah, look, first of all, civilians losing their lives is a disaster anywhere in the world. For those of you who are living in India where you saw this happen a few weeks ago, you have to be feeling it even more acutely than somebody like me who now lives elsewhere, even though I understand the situation on the ground in this region well. So that goes without saying. And that creates its own uncertainties and volatility in people's minds, but this too shall pass, right? The question really is, this region, South Asia, is one of the regions in the world where intra-regional trade is abysmally low as a percentage of trade. So if you look at some trade numbers, which we started talking about the uncertainty in this space, trade has doubled in nominal terms in the last 20 years, globally. The share of the developing countries in that has also doubled from around a quarter to around a half. The share of developing countries' trade among themselves has also doubled in that period from around 20 to around 40 something. But South Asia is single digits. Africa is single digits, low double digits. Latin America and the Caribbean is similar. These three regions are not realizing the potential yet of trade among themselves as a great prophylactic from being over-reliant on one or two or three large buyers for your produce otherwise. And I think as part of this change of trade, this may be a good time as countries here strike individual deals with the US, which they should, as soon as possible to reduce the uncertainty. But at the same time, they should look at their own tariff and non-tariff barriers. The reality is that the United States has the lowest tariff barriers of any country in the world. Even before this 10% flat rate, even with the 10, it'll be one of the lowest. The developing world has far higher tariff and non-tariff barriers for various good and bad reasons. I'm not questioning the reasons. I'm just saying, is this an opportunity to change that? And everybody knows that if you reduce tariffs, while you go through some pain, eventually you get growth out of it. And so the question really is this the right time to look at facilitating greater intra-regional trade in these countries? And will that be helpful in itself? It won't all work seamlessly, but it's worth thinking through.
But is it even a possibility given the geopolitics and the history?
Everything's possible when politicians put their minds to it to find solutions. This is a political problem, not a development problem. I'm not qualified to comment on that. I'm very clear what I do, what I don't do. I don't comment on politics. But I will say the economic opportunity to me is enormous. And take for example electricity. I know that the Prime Minister has thought about this a few times, which is to think about connecting the electricity grid across at least some of these countries. And you don't have to do everything across all of them. You can pick some where there is a commonality of thinking. That would be enormously beneficial. Even Sri Lanka and India connecting an electricity grid could be enormously beneficial. And so intra-regional trade of all types is generally a good thing to explore.
Well, speaking of inter-regional connectivity, trade, let me ask you about the Indus Water Treaty, because India has decided to suspend the Indus Water Treaty at this point in time. The World Bank, in fact, has been a facilitator of the Indus Water Treaty going back to 1960 when it was inked. Have you heard from the Indian government? Is the World Bank planning to intervene in any form or fashion on this issue at this point in time?
No, I'm not. The treaty is not suspended. It's technically called something in abeyance, is how the Indian government worded it. There is no provision in the treaty to allow for suspension, the way it was drawn up. It either needs to be gone or it needs to be replaced by another one. That requires the two countries to want to agree. The World Bank's role is basically that of a facilitator if they disagree, not by us making a decision, but by us being the party that goes through a process to find a neutral expert or an arbitrator court to settle it. And we have to pay the fees of those guys through a trust fund that was set up at the bank at the time of creation of the treaty. That's our role. We have no role to play beyond that. I haven't heard from either country yet about anything to do with the Indus Water Treaty. So that's exactly where it is. I know there's a lot of speculation in the media about how the World Bank will either fix it or not, or be approached or not. It's all bunk, because we don't have that role to play. And I wish you would help me tell the media that they should take a look at the treaty and realize that the treaty is a treaty between two sovereign nations, and they have to decide whether that's what they want to continue with. It's their decision, and so be it. It's worked for 60 years through ups and downs. It hasn't worked perfectly. Both governments will tell you it's been through ups and downs. So I'm not one to argue that you shouldn't play with it or change it or amend it. I just think this is a topic for the countries to decide. And the World Bank's role is what the World Bank's role is as defined in the treaty, no more and no less.
Tata Motors reported its financials for Q4 FY25 and profits stand at rupees 8,470 crore, revenue at 1,19,000 crore. The EBITDA came in at 16,992 crore. Jaguar Land Rover reported revenues of 7.7 billion pounds and the EBITDA margins for JLR stood at 15.3%. The company reported a 10th consecutive profitable quarter. Free cash flows at JLR were £1.5 billion for FY25. The company also managed to achieve its guidance of turning cash flow positive by the end of FY25. Tata Motors expects investments spent for JLR to remain at £18 billion over a 5-year period, and this will be funded by operational cash flows. Joining us right now to discuss Tata Motors' overall performance in Q4 and also the outlook going forward is PB Balaji, the Chief Financial Officer of Tata Motors. Mr. Balaji, thank you very much for joining us. How would you describe the overall demand sentiment, the mood in the economy in India right now and globally?
Firstly, thanks for having me on the show. Appreciate it. Overall demand situation as far as India is concerned is, I would say, is modest, is decent, not scorching. At the same time, neither is there any major concern at this point in time. So I would expect modest growth coming into this year. On the commercial vehicle business, I think the underlying fundamentals of the growth is very much intact, be it on freight rates, be it on interest rates, fuel prices. Overall, GDP growth in the industry's economy is good. At the same time, even investment plan for the government also continues to remain strong. So all of them portend well for a decent growth. When does the cycle begin? When does the cycle, which part of the cycle we are in? Very difficult to predict. But medium to long term, no major concerns as far as the CV growth is concerned. On the passenger vehicle growth, I think we did have a lukewarm growth last year. Nothing much to talk about last year. And I would suspect that this year would be a year where it will be modest growth once again and gradually build back as the year progresses. So overall, I'm quite comfortable with the demand situation in India, and we should be in a position as Tata Motors to continue to do well in this market. For us, the reason to do well, if I split this into CV, PV once again, I think on the commercial vehicle side, we are doing quite well on the heavies, the passenger carriers, as well as the intermediate vehicles. Where we have not done a good job is the small commercial vehicles. And this is a year where we expect to fix those issues that were more front-end issues that we have. We intend to fix that this year. On the passenger vehicle side, I think our product launch cycle, we get the offensive from now on. We just had the Tiago relaunch happening. We just had the Altroz relaunch that just happened 2 days back. All that augurs well for the hatches segment, which is where we lost last year. And the SUV segment continues to do well for us. We grew well ahead of the market. And that is an area where we have the Harrier EV landing, the Punch MC mid-cycle refresh happening. And then we also have the Sierra happening later in the year. So there's enough to go for growth as far as the PV EV business is concerned as well. So overall, the India growth plan for next year for us is strong, and we intend to drive that hard.
Okay, I would also like to ask you about market share loss in the passenger vehicle segment. In fact, analyst reports this morning have expressed some caution and concern about continued market share loss in passenger vehicles. Would you like to weigh in on this concern and how the company is looking to address that?
I think for me, last year is a year of consolidation, 13.2% share. In many months, we were number 2 in the market. So it's not so much a market loss, share loss issue. It's more about how do we grow market share from here on. In that, there are 2 angles here. One is our product launches start from now on vis-a-vis competition, which was more last year. And at the same time, we also had a challenge with respect to our capacity available on our service network, which created some amount of challenges from a customer perspective. Both these are addressed. So we have an intensive product launch pipeline starting now. And we also have more or less fixed the service capacity issues that were there. And that should ensure that the customer sentiment on that goes up as well. Both these augur well in terms of delivering growth well ahead of the market. And we are quite confident of how we are stacking up as we enter the new year.
Right. Speaking about EVs, you have a 55% market share in the electric vehicle segment. Now, the launches by your peers has, of course, impacted the space. There are more players entering, and there are companies which have increased their sales numbers on a month-to-month basis as well. How do you see competition? Do you think your EV strategy needs some rethink right now?
Not really. We just need to execute that with speed. And let me tell you how we intend to go about doing that. The first focus of the EV business is to drive penetration of EVs in the overall portfolio. I am not focused on market share here. It is more about how do we grow this market sequentially. Last year, we had a fundamental issue with respect to the fleet segment getting into challenges because of FAME incentives going away, as well as some of the EV players, EV fleet players are having a few challenges. And this year, we intend to address that in terms of catering to a wider EV portfolio than what was there last year. So that is going to be an important aspect of fixing the bleeders first. Then in terms of the portfolio itself, we are the widest range portfolio in the market with Tiago at one end, and when the Harrier EV launches, that is the other end of it. And then we have a Sierra that's coming in as well. So this kind of a wide portfolio with multiple range offerings makes us cater to different customer segments well. And that is what we intend to leverage as we go forward. So with the product portfolio in a intensively expanded and ensuring that we fix the fleet segment, we believe the growth volumes will start coming up. Then we have a bigger issue to solve, which is basically how do we drive up penetration of EVs in the overall passenger vehicle segment. And for which I think there are two issues to fix. One is the charging network expansion. Last year we now have about 21,000 fast chargers in the country, and we want to continue to work with our charge point providers to ensure that we expand this further. And number two is range. And now we are seeing that more and more cars are coming even from our stable at greater than 400 kilometers range, and that is more or less going to remove the range anxiety from the customer segment as well. These two should help ensure that the EV penetration drives up as well. So we have a comprehensive plan in place, and it is our intention to execute this flawlessly so that we can drive up penetration of EVs in the overall portfolio. Okay, market share of EVs in the overall, that's a less important issue. What is more important is to ensure that we drive up penetration.
Driving up penetration. And when you say that you want to increase the number of charging points all across the country, would there be any targets for FY26?
We haven't put it out there, but rest assured, this is priority number one for us on the EV side.
Okay. All right. Now, JLR, you've met your target of making the company cash positive by the end of FY25. How do you expect to perform on this parameter in FY26 and 27? Given the company's capex plans?
Yeah. There are two metrics that were critical to deliver last year. Actually three. One was delivering the revenue of about 29 billion, which we have done. Second was to deliver 8.5% EBIT, and we delivered that 8.513%. That is what the final number was, the third decimal point. And third is to ensure that we go net cash. I think all these targets, if you go back in Q2, when there was the aluminum issue that we faced, there was a lot of skepticism on whether we can pull it off. And here we are after 6 months confirming, yes, we have indeed delivered that. So one thing which we want to ensure in anything that we do is the say-do ratio has to be of a very high order. And from our perspective, what we are seeing now is in this kind of external environment that we are currently facing, which is a bit unclear. Because one is, of course, it's challenging. The other is also we are not clear what exactly how it plays out. Take the UK-US tariff, for instance. We welcome really the deal that has been done, which is now reducing tariffs from 25% to 10%. But it has gone up from 2.5 to 10, number one. Number two, even that reduction, we are not clear when does it become effective? Is it applicable for parts? Is it applicable retrospectively? So those are questions that are still out there, and we are hopeful to get clarity on that. Once we get clarity on that, it's our ability, then we'll be in a better position to predict what the numbers are going to be. Having said that, what we are distilling out of this situation is that there could be two impacts. One is your demand is likely to be impacted, particularly in the US, for which we need alternate sources of demand, number one. Number two, the tariffs are going to have a significant impact on your costs, and therefore, how are you going to ensure you manage the cost in that environment? So if I look at the first one, that is demand, what we have going in with is US is probably likely to be having a lower growth next year compared to what we had last year. And therefore, we need additional sources of growth. The first market that is looking very good for us is UK, and we would intend to accelerate that. Second is Europe is always is a very large market and a market that we are doing well, and it's a market that is starting to stir up, and therefore we would want to leverage that. China, which had been bleeding, is now, I think, is now stabilizing, at least for us, and therefore we would want to see how much we can build back on that front. And there's an overseas market that is doing very well for us, which is Middle East, India, etc. And there again, we should want to diversify our growth sources. So that is how we intend to play the demand side of it. On the cost side of it, I think, yes, tariffs are a cost. How much of it we can offset through pricing, we will see. Then on top of it, want to look at cost outs in the areas of warranties, ex-work costs, VMEs, better mix, the whole works. So we are looking at it comprehensively, and given our track record of delivery on cost agenda, we are quite confident that we will deliver the plans that we are putting together. How does the overall number balance because of this? I think you'll need to give us time till June 16th when we have the investor day, when we are able to tie this all together is our expectation. Hopefully by the time we'll have clarity. Sorry for a long answer, but hopefully that wraps up the entirety of the issue.
No, of course, sir. That was indeed an important point. I'd like to ask you also about the kind of impact that you're already seeing as a result of the tariffs that have been imposed by the United States, the tariff situation in Europe as well, because of US-Europe tariffs right now, the kind of tariffs that Donald Trump has imposed. For the UK, for the Europe market and for China, the immediate impact that you're seeing right now?
We are not seeing any impact at this point in time. The first impact will be felt in the US, because that's where the cost is going to go up. And so far, we have not seen impact. I suspect that's our reading as well, is the premium luxury segment, which is where we are playing, is relatively more resilient to these cost increases, price increases compared to other segments of the market. But at the same time, we need to be respectful of the customers as well. So that is the balance we want to strike.
All right. We're going to take a short break, but this interview, this conversation with Mr. Balaji, the CFO of Tata Motors, continues on the other side.
Welcome back. You're watching CNBC TV18 and we are in conversation with PB Balaji, the Chief Financial Officer of Tata Motors, on the company's Q4 performance and the outlook for FY26. India-UK deal, that has been welcomed by many. How does this improve your outlook for JLR in India?
Yeah, it's a deal that we welcome, and I think it's a very good deal for JLR, but it will play out over a period of time. As far as the immediate impact is concerned, there's no impact because if you look at the Range Rover portfolio, all of them are localized here in India through a CKD operation. And Defender, which we import, comes out of Slovakia, that is Europe. So that's not impacted by this FTA. So some of the questions which we are getting in the analyst call yesterday in terms of pricing in the market, etc., no change as far as the existing setup is concerned. Where it starts becoming interesting is the new products that will be generated in the future. Our ability to therefore access these at global prices is going to be far more in this kind of an FTA environment. At the same time, we also have to see the reverse from India to UK. What are the final structures that is coming in? I can see, for example, let's say the Agratas batteries. Is there an opportunity there? Is there opportunities for Indian cars to go there? Those are things we need to see. But in all this, again, similar to the UK situation, there is the fine print is awaited. And we need to know by when this is going to be implemented. What are the quotas that are going to be put in place? How does the arc go from 100 to 10% that people have said by 2030? What are the kind of time frames? How fast, how steep is it? So a lot of open questions at this point in time, but I think it's a matter of time before those clarity will be provided. So I will look forward to the details and the announcement notification of the tariffs under the FTA agreement. Until such time, we'll just have to wait and see. But no immediate change on any front.
Right. Mr. Balaji, we've signed a trade deal with the UK. The nitty-gritties are going to be worked out, but essentially it is a tariff of 10% that has been discussed. India will be imposing a tariff of 10% as opposed to 100% on fully built cars, and this will be for a fixed quota. We're looking to sign a FTA with Europe also, and it could be signed within the next few months. The US interim deal will also happen. Now, considering this environment right now, where India could strike 3 trade deals in a matter of months, does it make business sense for JLR to consider manufacturing electric vehicles in India for global markets? Is that something that you're weighing in strongly, perhaps in your new plant in Tamil Nadu?
All options are on the table. I think we always dynamically look at supply sources from all places. We will just have to wait for all the details to emerge, and these options then become whatever is the most sensible long-term option that is going to work out is what we will go for. And until such time those details come, all we can say is we'll remain open to all options. But before that, I can't comment anything because I don't know the detail.
Right. I would also like to ask you about the mood in China right now. US and China have agreed upon a trade deal, but China being JLR's one of JLR's biggest markets, how are things and how is the sentiment and outlook looking like?
I think China last year was a good year for us in terms of relative performance. Yes, absolute performance we did was weak, but relatively we have done much better than players there. And you'd notice that we are amongst the only few OEMs in the world which did not change our guidance and delivered on our guidance too in the last year. And that a lot of it is because the China market is something that we have managed exceedingly well and learning from our lessons of the past, particularly 2019, where we did have a few challenges at that point in time. So those learnings are well embedded, and that is what we are leveraging in the current year as well. I think what we are seeing in China is there's a leveling off of the demand situation that was there. At the same time, VMEs are pretty high for some of the OEMs there. We have managed to keep it extremely tight. Our OEMs are our VMEs are half of what the other OEMs are currently running at. And we intend to keep it that way. So we would want to ensure the health of the network and the VMEs are kept low. And then whatever natural demand comes out, that is what we would want to work with. And that we're seeing that natural demand stabilizing. And therefore, we'll invest in the brand, ensuring that we gradually build that natural demand rather than worry about any supply chain noise in between us and the dealer network.
Right. My final 2 questions. On the commercial vehicle business, we're looking at a transition to new regulations for AC trucks that come into effect from the first week of June. What has been the expenditure that the company has to incur to make that transition?
For us, any regulatory change, we do not go with just that. We wrap this as a complete package for the customer, because we need to ensure that the TCO is well protected as the regulations kick in as well. And we believe that the product offering that you're putting together is compelling enough to ensure that the regulation is complied with. At the same time, we're also solving some of the inherent challenges that the fleet operator or the truck operator faces. So can't give you a direct number on that, because we are not doing it as just a regulation. We are converting it into a full-fledged value-added offering. That's how we are looking at we've always done it for BS4, BS6, and that is what is giving us good results as well in the market performance.
Right. There is also a discussion on zero for zero tariffs in the FTA with the United States. Would you welcome zero tariffs in the automobile sector with the US market?
I think too early to say. It depends on what structure it is, because the cars that are made in the US that's a very different segment of cars and pickups that are there. So we'll need to see the individual details before we can comment. But conceptually, I think ensuring free trade flows both sides is something that we will always welcome.
Right. And finally, sir, on hybrid vehicles, many state governments, and most recently the Delhi government, has been weighing the same incentives on EVs as on hybrid vehicles. What would be your view on that? And considering that different state governments are looking at future policies and are considering hybrid as also a strong option when it comes to climate action, are you looking to launch hybrid vehicles also in your portfolio in future?
I think firstly, we should be clear what is the need for an incentive. You incentivize stuff where there is a funding gap, and we are expecting technology to evolve and to meet that funding gap, so that you ensure that you're not permanently funding something. That is the purpose of funding from a government perspective. Hybrids are decades old technology, and people make money on that. And there is nothing new that is coming through on that to be in a position to say there's a funding gap there. So conceptually, we do not agree to, and we do not understand both why any incentives have to be given on hybrids. People are supposed to sell hybrids for managing their own CAFE compliance. So they don't need a carrot for that. They actually need a stick if they do not comply with it. Number one. Number two, with respect to our own launch of hybrids, nothing to do with incentives. It's more to do with what customer wants. And as I said earlier, it's a pretty well-established technology. In that situation, if tomorrow the customer believes that he wants to go into hybrids, then we are very much willing to offer the hybrids. But at this point in time, we do not see at the kind of low displacement engines that most of the portfolio of the country is. The case for a hybrid actually doesn't exist, because two powertrains are more expensive than one powertrain. Whether there are other forms of hybrids that can help you drive EVs better, that's a different discussion. And in all this, the one thing that you also talked about emissions there. The one thing we should be careful about is that, and globally that is becoming a very important point as well, that people don't use the hybrid where it is supposed to be used, at least when the incentives were given. Invariably, the electric side of it stops. You invariably try to use it as a ICE engine only, in which case emissions don't go down. You're given away a tariff for a diesel engine or a petrol engine, which is not appropriate. So that's how we see this whole story. As long as it's a customer side of the conversation, we are more than happy to engage. If it's an incentive side of the conversation, we do not subscribe to it, and we believe whichever government is giving it is wasting its money.
All right. Thank you so much, Mr. Balaji, for joining us on the program, giving us your view on the growth drivers for Tata Motors and JLR for this financial year, and some of the headwinds globally as well. Thanks once again for being with us.
Thank you. Thanks for having me on the show.
All right. That's all we have time for. Thank you for watching. Goodbye.
Hello and welcome to Startup Street. I'm Shruti Mishra and with me as always Arundhati Ramanan and Ritu Singh. These are the top headlines from the startup space. VFlow Tech raises $20.5 million led by Granite Asia. The round also saw participation from Antares Ventures, EDBI and other existing investors. Proceeds will be allocated to scale the firm scale its manufacturing plant in India.
Omnichannel jewelry retailer Bluestone gets 40 crore rupees in a debt funding round. This debt round was led by Black Soil with participation from Caspian Impact Investments. The latest fundraise comes ahead of its planned IPO.
Mobile entertainment platform Reel Saga adds $2.1 million to its cart, led by Ficus Capital. Round also saw participation from IT Growth Opportunities Fund, Nazara Tech and several prominent angel investors. Capital will be used to fuel app development.
Karan Bajaj, the founder of White Hat Jr., raises $16 million in a seed round for his new venture that's called Complement One. The round was led by Owl Ventures and Bloom Ventures with participation from other undisclosed investors as well. Now, Complement One is a cancer care startup focusing on personalized lifestyle coaching in the United States.
Dream Sports will invest $50 million in CricBuzz, a platform for live cricket scores and commentary, and will allow TV a broadcast of cricket in North America. The investment will help boost fan engagement, shopping and AI-driven features.
AI infra startup Flam backs $14 million in a Series A round that was led by RTP Global. The funding will be used to expand Flam's operations across North America, Europe and the Middle East. This takes its total funding to $22 million since inception.
Skill gaming firm Gamescraft will pause operations of its online poker platform Pocket 52 on May 30, the latest casualty in India's real money gaming industry, grappling with the impact of the 28% GST regime and a slew to legal challenges. The move was part of a broader plan to reassess the firm's long-term approach to the category. Well, those were the headlines we've been tracking for you this evening on What's Brewing Today. AI infrastructure startup Flam has raised $14 million in its Series A round, led by RTP Global, with participation from Dovetail and other strategic investors. Now, with this capital, Flam aims to accelerate its mission of transforming how consumers engage with ads, retail environments, live broadcasts, and fan moments, all by making content and interfaces more immersive, interactive, and ROI-driven for brands. Joining me now to tell us more about this vision and what lies ahead is Shaurya Agarwal, the co-founder and CEO of Flam. Also with me is my colleague Arundhati. Shaurya, welcome to Startup Street. You claim to have built a full-stack enterprise suite of Gen AI-powered products aimed at reinventing brand audience engagement. Frictionless, appless, mixed reality experiences delivered in under 300 milliseconds. That's incredibly fast. Can you break down the tech infrastructure that makes this possible, and how are you achieving this level of speed and scale?
Hi, Shruti. Definitely. I think I'll quickly break down how this whole thing functions into three things. One is the creation. How do brands create mixed reality content? The second part is publishing, how they can just like upload the assets on the platform, create a link or a QR code which can publish across multiple touch points, whether it's like print or television, retail, digital platforms like WhatsApp. And the third piece is accessibility, which is the AI infra that we talk about. Essentially, we power Flam across 99% devices without any app download, without any web browser requirement. And this happens extremely fast because we render, we basically compress 3D content, heavy GLB files into streamable content, which can be rendered super fast. Even on a low internet, like 4 Mbps, we can render content and like stream content within like 300 milliseconds. So that's the breakdown of the infra for Flam.
All right. Hi, Shaurya. Arundhati just stepping in here. If you could sort of tell us how you're enabling these brands, broadcasters and enterprises to sort of transform any touch point into interactive, measurable and engaging experiences. You know, you have mentioned a Gen AI tool chain powering this. So what does the full stack suite look like and how is it different from other offerings in the market?
See, there is no other offering which is enabling brands to publish mixed reality interactive content on the fly. Now, brands which are using Flam can enable hyper-real mixed reality content across print, across television, across broadcast, across retail through a QR code, through a FLAM QR code, which is like you can just scan it from your native phone camera and the experience just instantly starts to render on your phone. So you don't need any app on your phone. You do not need any special hardware. Literally every single phone camera, whether it's a low-end Android device or like iPhone 16 Pro, across all devices, the phone camera becomes the point of entering into mixed reality. If it is digital platforms, whether it's like app banners or like websites or like Instagram, everywhere we can just enable mixed reality through a link. So you click on the link and you enter into the experience. So for brands, I think this has been a game changer, because if the experience is so seamless and the entry barrier is almost zero, then you can just enable consumers to consume high fidelity 3D content instantly.
Okay. You know, Shaurya, from Google to Tanish to the US presidential elections, you worked with over 100 brands. What are some of the standout campaigns or results that showcase what your platform can deliver? And which sectors or use cases are currently gaining the most traction, you know, retail, live events or broadcast?
I think let me talk about some high quality brands. Like Google, as all of us know, spends like billions of dollars on mixed reality research, and they are like doing incredible work. But like the consumer layer, to actually have some tangible product which can enable end consumer to experience, I think that's what FLAM has developed. So Google 9A, Pixel 9A launch recently was on FLAM. US presidential elections used us extensively across direct mail marketing, television, broadcast, TV. IPL recently leveraged FLAM fandom product, which is one of the most interesting products we have released recently, where anybody, you and I, can just like create amazing content with celebrities, cricketing stars, all of these famous people. So all of these campaigns have been extremely popular. I think there are three critical metrics points which are relevant for brands. One is like high engagement. FLAM is a very high intent product. So when a user enters into the experience, they're spending a lot of time. First of all, a lot of users are entering into the funnel of experiencing content. And then the average watch time is almost 3x more than any kind of ad format today. And obviously all of this leads to high ad recall, virality of the content, and eventually more conversions, more success for the brand. And all of this is sector agnostic, because this is just content, just like brands and enterprises use videos or images as content. Now they are using mixed reality as content, right? So this is like sector agnostic. This is touch point agnostic across retail, live events, broadcast, everywhere this can be leveraged. So there's no specific sector or there's no specific touch point, I should say.
So you're sector agnostic, but you know, you are seeing up to 49 times higher engagement and 4 times better conversations, right? So what is driving this kind of performance? Is it purely the tech, the creative storytelling, or a combination of both?
It's always the combination. I think creative agencies, ad agencies, brands are too good at what they do. They understand how campaigns should be designed. And obviously FLAM Infra offers that creativity, that storytelling skills in the best possible way, because it's so seamless, so easy to publish these campaigns. So it's always a mix of both.
All right, Shaurya, let's now quickly talk about your global ambitions. You know, FLAM is now expanding its global footprint with a strong presence planned across North America, Europe, the Middle East and Asia. What is your go-to-market and localization strategy for such a diverse and complex market?
I think if you see how last 12 months have been for us, we just introduced our product to the market like 12 months back. 100 plus brands have been using FLAM across 10 plus geographies. 580 million plus users have already seen FLAM content across multiple channels. All of this is possible because we are leveraging a lot of our product-led growth. Then we also leverage a lot of channel partnerships, whether it's like publishers, whether it's agencies. For example, in the Middle East market, we closely work with Khalij Times, Dar Al Khalij, Abu Dhabi Media Group. In India, we work with Bennett Coleman, multiple others, but like just giving some names to you. So all of these channel partnerships, distribution-led growth, product-led growth is helping us move fast. I think this is working very well for us, not just in India, but outside of India as well. So we will continue to double down on this strategy.
All right, Shaurya, we're completely out of time on the show, but thank you so much for joining us, and we wish you all the best going forward with this journey.
Thanks for having me on the show.
All right, moving on.
Via, which is an AI-powered astrology startup, has raised $1.5 million in a seed funding round that was co-led by Accel and Arkham Ventures, with participation from Weekend Fund along with contributions from other angel investors. This will primarily be used to expand Via's core team, enhance its AI technology, and build a strong community of Vedic astrology experts. Now, founded earlier this year, Via works with a curated group of astrologers and supports them with an AI engine that decodes complex astrological variables. What does all of this mean? How exactly are they using AI to foretell futures? Well, let's bring in the co-founder of the company, Via, Mahin Puri. Mahin, thank you very much for your time here on CNBC-TV18. Interesting company. Let me just start by asking you, and my colleague Shruti is also joining in, what really sparked the idea to merge AI with Vedic astrology, and how do you ensure that there is credibility in this domain, which is so very personal and belief-led?
Yeah, thanks for having me. So what really excited us about astrology in general is how people from all walks of life in India, that it's the large businessmen or even like small and mom and pop kirana stores, they all sort of depend on astrology as a source of guidance, either through difficult times or to decide in different life events, which is like starting a new business or getting married. So the cultural lens of astrology and the mission of really supporting people through this journey is something that we got super excited about. To answer your question about AI, so AI we use in various ways. So one is, so that if I have to divide astrology into 4 parts, the first part is like chart construction, which the AI does. And the second part is figuring out sort of what aspects or variables to consider within astrology to answer a particular question. So that's where AI is mostly used. The human mind is limited in the number of variables it can consider at a particular point of time. What AI is able to do is guide our astrologers on looking at all the variables at once and picking out the variables we need to focus on while answering different questions. And that is, on top of that, using the human intuition and the experience of the astrologers adds a lot of credibility alongside AI.
All right, Mahin, this is Shruti quickly stepping in. Let's get to the fundraise. How will the $1.5 million in seed funding be allocated across team expansion, AI development, and community building? If you could elaborate on those plans.
Yeah, so the biggest thing that we are focusing on is building the right AI talent to build out our own fine-tuned models that are trained on all of the astrological knowledge and all the books that are used in astrology. And apart from that, we want to build a trusted brand working with all the credible astrologers across the country.
All right. You've been live for a few months now. What does early traction look like in terms of, revenue growth, repeat usage, consumer engagement? And if you could also give us your targets on these, say, over the next 24 months and how big the business can realistically get.
Yeah. So currently we're at around 30 to 40,000 users. Again, very early on. It's just been a couple of months since we've gone live. Interesting sort of frequency of users is like some sort of view it as a source of guidance over the next, let's say, every 3 months. So the frequency is they come on the app every 2 months as a source of guidance on the next few months. And some see it sort of more frequency based as a source of guidance on a weekly basis. So frequency ranges on sort of how users want to use astrology in their sort of day-to-day life. And sort of our goal right now is to basically build a sort of product that consumers love and focus a lot of what we call, our internal net promoter score, which is how much sort of love consumers have for our product.
Okay. Mahin, despite its size, India's spiritual services sector is still largely informal and unstructured. What makes you confident that the Indian consumer, especially the mass premium urban segment, is ready to adopt a tech-first, standardized astrology solution like Via?
Yeah, that's something that we focus a lot internally is we vet our astrologers through sort of an elaborate system of vetting process and only work with a select few instead of a marketplace model. Which ensures that we uphold a standard of quality. So there's this sort of vetting process begins with, just a basic background checks, educational sort of licenses, to even actually conducting deep down interviews and actually having our current expert team take all of those interviews so that the standard of astrological knowledge is met across all of our astrologers. Combined with that, we sort of are working towards building an evaluation system so that our AI engine has sort of almost 100% accuracy rate on getting the right astrological variables to look at. when they analyze different variables.
Okay, Mahin, very briefly, India has always exported these spiritual traditions we have, whether that is Ayurveda or yoga. Do you see Vaya also eventually becoming a global astrology brand? Are you working towards that?
Definitely. I think apart from targeting a mass premium market in India, we're also targeting Indians across the globe. So typically what we've seen is that Indians across the globe, whether they reside in India or not, are deeply rooted to our culture and actually view our culture and sort of miss the cultural ties that they have with the country. So our goal is to build an experience for Indians all across the world, and I'm excited to sort of work on the mission globally.
All right, one final question, Mahin, before I let you go. And if you could quickly answer that, what's your long-term vision for monetization beyond the one-on-one consultations or subscriptions? Are you exploring AI as a service for astrology or B2B integrations?
So just the DNA of the company right now is mostly consumer. So currently we're focused on Vedic astrology, and then we're looking to sort of expand to other areas like Vastu or even palmistry, and sort of cater to different variations of astrology to sort of solve the same problem of guidance. But sort of currently, as of now, we're only sticking to astrology.
All right, Mahin, we've run out of time, but thank you very much, for joining us here on Startup Street today. Thank you.
Thank you so much.
On that note, it is time for us to head into a short break. But coming up next, fuel tech startup Naugati secures $2.5 million in a pre-Series A round. We put its co-founder on the hot seat to find out the company's fund allocation strategy, expansion plans, and a whole lot more. Stay tuned. Welcome back. You're still with us on Startup Street. Fuel tech startup Naugati has just raised $2.5 million in a pre-Series A round led by marquee investor Ajay Upadhyaya, with participation from industry veterans and institutional backers. With plans to go global and deepen its footprint in India, Naugati is looking to revolutionize how fuel stations and fleets operate. From real-time visibility to smarter resource management, the company is betting big on tech to transform the fueling experience. Joining us now to discuss this further is Vaibhav Kaushik, the co-founder of Naugati, as well as my colleague Ritu. Vaibhav, thank you so much for taking time out and being here with us on Startup Street. You know, fuel and fleet tech is a relatively untapped space, right? So what are the biggest inefficiencies that you're addressing? If you could sort of take us through what's on offer.
So, thank you for having me here. Second, time I'm here on Startup Street. So, in terms of fueling and fleet, the main focus has always been on the transparency. So, for CNG particularly, the problem that fleet operators primarily face is that they don't have any visibility in terms of what amount of fuel was actually dispensed into the vehicle. So this is where Naugati comes in by providing that visibility, that transparency to the fleet operators, that if you're paying, say, 1,000 rupees, those 1,000 rupees are actually being attributed to the fuel at the fuel station.
All right. Hi, this is Ritu stepping in. You also have this platform that connects fuel stations, fleet operators, and consumers. What have been some of the biggest technical or operational challenges you've seen in building this kind of an ecosystem? And, what sort of improvements are you bringing about therefore?
Right. So we have two primary offerings. One of them is the Aaveg B2B vertical SaaS offering, right? That is sort of a digital supervisor for all the fleet, for the fuel stations, right? Then we have a Navgati fueling app that is being used by the end consumers to navigate to a station on their route, right? So the entire ecosystem is Aaveg on one side, where the fuel station data is monitored in real time using the existing assets, be it the dispensers, compressors, CCTV cameras at the fuel stations. And then the Navgati app acts as like a discovery platform, engagement platform for the end consumer as well as the fleet users. So drivers can actually use the app to navigate to a station on their route, see what all loyalty programs are available. Like the example is Mahanagar Gas's MGL CNG Mahotsav, right? That is run by Navgati's fleet program. So what happens is that if you buy a new bus or truck, right, you get some MGL coins. Those can be redeemed by an MGL card. So you can use Navgati app, you go to the outlet and then you transact. So you can actually transact using coins instead of actually paying when you're actually transacting. So that is the entire loyalty program that has been built by Navgati.
Right. And you've raised $2.5 million in this round, right? How do you plan to strategically sort of allocate these funds in a bid to accelerate growth?
Right. So Navgati is primarily operational in the Delhi and the Bombay region, right? So the objective is to scale the offering pan-India, as well as to explore other countries in Southeast Asia. We have, we'll be announcing our launch in the Southeast Asian countries by next quarter. And we also have inbounds from African nations. But the only challenge here, that is that for most countries, when you switch continents, you switch countries, the context has to be switched. So the problem statement will have to be tweaked because at fuel pumps, congestion might not be the most prevalent pain point for a country or a fuel station in, say, Middle East, right? As opposed to a fuel station in Delhi, which is actually struggling with congestion. So our focus is to enter countries that have a similar demography as in India, high population density, high vehicle density, and then enter into countries where we can focus more on the compliance as well as the loyalty aspect going forward. Right?
All right. Your fleet offering is also already live with Mahanagar Gas, as we understand. How do you plan to scale this with other major fuel companies? Are you already in talks with some?
Right. So almost every gas company in the country wants to use our sort of plug-and-play fleet platform, right? So Navgati's fleet platform can be customized to the company's loyalty program. So for MGL, it is MGL coins, right? For other companies, it will be customized to have sort of their branding on, say, the card as well as the virtual card program, coin program. So every other gas company in the country has reached out to us to demonstrate it for certain geographical areas of theirs, and then scale it pan-India to wherever their fuel stations are. So you'll see the fleet program live for most gas companies by end of this year.
All right. And, if we could talk numbers, can you take us through the revenue streams and what you're currently clocking, and where do you hope to end this year? What's the 18 to 24-month growth outlook for you?
So, Navgati primarily charges a subscription fee for the Aaveg subscription, right? For the fleet program, it is more of a transaction fee based model, right? And we're doing about $1.5 million in annual recurring revenue. And the objective is to scale it to about $35 million in the next 2 to 3 years.
All right. Vaibhav, thank you so much for taking time out and being here with us on Startup Street. We wish you all the best on your journey, and we'll talk to you soon.
Moving on, also in what's brewing, quick commerce platform Zepto has announced that it will launch Zepto Atom, a data analytics subscription platform for brands. It will offer real-time, minute-by-minute insights on sales, customer impressions, and more. The feature is set to go live on May 16. My colleague Shilpa Ranipeta caught up with Adit Palicha, co-founder of Zepto, to talk about this new offering and how it is different from a Kantar or Nielsen. Take a look.
Yeah, so we've just launched Zepto Atom today. It's a new product, which is essentially a advanced data analytics tool and a subscription for all the brands that are listed on Zepto. What it is giving brands is pretty pretty next level insights into sort of their performance on the platform and in general across geographies, right? So for example, on Zepto Atom, you can look at your, pin code by pin code performance. You can see a full map across the country. Every city you can double click on. You can look at each neighborhood, see where am I over indexed, where am I under indexed, where do I need to double down on distribution or pricing or marketing. And the idea is to create a tech powered, tool that can hopefully disrupt the consumer analytics industry in India, which is over 1,000 crore. And I'm also able to do it, or like in an automated fashion, which means I can provide these insights much cheaper than, let's say, doing, paying consultants to give me sort of manual data insights that, usually candidly charge a bomb.
So is it live? And quickly tell us, like, have you already onboarded brands here?
On Friday, we're doing a full launch of Zepto Atom on a webinar where we're going to announce, all the new features in detail, and we're also going to, announce the pricing as well. And so Friday, it's going to go live to all brands, and it's already been in pilot for the past few weeks or so. I mean, looking at sort of the early results, I mean, I think we could easily touch 1,000 brands on board within the first few weeks or so.
How significant do you see Atom being a revenue stream for you? It also comes at a time when you are also doubling down on profitability, right? So just help us understand, how do you see this contributing to your top line and bottom line, and how significant is this piece?
Yeah, absolutely. Look, I think from our lens, there are multiple, highly profitable revenue streams in this business, like advertising revenue, for example, which is, doing now, 130 plus crores a month of ad revenue, right? And we've, scaled it to, 200 million ARR, right? We've got, this, data, monetizing the data stack as well, which is what we're doing here. Like I mentioned, we literally generate, north of 10 million data points every single day through our data pipelines that we've built out here in Bangalore in Zepto, right? And those 10 million data points per day, there's so much richness there that I have a huge advantage to be able to monetize that. So, this is the second phase, right? Which is, can we use our data to provide value to brands? I think it can be a meaningful revenue stream. Can't really comment on the specifics, but, definitely tens of crores per quarter, additional to bottom line. But of course, there are multiple other key initiatives that we have, like Super Saver and assortment expansion that have really meaningfully added to bottom line year on year, which is why we're expecting, pretty surprising profitability results, at least for most of your viewers in the very short term.
Adit, since we have you here, I have to ask you about the recent news around funding. CNBC-TV18 also had reported that both Motilal Oswal and Ramdev Agarwal are looking at investing about $50 million each in personal capacity into Zepto as part of a secondary round where you are looking at shoring up domestic ownership. So can you please confirm this to us?
So Shilpa, I'm not surprised you're asking questions related to, capital markets on CNBC, but frankly, I'm not in a position to be able to comment on that or just generally fundraising news. Right now I feel that the company's in a pretty good position. We've just grown close to 300% year on year. We were close to 1 billion of annualized GOV last year. Now we're close to 4 billion 12 months later. So we've grown 300% year on year. What I can tell you is that, we gave a public commitment that, let's say, by end of this financial year, we will have, proven, EBITDA positivity, right? I think we're on track to do or beat that. And so I can tell you that the company's in a very good place. We don't need to raise, any primary capital, and, any transaction that we're contemplating is, purely for the purpose of trying to sort of increase domestic ownership.
And with that, it is a wrap on this edition of Startup Street from Shruti, Ritu and me. Goodbye and many thanks for watching. More news and updates coming up on the other side.
Celebrating the 80th anniversary of its founding as the NASDAQ HashDex Asset Management, celebrating the launch of the HashDex.
The Gates Foundation, one of the largest charitable foundations in the world, is marking its 25th anniversary. Now, the Silver Jubilee comes with a big commitment. Bill Gates is pledging to give away, in his words, virtually all of his wealth over the next 20 years, which means the foundation plans to spend $200 billion over the next 2 decades. Now, this accelerated timeline has meant a change to the foundation's charter, which had stated that the organization would sunset 20 years after the death of Bill Gates. The last big change to the foundation had come in 2021, when Bill and Melinda Gates announced their divorce. Melinda Gates resigned as co-chair in 2024, which left Bill Gates as the sole chairman of the Gates Foundation. Now, from combating infectious diseases to agriculture research and reproductive health, the Gates Foundation has been at the forefront of solving some of the biggest issues in the world today. And joining me now to discuss the foundation's future and his pledge to give away virtually all of his wealth is the man himself, Bill Gates. Bill, many thanks for joining us on CNBC-TV18. And let me start by congratulating you on 25 years at the Gates Foundation. But Bill, why this decision to set yourself a new deadline of 20 years to give away virtually all of your wealth? What has prompted this decision? Why this change from the original position?
Well, looking back on these 25 years, it's amazing what we've been able to accomplish. You know, together with partners, the one statistic of cutting the number of children who die every year in half has been phenomenal to be part of that. And so as I was thinking about that, I decided that we should essentially double down and spend all the rest of the money I'm lucky enough to have through the foundation on these causes over the next 20 years. And that'll allow us to be very aggressive, make some fantastic progress, and, we'll have real clarity. A lot of resources for 20 years, and then others can step in with whatever we haven't been able to finish off.
If I may, Bill, is this decision to accelerate or speed up the giving that you're doing linked to the overall environment that we're currently seeing, where there is a retreat from multilateral institutions, from multilateral arrangements, from development aid? How much of this acceleration perhaps is also linked to the change in the environment as we see it today?
Now, this decision was made before all of these reductions were clear to us. I would say in the short run, it means the work we do is going to be challenged. Although I expect every year we'll have progress in India and some of the countries we work in. In Africa right now, these cuts to the aid budgets, the debt situation, some of the instability means the next 4 or 5 years will be difficult. But over the time period that all my money will be given, I still expect to see pretty incredible progress. So in the short run, I am very disappointed that aid generosity is down. But with the innovations in the pipeline, with, I think, going to people and saying that those aid budgets should come back to some degree, I'm, super excited about what we can achieve in these next 20 years.
Bill, you talked about doubling down on the significant resources that you've already committed. $100 billion was the previous amount that you did over the last 25 years in spending. You're doubling down on that, $200 billion between now and 2045. So help me understand, these are big numbers. Prioritize for me how you intend to use this money and what are you hoping to achieve in terms of impact?
Well, the first 25 years, we got child-to deaths down from 10 million to under 5 million a year. And we also took the 2 other diseases, HIV and tuberculosis, and the deaths were cut substantially for both of those. We also came up with ways to save mothers who are giving birth. And so we're really putting most of the resources into the global health work. We hope to be able to cut the number of children who die more than in half again. and also to make dramatic reductions in all infectious disease. We need to finish our polio eradication. Still a lot of hard work left there. And we also think some other eradications, guinea worm, malaria, a number of diseases could be taken all the way to zero. And so by having, for the next 20 years, over 200 billion in resources, double what we spent in the first 25 years, we'll be able to partner with scientists, and we have a great partnership with the Indian government to help them achieve their ambitious health goals. And this field, the field of global health, will be able to perform miracles, and our resources will be a meaningful part of that.
You know, Bill, you spoke about the ability to deliver miracles. What have been some of the hardest fought battles over the last 25 years? You talked about some of the important outcomes, especially on the global health front, that you've been able to achieve. What's been the hardest part of making those a reality? Resource is one thing. Execution is another thing altogether. What's been the tough part on the execution front?
Yeah, so for the foundation, we both work on the R&D side, so like creating new vaccines. And so, with Serum, a great Indian partner, a meningitis vaccine was one of the first new ones the foundation did. Later, a rotavirus vaccine that was very low cost, a pneumococcus vaccine. Then with other partners. Vaccine work, both in the R&D and the delivery, is probably at the top of the list of the impact that we've had. Vaccines, you need to keep them refrigerated, you need to make them cheaper, you need to convince mothers to bring their children in. So, there are plenty of challenges just in that one area.
Bill, you talk about India. Now, you've been spending a fair amount of your time here in India. And of course, the foundation has been working in India for a good part of the last 25 years. Let me ask you about what excites you about what's happening in India today. How important is India going to be for the Gates Foundation over the next 20 years?
Well, certainly India's a very, very important place for us. It's our biggest overseas office, and it plays two big roles. One is that the Indian government has very aggressive goals for improving health, and so we get to partner and try out the latest advances in medicine, and that we've seen great results from that. But the actual creation, the R&D of the new tools, whether it's diagnostics, vaccines, drugs, new seeds to help farmers, or ways of taking AI and helping with health and agriculture as well as education. India is going to be a place where there's so many smart people, so much desire to see these improvements that will pioneer a lot of things first in India, and the brilliant work there will then benefit the entire world. Paradigmatic of that is the work in digital finance, where Aadhaar and the ability to pay digitally, India really did an amazing job on that, and now we work with the Indian government to make that available to all countries.
But Bill, you've been spending more and more time here in India and doing lots of fun, interesting things, not just linked to the foundation, but even outside of the work that the foundation is doing. What about being in India, about making the connections here in India, the people that you're spending your time with inspire you today? I mean, is this a new romance with India that started over the last few years?
No, I've always been fascinated by India, and of course Microsoft has had a fantastic relationship in terms of the huge development offices that we have in India, as well as amazing people like Satya Nadella that have come and made huge contributions to the company. And so as I moved from Microsoft to the foundation, I took that understanding of the great talent that's there with me. And so, I get to India on a regular basis and get to meet with the partners there. the majority of the world's vaccines by volume are made in India. We've had, so many important partnerships with that, and that's really growing. The quality of research in India, its desire to go even beyond vaccines with the tools that are provided, it's very timely. And, part of that is Prime Minister Modi's been very generous at sharing with me his goals, and so we can talk about how the foundation helps with that.
Bill, you've referenced vaccines, and I want to ask you this in the context of the last conversation you and I had, which was in September in New York last year. Now, there you had talked about being a salesman for Gavi, the Global Vaccine Alliance, in its quest to raise funds. You've been central to Gavi's ambition and aspiration of providing affordable vaccines to the world. At this juncture, with the very real possibility of funding drying up, specifically from the US, how concerned would you be about Gavi's future?
Well, I'm very, very concerned. It would be tragic if Gavi weren't able to raise as much or more money for this next 5 years as it's had for the last 5 years. And yet, it's pretty clear that we're going to see a reduction. I continue to talk to all the governments about the impact. There's nothing more amazing than making sure all the children of the world have these miraculous vaccines. So we'll see what we're able to raise, but it's looking tough. I'd say the next 5 years, the whole aid picture, whether it's Gavi or Global Fund, are going to mean that we might go backwards a little bit before we resume the progress we've seen since the turn of the century. And that's just a mistake, and I'll be speaking out very loudly, try to get the U.S. back in, try to get others to maintain or even increase, in some cases, their giving.
But do you feel confident or optimistic about that? You said you're going to try and draw people back to the table. But at this point, with the global retreat that we are seeing, especially from development goals, Bill, how much of a slide back do you believe we should be prepared for? Are we set for?
Well, we have two forces. One is the power of innovation, that is new tools, whether that's new drugs, new vaccines. We have AI to even help with the delivery, to talk to patients and give them advice about care seeking, things like the ultrasound that'll help figure out about the whether a pregnancy needs special care. So the innovation side is, if anything, going faster than ever. The generosity on resources for the delivery side, the next 5 years are going to be tough. And that might mean some of our statistics that have been improving, we might have a period where they'll get somewhat worse, particularly in Africa. And that's tragic. That shouldn't happen. If you look at the full time frame that all my money will be given over, I'd say we will be much better off by the end of that than we are right now, despite this period where the aid budgets are really going to hurt our work, particularly, as you said, things like Gavi and Global Fund not being fully funded.
Well, we are going to head into a break and continue our conversation with Bill Gates on his big pledge to spend $200 billion as part of the Gates Foundation over the next 20 years. Welcome back. You're watching the CNBC-TV18 exclusive. We're in conversation with Bill Gates on the big pledge of accelerating the spending being done by the Gates Foundation, $200 billion over the next 20 years. Bill, the last 25 years, the Gates Foundation has worked very closely with Warren Buffett. He's been instrumental in the $100 billion that you've spent in the journey so far. Is there a disappointment that he isn't going to be a co-traveler, a fellow traveler over the next 20 years for you at the foundation?
Well, I'll certainly be very sad not to have Warren's regular advice. I mean, Warren is so wise, so generous. He's been a great friend to me. His example as a philanthropist, I think, has influenced many people besides myself. As you say, he's a huge contributor to the foundation. His family is very committed to the causes the Gates Foundation works on, and so they'll continue to be, his children will be great partners of ours in many of these areas. But no, it'll be tragic if Warren's not around. He's 94. I hope he lives this whole 20 years, but he might not.
Well, speaking of milestones, it's 25 for the Gates Foundation, it's 50 for Microsoft, and it will soon be 70 for you in October. As you look back and reflect on the many milestones that you've achieved personally and in your careers, if you had a chance of a do-over, would there be anything that you'd change, anything that you'd do differently?
Well, I'd be very reluctant to go back and change things since I've been so unbelievably lucky. My parents, who I got all my values from, and they made sure I got a great education. I've had amazing friends like Paul Allen, who helped found Microsoft, Steve Ballmer, who allowed Microsoft to be so successful, and now an unbelievable number of great partnerships at the foundation with the incredible team there, and partners all over the world. So I'm the luckiest person in terms of what I've been able to be involved in. So yeah, I've made plenty of things that I've had to learn and do better, but I don't think I'd want to risk going back and making any changes.
Well, speaking of wanting to do better, you're no stranger to criticism, and it's been constant, but perhaps post-COVID even more so. Questions about the influence that organizations like yours build on decisions that have been taken. Many call it the tyranny of the unelected. How do you now respond to that criticism, Bill, and how do you believe the foundation should learn and position itself over the next 20 years to take some of that feedback and criticism on board in some constructive way?
Well, I think the agenda of saving children's lives, and making sure they're well nourished so that their brains and bodies fully develop, fortunately, that's not a super controversial agenda. All the governments we work with, including India, have goals to reduce those deaths, and so we're able to work together. Vaccines themselves, we test them to make sure they're incredibly safe, and so there is some controversy about those. But for example, with polio, there's not a single kid in India who's been paralyzed since 2011, when the final case, which was tragic, was taken care of, and so we get pretty strong support for the work we're doing. Sometimes seed technologies or contraception, we have to make sure we're communicating well about those things. I wish there were more people involved in, critiquing what we're doing in malaria and TB and HIV. Some of the work we do can actually be pretty lonely because it doesn't get the attention, the resources or the number of people engaged. So, I'd love somebody to criticize our TB drugs or vaccines or diagnostics and, share their ideas, because TB is back to being the world's biggest killer, and there's just so few people funding the work there that we wish there were more.
You talked about TB, malaria, and you're hoping that we see breakthroughs on both those fronts. But outside of health, the innovations on energy, the R&D work that's happening on Alzheimer's, I know that there's been a large part of your mind space and as well as your resources that have occupied these areas in the last few years. What are you most optimistic about, both on energy, specifically nuclear energy, and the work that's happening on things like Alzheimer's, the tuberculosis vaccine, etc.?
Well, if I had to pick one, I'd say, getting to the bottom of malnutrition and really solving that might get to the top of the list. It's a tough competition because we've got a HIV vaccine, a TB vaccine that you mentioned, a malaria vaccine, all very important. I also support new energy innovation. I do that through for-profit investments, including, for example, TerraPower, that's working on new lower-cost nuclear reactors. And so climate change, avoiding the worst of that and getting cheaper energy is important. But I'd say the malnutrition would be at the top of the list.
Well, it's clear that you're definitely not retiring anytime soon, Bill. What keeps you going? I know pickleball is definitely not going to be something that's going to occupy a lot of your time outside of the foundation's work. But what keeps Bill Gates going today?
Well, I'm very lucky. I love reading. I love, traveling. I have great sisters and friends, and I love tracking the innovation. Meeting people who are out in the field doing the tough work. So it's fascinating. And, even though we'll have setbacks overall, the possibility of what we can achieve in these next 20 years keeps me going, makes me want to travel and work hard.
And the possibilities that you alluded to, what we're seeing on the AI front at this point in time. But for AI to really address the world's real challenges, healthcare, finding solutions to the many access deficits that exist. What are we talking about? Are we 5-10 years out before we start to see an inflection point on some of these big, real transformational challenges?
Well, there's no doubt in the next 5 years it'll be pretty radical, both in terms of how we discover new things, where the AI will help, and even healthcare delivery, where the patient will be able to talk with the AI and share everything that's going on with them and how they should interact with the health system. And so, no, that's near term. We have a lot of partners who are doing pilots even this next year.
Well, you've been part of the private sector and, of course, then moved to the development world. If I were to ask you for your message to the private sector in the current volatile environment that we're in, to other philanthropic organizations as well, organizations that you're perhaps partnering with or you're hoping to partner with in the future, what would your message be to them? What would your message be to governments today? You said you want to ensure that your voice is heard. What would you tell governments around the world today as we perhaps face what could loosely be called a leadership recession?
Well, the value of helping other people is pretty strong in all the world's religions. And so, that should extend to the poorest, those most in need. And so the idea that we're having less money to buy vaccines for the world's children is a bit of a surprise. And my advice is, hey, let's reverse that and accelerate the progress we've seen, which, we should all be so proud of.
Well, Bill, with that, thanks very much for joining us here on the Global Dialogue today. Thanks very much for giving us a roadmap of where the Gates Foundation is headed. It's going to be an accelerated timeline for you to spend $200 billion over the next 20 years. It's a significant amount of money and, of course, a big change as far as the foundation's charter is concerned. Bill Gates, always a pleasure. Many thanks for joining us here. We will take a break. There's a lot more coming up. Don't go anywhere. We're back in a moment with more.
Welcome to a special edition of Newsmakers. The biggest news in the market, other than, of course, the big political news, is SMBC buying a 20% stake in Yes Bank. This means a seminal change for the bank itself. 5 years ago, it was in trouble. Now it looks like the SBI prop is no longer needed. The bank can stand on its own feet and someone is willing to buy it for capital investment. But what other advantages accrue to Yes Bank because of this relationship with a very big global bank, Japanese bank, SMBC? To answer all those questions, I have with me the Managing Director and CEO of Yes Bank, Prashant Kumar. Good morning, Mr. Kumar, and thank you very much for your time. Congratulations first. This is a seminal change for the bank itself.
No, thank you so much. I think it's a very, very significant transaction in the transformation journey of Yes Bank.
First, if you can tell me, when does it get completed? Because I'm still seeing Sumitomo Bank to buy a 20% stake. When do we say they are holding a 20% stake?
So now it would require the approvals from Reserve Bank of India and Competition Commission of India. And we are hopeful that the whole transaction would be completed in the second quarter of this financial year.
Okay, so we understand that at that time, the Japanese bank will be able to appoint 2 directors on the Yes Bank board. Now tell me the journey from there. How does life change for you? Are you, how will you liaise? Will they give you more trading partners? Will they give you MNC clients? What will they give you?
I think the first important thing, there has been a overhang on the bank where the question was that SBI being 24% equity holder cannot continue for a long time. It means we need to have a strategic partner. And that was very critical for us. I think the SMBC, who are the second largest financial banking group in Japan and 15th largest in the world. And they are known for their corporate governance, reputation. They coming and investing into Yes Bank at 20%. That is also a confidence.
Yes.
That is a confidence in the franchise. That is one thing. Second thing, they are, as a strategic investor, always a very long-term investment. Unlike private equities, where always there is a short-term objective, it's a long-term investment strategy. So this investment would definitely build this franchise for future. So we are quite hopeful.
Cyril Amarchand Mangaldas presents CNBC-TV18, The Thought League Season 3.
Hello and welcome to a brand new season of Cyril Amarchand Mangaldas presents CNBC-TV18, The Thought League, a platform where business leaders legal minds, policymakers, and global visionaries come together to ignite the next wave of transformation. This year is particularly special. It marks 10 years of Cyril Amarchand Mangaldas, a decade of redefining excellence, driving innovation, and staying ahead of the curve. And what better way to begin this landmark season than with two of the most distinguished figures in the world of law and governance. Joining us today is none other than Honorable Justice Dhananjay Y. Chandrachud, former Chief Justice of India, a jurist whose visionary leadership continues to shape Indian law, society, and constitutional thought. Known for his progressive judgments and deep commitment to constitutional values, Honorable Justice Chandrachud has been at the forefront of judicial reforms and technological innovation in the judiciary. We're also privileged to be joined by Cyril Shroff, Managing Partner of Cyril Amarchand Mangaldas, whose leadership and pioneering approach have helped redefine the future of legal profession in India. In this inaugural episode, we'll explore how the judiciary can empower India's journey to becoming at least a $30 trillion economy, but optimistically a $50 trillion economy by 2047. Gentlemen, thanks both of you for joining us here on the program. Justice Chandrachud, if I can start with you, sir. What can courts do? What can the judiciary do so that we are on track to, as I said, get to at least $30 trillion of GDP by 2047, which will require about 8% compounded growth? And of course, on the optimistic side, I mean, do double-digit growth, sir. Go on.
Business to flourish requires certainty in the legal system, in legal institutions. It requires the application of objective standards, and it requires efficient decision-making. The courts, in that sense, are the institution, particularly in a democracy, which hold this balance and ensure that in the process of governance, all stakeholders follow rules of the game which are clearly defined, where rights are preserved, and where there is efficient decision-making, efficient in terms of timeliness, in terms of outcomes. So courts are a vital stakeholder and a vital pillar in promoting, economic growth and ensuring development in a country like ours.
Mr. Shroff, opening thoughts, sir?
Absolutely. I sort of concur with what Justice Chandrachud has said. And I'd also like to add that it's not just the rule of law, but it's also the role of law as well. I think it's very important that rights are protected. I think private capital comes in and businesses thrive and infrastructure is built and a society takes foundation when rights are protected. Whether they are constitutional rights or whether they are civil rights or corporate rights or private property rights. This is very fundamental to attract capital both from India as well as globally. In fact, in last year, the Nobel laureates in economics, Darren Acemoglu and Simon Johnson, won their prize for essentially expounding a theory that political governments which extend political liberties and property and protect property rights as broadly as possible are the ones that lead to stable economic growth. So protection of rights, and I think it's judiciary alone which can do that, is very fundamental to growth. And I personally also believe that the rule of law is a fundamental infrastructure of the country. We should not think of infrastructure only as roads, ports, airports, and things like that. That's the hard infrastructure. But the more important infrastructure is the legal infrastructure, and particularly the rule of law. And that is where I think the role of law plays a very important role in private capital formation. And we've seen that, even in how India's economic trajectory has been, that its private capital has formed when policies are clear, law is properly enforced, and the judiciary is working.
Justice Chandrachud, predictability is a big thing for private capital, for businesses. What can the judiciary do to sort of, ensure predictability for economic actors in the system?
For one thing, predictability really is something which is intrinsic to judicial functioning, because courts develop the law on the basis of precedent. they apply the law in incremental stages. So predictability of outcomes in that sense, if properly monitored by the judiciary, is something which is a natural consequence of the way courts and judges function. But predictability can be achieved by having domain experts who know what the area of dispute resolution is that they are resolving. So, for instance, if you have a dispute under the competition law, predictability will also be a function of having the right kind of person decide these cases. Or, for instance, arbitration law or electricity law or the insolvency and bankruptcy code. What has happened in India, especially after 1990s and particularly in the last decade now, is that we have a whole host of laws which have been brought in the area of economic governance. And in order to ensure that we have predictability of decision making, we have to be very clear that the decision makers within the judiciary are A, properly trained, two, that they are able to understand the position of that particular case in the wider context of what's good for business and the nation. So at some point of time, the court must not only focus on the facts or the nitty-gritties of the case, but also the impact of that decision on the wider economic structure of the nation. And I think creating the sense of predictability is crucial because imagine a system which is uncertain. Why would someone come and invest capital if there is uncertainty about the fact that a dispute might go either way in a court? There has to be some degree of confidence that this particular legal system applies consistent yardsticks. These are settled principles of law. So, though it might sound a little boring, frankly, that sense of boredom is key to predictability, of not doing something which is radical or excessively innovative, but developing over the building blocks which have been laid down for us in the past, and then adapting them to the needs of the modern economy.
Could you give us a sense for the uninitiated viewer, do we have sort of, in a way, business courts which look at businesses in particular? Do we have, domain expertise existing right now or not really? And why has this not happened as of now?
Parliament enacted the Commercial Courts Act, and that was a welcome step because the purpose of enacting the Commercial Courts Act was to create commercial courts and commercial divisions which would be equipped to deal with commercial disputes. Now, having said that, what has happened really is this, that because of the heavy burden on courts, you will have a court which deals with a multiple array of disputes. So very often, for instance, take the case of a high court. The same court may be called upon to decide disputes relating to service cases or criminal cases, or for that matter, then commercial cases. I think that is not good for the system. What we need to ensure and what we must do is to create this pool of people who are truly qualified and trained in that particular field of the law, because the law is becoming increasingly more specialized. Now, having said that, it's easier, to postulate it than to achieve it, for the simple reason that there's a dearth of infrastructure. The judge-to-population ratio in India has to be substantially increased. But on an informal basis, at least, particularly in the commercial courts, there are courts in India like the Delhi High Court, the Bombay High Court, Bangalore, Kolkata, the Madras High Court, and a few other courts as well, which are dealing with the Gujarat High Court, which are dealing with a lot of commercial disputes. Now, within the court, there are obviously commercial specializations. And the Chief Justices, when they design the roster of work, bear this in mind so that cases of that particular genre should be assigned to judges who are truly qualified and have domain experience in resolving those cases.
Very helpful, Mr. Shroff. You represent some of the biggest corporations in the country, you and your firm. Give us your perspective on this issue, sir.
So I agree with what Justice Chandrachud said, that in theory, it's a good idea about having specialized courts, and commercial court is one example. But the reality is that because of the sheer volume of cases and the burden on courts, that principle is not strictly applied. There is another aspect which I'd like to add, and which is probably not worked out the way it was intended, which is the tribunalization of justice. So one of the features that we have seen over the last few decades is that whenever there is a special topic which requires deep expertise, that we tribunalize. We take it out of the court system and send it to specialized tribunal. It initially started with taxation as well, which I think kind of worked well for some time. But now there are many topics which go to specialized tribunals. And it's an open question as to whether that has worked well or not, because these tribunals do not have the trappings of a court. And therefore, the look feel of a court and the rigor that courts follow is absent. And not often the members are lawyers or judicially trained. So you very often have a judicial member sitting with a technical member as well. And somewhere the kind of rigor that you expect from a proper court is compromised as well. So that's one approach that the country has taken, and maybe we didn't have a choice because of the sheer volume of cases. Now, whether it is, for example, the IPC, or whether it's competition cases or appellate cases of competition, or whether we have environmental cases, securities law cases as well. So these are the principle of specialization has been dealt with by tribunalization, but it hasn't always worked the way it was intended.
Very, very interesting points there by both of you. Let's take a quick commercial break here. We'll continue this very interesting conversation on the other side.
Cyril Amarchand Mangaldas presents CNBC-TV18, The Thought League Season 3, A Glorious Decade, A Century of Service. Cyril Amarchand Mangaldas presents CNBC-TV18, The Thought League Season 3, A Glorious Decade, A Century of Service.
Welcome back to Cyril Amarchand Mangaldas presents CNBC-TV18, The Thought League. We're in conversation with Justice D.Y. Chandrachud and Mr. Cyril Shroff. Gentlemen, thanks very much for waiting. Justice Chandrachud, now I'm getting into the domain of reform, right? Judicial and legal reform in that sense. Economic impact assessment. I mean, the building receiving capacity, assessing impact, I think you alluded to the latter part in a brief bit, but if you can just explain to our viewers how that is very, very important.
I'll give you a very simple case. Section 138 of the Negotiable Instruments Act, has been brought into force by Parliament. And the object was to ensure that monies of creditors are realized expeditiously when checks are dishonored. So what was essentially a civil wrong, namely the failure to pay a debt, has now been converted into a criminal offense. Now, what has happened as a result of this is that there has been an upsurge in the filing of criminal complaints under Section 138 of the Negotiable Instruments Act. The magistrates have to follow the procedure of a criminal court. They have to go through all the rigors of, a normal proceeding in the criminal court, subject to certain exceptions, of course, which are laid down in the Act, which I need not go into at this stage. But what happens, therefore, is this, that if an economic and social audit of the legislation is not carried out before the law is enacted, we have a great law in place, but we don't have the infrastructure to deal with the kind of litigation which will result as a consequence of the law. And it's important that we do this economic audit going forward, because that's the only way in which we can assess, when I say we, that Parliament and the state legislatures can assess whether the judiciary is actually future ready to handle these kind of laws which are now being enacted and which are the need of the hour in the area of economic regulatory governance.
Let's move on to another topic now, and this is the use of technology to make justice more available, accessible. And Justice Chandrachud, you kind of spearheaded this during your time as the Chief Justice. Where are we in that process? There are still significant gaps. I mean, I think there are, again, institutional gaps in terms of funding. It is uneven application of technology. How much of it is available in what parts of the country? Take us through the situation as it stands right now.
Well, I must tell you that there's no dearth of funding insofar as technology is concerned. I was chairing the E-Committee of the Supreme Court since 2019. And my experience was this, that the progress which we have achieved in India is perhaps unheralded in any part of the world, including developed countries. I'll just give you some examples. We introduced live streaming of court proceedings so that any citizen staying in any remote part of the country can access what is happening in their case, whether it's before the High Court or before the Supreme Court. We've introduced digitization of case files, as a result of which the reliance on paper has been completely done away with. We have a comprehensive national judicial data grid, which is a repository of all cases decided and pending in the Indian judicial system. So at a glance, we have information management which is available across the board. These are just some of the initiatives. In the Supreme Court, we adopted some other initiatives like live transcription of proceedings. I ran a completely virtual court, a paperless court, not just a virtual court, but a paperless court. The idea really of this is that justice is a service. When we were operating in colonial times prior to independence, justice was regarded as a sovereign function. And a very distinguished writer on the subject, Professor Richard Susskind, says that justice is in that sense a service. And the way we have really adapted technology in India, including by the use of artificial intelligence, is that we as courts must reach out to citizens. So all in all, actually, there's been no dearth of funds. I must tell you that. Phase 3 of the e-courts project, which was approved last year by the government